Of the United States. I believe Zelensky, Mertz, and Keir Starmer, of course, all meeting here in London today.
The coalition of the willing. We're going to talk to Saab CEO a little bit later on. We'll get the update on the defence picture here in Europe from him. Right, let's get an update on what's happening with these markets. Here we go. Friday's session is open. Let's show you what the numbers look like. The FTSE 100. It's going to be interesting to see how NatWest trades through. Keep an eye on chip stocks as well. I just want to flag that one too as being a factor for these markets this morning post Intel, though it wasn't a great day for European chip stocks yesterday. Some of the names that we follow under a little bit of pressure. So the IBEX is up by 0.2%. The FTSE is fairly flat. It's been a choppy week, obviously, for the gold miners, which is another factor you need to fold into the FTSE. It is now up by 0.2% as some of these stocks begin to kind of get going. I think we're going to have to wait maybe for the DAX this morning, but the CAC is already up by 4.5%. Val, what do you got?
Look, when it comes to the sector's picture, technology jumping out as the best performing sector so far. We have ASML, biggest points gainer, up 1.25%. So the maybe positive read through from those Intel earnings last night. They did give quite a rosy forecast, and we're seeing a read through into European tech this morning. It was also quite an interesting session and a good session for Asia tech as well. So that move seems to have gone global. The rest of the sectors, we do have a few at the bottom of the basket in the red. Basic resources is one of them that comes after yesterday. We had such a huge jump in oil prices, so maybe giving some of those gains back. We also have consumer products and utilities at the bottom.
There's lots of individual movers we want to keep our eye on, though. You mentioned some of the tech stocks. Sanofi, of course, having a fantastic morning, higher by 4% and climbing as we speak. We should mention Accor as well. This is, of course, the hotels and hospitality firm. They announced a buyback this morning, so they're seeing quite a bit of love as well. But some of the outperformers, especially in luxury from this week, they're actually underperforming today.
Yeah, Kering's definitely fading, isn't it? So it's had a massive move. Unsurprising, I think there was a bit of a short squeeze maybe in yesterday's positioning. It rallied quite strongly. I think despite the fact that it's hit a series of 52-week highs recently, I think the market has been still unconvinced. Yesterday we saw, obviously, it moved sharply higher. I think you're just fading a little bit of that move as well in terms of the market move that we're seeing this morning. You're also seeing some of the energy names coming off the boil a little bit. Big moves there yesterday. But ASML, Sanofi, Siemens, Safran's out. Safran's out with I think it's the third upgrade that Safran has delivered this year in terms of its outlook on revenue. It's up another 1% and is moving the market higher in France as well. Yeah, it's a fairly decent mix of stocks, but some of the big moves yesterday, some of the squeezy stocks yesterday, feel like they're unwinding maybe a little bit this morning.
I mean, we're still waiting for an opening trade in NatWest after they raise their guidance, so keeping an eye on that, perhaps moving the FTSE when it does open. But let's broaden out this conversation. And joining us around the table is Shanti Kellerman, the Seven Investment Management co-CIO. What has been your take on earnings season so far?
I think it's been a solid start, and we have lower expectations for this quarter than we did Q2, which is obviously helpful. I think it's going to be more about the forward guidance than what is actually delivered, particularly in the US, because everyone is so focused on the forward impact of that tech spending and things like that. Europe, I think you'll probably see companies more reaction to the actual earnings and less focus on that guidance, just because they're, the market's focusing on different things for those companies.
We still have a lot to come. Yeah. What is your eye really focused on for the remainder of the season?
Well, obviously, it's the tech earnings, and because that's such a huge portion of the market, and it also has so many reverberations through, if you look at, semiconductors, through all of those supply chains, and increasingly the tech sector is becoming more entwined with the infrastructure sector as well, and I think that's something that'll naturally broaden some of the market returns, because a lot of those companies' fortunes are getting very intertwined with the hardware systems, the data center construction, which are just going to need different types of companies to help build that infrastructure.
There is a meeting between Scott Bessent and his Chinese counterpart this weekend. There's a meeting between Donald Trump and Xi Jinping next week. How are you thinking about trade negotiations right now between the world's two largest economies? Does it even matter at this stage?
So I would say, we get loads of questions in from customers all the time. Tariffs are really not coming. No one's asking about it. I think there's just mass fatigue. Now, it doesn't mean it doesn't matter. Things can't happen that aren't important. But I think there's a lot of fatigue in the market about it. And I think it's kind of the pattern we see as we have, these really harsh things come in, then we roll them back, and we all have a huge sigh of relief. And it's hard to see why you'd expect anything dramatically different this time. I think they'll probably will roll back on some of those, 100% massive tariffs, because it's not really in anyone's long-term interest.
What is the worst case scenario here? What is, if clients aren't worried about it, the market isn't worried about it, what's the risk we're not seeing?
Well, yeah, so obviously I think we've had quite happy markets, elevated valuations. We certainly could have a pullback. I think if that happens, I wouldn't see it as the start of a huge fall, because there's a lot of cash still on the sidelines. There is still economic growth. People still have money. So I think I would view anything as a correction, a temporary thing, not the start of something more sinister.
So what's going to move things around next week? You've got the meeting, Trump and Xi. You've got the Fed. You've got a whole boatload of earnings. That are going to be. Which of those where should I be looking in terms of where I think things are going to change?
I like earnings because I know they're real, they're audited. You look at a lot of surveys these days, consumer surveys. Everyone in the UK says everything's awful, but then it turns out we all spent more money last month.
Yeah, I know. Never believe what a consumer tells you. Believe what they actually do.
Yeah, and then same thing. Do I necessarily believe what Trump tells me, or do I believe what actually? Yeah. And even if we have some grand agreement next week, does that all unravel a month later? So I think for me, it's the earnings is what I'll focus more on.
Momentum has been a really big theme in a lot of different asset classes, and correlations have been kind of quite high. People are in the same basic trades. If we see momentum unraveling in one area, let's call it gold, crypto, there are a few others, do you as an investor go, I just wonder whether or not actually there's going to be some other momentum trades that are beginning to fade a little bit here? We've pushed up a long way. Is there enough momentum to keep equities moving?
I think it's very reasonable that we have a bit of a pause in momentum. You can't keep going up forever. But we also, one thing we talk to customers about, you have to be comfortable with being at all-time highs, because in the long run, if markets go up, you need to be at all-time highs quite a lot to keep going up. So it's not necessarily a bad thing or a warning sign to just because you have an all-time high, we should be worried. I think gold has certainly had a great run. I think you wouldn't be surprised to see a pause in momentum. But the longer-term factors on central bank buying, other countries worrying about, can the U.S. seize all of my assets if they decide don't like me? I think those are still firmly in place. And then it's about, can we keep delivering earnings? And the outlook for that is pretty solid. Not entirely certain, but I think there's a plausible case to get there.
A couple of stocks I just want to flag. Talking of delivering on earnings, NatWest out this morning, and its numbers are certainly delivering on the upside. You've got NatWest up by nearly 6% this morning. Saab is also moving massively to the upside as well. It's up 6-7%, I think. We'll talk to its CEO very, very soon. But yeah, you're seeing a big move. There you go, 5.61%
big move
to the upside.
For NatWest, touching a 15-year high.
Yeah.
Intraday high, I should say, up 5.3%. So the earnings keep coming in great for the banking sector, both on this side of the Atlantic and over on Wall Street. I do want to ask a question more on deregulation. We've seen that impacting the banking sector in a positive way, even impacting some of the auto names in the U.S., even more to the detriment that tariffs have already caused their business. Do you see that as a key factor, at least for this momentum in U.S. equities moving forward?
Yeah, I think deregulation absolutely can be a tool to take costs out. So you've got tariffs putting costs in, regulation taking costs out. I think the pace it's happening is very slow and piecemeal, because in some ways you get, I work in a bank financial institution. The FCA says you're pulling back this regulation. We all kind of sit there and go, are they really doing this? How far back can we go? Can we really row back as far as we were before that came in 5 years ago? So I think it takes time, and you need not just the regulation to change, but you need kind of evidence of the regulators' behavior changing before companies will truly go back to where they were before.
Shanti, you talked a lot about economic growth, resilience, earnings, et cetera. How much of the estimates or even some of the resilience and optimism that is baked into this market is dependent on energy and oil prices staying stagnant? That seems to be the major question when it comes to European sustainable growth. Does that apply for global equities?
I think it's, Europe is certainly more sensitive, and we have higher energy prices in Europe than we do in the U.S., and that's always going to be a bit of a competitive disadvantage for some of those European industrials. There's probably room for oil to go up a little bit without, crashing the global economy, and I think that's probably why we saw some of those sanctions go in on, Rosneft, where you could do that when oil's at 60. Your willingness to do it at 90, 100 isn't there. So I think there's a little bit of space, but higher commodity prices are essentially a drag on global growth, earnings, consumer spending. And so I think we've got to be conscious of there's a little bit of space, but if that goes too high, then I would certainly view that as a negative going into next year for economic growth.
How are we feeling about credit? We're starting to see cracks appearing in the credit market. People are worried about it. Certainly not at the kind of high-end stuff, but obviously at the lower-end stuff.
I would say one interesting thing, we've started to get questions from retail customers about private credit, which, is not an asset class.
Should I be investing or should I be avoiding?
Yeah, I think First Brands triggered a lot of that, of just people going, what on earth is this? So I think it's kind of interesting that's made it into that retail consciousness.
So the First Brands has made people more popular. So it's made private credit
ask about it.
About whether or not they should be putting money in it, or whether or not it's a risk to the system.
A lot of it's, do you own this? If I'm honest.
Okay.
But so I think in that part of the market, it's largely in the institutional space, and it's not pervasively in retail portfolios. So if you have a crack there, I think it can be weathered quite well. If we look at the corporate market, you have to remember the high yield market today has a far higher credit quality than it did 10, 15 years ago. So I think people, when they say, oh my gosh, spreads have come down so much in high yield, you have to remember it's a better quality high yield market than it was. It probably should have lower spreads. I think in the corporate world, we still don't see much risk, particularly in the large caps. A lot of them are still benefiting from those, the average rates they're paying are coming down quite slowly and they're adjusting. So yeah, there's nothing I see that really worries me in credit markets.
Cool. Let's see. Thanks for stopping by to see us. Shanti Kellerman, Seven Investment Management's co-CIO. Thank you. Let's take a look at the Core 6 this morning. What are we watching in Europe? Defence stocks certainly feel like they're on the front foot. Rheinmetall, as you can see in the middle of the picture, is up nicely. But it's tech really to the right-hand side that is delivering that right-hand side move. Schneider's also up quite nicely. Defensive stocks, let's call them Nestle and Novo Nordisk, a little lighter this morning. But we are starting to see a little bit of a kind of rowback maybe on some of those luxury names that we've seen big moves in this week. Let's find out what else we are watching. The banking sector remains front and centre for Chloe Melly.
Good morning, guys. So, very positive movement for NatWest this morning. It is up 4% after raising its income and returns guidance and also delivering its highest earnings in at least a decade. So the profit pre-tax beat estimates by a massive margin. This is actually the third UK bank to be reporting this week. We had Lloyds and Barclays earlier, and all of them upgraded at least part of their guidance and seem to be signalling that the UK customer is able to weather those economic headwinds a little bit better than expected. We do have the budget coming next month, so that might change a little bit. But in the meantime, NatWest is doing really well, and that is really driving the shares this morning. Moving on to another positive story, Sanofi is also up this morning after its profit beat estimates thanks to really strong sales of its blockbuster asthma drug Dupixent. It did flag some weakness in the vaccine segment, with the CFO saying that there was a little bit of a negative sentiment around vaccines and lower vaccination rates in the US and elsewhere. But it seems that the market is really focusing on that Dupixent momentum instead of that vaccine weakness, and we are seeing the shares up 3.2% for Sanofi this morning. Moving on to suppliers to Intel. So ASML and B Semiconductors are both up this morning after Intel over in the US provided quite an upbeat revenue forecast and seems to be signaling that it is making really good progress on its turnaround. And those two here in Europe are suppliers to Intel, and we are seeing that read across, and they are moving higher on the back of that. Moving on to Accor, which is a hotel operator. It is up this morning after raising its guidance and also unveiling a €100 million buyback. So the raised guidance was because of better cost management, and that seems to be rewarded really well by the market. We are up 5% for that hotel operator. And finally, just one bad move this morning to talk about. Well, there's other ones, but the ones that we're talking about here. Signify is down 7%. It is a lamp manufacturing company. It cut its forecast, and that was due to weakness in the US, and that is being not rewarded at all by the market. It's taking quite a hit on the back of that. We're down 7%.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. One earnings story that we haven't hit yet is Saab. Coming up, we check in on those earnings. Of course, the market reaction there looks like a positive one at the get-go. Shares higher by about 7% this morning. The CEO of the Swedish defense aerospace firm joins us live from Stockholm for an exclusive interview. Coming up next, stick with us. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi Zahran, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Breaking data coming out of France, crossing the Bloomberg terminal. The French October composite PMI falling to 46.8. The forecast was 48.4. If you look underneath the hood and look at where that pain point is, it's very much in the services space. The services PMI falling to 47.1. The forecast 48.7. Compare that to manufacturing, actually rising to 48.3. Forecast of a 48.2. You're already seeing the euro start to take just a little bit lower. And anecdotally, when you look at the data set, it looks like they're talking about sustained political uncertainty as well as some geopolitical uncertainty as well. That's weighing on that services number. We'll see if that comes back. But based on the political situation, Guy, I'm not sure if it will.
We need to flag that a little later on today, we are going to get the latest rating review of France. Will that be meaningful? There's a lot priced in, but you can still see a shock, as we've learnt over the last few weeks. Let's turn our attention back to what is happening with the corporate news this morning. Beaten a race from Saab, the company raising its full-year organic revenue forecast as it reports third-quarter earnings that beat. The Swedish defence and aerospace firm also sees full-year EBIT operating growth to be higher than organic sales growth. Joining us now is Michael Johansson, the CEO of Saab. Michael, a beaten a race, market likes that, stock is up very nicely. The company is clearly humming along very nicely at the moment. Do you see the kind of momentum that you're delivering at the moment being sustained?
No, absolutely, and that's why we raised our guidelines for the full year as well on the top line side. The organization is delivering in a very nice way, and of course it's been we needed to see that the capacity investments that we've done over the year and the last years before this is now coming into play, and that gives us the strength to deliver in a much higher pace than we have thought before, and that's why we are raising our guidance now. So I'm really pleased with the delivery rate of the organization and the execution of all our projects that we have in the company today. And we have a huge backlog as well. So that's all about why we have raised our guidelines now.
In terms of pushing forward, you've got a big backlog. You've told us that. Clearly, there's a lot of interest in buying the product from the company. Can you just give us an update on some of the contracts, though, that you are bidding for currently, what your outlook is and what your expectations are for further Gripen sales?
Well, I mean, we have more campaigns that we've had for a long time now on both the Gripen and the Global Eye, the airborne early warning. So we put a lot of effort into that now so not only being selected but also contracting in these campaigns. So I look forward to that, but it's always a political decision. I have to say that in the end on these big mega deals. So it's relationships between countries, and prime ministers and defense ministers will be involved to decide in the end. So it's not only about the product as such, which we have great products, there's no question about that, but there's a high intensity also on the campaign side in a number of countries. And you saw President Zelensky and his delegation coming to Sweden this week and handshaking with our prime minister to support development towards an air force in Ukraine over time where they prioritize the Gripen E, which is great news to us. So now we can start that planning. I have to say, though, that doesn't mean we have a contract. There's still a way to go, but it's a good sign of where we need to go.
Michael, can you talk about, you mentioned you have this record high order book. What does your capacity look like to keep up? Do you see any choke points in your process?
Well, I think we are investing heavily to continue to grow the company and manage its capacity. What we are maybe battling a little bit with where we see pain points is, of course, in the supply chain, which I think is true for many of the defense industries, that we have to bring with us the companies that supports us going forward and also invest in the supply chain to make this sort of capacity growth happening quickly as possible. So that is the main thing, that we need to have the supply chain and ecosystem of companies going in the same direction. But that's been quite good as well. But there are pain points, of course, in that supply chain.
Are rare earths a pain point in that supply chain, Michael?
Rare earth is absolutely a concern over time. If not Europe, US, Australia start really getting this in progress and creating sovereign capacities ourselves, this will become a problem, of course. We are not seeing any sort of effects as of now, and we have the majority of the order backlog secured when it comes to these things. But, I mean, of course, I'm concerned not only for the defense industry, but also for other industries. So we have to get a trade deal together with China, but we also, of course, need to get Europe and US and Australia as examples to also get sovereign capacity on this side. So concern long term, but not right now.
Okay, so just to be clear, Michael, you have enough capacity currently to deliver what you need to deliver in terms of the order book you currently have, in terms of the rare earths that you currently possess. So it may not be you, I'm assuming this is probably further down in your supply chain, has the material needed to deliver on the product that you have committed to thus far?
Yeah, that's sort of, in general terms, if you look at the whole picture, we have a lot of things secured for our backlog. But that doesn't mean we look sort of into this in many sort of levels now, because you're right. I mean, this is further down our supply chain, and we talk a lot more to sort of the suppliers now to make sure that this will be sustained over time. So that's what's been happening now. But my view right now that the data that I get is that we have secured a lot of this now for the backlog that we have, but still, with a number of years ahead, we need to have this in place so we can continue to grow. So it's about years, not sort of months or weeks that we get into trouble, but it needs to be sorted.
Michael, we've got FCAS, we've got GCAP, we've got the Gripen, we've got a number of different programs that are underway at the moment. Rare earths are another kind of area of interest in this space. Do you think Europe needs to do more to share? Do you think we need to be more coordinated in our approach? Like, what is Saab doing versus what is Dassault doing? What is BAE Systems doing in terms of the rare earth sourcing? Do you think we need to work together more? Is there that level of coordination that is happening? And does there just more broadly need to be more coordination? There is ongoing stress within the defence space at the moment about who should be building what and whether or not we're overbuilding and whether or not we've got too much of one product or another product. Is Europe doing a good job of kind of coordinating the effort to rearm?
Now, my view is that we have to do more together to create scale, but also to share the burden for investments going forward. It's based upon sort of having common acquisitions between countries in Europe, aligned requirements, and that can be done. Industry would support that to work more together going forward if that happens. But also when it comes to supply chain issues, of course, being the head of ASD, the Aerospace and Security and Defense Organization in Europe, I also push for that we now come together as industries supporting and giving our view of what the Commission needs to do to secure sovereign capacity in certain important supply chain issues connected to REE or components or what have you going forward. That is very important that we have a consolidated view on that, and we push for that, and we invest in that going forward. So it is important that we do things more together, generally speaking, in Europe to create more strength and deterrence and capacity going forward. No question about it. I'm for that, and I'm for collaboration. Yeah.
Michael, just one final quick question. Have you had any recent conversations with either Airbus or Dassault or what is happening on the GCAP side? Kind of where are we, do you think, in that process? You've told me before in the past that maybe you'd be open to talks. Is there anything recently happened on that front?
I'm just monitoring what's happening on GCAP and SCAF, to two different big programs to see what happens. But of course, I mean, to us, I've said that before, to us it's important to retain the systems integration capability, the OEM capability as a company. And we are open to do collaboration. If we can do that and still retain that capacity and capability, we will collaborate, or we can continue doing it on a sovereign basis. But of course, we discuss these things when we meet. But I'm not saying I'm involved in the GCAP or SCAF. We're just looking what's happening. There might be other things, of course.
All right, thank you. That was Michael Johansson, CEO of Saab. Well, coming up on this show, we'll check in on those European PMIs. We'll have German PMIs breaking right after the break. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back to the opening trade. About 30 minutes into today's session, green on the screen, but not by much. We've really pared back some of the opening gains that we saw just 30 minutes ago. Your outperformer still at the broader index level, but again, we are barreling towards negative territory in just 30 minutes, Guy.
Absolutely. In terms of the internals, 354 up, 226 down. Slight balance towards the up and down. It's Friday. I'm going to put the volume down to the fact that it's Friday. We're a little light on the volume. Let's talk about where the leaders are. So this is where it gets interesting. Corporate earnings certainly playing a significant factor in terms of what we're seeing in terms of the narrative to the upside. Sanofi is up by 3.1%. NatWest is up by 3.3%. You're also seeing maybe some read across coming out of what we saw yesterday from Intel. ASML is up by 1.4%. 1.4%. Doing nicely on the back of that, adding some quite large amounts of weight to the upside. VOSI is down, GSK is down. Let's take a look at what we are seeing on the laggard side of things. SAP also giving back a little bit of ground as well after some big moves earlier on in the week. GlaxoSmithKline, is that just a rotation maybe out of GSK into Sanofi? I don't know, but GSK maybe balancing out what we are seeing in the pharma space this morning. Val, what else do we need to know?
Here's what else we're monitoring this morning. Intel shares rallying in late trade after the chip maker returned to profitability and gave an upbeat revenue forecast. It expects fourth quarter sales to come in around $13.3 billion, which is just below estimates. But the outlook suggests Intel is on the right track following a turbulent year. The CEO, Lip-Bu Tan, has recently secured an investment from the U.S. government and backing from NVIDIA and SoftBank. The loonie is falling after U.S. President Donald Trump says he would immediately halt all trade negotiations with Canada. Trump made the announcement in a Truth Social post, citing an advertisement against his tariff plan featuring the voice of former President Ronald Reagan. And finally, the European Union has put off a decision on whether to tap frozen Russian assets to aid Ukraine. Talks among the bloc members stalled after Belgium demanded greater assurances that it would not be held liable for risks linked to the proposed loans, which many are held in Brussels. Meanwhile, Ukraine's President Zelensky and other European leaders are gathering in London today for the Coalition of the Willing discussions on Russia's invasion of Ukraine. This is as Russian Air Force plans crossed into Lithuanian airspace yesterday. Ready?
In the meantime, as we monitor all of those stories, we are getting breaking economic data crossing the Bloomberg terminal, this time coming out of Germany. Just about 15 minutes ago, we got it out of France. The October composite PMI numbers rising to 53.8. The forecast was 51.5. Their services numbers coming in very strong here, rising to about 54.5, forecast of 51. Manufacturing PMI also rising, but again, kind of in line with estimates, 49.6 there, forecast of 49.5, or I guess 0.5 is a better way to say it. You are seeing strength in the euro off the back of it, 116. Enormous that you are seeing this much of a strength and jump in the services PMI relative to the French story 15 minutes ago. That's where the pain point was.
That's a 29-month high on the services number.
Yeah.
It's a 29-month high on the comp number as well. The question is how much of this is premised on the idea that we are going to see this pickup in German spending? We were talking about German debt a little bit earlier on. Is the Merz fiscal package, when does it start to kind of really deliver? Is it going to start to deliver? There's a note, I think, floating around this morning from one of the German banks talking about potentially it fizzling a little bit.
Yeah.
There's a lot baked in, a lot of expectation around what is going to be happening with this German debt story.
Yeah, Commerzbank monitoring that very, very closely. Let's get another view on this conversation. Maria Demircis, leader of Europe's Economy, Strategy and Finance Center at the Conference Board, joins the program. Maria, pleasure to have you as always. In the last 33 minutes, we've had two major data sets, one from France, one from Germany, telling us two very different stories. Your initial thoughts?
Yeah, indeed. On the French side first, that came 15 minutes ago, I was hoping that the fact that we averted elections was going to stabilize the PMI. Unfortunately, it didn't. It just goes to show that the budget really is crucial, and the fiscal position of France is in the mind of all business leaders. They're expecting tax increases at the end of this year with the new budget. All of this, of course, has a negative feedback on what they think about the economy, and we saw it in the numbers today. So I think this will stay with us for some time. By contrast, Germany, that's very good. So, last month the numbers surprised on the upside. They continue to surprise on the upside. We're going to stop thinking that this is a surprise anymore and actually expect to see some robust recovery. For the moment, it's just the services that is doing now. I'm hoping that manufacturing will also help on the back, of course, as you said earlier on the fiscal spending that will come from the German government, very much on defense and of course, on all the companies and technologies that will have to benefit from that. So good news from Germany. I'm hoping that will continue.
Good news from Germany, but as you pointed out, Maria, on the French side, you are seeing that weakness. In the report, though, it talks about and attributes some of that weakness to a lot of the political uncertainty and just how long that may add. We're not seeing a major reaction in the bond market this morning when it comes to the spread between those two, but we have seen plenty of credit downgrades when it comes to France as well. How does France recover from this, short of electing a new leader?
Yeah, I think what they need is a robust budget. I think that's the only way it can recover. Something that will have a buy-in, and that's where the difficulty is, but something that will indeed help with the French economy. There are indeed problems with the fiscal budget. At 5% at deficit, it's just not sustainable. We need something that is convincing to all of us, including, of course, the business leaders, that actually France will be able to deal with its fiscal position in the years to come. That's the real big question. For the moment, it hasn't convinced, and I think a lot is at stake with the budget before Christmas.
Maria, we had a recent poll of economists conducted by Bloomberg that showed that a majority of economists think the ECB will be on hold not just for 1 year, but for the next 2 years, so through 2027. Do you agree with that kind of sentiment from your peers? And what kind of narrative would really be the thing to change the dial on that narrative?
Yeah, I think there's two things here, right? One is the inflationary thing, of course, that the ECB is looking at. Inflation is a problem that is actually resolved right now. We're in very good territory when it comes to inflation in the euro area. By contrast, this is not the case in the UK and the US. So I think that's good news. And then the question is growth. Can we have better news on growth? We are at 1% almost in the euro area, forecasting a little bit more for next year. I think this is what we need. If we have a convincing fiscal package and money that is coming to Europe from the private sector that can convincingly invest in Europe and bring us out of our own troubles, that of course means that the news will be better, and we can actually explain this view of the interest rates staying where they are. If the growth news, however, are not as good as they could be, then we might have a change in the interest rates. For the moment, I share this view. I think we are in good territory. It's just wait to see the promise of growth and where it will come from.
Do you think the promise of growth could perhaps be dented if we do not get a breakthrough with these U.S. and China trade negotiations. We're having some taking place over the weekend, and Trump and Xi are meeting next Thursday. Do you see that as a risk to the European economy as well?
Oh, absolutely. It's an enormous risk. The European Union is really in the middle of this. We saw it also with Xperia, the company that was, in fact, taken over by the Dutch government yesterday. This is all reactions to secondary sanctions, the possibility of secondary sanctions from the U.S., which is, of course, all due to the U.S.-China trade war. This is an enormous risk for businesses in Europe, for the supply chains, for secondary sanctions, and of course, for their ability to invest. So yes, this is a very big problem for us.
Maria, the French president wants to take a much tougher line on China and wants to start using some of the more hard-hitting tools that Brussels has at its disposal. What would be the implications of that, do you think, for European growth if we would see a further deterioration?
Supply chains will be the biggest issue. The EU has always taken the position that we want open markets. Open markets means that we sell to these areas, both the US and China. And of course, we're integrated in the supply chains very, very tightly. If we were to take a tougher stance on China, all of this will suffer. We will have to bring some of that back, so shorten the supply chains. And none of this can happen in the next year. So we are talking about a need of retransforming businesses that will take anything between 5 to 10 years. So things will have to get worse before they can get better. It may be necessary, though, given the trade war between the US and China, but also the issue of economic security. In Europe, economic security now is a first-order problem. Think of rare earths. Yeah. Where are we going to use rare earths from for the defense industry and for the semiconductors? All of this depends very tightly on China, and I think our dependence on China needs to reduce.
Yeah, we just heard the Saab CEO talking about that very subject. Just find a quick question from me. A lot of the European optimism hangs on the idea that Chancellor Merz in Germany is going to deliver, that this fiscal package is going to be there. I'm not seeing it in the data yet. Maybe there's some evidence in the PMI numbers this morning, but the broader hard data isn't showing it as strongly as maybe you would have anticipated thus far. It is a story for next year, but people are questioning whether or not it is going to show up, whether it is going to deliver in the way that we all hope and dream of here in Europe. What is your view on this? Is there a risk that it doesn't?
It cannot. It has to. It has to deliver. They said the threat from Russia is a real one, and by that I mean defense and security. So we have to take defense and security seriously, and therefore we have to deliver on this. However, this is Europe, and things are slow and they're not optimal. They're messy, but they will have to deliver. Security is a first-order problem, and we can't really afford not to secure our borders. And I think this will deliver on Germany, but also on other countries.
Well, speaking of that pressure from the defense story, Maria, in the last 24 hours, we went from frozen assets being utilized from Russia towards Ukraine from that being perceived as a sure thing to getting stalled until December. It looks like Belgium having some concerns about liability around that. Can you just walk us through, one, the concerns, and two, the roadmap from here?
Yeah, so just on the concerns first, the frozen assets that we're talking about, the 140 billion, reside in Belgium with Euroclear. This is an institution that is under the supervision of the Belgian National Bank, and therefore it is under Belgian law. So therefore, if all of this were to unravel, it will be Belgium as the frontline country, borrowing from the migration metaphor, that would actually have to bear the wrath of the whole thing unraveling. So I'm not surprised that the Belgian Prime Minister is very tough on the way that it asks for security guarantees, because indeed the unraveling of this will be catastrophic. My own view is that it remains a very, very difficult issue to resolve. Now I think the pressure on security is so big that something will happen by December, but it is crucial that the risk involved with all of this is mutualized. By that I mean it is the EU that actually shares the risks. Belgium cannot bear the risk of this thing unraveling in the future when Russia goes to courts, international courts. I'm talking now 5 years down the line, not immediately. Again, there remains a question mark whether the EU collectively can bear the risk. I think this is something now that will happen, but it has to be watertight as far as Belgium is concerned.
Maria, thanks for the update. Thanks for the info. Maria de Merz is leader of Europe's Economy, Strategy and Finance Centre at the Conference Board. Thank you very much indeed. Let's turn attention back to markets. This year has been, and I say this with some understatement, a dismal year for London's initial public offerings market, with fundraising at a 30-year low and notable companies listing elsewhere. Bloomberg Originals has been looking at why the city's exchange has been losing its appeal.
Things look like they're going from bad to worse for London's IPO market. In 2006, more than $50 billion was raised during initial public offerings. But in 2024?
You can see that it is relatively healthy, and then it just drops off.
Particularly since 2008, we've seen a fall in about 40% of the number of companies listed in the UK.
The first half of 2025 has been the worst for IPOs since 1998, and that sounds terrible.
London falls out of top 20 IPO markets as fundraising slumps 69%.
In the global rankings, the UK is now all the way down here. And this is just one of a string of factors undermining London's more than 300-year-old exchange. A few green shoots have begun to sprout under London's trading floor, but buried beneath a financial malaise decades in the making. This is a story important to ordinary people as well as investors. But just a heads up, it's not a happy one.
It's a shocker, isn't it? It really is.
That was the weekly doc on the drought of London IPOs and it falling out of the rankings of the top 20 areas to IPO as a country. Now, IPOs and M&A activity generally does feel like it's done well this year, at least this quarter. And there's been a lot of attention not just on equity raising, but debt raising. And I think that's going to be a key story going forward, at least when we talk about how these hyperscalers, the likes of Oracle, how are they going to be funding these pledges for all this infrastructure spending when it comes to data centers?
Yeah. You're going to see the Oracle one go through a little bit later on. What is that going to tell us about this story? There are data centers, and there was a really interesting piece in the journal yesterday talking about how much money data centers actually produce in terms of returns to shareholders. Like, these are expensive things, and you wonder when you look at this debt, what kind of rate of return do we think these businesses are going to produce off the investment that they're putting in? Like, it sounds really easy. Build a data center, generate decent returns. Yeah. I think Oracle's numbers are already being questioned. Other data centers that are out there have struggled. You have to make ongoing investments into these things. It sounds straightforward, given the boom that we're seeing at the moment. But at the end of the day, can you make money?
But put that $38 billion into perspective for you guys. That is huge. Essentially the size of a new 10-year reopening for U.S. Treasuries. It's a massive amount of duration. And I think the market, maybe not now, but will begin to start questioning, is there enough appetite to finance this via traditional debt structures? Yeah. We also know that maybe corporate credit and private credit, will be taking some of this burden in order to finance this next rollout. But it's really a lot of questions over, is there going to be the appetite, and is there going to be a tipping point where the market thinks that's too much debt, that's too much leverage?
Yeah. Well, that's a cautious view on this. The other point of this is that if you are worried about debt sustainability, if you're worried about some of the fiscal issues around the world, and you're looking for safe corporate credit to put your money into that would lean in on the momentum thing that you're seeing in the equity market, this kind of debt sale could be your answer. And it brings me back to the kind of the era of COVID, where the Apples, the Amazons, the Microsofts of the world were borrowing at rates that were akin and very close to the 10-year Treasury.
That was the software. This is a different beast.
But it's the same liquidity argument.
Maybe. I think those are very different businesses you're talking about in terms of funding. And can you make a rate? What is the rate of return that this stuff is going to kick out? I think is a key question in terms of what debt sustainability story it's going to have to work with. Yeah. If you are the margin on software for these companies is enormous, and also they are so cash generative that basically they're just it's a debt's so cheap, we should do it, we should return money, we should buy back shares. It's a cash management exercise, whereas this is for a piece of kit that they are going to have to put into the ground and make a return on. I think it's a different argument.
This might be something that we'll get clarity on in hindsight, maybe not necessarily in the moment. Coming up, we're going to talk about the other thing that's hitting the wire later today, the long-anticipated U.S. CPI data, the only print ahead of the next Federal Reserve decision. Before that, I want to leave you with a little bit of sound. KKR co-founder Henry Cavras told Bloomberg that he sees no systemic risk when it comes to private debt. Let's hear what other Bloomberg TV guests have had to say recently on that very subject.
If the punch bowl's being taken away, only a couple people may have noticed it yet, but so far it's still it's still partying like it's 1999 in the credit markets for the most part.
I worry about those firms that don't have a driver's license, that have decided they want to get into private credit, have no way to drive, haven't passed a test or anything. And yeah, will they have problems? They could.
This is not a private credit story. These credits were bank-led, they were bank-originated, they were bank-syndicated. So we can't really understand why there's a referendum on private credit.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back to the opening at Trade. We're 51 minutes into today's session, and it does seem like the momentum is beginning to peter out. We do have some indices flipping into the red. The DAX in the red. We also have the CAC 40 in the red. Eurostoxx 600 is fairly flat at the moment, but looking over to their U.S. peers, it is still positive for U.S. futures. S&P 500 futures up 0.2%. NASDAQ futures up 0.3% after some solid gains of yesterday. But let's look ahead to risk events on the horizon. We still have some more PMI data to deal with. We did get a weak French PMI, a strong German PMI. We're about to get the Euro area-wide PMI dropping in 9 minutes' time. We also get the UK PMIs at 9:30. The US ones are released later this afternoon, but most of the attention will be on the CPI released at 1:30 p.m. London time. We also get the University of Michigan consumer sentiment. So any readings on the U.S. economy, the market is essentially desperate for amid this government shutdown. Later today, we also have the Coalition of the Willing arriving in London. But let's go back to the U.S. CPI report. The September data on consumer prices is slated for release at 1:30 p.m. later today, following a 9-day delay due to the ongoing government shutdown. Joining us for more on this is Bloomberg's Rachel Evans. Rachel, how do you think the markets are going to interpret this data today?
Well, I think you kind of nailed it in your intro there. I think markets are just desperate for any kind of colour on what's been going on in the economy. Now, it's worth noting that this report obviously comes from September, so that's prior to the shutdown, but just some kind of window into how the economy was performing before we got that shutdown, I think will be very, very closely watched. In terms of how the market's going to react, I think, obviously we're all looking ahead to the Federal Reserve meeting next week. It seems like a rate cut next week is pretty much locked in for now, but there's a few question marks about what happens next. Obviously, there's a lot of pressure on the Federal Reserve to kind of continue cutting rates. And if we do see a hotter inflation print coming through today, that could start to kind of shed some doubt, perhaps, on that potential path.
Well, sticking with that, what do you think matters more here? Do you think it's still the CPI print that we might get later today, the inflation story, or is it still the labor market that the Fed is focused squarely on?
Yeah, I mean, I think the labour market has been kind of front of mind for the Fed for a long time, and you see that in a lot of kind of the commentary that comes out from Fed officials, that they are really watching for how the labour market develops. But given we had kind of like the news on oil this week with sanctions, I think inflation is coming back into people's focus. If we do see some of those kind of pressures from higher energy prices kind of creep back through, that is something that could potentially be a problem for the Fed and also for kind of markets who have been assuming that inflation is getting under control and that the path is clear for those cuts.
Where's my volatility next week going to come from? Is it the Fed? Is it Trump-Xi? Is it the earnings, Mag 7, reporting a lot of numbers next week? Kind of, what's going to be, where's the biggest probability of a volatility event going to come from?
I wish I had a crystal ball.
I know, that's what I'm asking you for.
I would say that you're probably most likely to kind of see this either kind of off the trade headlines that come out of that Trump-Xi meeting.
That's a wild card, isn't it? Like, who knows what's going to come out of that?
Completely a wild card. And I mean, we've seen kind of today with these headlines around Canada, just kind of like how small some of these things can be to prompt such a large reaction. We're talking here about sort of the trade talks with Canada being called off over an advert, effectively, right?
Yep.
So who knows what is going to be the kind of tenor of the conversation that we get next week and what that's going to do. We have seen the market is still very sensitive to kind of those trade moves, even as kind of like the S&P and NASDAQ have continued to push higher and sort of some of the weaker earnings have been shrugged off. You know, it's been those trade headlines that have really moved the needle one way or another in recent months. So I think that has the most potential. But if we do see some of those big earnings kind of come through and show some doubts about the future of AI as a driver of growth, that could also get people a little nervous given how frothy things are.
Rachel, we have the ECB and the Bank of Japan making their decisions the day after the Fed. The Bank of Japan has been known to surprise. We have a new prime minister. Do you think there's likely to be a surprise at this meeting?
So the expectation is really for a hold and then for a hike in December. That seems likely, just given I think, you know, central banks tend to try and avoid kind of really rocking the boat and to sort of like give sort of the market a bit of time to get on board with things so that you don't see too big a reaction. But you never know. I mean, there's been a lot of conversation about what Takaichi, the new prime minister, kind of thinks about sort of the Bank of Japan's independence and how she's going to approach that relationship. So I think people will be watching a little bit for some of the colour around the decision and what kind of like the messages from UADA about kind of how they're thinking about rate hikes going forward.
As you said, Dan, you said it's Friday, which takes us on to our next subject, which is what happens this weekend. Rachel, nice to see you. Thank you very much indeed. Rachel Evans looking forward to next week. Well, a little bit of this week. We've got the CPI number to get in. But it's the weekend. We're nearly there. It's been a bumpy week. I think we're going to need a lot of rest and relaxation this weekend as we prepare for next week. There's actually a few things out there. The World Series begins. What is that? That's baseball, right?
Major League Baseball.
Oh, my gosh.
US. Shall I remind you? It's also a very popular sport globally, shall I add?
Okay.
Japanese are crazy about it.
Rumour has it, yeah. El Clasico, football, probably a slightly more important event in terms of the sporting story. More people may be following that.
Real Madrid versus
Real
Barcelona.
Madrid. I know, it's a massive game. A huge game.
Team Real Madrid, all the way.
The Rome Film Festival, are we tuning into that?
No, because we're going to be watching El Clasico, obviously.
Okay, fine, fair enough. And then you've got what I think is basically the revival that they have at Goodwood, but down in Bologna, which is a very nice place to be hanging out as well.
Might I remind you that it is Canada versus USA in the World Series, and I know you're an aspiring Canadian citizen.
I am, yeah. Michelle Hussein has got a great conversation with Nigel Farage. Pay attention to that. This is Bloomberg.
ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Welcome to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. But first, here are the top stories making the headlines this morning. Tech shares leading global stocks higher as investors wait for the latest CPI data delayed by the U.S. government shutdown. Well, trade tensions ease between Washington and Beijing on a plan for Donald Trump to meet Xi Jinping next week in South Korea. But the White House relationship with Canada takes another turn as President Trump says he will terminate all trade negotiations with Canada. Well, we have a range of top guests from Berlin and from the Berlin Global Dialogue this hour, including Waitlist, Global Chief Investment Strategist at BlackRock. We'll be speaking to Bernie Mensa, President of International at Bank of America, and Alexander Bornyakov, Ukraine's Deputy Minister for Digital Transformation. Now, first thing is first, so there's quite a lot going on in the markets. I'm looking at European stocks. Actually, they're edging higher. U.S. equity futures also gaining a little bit. There does seem to be a mood music out there that trade tensions are easing ahead of a key inflation reading. Again, positive earnings also continue to support the equity market. It's not the case across the board, but you do see real pockets of strengths. We heard from the French drug maker Sanofi. We heard from NatWest. We heard from Holcim and Saab, for example, among the companies that gained after earnings beat expectations. We're also getting some data, PMIs from the Eurozone. This will have a huge impact on the thinking of traders across the world, especially when it comes to ECB decisions. Eurozone October composite PMI rising to 52.2. Anything above 50, as you know, is expansion. It's also a little bit above forecast of 51.1. So we have another packed show this Friday. Geopolitical tensions are boiling over once again, with President Trump saying he's terminated trade talks with Canada. At the same time, Trump's plan to meet with the Chinese president next week in South Korea is boosting sentiment. Tech stocks driving much of the gains tied to the AI boom. Banks preparing to launch a record $38 billion debt offering to help fund data centers tied to the software giant Oracle. So let's get straight to our market expert, Wei Li, Global Chief Investment Strategist at BlackRock, who joins us. Now, Wei, I love speaking to you, especially on these days where there's so much coming from all sides. You have a clarity of thought that makes everything put into place. How much focus will be on the inflation report? Now, this is a bit of an oddity. We haven't had any inflation report from the U.S. for 3 weeks. We're getting it today. It's for September, and then we go back to darkness.
That's right. That's right. I think today inflation is the biggest market driver, but beyond today, I think earnings, trade headlines are going to drive market volatility. I think when it comes to inflation, the big picture is that core goods have been increasing and really breaking out from a 25-year deflationary kind of period, and core services in the context of still persistent wage is not likely going to stay low. So I think for now, yes, the Fed has the macro cover by ways of a weak labor market to keep cutting rates. Next week's 25 bips of cut is basically a foregone conclusion, but beyond the medium term, actually inflation is going to still be a challenge.
Wait, when you look at the inflation report today, could it actually change expectations for the next week, or does it change the mood music longer term?
I think it's more longer term. I think next week, the only uncertainty in terms of the Fed communication is around QT rather than the rate decision. But markets are pricing quite a lot of cuts by the end of next year. And I think that's where maybe there is room for disagreement. Maybe markets are pricing in too many cuts in the context of there is still room for tariffs to feed through to goods inflation. And I think we'll have to kind of deal with that as we head into next year.
Wait, I mean, trade is another huge thing. And actually, 2 weeks ago, I would have probably asked you, are the markets now looking beyond trade tensions? And actually, we're back in the full, in the full because of U.S.-China. Like, how do you unpack all of this?
Well, it's complex. I would observe that the Bloomberg Trade Uncertainty Index is starting to rebound again, having fallen a lot from April high. And I think that's just the nature of negotiations, right? Back and forth. And I think the bigger observation I would make is that it's not going to be very likely to generate alpha by just following the day-to-day blow-by-blow trade headlines. On one day, we're going to make a deal. On the next day, we're not going to meet, and now we're meeting again. So it's really hard to generate alpha in that way. I think having a clear frame is important. And as you know, Francine, we call it the immutable law in BlackRock, the things that cannot change too quickly. And if markets price in extreme changes within a short period of time, we would lean against it. And this is why we are still pro-risk, even though trade uncertainty is higher, because there are things that just cannot change too quickly. The two biggest economies decoupling within a short period of time, unlikely. A trade deficit to close despite a significant reliance on foreign funding from a U.S. government perspective, unlikely. So when that gets priced in, we fade.
Wait, do you have to have a call on absolutely everything? So we had big news overnight with Canada. And again, and there's certain parts of the market that say maybe this is a Trump administration being concerned about what SCOTUS, the Supreme Court, will do when it comes to that big tariff decision in November. Again, are we overanalyzing, or do we really need to try and understand, what these little bits mean in terms of policy from the White House?
I think there is a difference between kind of the day-to-day blow-by-blow trade headlines and the longer-term landing spot, right? So you can either kind of, from a very tactical perspective, fade extreme moves, which is what some of the investors do, or you can position for what you think is a reasonable longer-term landing spot, somewhere between kind of 17%, 20% average tariff rate may well be a reasonable kind of target to position portfolios. So depending on your kind of trading/investment strategy, you can do very short-term or longer term.
You spent quite a lot of time also looking at earnings. And this, you basically, you have to be very selective. But overall, we were expecting this earnings season to be tough, and it hasn't. Does it come from lower expectations, or are companies just finding a way around all these uncertainties?
What is really interesting is that actually expectation for U.S. earnings has been increasing. So for the whole calendar year of 2025, the expectation was going to be 9%, and now it's 11%. So it's actually increasing. But U.S. earnings strength is starting to broaden out, right? It's not just the tech sector that is expected to deliver 14% year on year in Q3 earnings. The rest of the market outside of the Magnificent Seven is expected to deliver shy of 8% in this upcoming quarter. So you see a bit of a broadening out momentum, perhaps helped by cutting cycle and just generally resilience in U.S. economy. And that is why we favor U.S. equities over likes of European equities, where actually for the whole calendar year of 2025, expectation is for them to not grow earning much at all. So being selective in European equities like industrials, financials is important.
Are you surprised that AI keeps on exceeding expectations? We keep on saying it's priced to perfection, but then the earnings report comes in and they're pretty good.
Yeah, they are. I think AI is entering a very interesting phase right now where the build-out becomes more capital intensive. Because up until now, it's basically these hyperscalers funding their capex from their huge piles of cash, free cash flow. And that has been no problem. But now the new entrants in AI build-out are having to tap into private credit, tap into credit market using joint ventures. And this is why there are increasing questions around return on invested capital as the expansion becomes more capital intensive. But I think the jury is still out there in terms of if these trillions of capex estimated in the coming years are going to be justified. But in the meanwhile, it's just very costly to stay out of this trade, right? If you think about, we're still early in the adoption phase, so you get this sense of race against time. Will profit outrun depreciation? And this is the tension that we have right now. But we still like this theme. We're still early in the adoption phase, and I think a big question remains: who are going to be the ultimate winners versus losers? Is it going to be the builders of AI, or if we're talking about potentially excessive build out, turning GPU and compute into commodity, maybe the application layer?
Wait, do you see, like, as an investor, we talked a lot about credit also last week and what that meant, but is it going to be less linear in terms of news flow and much more volatile? Like we've seen, do we need to get used to what we've saw in the last 8 months?
Maybe. I would say that the credit cycle has been missing, right? You look at kind of the default level, you look at the spread, you don't really see a very meaningful pronounced credit cycle, perhaps supported by easy liquidity, perhaps supported by fiscal stimulus. But we are at a moment where differentiation and dispersion is going to be very, very key. Private credit are likely going to play a bigger role because of the blurring of the lines between public and private in the context of building and financing the transformation. So certainly we think this is a big theme, but differentiation, dispersion is going to be increasingly important. I'm paying a lot of attention to kind of the different categories of credit and also the potential increasing in payment in kind and so on and so forth. But right now we like fundamentals. Leverage is not exceedingly high, and there's a reason that spreads are low.
Wei, thank you so much, as always, for joining us. Wei Li, their Global Chief Investment Strategist at BlackRock. Now, U.S. trade negotiations with one of its neighbors has been thrust into chaos. We were just talking about Canada. President Trump announced he's immediately severing talks with Canada. While posting the announcement on Truth Social, Trump called Canada's behavior egregious. He's taken issue with the tariff and featuring the voice of former President Ronald Reagan. Well, let's bring in Brendan Murray, who leads our trade coverage. So, Brendan, what was in the ad, and exactly how is Trump's decision likely to impact the Canadian economy?
Yeah, exactly. So I think you have to chalk this one up as more of a tantrum than anything that really disrupts the trading relationship between the U.S. and Canada. And you have to see what President Trump didn't do as well, or didn't say, is that he would raise tariffs on Canada because of this advertisement. So he's just threatening to suspend talks. There weren't really any signs that they were locked in any serious negotiations yet. They are looking ahead to the middle of 2026 when the USMCA agreement has to be renegotiated and reviewed. And the Trump administration wants to take those talks one-on-one with Canada and one-on-one with Mexico. So this is just President Trump kind of setting the tone for what will be months and months of negotiations. But the more interesting part of that social media post was the reference to the Supreme Court decision. You could read into that they are getting nervous in the administration, that the court is not going to rule in their favor. Prediction markets see a 60% chance that the Supreme Court is going to rule against President Trump. So he's trying to sort of sway public opinion, that he's saying that Canadians are trying to sway public opinion against him, and that's why he lashed out of Canada.
So interesting. Brendan, at the same time, the presidents of China and the U.S. are set to meet next Thursday. Now, this was a meeting that was like off and on and off and on. What can we expect from those talks? But also, why is it so difficult to know whether they're happening or not?
Yeah, so we're heading into this fifth round of trade talks between the U.S. and China, between Secretary Bessent and his Chinese counterpart. And we've seen a pattern all along. They escalate with the rhetoric, and then they de-escalate when they get together. The base case here is that they will extend the truce that they have and not imposing more export controls or higher tariffs on each other. They'll kick it out another 90 days. Maybe they'll even extend it longer. Secretary Bessent has said it'd be nice to have a longer than a 90-day roll, as he calls it. So the rhetoric sounds like the relationship is pretty tense, but at the end of the day, we've seen this movie before, and they end up at a deal. But that said, they are threatening some pretty drastic things with export controls on each other. So it's going to take quite a bit to get them, once they get to the negotiating table, to reach a deal so that those escalations don't happen.
Brendan, thank you so much. It does definitely feel like a high-stakes meeting. Brendan Murray there in London. Now, Bloomberg also understands that the French president, Emmanuel Macron, has told EU leaders to consider using the bloc's most powerful trade tool against China. That's if they are not able to find a resolution to Beijing's planned export controls on critical raw materials. Let's bring in Susan Lynch, our Brussels bureau chief, who's with me here at the Berlin Global Dialogue. Thank you, Suzanne, for joining us. Look, I mean, first of all, like, Europe is in a little bit of a precarious situation because they're kind of caught in the middle, and now Macron wants them to retaliate against China.
Yeah, we reported this last night. EU leaders obviously were meeting in Brussels yesterday, and during that closed-door session, the French President Emmanuel Macron said that this anti-coercion instrument, which is a trade tool that the EU has at its disposal, should possibly be used against China. Now, I mean, I think the message here from Macron is that Europe needs to toughen up when it comes to China policy. I think there was widespread agreement, and Chancellor Merz, the German Chancellor, said afterwards, look, we're not at that point yet, but I think it speaks to the gravity of this situation now for Europe. Some of Europe's top leaders last night at the summit wanted to discuss China. They talked about these restrictive export controls that are impacting Europe. Europe, like a lot of places in the world, but particularly Europe, is very dependent on Chinese rare earths. Everything from electric vehicles to the defense industry. So a lot of concerns about how this planned move by Beijing is going to affect European industry.
I mean, a lot of the talk this week is also on those Russian frozen assets. Like, where are we?
Yeah, that was a big debate yesterday. It was funny, we started off the EU summit yesterday with a decision on sanctions. By the end of the evening, there were all kinds of divisions around other issues, and this included this plan to use Russian immobilized assets to help Ukraine. The issue here is Belgium. Most of these assets are located in Belgium at Euroclear, the clearinghouse. So as a result, Belgium is more on the hook than anyone else from this if these assets are used. So the Belgian Prime Minister, Bart de Wever, really went in strong ahead of this meeting. He said he had red lines and he wasn't prepared to move on this unless his concerns were addressed. He repeated that within the meeting. So the result was that the EU did not really move forward on this. What they said was, yes, they want to continue helping Ukraine. The European Commission will come forward with a proposal on how this plan with the assets will work. But this has now been delayed, a political decision, until December. That's potentially a big problem for Ukraine because it needs the money. It's got financing needs right into early 2026. So this delay is not good news for Ukraine, even though the sense we get in Brussels is that this plan will happen eventually. It's just that leaders were not expecting this kind of response, this resistance to such an extent from Belgium last night at that summit.
Suzanne, thank you so much for the terrific briefing. Suzanne Lynch there, our Brussels bureau chief, and we'll be here throughout the day, of course, also bring you updates from the Berlin Global Dialogue. Coming up, we'll discuss how Ukraine is seeking to put technology at the center of efforts to defend and rebuild the country. We'll be talking to Alexander Bornyakov, Ukraine's Deputy Minister for Digital Transformation. That's next, and this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We had a good discussion on the reparations loan to be financed with immobilized Russian assets, and it allowed us to identify points we still need to clarify, and then indeed we will come back with the different options that we will develop. Let me underline again, we will always respect European and international law while we are taking this work forward that we've just described.
Well, that was Ursula von der Leyen, the European Commission president, of course, discussing the plan to tap frozen Russian central bank assets to aid Ukraine. That's one of our top stories. Now, the EU Defense Commissioner has also weighed in, saying the bloc should use funds from its 150 billion euro investment plan for its defense industry to help Ukraine.
Very important decision can be on so-called reparation loan. You know, using those frozen assets without confiscation, but using frozen assets to send to Ukraine 150 billion euros, which can be used for defense. And maybe that could be a signal to Putin where he will start to understand that he really will not achieve anything in Ukraine.
Well, we're now joined in Berlin by Alexander Bornyakov, Ukraine's Deputy Minister for Digital Transformation. Deputy Minister, thank you so much for joining us. Look,
hi everybody. My pleasure.
It's so good to speak to you. I mean, you basically have a government services app called DIA, where people can do things like they can do pay taxes. It's basically the infrastructure that allows people to interact with a lot of the digital government. How difficult is it to implement it right now in Ukraine?
Well, we started implementation back in 2020, and I think it was even more difficult back then because of all this opposition and the pressure that, you're going to ruin everything. Like, there was a huge opposition from many other counterparties, other ministers, that we're going to destroy everything. But it didn't happen. And DIA mostly is about digital papers. So we started from driver license, passport, then it went to car titles, birth certificate, tax ID number. So I it's a storage for all my official papers, diplomas, everything. So 23 million people as of today using DIA. So it's basically almost everybody in Ukraine, because you cannot use it if you're not 18 years old. So that makes it popular among all population of Ukraine.
Deputy Minister, I guess the difficulty now is that there are power cuts, right? There are power cuts. You need to defend like the data infrastructure. So what kind of efforts go into that? Even cybersecurity.
Well, you cannot hack something that is out of the grid. So, well, it's a very painful topic, first of all, because I just came from Kiev. At my home, there was no electricity for 10 hours straight. My parents' house, 2 days no electricity. So they're in Chernihiv. So that's Sumy, Chernihiv. That's cities that close to the border. They suffer most. There are contingency plans, and there's a lot of help, and people do whatever they can. But unfortunately, there is no way to help if every day they continue to bomb. So and they change the tactics. So before they're trying to like send maybe hundreds of Shaheds to different targets, maybe they were hoping to reach maybe another 100 targets. But now they choose 2-3 targets and then send 20 to 30 missiles.
And these are energy projects. Yes, right? Mainly energy projects.
So and we face another challenge. So despite of the efforts to protect them on cybersecurity level, on physical level, you cannot protect. There is no. I don't think it's a way to protect if there is a 20 drones with 100 kilos of explosive hitting the. If you shoot down 10. Another 10 will do the job. And then they also send 3 or 4 ballistic rockets to the same place.
And Deputy Minister, in terms of the cyber attacks on some of these energy projects, assets which are, again, crucial to running the country, have you seen a step up?
Well, this is not the big news. It's not on the news often, because when the pictures of drones hitting targets are selling better, but cybersecurity threats, it's not just... they don't went away. So they constantly attacking every day. We have their cybersecurity centers that monitor 24/7 every day, and they record, dozens of incidents every day on different from different.
Is it getting worse?
I wouldn't say so. I think they're pretty much stable, and in cybersecurity world, it works in a little bit different way rather than when you send drones. Sometimes, to successfully penetrate a target in cybersecurity world, you have to wait a month. So, so the curve is not like hitting silence, hitting silence. So it's usually silence, then hop, big incident, because they found a way to penetrate. So that's why sometimes it's no news on this front, and then some of the big news. Because it's really take time. They trying to look away.
Can you talk to me about the Ukraine Phoenix Tech Fund? So this is a pet project to basically try and get partners and money in to support the ecosystem for tech in Ukraine. How's it going, and who are your main partners?
We were in touch with the founders, Dominic and Peter, who was big friend and still big friend of Ukraine, and his other partners like Chuck from New York University, and we've been helping them with the a recognition and underlying the importance of this fund, because part of what we do is in defense tech we're trying to allocate enough resources to develop those solutions that kind of keep Russians at bay. So Phoenix Fund is very important, and it's especially important because today. As a deputy minister, I'm in charge of policy making and startup ecosystem ventures. So that's my actually job, to support this industry. This is what I have to do straight away. And the fuel in this industry are money. And when the border was closed, so our civil aviation is not working. It's really hard to get, and it's really hard to get out of Ukraine. So this venture and startup ecosystem, it's global. So of course it faced existential threat. And funds like Phoenix, they bring money into Ukraine, so that's essential for us.
Okay, such an interesting conversation. Thank you, Deputy Minister, for joining us. Alexander Bornyakov, there, Ukraine's Deputy Minister for Digital Transformation. Now, coming up, private credit giant KKR tells us the sector poses no systemic risk to broader financial markets. So we discuss if the credit jitters are over, stated with the Bank of America's international president. He's Bernie Mensah. He's coming up next, and this is Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back, everyone, to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. But first, here are the top stories making headlines this morning. Private sector activity unexpectedly jumps in Germany to a highest level since May 2023, but a less positive picture in France, with the sector contracting over the budget and fiscal uncertainty. Trade tensions ease between Washington and Beijing on a plan for Donald Trump to meet Xi Jinping next week in South Korea. But the White House the White House relationship with Canada takes another turn as President Trump says he will terminate all trade negotiations with Canada. Now, we are full of data. Also, I know there's a lot of excitement because of the inflation report out of the U.S. It's like a glimpse. We haven't had any data out of the U.S. for 3 weeks. We get the one today because legally we had to, and then we go back to the government shutdown with no data. The UK PMI, it's open for business, so we do have data there. UK October composite PMI coming in slightly better than expected, 51.1. Again, anything above 50 means expansion. The forecast was 50.5. Now, Henry Kravis, the co-founder of KKR, has pushed back against warnings that the collapse of Tricolor and First Brands is a sign of wider trouble in private credit. Well, speaking here at the Berlin Global Dialogue, Kravis said there was no systemic risk. Last week was quite a week. We had Jamie Dimon talking about cockroaches in certain private credit companies.
They don't invest.
They don't invest, but do you worry about something systemically wrong with private credit?
So let me tell you about private credit. No. Just recently, okay, we have a big private credit business at KKR. So do many other firms have private credit. Even banks have a sleeve of private credit. Everybody's talking about, oh my God, private credit's going to go bad. I do worry about one thing. I worry about those firms that don't have a driver's license, that have decided they want to get into private credit, have no way to drive, haven't passed a test or anything. And yeah, will they have problems? They could. I don't find it systemic. We don't take deposits. This is just really what it is. It's private credit. 2 big bankruptcies last 10 days. Not one penny of private credit was in them. But the market hit all of us that are in private credit because they assumed that was it. And then finally, once they figured out, well, this is really all banks, it was UBS and Jefferies were the 2 big banks that were the big lenders in that. I am not worried about a systemic risk issue in private credit.
Is it, I mean, the other question is it the banks or the private credit firms that suffer the most when we reach peak, peak correction?
Depends. The thing you have to focus on if you're going to be in the credit business, what are my risks?
Right.
How am I protecting my investors, or how am I protecting my portfolio? And if you don't think about that, and you're only trying to knock the ball out of the park on every investment you make, you're gonna have trouble.
Well, that was Henry Kravis, the co-founder of KKR, speaking here at the Berlin Global Dialogue. Now let's continue the conversation on markets and private credit jitters. We're joined by Bernie Mensah, International President of Bank of America. Bernie, thank you so much, as always, for giving us a little bit of your busy schedule. Yeah. I mean, the event is great because it kind of brings, all sorts of people together trying to figure out what happens next in the economy and what happens next in markets. What do you worry about the most when it comes to markets in the future?
I think at the moment there's a lot of talk of, are we peaking, are we end of cycle? So you need to be sort of cautious and careful about what's out there, and you're looking at the data all of the time. So there's no one thing that keeps me up, but I think that we should just be cautious, just given where market levels are.
Should we worry more about credit than we currently are? So, last Friday felt like it could be something that could snowball into something much bigger, even maybe something systemic, and now the markets have moved on to other things.
I share the narrative that is not systemic. There are 1 or 2 specific situations that have happened. There's some talk of perhaps fraud or not. I think if you look at the high yield index, around about 300, 225, 290, we're not at the all-time tights. We're sort of near there, but then we're going through an easing cycle. So we should be complacent about idiosyncratic events that happen at the company level on the credit side, but it doesn't feel as if it's systemic, certainly not.
Does anything feel toppy? I know we talk about the AI bubble. We just follow the trade tensions. Every hour I feel like there's a new trade meeting that's on or off between the U.S. and China, and now things with the U.S. and of course Canada. Like, how do you see it playing out in how your clients see it?
Well, the first part of what you said, some things do feel toppy. You look at gold and you look at the S&P, etc. So it feels that way, but there's many reasons to think that some of those things should be where they are. There's been many, for those of us who've been around a while, you can get to these periods of time and have another leg of growth, and some of the fundamentals around that are relatively positive. In terms of the trade talks, I think we had peak uncertainty back in April, and then we've had certain flare-ups. I think China is probably the most relevant. Canada, US, and Mexico we'll see, but I think the market reacts the most at the moment when the Canadian tensions flare up, the Chinese tensions flare up, sorry.
Bernie, are you surprised at the way that some of your clients have been behaving because they've been cooler than expected and kind of trying to figure out the trade tensions and move away around them? Or actually, are they much more cautious than you expected them to be?
I think I'm really been impressed in the sense that people are really trying to think things through. So I wouldn't say cautious, but I see a lot of work. This event's a classic example. A lot of work trying to look through. And I always say to them, try and look through the noise and the fog and try and figure out what's happening in the real, sort of either in the real economy or the real underlying trends. What's happening with CapEx? What's happening with AI? What is the slight recent dollar weakness doing to, to trade flows? What are the underlying inflation cycles? What are the real tariff numbers as opposed to the headline numbers that we've seen? So a lot of people are trying to work through that to figure out where the plane might land in a quarter or two.
Are they a little bit more used to the kind of volatility or news flow that we're seeing? So are you expecting activity to pick up?
Yes, I think that we've all gotten used to a different cadence of news flow since the start of the year. Activity picking up is interesting. There was a pickup in activity going into April, and so you've seen some of that lag effect come through. I think as we come through end of Q4, I do see some activity picking up in terms of investors sort of figuring out, okay, what do we do through to the end of the year and how do we position through to next year? And I think for corporates who sort of said, well, we'll wait for some of the uncertainty to dip, there's a broad sense of what the broad level of tariffs are, 10, 15%. And so if you assume no big flare-ups, you can start to plan through that.
Are you optimistic about Europe? I know at the Berlin Global Dialogue, of which you're an integral part, we've been talking so much about Europe, not giving up, kind of trying to stay relevant and competitive.
Yeah. It's the wrong analogy. I say 2 steps forward and 1 step back, because that's a sort of a movement analogy. But I'm optimistic about 2 things and worried about 1. I'm always optimistic in Europe. It's an area with incredibly high savings rate, incredibly educated and talented workforce, and incredible infrastructure installed base that is difficult to replicate elsewhere. So those base elements, it's an incredibly wealthy region. So that's a good thing. The other thing I'm actually impressed with is, or noticing, is the countries seem to be moving ahead. I noticed a letter by a bunch of EU leaders on the 17th, on the Tuesday, I think, this week, urging action. There's the Draghi report out there. I read a report where he said, stop asking me what to do, just do it. Sort of. So those are 2 positive things. And this piece where I'm a little bit cautious about is it does feel as if the countries are a little bit ahead of the EU in terms of Brussels. And you have this sense, being here, that the countries are saying, hey, Brussels, Commission, can you come with us? Because we need to move along. And I think that if they moved in step in terms of some of the deregulation, the simplification, some things like the CSRD rules, Corporate Sustainability Reporting Directive rules, and others, then you could really see some momentum pick up. But countries like Germany, by taking a bit of a country view in terms of the release of the debt brake, etc., seems to be moving the dialogue along.
Do you think Brussels is listening? We also heard the Chancellor Merz here talk about a pan-European stock exchange. I mean, we still don't have a capital unions market, but are you hopeful that actually something will happen in our lifetime?
In our lifetime is a good way to... I think that, I hope they're listening, I really, really do. You would hope that given the governments that are in place is a little bit where the electors are, Brussels must be listening. And I assume that they're very well-intentioned in thinking through other things they're trying to achieve. So I'm not sitting here saying that there's, not good reasons for perhaps the caution that they're putting into play. So I hope that with the feedback from the private sector, feedback from places like this, from the individual governments, from the leaders, that they are listening and taking action.
Are you expecting more IPOs or deals? We're seeing green shoots, I guess, in Europe, but are you expecting that to really increase in the next 6 to 7 months? And what does it mean for Bank of America? How can you capitalize on it?
Yeah, well, we've had a great quarter. We just announced our results last week, and our pipeline looks terrific, and the level of dialogue that we have with our clients is really at very high levels. You might say some of that is a lag because the markets were shut for a period of time. So I think that's a good thing. But apart from what is good for us, I think our clients, it'll be good for our clients. It gives them another avenue. The private markets are big, they're important, there's a lot of activity happening there. Companies that are coming to IPO are much older than before. They're staying private a lot longer. The number of public companies has dropped a lot since 2004, 2005. So I do think there's space in the public markets for people to access, for pricing to take place, for alternatives to be there. And the markets are ready for that. So certainly from our book of activity, I should see more activity going forward.
I mean, in terms of deal making, how's Asia looking compared to Europe, compared to other parts in which you're in charge of?
I think one of the great things from where I sit is that this, actually, for all the talk of deglobalization, there's an incredible amount of cross-border activity. We've done deals out of Scandinavia into the US, Scandinavia into Europe. We've done deals out of Japan into Switzerland in recent times. And one of the things that we're seeing, actually, just given the new environment, is that actually companies are having to think global. Where should our supply chains be? Where should we have resiliency? Where should we actually have more exposure than maybe we didn't before? And whilst everybody's still focused on the US, and it's a tremendous opportunity, you just have a sense that people say, well, look, I want that plus. Maybe I should have a little bit more in Europe. Maybe I should have a little bit more in Southeast Asia. So that's driving some good
Where are you seeing capital? I guess, Bernie, one of the questions is that even with these, renewed trade routes, a lot of companies that look to list and just want to go to the US because it's a bigger capital pool.
Yeah.
Does that change with time?
It should change with time, over a period of time, because one is where we are in Europe. If Europe gets its capital markets union in place, then Europe should be, yes, well, then that would. At the moment, a lot of European savings are going into the US actually, and helping in that market. There are other financial centers that are looking to grow, to provide some pools of capital. I think all of that makes the pie bigger, frankly. I can see a world where there's more activity in the US, but more activity in Singapore or Hong Kong, and more activity in London or Europe, because as more pools of capital are drawn in, there's more to go around.
Bernie, thanks so much for your time today. That was Bernard Mensah, International President of Bank of America. Now, coming up, we'll have plenty more from the Berlin Global Dialogue. Also, our Oliver Crook hosting a panel here at BGD called Financing in a Multipolar World, Strategies for Economic Security. Speakers include Saudi Arabia's Minister of Economy and Planning, Faisal bin Ali Ibrahim. That discussion continues on Live Go on your Bloomberg terminal. Now, this year has been dismal for London's IPO market, with fundraising at 30-year lows and notable companies listing elsewhere. Bloomberg Originals has been looking at why the city's exchange has been losing its appeal.
Things look like they're going from bad to worse for London's IPO market. In 2006, more than $50 billion was raised during initial public offerings. But in 2024,
you can see that it is relatively healthy, and then it just drops off.
Particularly since 2008, we've seen a fall in about 40% of the number of companies listed in the UK.
The first half of 2025 has been the worst for IPOs since 1998, and that sounds terrible.
London falls out of top 20 IPO markets as fundraising slumps 69%.
in the global rankings, the UK is now all the way down here. And this is just one of a string of factors undermining London's more than 300-year-old exchange. A few green shoots have begun to sprout under London's trading floor, but buried beneath a financial malaise decades in the making. This is a story important to ordinary people as well as investors. But just a heads up, it's not a happy one.
It's a shocker, isn't it? It really is.
And subscribers can watch that documentary right now on the Bloomberg terminal, Bloomberg.com, and of course, Bloomberg Originals YouTube channel as well. Coming up, the U.S. hurdles towards the longest government shutdown in history as both Republicans and Democrats refuse to back down. Well, PIMCO's head of public policy, Libby Cantrell, joins us next, and this is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Welcome back, everyone. The U.S. could soon witness the longest government shutdown ever recorded after blowing past the 3-week mark. Now, both Republicans and Democrats show no signs of ending the stalemate as some of President Trump's unusual budget maneuvers lessen pressure on him to broker a solution. Well, we're now joined by Libby Cantrell, head of public policy at PIMCO. Libby, as always, thank you so much for joining us. I mean, there's a lot of excitement because actually we have inflation data today, but that was a legal requirement. And then we go back to the shutdown and no data. How does the shutdown end?
Yeah, well, nice to be with you. I mean, I think that is the main question for us and for our clients as well. You know, our concern was that if the government were to shut down, there would be no natural catalyst to reopen the government. If you recall, the longest full shutdown was back in 2013. That was for 16 days. And the catalyst to reopen the government then was in order to raise the debt ceiling. They funded the government and raised the debt ceiling. You fast forward to 2025, and there is no real catalyst. And in fact, it is a little bit eerie. In Washington, folks are incredibly comfortable with their political positions. President Trump, the Republicans, very comfortable denying a vote and denying negotiations on the Obamacare subsidies. Democrats, who are usually agitating to reopen the government, they are very comfortable keeping the government shuttered, again, in order to shine a spotlight on the issue of healthcare. So it is a little bit surreal, honestly, the fact that there are real implications for the real economy, for data, as you mentioned. But again, folks are really comfortable. So our expectation, what we're telling clients, is that we could see potentially the government reopening in November. Maybe we could be in Thanksgiving. The government could still be shuttered. There is, it's an outlier, but there's also a tail risk that we may get to Christmas and the government's still shuttered. So this will, what our concern is this will have likely deeper economic impacts the longer this shutdown lasts. But again, no real political catalyst to reopen the government at this point.
Libby, I mean, and this is something that we were discussing, this morning, is that there doesn't feel to be any urgency because of the news flow, because there's so much actually that the Trump administration is also working on. But how much of this is they think they're winning the messaging around this, that this is about votes longer term or making the other party look bad?
Yeah, I mean, I think that is right. Again, I think that both sides think that they are winning with their respective bases. And if you look at polling, that's probably in some ways true. Each side sort of blames the other, which is, kind of the business as usual these days in Washington. However, usually shutdowns are a political loser for both parties, just by and large. And I think this is no exception. As the longer this goes and the more the government services are impaired, the more flights are delayed, the less able folks are to get a mortgage loan through FHA and what have you. I think the more folks are going to be mad at both sides. And you're already starting to see this a little bit in the polling. So that could be a catalyst. It could, but again, right now, both sides think that they're winning the messaging war. They think that they're winning kind of the political issue of the day. As you said, there really is no urgency. The House is not even in session. I mean, the House hasn't been in session for now going on 5 weeks, and they look like they will be out of session again next week. So again, we're expecting November to be the earliest that the government reopens. We could be until Christmas, however.
Libby, we also, President Trump, from what we understand, likes to negotiate. So could he just turn around and find a deal on health care?
Yeah, he is the wild card, and I think that is something it's a good thing to flag. I mean, he is this is an issue, and just as a background, this is the issue kind of the day. The issue of the focus here is around these enhanced Obamacare subsidies. They were passed during COVID, and then they were extended in 2022, and they expire at the end of this year. And so Democrats think this is a good political issue. If you look at just again polling, voters usually rank healthcare as sort of the top 3 issue. In terms of the things that they vote on. So they do care about this. And I think that, President Trump, he knows sort of the zeitgeist of voters as well. So he is sort of the wild card here. You could see him pivot. I will just say, though, that again, the longer this occurs, and the markets have sort of shrugged this off, but I think our concern is that you start having some nonlinear economic impacts. Our view is that if this stays shuttered until November, you could see a point being shaved off of GDP. Now, some of that will be reinstated when the government reopens and federal workers get repaid. But the longer this goes, the more potential you have for sort of deeper economic scarring. And of course, as you said, no data. And the longer this goes, not only are we not going to have data releases, despite today, we're going to have no data collection. So these are, I think, going to be increasingly problematic. Both for politicians, and again, Trump is the wild card here, but also for the real economy and then potentially for financial markets.
Libby, how difficult is it to try and understand, or what's your base case for what the talks between the U.S. and China could yield between the 2 presidents? And does that change the public discourse back in Washington?
Yeah, I mean, it's a great question. And here I'm in London. I was in Europe earlier this week, and of course, this is one of the top questions that we're receiving from clients is sort of what to make of this dynamic. And I think that the best that financial markets can hope for from this potential meeting between President Xi and President Trump is really a détente and not a deal. I think that the expectation for phase 2 trade deal or what have you, or something even more fulsome than that, something that even President Trump has outlined over the last few days, it's possible, but I don't think it's really probable at this point. In some ways, President Xi is taking a page out of President Trump's playbook from Trump 1.0. He is using some of these sort of economic coercion tactics that the U.S. has used against China, previously. And so, this is, I think, quite a different dynamic than, again, sort of the previous administration, or Trump 1.0, if you will. So again, I think that the expectation is, détente, the best case scenario, but not a deal. And I will just say, and something we're flagging for our clients, is that there is a tail risk here. And this, as we've seen, this relationship can deteriorate pretty quickly, not only in terms of a ratcheting up of tariffs, but I think more importantly, maybe to China and also to the U.S., these sort of export controls, whether it's on advanced technology or whether it's on rare earths. So this, I think that is the tail risk in the market, that this relationship, which is already fragile, sort of simmering, if you will, can boil over, really at any moment.
Libby, thank you so much. As ever, Libby Cantrell. And of course, we have to see what the Supreme Court also decides on the tariffs. Libby's head of public policy at PIMCO with a terrific briefing on what we're seeing and what we could see. Now, it's been a busy couple of days here in Berlin. Let's bring in Chad Thomas, our Europe executive editor, who's been with me throughout the day. Look, it's been an exciting couple of days. What's your main takeaway, Chad?
Well, I'm going to be watching very closely a couple of things still coming today. One, of course, is your panel with the French and German central bank governors. I'm really curious to hear what they have to say about setting policy when we have so much change happening in the world. How do you deal with the uncertainty of things like Trump, as you were just discussing, calling off the trade talks with Canada? We'll also be watching, or I'll be watching very closely, what the Mercedes-Benz CEO has to say today. As you know, we've been watching Nexperia, this Dutch company that many of us have probably not thought about very much, to be honest, until very recently. They're a big chip maker. There's a big dispute between the Dutch government and China over Nexperia. And we're hearing, and from our sources, that car makers are in a dire situation when it comes to their chips, because Nexperia is one of the biggest providers of, they're not specialized chips, but they're chips that are in every car that we buy. And so we could be days away from shutdowns of car factories in Germany, elsewhere in Europe. So that will be something I'll be watching very closely today as well.
Yeah, and then you have Macron, a great Bloomberg scoop, basically saying, look, Europe should fight and retaliate against China.
Yeah, and that was really interesting, as you say, one of our scoops last night from the summit, that Macron was saying we need to use the toughest tools that we have in our kit to deal with the fact not only we're talking about Nexperia, but we're talking about rare earths as well, and the fact that China is putting controls on the exports of rare earths. Big issues for the EU when it comes to how they're going to deal with China, and of course also the continuing discussions with the US as well.
Chad, thank you so much. Chad Thomas, our Europe executive editor, of course, masterminding all of our coverage from the Berlin Global Dialogue. Now, don't miss our panel conversation with the Bundesbank President, Mr. Nagel, and the Banque de France Governor, Mr. Duguerreau. We'll have plenty more throughout the day. And of course, it's inflation data from the US. The government shutdown, just taking a brief pause. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
A cidade estava sitiada.
Nisso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Halted. President Trump terminates trade talks with Canada after Ontario runs an ad featuring a 1987 Reagan address extolling free trade. Intel coming back. Intel returns to profitability after a turbulent year. Meanwhile, the Trump administration is making a move to speed up power grid connectivity for AI data centers. And the return of the data. Well, some of it. The September CEI report expected to cross at 8:30 Eastern with data gathered before the shutdown. So let's take a look. We are pointed higher for futures today. This after the S&P 500 did finish higher yesterday. We're up about 1.2% on the week for the S&P, and we're up about 1% for the NASDAQ 100. So even with all the turbulence this week and last week, we still continue to march higher. Let's take a look at the bond universe, because as Paul Donovan says today, we're getting a lone piece of data in a data drought. We do see the curve a tiny bit flatter today than it was at this time yesterday, with the 30-year yield still below 460, with the 10-year yield firmly back above 4%, and the 2-year yield climbing ever so slightly as well. And then I did want to point to a couple of currencies, because obviously the loonie is going to be in focus today. We are seeing it weaken. We're looking at the Canadian dollar at 140.21. 140.80 was the most recent high for that pair. And then the yen, look at that, it is perilously close to 153 and could continue to weaken depending on what we see CPI-wise. We did see Sanae Takeichi give her first address to Parliament and talk about spending, but not actually raising taxes. So that's having implications for Japanese assets. Well, now let's get to some individual market movers over to London and to Valerie Teitel. Good morning, Valerie.
Good morning, Bonnie. Let's start with a check on Intel. As you mentioned, they returned to profitability and actually gave a quite rosy forecast when it came to revenues. Those Intel shares feeling quite excited off the back of that, up 8.5%. Now, it does show that there is some promise in the new CEO's turnaround plan. Intel has gone quickly from being the worst performing chip stock to one of the best performing chip stocks, up 90% year to date. Maybe today we might make that 100% gains for Intel today. Moving on to Ford, this is also another earnings story. Now, investors were comforted by the fact that they do have a plan to boost back production of their highly profitable F-150 line. So Ford stock is up 2.6%. This is despite them lowering guidance, but it does seem like investors are more comforted by this rebound plan for their truck line. Lastly, I want to check on Decker Outdoor, another earnings story here. Decker warning about an increasingly cautious consumer as we head into the holiday period. They did lower their guidance and getting punished for it in the pre-market. Decker's Outdoor down 11%. Funny.
Valerie, thank you so much. Valerie Teitel there. And later this hour, we're going to be live from the Berlin Global Dialogue with the South African Minister of Home Affairs. Thus, we'll drumbeat to the CPI data with Kayla Sader of State Street. But first, President Trump is shutting down trade talks with Canada over an ad campaign funded by the government of Ontario. The ad uses excerpts from former President Reagan's address in 1987. Here's a part of the ad.
High tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. Then the worst happens. Markets shrink and collapse, businesses and industries shut down, and millions of people lose their jobs. America's jobs and growth are at stake.
President Trump reacting on Truth Social, writing, quote, "They only did this to interfere with the decision of the U.S. Supreme Court." In caps, tariffs are very important to the national security and economy of the USA. For more, Bloomberg's Brendan Murray joins us now. Brendan, where does this leave US-Canada, given that Ontario is not Canada, but it is having national implications for the country?
Yeah, I think you've got two real issues here. One is sort of the tantrum that Trump has thrown based on this ad, and you can argue that the ad does kind of do some creative editing with the April 1987 radio address from then President Reagan, but the bigger issue here is the evident concern that the president has that the Supreme Court hearing is just coming up in a week and a half, and there were some people that will tell you that there are administration officials worried that they're going to lose that case, and the president's ability to use these reciprocal tariffs and the fentanyl tariffs are going to be struck down by the high court. Now, prediction markets see about a 60% chance of that happening, and so you can tell that the president is feeling the pressure, and he's turning that against Canada and Ontario in this ad. It doesn't really affect the overall trading relationship between the U.S. and its #2 trading partner, but it definitely sets the tone for upcoming talks to review the USMCA agreement over the next 6 months. It sets the tone at a fairly low place, and they weren't high to begin with. So we'll have to see how it plays out and how Prime Minister Carney responds.
Exactly. Can he insert himself into Doug Ford's fight? I heard a guest earlier on Bloomberg calling this a Punch and Judy show. If we move to a different theater of trade, how is it looking with Beijing ahead of US-China talks? We had France's President Macron telling the EU to consider tougher trade tools against China as well today.
Yeah, exactly. Going into these talks, the U.S. is very concerned about the latest move from China to raise its export controls on rare earths. And the question was, will the U.S. be alone in pushing back on that? And the answer that we're seeing unfold is no, they're not. Japan has come out strongly against what China is proposing. And now we hear the president of France making similar comments that the world needs to kind of unify behind the pushback on this. The talks between the U.S. and China are going to play out over the next couple of days in Kuala Lumpur between Treasury Secretary Bessent and his counterpart. The rhetoric has been pretty tense between the two sides going into this, but this is the pattern that we've seen over the previous 4 rounds of talks. They escalate the talk and the threats, and then they de-escalate once they get in a room and try to hammer things out. It's not in either side's interest to elevate this trade war and slap tariffs on each other's goods or raise export controls. So the base case here is that they're going to come away with some sort of extension of the truce, another 3 months or maybe even longer.
South Korea says the country and the U.S. are now still sharply divided over the cash portion of this $350 billion investment pledge. What's happening there, Brendan?
Yeah, exactly. This is one of the deals that President Trump wants to bring home from his trip to Asia. They've already sort of have an understanding of what the deal could entail. $350 billion in investments from South Korea. Now the breakdown of those investments, how it's financed, and where the money's going to come from is the subject of a big debate in the South Korean political circles. They don't want to give away too much, but by the same token, they don't want to face the prospect of higher tariffs that would put them again at a disadvantage against Japan, especially in the auto and steel industries. So the outcome is still uncertain, but it's just another example of you announce a deal and then you start negotiating the details, and it's very hard to get to a conclusion in the short time span that the Trump administration wants to operate in.
Yeah, so much left to finalize. Brendan Murray, our trade czar, thank you so much. Meanwhile, the Trump administration is pushing regulators to rapidly step up the pace at which data centers are connected to the power grid. The move aims to help President Trump's AI ambitions and support the growth of the data center industry. For more, we're joined by Matthew Bloxham of Bloomberg Intelligence. So this is obviously, a push from Chris Wright, the Energy Secretary, in some ways, Matt, and it should be a good thing, right? Speeding up this regulation process.
Yeah, it should be, and they're looking to kind of cut the lead time to about 60 days. So I think certainly it's a positive sign for the AI and cloud industry, but it does come with some, potentially serious implications for the kind of U.S. power grid. If you connect AI data centers to the power grid too quickly, you could impact supply for consumers and regular businesses. So I think, even though they're going to expedite reviews, there's clearly going to be some safeguards there to make sure that power is being delivered to all parts of the economy. And I think that they're looking to favor expediting deals where there's actually going to be new power brought on as part of the proposal. So, yeah, should be a good thing, but it's certainly not a silver bullet. And I don't think we're going to see any quick changes in the coming months, but it's definitely an encouraging sign for the data center build-outs.
Sure, and clearly a green light is one thing, but the infrastructure to actually enact, what the bureaucracy allows you to do is quite another. I wanted to ask you about Intel as well, because we've seen this huge rally all year, really, up 90% this year so far, but it did signal that a comeback is underway.
It did, yeah, and obviously, the share's up 90% or so, but I think this is probably one of the biggest relief rallies we've ever seen. Intel was really in a difficult place. Certainly under the new CEO, there are lots of signs that they're moving in the right direction, moving back into profitability, but it's the core kind of PC and server chip unit that's really driving the current growth and this the kind of message that demand is outstripping supply. I think what analysts and investors want to see is better traction in the foundry unit. That's the part of the business that will produce semiconductors for other companies, and they're trailing massively in that area compared to the likes of TSMC. Now, the investment from the government and from NVIDIA could signal some stronger demand for that, but I think that's still where the big question marks are in the market. Can they make a success out of that foundry business?
Matt, thank you so much. That is Matthew Bloxham there of Bloomberg Intelligence. Now to other top stories trending on the terminal this morning.
a record debt sale to fund data centers. According to sources, banks led by JP Morgan and MUFG are preparing to sell $38 billion of debt for data centers tied to Oracle. This would be the largest AI infrastructure deal to hit the market. France's private sector unexpectedly shrank in October, driven by prolonged fiscal uncertainty. The S&P PMI index dropped to 46.8 from 48.1 the previous month. The services sector was the biggest drag, reporting its worst performance since February. In the U.S., applications for unemployment benefits rose last week based on Bloomberg analyses of initial claims data. The numbers are unadjusted state-level filings. Now, the Labour Department hasn't issued its weekly report since September 25th due to the government shutdown, now in its 24th day. Coming up, we're live from Berlin with South Africa's Minister of Home Affairs. That's next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Leaders in business, politics and academia gathering at the Berlin Global Dialogue. Bloomberg's Francine Lacqua is on site with South Africa's Minister of Home Affairs. Francine.
Yeah, thank you so much, Fanny. I'm so excited to be joined by Leon Schreiber to talk, of course, about everything that's home affairs related in South Africa. Minister, thank you so much for joining us. Look, I know you've been focusing a lot on reforming the visa systems, which was maybe one of the impediments to growth. How's it going right now that you've put things in place? Are you starting to see what you wanted to see?
Yeah, I think from the start I've been clear that I want Home Affairs to be an economic enabler in South Africa. And I think problems with the visa system has actually been one of the major non-tariff barriers to business, to doing business in South Africa. So I think we are making really exciting progress on this front. When it comes to businesses and corporations, the Trusted Employer Scheme has helped a lot to partner with industry and make sure we get those critical skills in at the top of the economy. But I think across the board, we are really focused also on sectors like tourism. One of the big challenges we've had for a long time is that we are not able to unlock markets like India, China, Indonesia, and that's simply because they require tourist visas if they want to come for a holiday to South Africa. In contrast to that, we've seen strong growth in countries that don't require visas, and so obviously that tells us the visa system is one of the key problems. So this week, as we speak, we are rolling out live the electronic travel authorization system that will digitalize and automate the visa process, starting with tourists, We are focused on the G20 summit that's taking place at the end of November initially, looking at those 4 countries in the G20 that require tourist visas for South Africa: India, China, Indonesia, and Mexico. But the beauty of this system is that it is based on machine learning. So it automates the adjudication process. That's going to lead to much quicker turnaround times. It eliminates the need for you to travel somewhere if you live in China to go and apply for a visa and wait weeks to get an outcome. I'm very excited about that for the economy.
That could really be a game changer. How many more tourists will, high spending tourists could that be?
Yeah, no, exactly. So there's the overall number. South Africa has almost gotten back to the pre-COVID level, but we're not quite there yet, and we should be actually running ahead of that when it comes to tourism numbers. I think 9.5 million last year in total. About 1 million of those were really high spending. If we do that, if we double that number, just 1 million tourists from some of these other destinations that we're now unlocking, it could have a huge impact. Our research says 13 new tourists create 1 new permanent job. But I think high-spending tourists, the number could actually be lower. And of course, our number 1 priority as the government of national unity is growing the economy and doing something about unemployment.
Minister, I know you've also started a nomad visa category, but that doesn't seem to have taken off as much as the others. Why is that?
Yeah, so there is some movement there, but again, the problem is these people are digital nomads. Now you're asking them to fill in a piece of paper. So the digital nomad visa or the remote work visa is really at the top of the list for our next category. So once we have the ETA Foundation working for tourists, we want to add other categories into this. The digital nomad one is an obvious one because it has almost the same application requirements as a tourist visa, with one addition being a contract somewhere abroad. So I'm very excited that once we get the ETA stable for tourist categories, the real game changer, and where I think South Africa has the opportunity to actually become a world leader, is to automate other visa categories, using technology to go into more complex visas, starting with that one, but looking at study visas, work visas. Technology can do so much to speed up the efficiency of that process.
Minister, what about digital ID? So I know you said earlier this year that you were going to the cabinet to try and push that through. Where are we on that?
Yeah, so South Africa has a good foundation. We have an identity system, we have smart ID cards, we have biometric records for holders of those smart IDs and passports, but we have not completed the foundation. So we still also have about 16 million of these very old green ID books that represent serious fraud risks to our economy. So what we're doing first is replacing those existing old insecure documents. We're doing that in partnership with the banks, a very interesting and exciting initiative where we are working directly with 8 of the biggest banks in the country, piggybacking on their network and their existing integration with Home Affairs, because obviously they do ID verification if you open a bank account. And we are now going to use that to push access on a scale we've never seen before so that people can get the more secure document. That's step 1. But while we're doing that, in parallel, developing the digital ID infrastructure, the one advantage we have is because we already have biometric records for 30+ million people. We've got existing verification services. We just need to build the front end now and digitalize that.
Minister, I mean, in your mind, would it be something like India's Aadhaar card?
Yes, that's one of the inspirations. I mean, we would like to also do what India did in documenting all South Africans. I mean, we still have a challenge with undocumented South Africans. Aadhaar was a huge success on that front as well. But we want to go and move it onto your smartphone. So we want to have digital ID on your smartphone, biometrically secured, exactly like you would do with online banking. I have to make this point. South Africa is a world leader in online financial services. I mean, online banking in South Africa is way ahead of many countries around the world. That's why it's so great that we can partner with banks to use the same principle for government services. And I think the key point is remote authentication. That's really the power of digital ID, that you can prove who you are through a smartphone linked to your facial biometrics.
Minister, around the world there's been an explosion of anti-immigration sentiment, and South Africa has not been immune to this, and so we've seen some xenophobic violence. What is your department doing about it?
Yeah, I think South Africa actually is a neglected part of the global migration story because as much as we have similar challenges to other countries, we also have a much higher unemployment rate. And that is really, when you then have undocumented migrants coming in, seen to be competing with unemployed South Africans, that becomes a real tinderbox. So we are managing it responsibly, first of all. We're anchoring what we do in the rule of law to make sure that we also protect social cohesion, even as we enhance our enforcement operations. We've deported 51,000 people in the last year. That's more than France and Germany combined. If we had more resources, we'd be doing more of that. At the same time, we are digitalizing our border environment. We know for 3 decades that infrastructure was neglected, systems were not modernized. So the ETA that we were talking about is going to then be linked to automated entry and exit. And we want to actually expand that biometric tool to make sure that even if you come from a neighboring country, you have to get an ETA first, so that we have your facial biometric and we link that to give you permission whether you can come in or not.
Minister, also, you've been part of this coalition government since June of last year. How's it going? How are the 10 parties working together?
Yeah, I think better than we have since the beginning. So I think we're in a better space now than we've been than we were initially. I think the budget dispute we had around tax increases, etc., firstly, these are quite normal in any society with a coalition government. And I think, secondly, the important part of that was that we actually got over it. We actually found a way forward. So we are starting with the next budget cycle now. I'm hoping that we can do it in a less sort of public and destructive way. If we can succeed in that, I think that builds another layer of confidence that we actually are working pretty well together. And I would also make the point that there are some coalition governments in countries that are much more used to coalitions than South Africa that actually fell long before, and we're still going.
That's a very good point, Minister. Thank you so much, Minister Schreiber there from South Africa. With that, Vani, I'm going to send it back to you in New York, and we'll have plenty more throughout the day here in Berlin.
And we're certainly looking forward to it. Francine Lacroix, thank you so much. Coming up, Democrats and Republicans block measures on pay for federal workers. A look at what else is making headlines in your front page news next. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's time now for your front page news. First up on the New York Times, Senate Democrats blocked legislation that would pay essential workers during the shutdown. The GOP also blocked a pair of Democrat bills that would have paid a broader cohort of workers. Democrats say they opposed the GOP measure because it would hand President Trump wide latitude to pick and choose which workers receive pay. Next up, the Wall Street Journal is reporting the U.S. flew Air Force B-1 bombers near Venezuela yesterday, though they remained in international airspace. The show of force ramps up pressure on President Nicolas Maduro in a military campaign the administration says is focused on countering alleged drug traffickers from Venezuela and Colombia. And on the front page of the Financial Times, big pension funds are scooping up former private equity professionals amid a PE fundraising squeeze. The FT cites Preqin data showing PE groups raised less than $600 billion in the 12 months to June. And those are your front page stories. Next up, we're going to be talking to Kayla Sater of State Street. This is Bloomberg.
Estava sitiada.
Isso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talagi kon ahmalep ahmata suara pangok ahmalep manjang lenya ay kun mamanya. Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Halted. President Trump terminates trade talks with Canada after Ontario runs an ad featuring a 1987 Reagan address extolling free trade. Intel comeback. Intel returns to profitability after a turbulent year. Elsewhere, the Trump administration making a move to speed up power grid connectivity for AI data centers. And the return of the data. Well, some of it. The September CPI report expected to cross the wire at 8:30 a.m. with data gathered before the shutdown. So all eyes on the data later on, even though we have a fairly good idea of what we're going to see. That said, we're quarter way through earnings season at this point, if you can believe it. And Intel's report yesterday casting perhaps a better eye on futures today. They're certainly pointed higher. The S&P did finish the session up 0.6% yesterday, and we're up more than 1% of the week so far. Same story for the Nasdaq 100, a weekly gain of about 1%. So we're definitely headed in the right direction market-wise. Let's take a look at bonds, because certainly the shutdown in day 24 should be having a bit of an impact on them. Maybe we're seeing a tiny bit of flattening with the 30-year yield still below 460. The 10-year yield, though, back above 4%. We await that CPI data, of course, in 3 hours. And then take a look at a couple of currencies, because the loonie moving higher as the market responds to Trump's stance on Canada. Recent highs around 140.80, so we're not that far off that. And the yen moving very close to 153 right now. We'll see if it goes above 153 after the CPI data. But the first reason for it moving is that in Japan, Sanae Takeichi gave her first address to Parliament. Let's get to some individual stocks to watch now. Over to London and Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with a check on Intel, because as you mentioned, their results out after the bell yesterday. They did return to profitability and raise their guidance off the back of some solid demand for PCs. Now, Intel shares are up 8.4% in pre-market off the back of this. Really, I guess, assuaging investors that their turnaround plan is on track. It has been a turbulent year for Intel, but shares are now up 90% year to date. And with this pre-market move, we could make it 100% gains today. Keeping with earnings, let's move on to the auto industry. Some solid news out from Ford. They did beat on profit and came out with a solid plan on turning around production of their very profitable F-Series of pickup trucks and super trucks. So Ford shares moving 2.8% higher in the pre-market. And this is despite Ford cutting guidance. This is kind of on the back of the fact that one of their key suppliers had a fire, and that did hamper production of their trucks and super trucks. But now they have a turnaround plan to boost production, and it does seem like investors are thinking this is good news going forward. Lastly, again on earnings, Decker Outdoor, Vonnie, this is the maker of UGG boots and Hoka running sneakers. They did warn on a cautious consumer headed into the holiday season, this on the back of tariffs impacting their activity. So they did lower their guidance, and shares are getting punished for it in the pre-market, with Deckers Outdoor down 11.5%. Vonnie?
Valerie, thank you so much. Valerie Teitel there in London. State Street's Kayla Sader looking ahead to today's CPI data, saying it should cement a Fed rate cut next week, but don't be so sure about December or January. She writes this: looking at daily price trends for October data, there is evidence that non-tariff affected prices and imported good prices are accelerating. This could push back on current market pricing by January, especially if inflation expectations begin to rise. Kayla joins us now. She's macro multi-asset strategist at State Street. Kayla, we'll get to the forward guidance in just a moment, but first of all, Julian Emmanuel just out with a note a moment ago saying that this data will pierce the fog, but are we so sure we're going to see what we expect, as in a slight deceleration in pricing?
Yeah, hi Vonnie. Thanks so much for having me today. We are expecting spot 4.2 headline and spot 3.2 in core. And so that is in line with overall expectations. So that's one of the reasons why we expect market pricing for the Fed cut next week to still hold, is that our expectations are aligning with the market expectations.
Are there any blind spots that maybe we haven't been seeing? And if not, then why do you think inflation should suddenly accelerate again going into October, November, December?
Yeah, so a couple of things that we're able to get more insight into inflation is we have something called Price Stats, which is a daily measure of inflation using online prices. And what we saw heading into October is that prices were starting to accelerate a little bit. And if you asked me this question 2 weeks ago, I would have been very concerned as we were seeing that acceleration. Fast forward to today, and we're seeing less acceleration than before. Now, with that said, we're definitely not out of the woods. This inflation is looking a little punchy. When we look at prices from for example, tariff affected or imported standpoint versus non-tariff affected or non-imported goods, what we're seeing is that non-imported goods inflation is still quite high, and we're seeing some signs of tariff inflation. Now, this is not as bad as earlier in the spring, so that's really important to note. With that said, it's important to put this into context with Fed pricing so far, because what we're seeing is that even if it's not as bad as it was, it's not great. And so that does push back against some of the pricing for December and January.
Yeah, the labour market, though, isn't great either, Kayla, and the longer this shutdown lasts, the less great it looks. We crunched the numbers, I mean, so did many people, from state data, and even those 4 states were missing out of that data. We found that initial jobless claims climbed last week, 227,000, so, you know, a further slight weakening in the labour market. The Fed can't ignore that either.
Yeah, that's a really good point. And, you know, this push and pull of the labor market and inflation is what makes the current environment so challenging. I think one thing that's really important to consider is, why are we seeing jobless claims rise? And would rate cuts really help that? If these labor market issues are being driven by uncertainty around policy, especially on the fiscal side, and perhaps where tariffs are going, things like that, I would argue that rate cuts may not be able to fix that issue. And simultaneously, because we still see sticky inflation, it would be pragmatic for the Fed to be relatively cautious here.
So, Kayla, are you saying that we may not see a cut in December, but if we do see one in December, we'll likely not see one in January?
Yeah, yes.
Okay.
Agreed.
So what about the shutdown then? How much does it impact the labour force? How long would we have to see it last for it to really impact those, you know, data that we'll eventually hopefully see again?
Yeah, that's a great point. And something that markets are definitely concerned about is, you know, how are we supposed to navigate this environment when we don't have official government data? Because where it stands now, it's going to be really tricky to have data for the October inflation print. And data integrity and data quality is really important. So that's, you know, fortunately, that's why we have something called price stats, and those using online prices is really helpful here. But this does leave the market overall in terms of official data in kind of this very gray spot. And so, you know, I think that's why being cautious is the most important or most pragmatic path forward here.
You know, you also say in terms of the markets, you're keeping a close eye on liquidity as excess reserves in the financial system are declining. Are you actually concerned, Kayla, or do you think we're several months away from any kind of concern?
Yeah, that's a great point. I think liquidity is something that's really important to keep an eye on here. And one of the biggest risks to the overall, you know, equity market rally and overall risk assets. We do see some signs of funding strains, but we're not, this isn't total turmoil or anything like that. It's just something to keep an eye on. So right now there's a little bit of pressure, and it's important to look at that and thinking through what will the Fed do next week. You know, will they stop QT? That could help ease some of these strains, but it's something that we're keeping a close eye on that could put pressure on overall markets if it's not amended.
All right, Kayla, thank you so much for joining us today, and good luck in just less than 3 hours when we get that CPI data. That is Kayla Sater of State Street. Now to other top stories trending on the terminal this morning. Chinese state-owned companies canceled some purchases of seaborne Russian crude after the U.S. blacklisted Rosneft and Lukoil. The global oil market has been jolted this week by the wave of U.S. sanctions, which targeted Russia's 2 largest producers. JP Morgan is looking to allow institutional clients to use their Bitcoin and Ether holdings as collateral for loans. According to sources, the program, which will be offered globally by the end of the year, will rely on a third-party custodian to safeguard the pledged tokens. JP Morgan declined to comment. And Argentine President Javier Milei's approval rating fell to 40% in October, its lowest level since he took office. That's according to LATAM Pulse, a survey conducted by Atlas Intel for Bloomberg News. The figures provide the latest snapshot of voters' views on Milei before Argentina's midterm elections on Sunday.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump shutting the door on Canada on trade talks. That's after the government of Ontario came out with an ad campaign that uses excerpts from former President Reagan's address in 1987. Here's a part of the ad.
High tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. Then the worst happens. Markets shrink and collapse, businesses and industries shut down, and millions of people lose their jobs. America's jobs and growth are at stake.
President Trump reacting on Truth Social, writing, quote, "They only did this to interfere with the decision of the U.S. Supreme Court. Tariffs are very important to the national security and economy of the USA." For more, Bloomberg's John Harney joins us from Washington. John, I'm tempted to ask you why Ontario is running an ad about the United States, but it certainly had the effect desired, no doubt, because it got a big reaction from President Trump. Why?
It certainly did. The trade dramas that have marked the Trump administration have been likened to a roller coaster. I think it's more like bumper cars, where you never know when the next collision is coming from or from what direction. So this, as you point out, is not the work of Mark Carney, the Prime Minister of Canada, who's been trying to reach accommodations with his giant to the south, but from the government of Doug Ford, the combative Prime Minister of Ontario, who in some ways has some resemblances to Donald Trump. He comes from a conservative political family. His brother Rob was a notorious mayor of Toronto some years ago. But he has been a staunch opponent of the tariffs, and he has certainly gotten a reaction from the United States.
Well, Doug Ford and Donald Trump got into it once before. We may remember that. That was pretty serious at the time, but then there was apparently phone calls between the two, and I don't know, maybe their personalities are alike, but it seemed to all go away. Can this happen this time?
Of course it can. I mean, there's the nature of these dust-ups, clashes, conflicts always seem to be transitory, perhaps. But the tariff agenda of the Trump administration remains, and the Canada-United States trade relationship is in peril at the moment.
Absolutely. You talked about bumper cars. A previous guest on the network said it was like a Punch and Judy show. But separately, Trump is also planning to open almost all of the U.S. coast to offshore drilling. Can you tell us a little bit more about these plans and when they might come to fruition?
This is all part of the Trump administration's determination, ever since his first administration, actually, to pursue an agenda of what they call energy dominance, which means fossil fuels, oil, coal, to a lesser extent perhaps, and natural gas. Now, many of these areas have been put off limits, included by previous presidents, including Donald Trump, who wanted to, who's responding to complaints or concerns by governors of certain coastal states that oil drilling could damage beaches that were very important to their tourist industries. This will certainly be opposed and end up in court, perhaps extended litigation by environmental groups and of course, various state governors. At the same time, the oil companies have been not too keen to pursue new offshore drilling because, of course, of the cost, and the price of oil has not been too attractive at various points.
So many players with a voice in this particular debate. John, thank you so much. John Harney there in Washington. Staying in Washington, the Trump administration pushing regulators to dramatically accelerate the pace at which data centers can be connected to the power grid. This as President Trump continues his push to support the growth of the data center industry. Let's bring in Matthew Bloxham of Bloomberg Intelligence for more. Matt, this is very interesting because for sure you would have to imagine that the impetus is the right kind of impetus, but is it even doable?
Yeah, well, so the proposal's looking to limit the review time to 60 days. At the moment, some of these reviews for connecting data centers to the grid can take years. Obviously, lots of competing interests here. AI data centers are putting pressure on energy supply, potentially pushing up pricing for consumers and businesses, and potentially limiting power to those consumers. So I think this is a delicate issue, and it needs to be kind of handled quite carefully. I mean, obviously, the AI industry is going to be delighted to kind of hear anything that kind of removes red tape for them in terms of bringing new capacity on stream. But it needs to come with clear plans to actually increase the amount of power that's provided to the grid. And I think part of these proposals that we've seen do suggest that there will be some kind of checks and balances to make sure that all different consumers of electricity are actually being served appropriately in the US.
So separately, I want to ask you about Intel because it was a little bit of a surprise, to say the least. It rallies and it continues to rally now in the pre-market after it gave a forecast that signals a big comeback is underway. How surprised were you, and is maybe the enthusiasm overdone?
Yeah, Intel's come a long way since the dark days of the last couple of years under their new CEO, definitely making a lot of progress. What we saw in the results overnight and what they're talking about for the kind of forward, maybe kind of 12 months or so, is strong demand for their kind of core PC and server CPU products. Now that's encouraging, but growth is still quite tepid, 2 or 3%. What's important, I think, is that the new CEO has returned the business to profitability. He hasn't changed the strategy that much, but he's brought a lot more financial discipline to the company rather than just kind of spending money willy-nilly. I think that the issue that people are really looking for them to continue to make more progress on is their foundry business. And that's the bit of the business that makes semiconductors for other companies. That's still struggling. That actually missed expectations in Q3, and it's where they've still got a lot of work to do. It's where there's a huge opportunity, but they do need to convince other technology companies to rely on Intel to produce their chips for them. And obviously, there's a lot of competition out there, particularly from the likes of TSMC. But obviously, with the backing of the government and with the investment from NVIDIA, there's definitely an opportunity there for them.
Absolutely. Well, if this pre-market gain holds, we'll be up almost 100% on the year for Intel. Matthew Bloxham of Bloomberg Intelligence, thank you so much. In other earnings news, Ford shares rising in the pre-market after the automaker posted an earnings beat and signaled it will largely bounce back from a fire that disrupted a key supplier. CEO Jim Farley spoke with Bloomberg's Matt Miller about the road ahead, including Ford's EV strategy.
It's a very dynamic market We've been the market leader in the U.S. for a couple of years now. I think GM has now moved into second place. We came into the market 4 or 5 years ago with Lightning and Mach-E and E-Transit, and we have learned a lot. We'll update everyone on how we're adapting to these changes, but the market is clearly, changing in front of our eyes. Now, that isn't the case around the globe, though. Europe is about 18% all electric. The Chinese are really making a lot of progress in Europe. And in China, half the market is PHEV and EV. So globally, because Ford's a global competitor, this EV trend is very strong. And we believe in the U.S. that the affordable EV market is going to be robust for many years to come. That's why we're investing in our universal electric vehicle.
Lucky enough to sit with Mary Barra and Mark Royce when they showed their next-gen EV tech. And I asked them how they can get to some sort of rare earth minerals independence. Because, no matter what you do as a business leader, you're always kind of beholden to China or trade talks, at least now. What are you doing at Ford to try and deal with that really difficult issue for U.S. producers?
It is, and I would just add not only rare earth, but obviously processed raw materials for batteries. And I would put a new one on the table now, mature node semiconductors that go into every Ford. All three of those are critical for Ford and for U.S. manufacturing. Matt, so you're spot on. Look, for rare earth, we continue to diversify our supply chain. There are some American and FTA country sources of rare earth. They're not as big yet, but we're really encouraged to see the administration's focus on this. And also, those companies are getting more resources now, and they're getting more serious. And with backing of companies like Ford, they'll be able to invest more. I believe we're on the right trend on rare earth. But on battery processed raw materials, we have not made a lot of headway. And the Nexperia shortage is a great reminder. Diodes, transistors, these are basic semiconductor components. They also are being dominated by China. And this is a crisis going on right now, actually. And we're going to have to make our way through this whole transition.
Ford CEO Jim Farley speaking with Bloomberg's Matt Miller there. Coming up, we'll get you set up for your trading day. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Jumana Bersachi in Vienna, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. It's a slower earnings day, but we do get results from Procter & Gamble and General Dynamics before the bell. Then I hardly need to tell you this, but we get an inflation print for September at 8:30 a.m. Eastern. That CPI data is coming out as far as we know. Plus S&P PMI data as well at 9:45. And tonight, President Trump is leaving for Kuala Lumpur, kicking off that week-long trip in Asia. Let's take a look at some pre-market movers. So Intel, obviously, it returned to profitability, gave an upbeat forecast, and those shares up more than 8%. If this gain holds, the company will be up almost 100% year to date. Newmont Mining is down 6%. Now, its production guidance for 2026 did disappoint. Also, lower gold prices, relatively speaking, weighing on the shares just a little bit recently. But it's important to note this stock is up 150% year to date, thanks to those gold prices in particular. Decker Outdoors down nearly 12%. It can't catch a break. It's the maker of Hoka's. Obviously, that's its primary growth driver, extending this double-digit dip on weak sales forecast. And that stock is down 50% year to date. That's it for Bloomberg Brief. Surveillance is coming up. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I am never doing that again.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
we're in that moment where we see downside risks to the economy.
It's problematic that inflation has been stuck at 3%.
We should be very careful about cutting into higher inflation.
The CPI report probably is going to be using more estimated results than normal. This data may not be as reliable.
The Fed is going to cut almost regardless of what inflation print that we get.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, it's CPI day. Investors bracing for the delayed September inflation report as economists are looking for signs of tariff pass-through just 1 week before the Fed convenes and the much-anticipated Trump-Xi get-together in Asia.
And this is important because it really goes together. As these two leaders of the world's biggest economies get together, the question is who has the leverage? Who has the bigger impetus to really cave in some sort of new normal as they try to get some stasis? And ultimately, that will come down to the economy. Who is weathering the storm and some of the changes better? And that right now is what a lot of people are parsing through with all of the data, and that's the reason why this sort of clarity in the fog of the CPI is going to be important.
Before we get to Thursday and these two leaders sitting down, what's going to be really important for the market is what happens this weekend. What kind of tone is set when He Fang sits down with the Treasury Secretary Scott Bessent, and what kind of parameters of a potential deal could we see following that meeting? Because they're going to set this table for Xi Jinping and Donald Trump. Base case is we just get an extension of this truce that is going to be ending on November 10th.
Such a massive week next week. A get-together between China and the United States, a Federal Reserve rate decision, and seemingly the data this morning has absolutely no relevance to any of those things based on what we've heard. Headline CPI could have a 3 handle later on this morning, and this Federal Reserve's still going to cut interest rates next Wednesday.
I would take that a step further. It likely will have a 3 handle when it comes out later this morning, and people are going to look past it because there aren't necessarily the inflationary inputs on a longer lasting basis. And also, nothing has materially changed since the last time that Fed Chair Jay Powell said that he is going to cut rates essentially for all intents and purposes. Question is, what is the signal coming from earnings also? Yes, we're getting CPI, but next week we are getting more than 40% of the S&P 500 reporting earnings, and so far the earnings have been blockbuster good relative to expectations. So how do you pair the idea of an economy that's weakening, an employment market that's flagging, with the idea that earnings are coming in better than good, and you have a CPI coming in hotter than you'd like? How do you pair those things together and get a Fed that's cutting?
I think we get $10 trillion plus a market cap reporting just on next Wednesday alone. So big couple of days coming up next week for earnings season. Big tech in focus. Equity futures this morning positive by 0.3%, on course for a second week of gains on the S&P 500. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer, with stocks holding near all-time highs. George Pollack of Signum, with President Trump and China's President Xi set to meet, and the former Kansas City Fed President Thomas Hoenig ahead of CPI data later this morning. We begin this hour with stocks rising as markets await the latest read on inflation. John Stolfus of Oppenheimer writing, our intermediate and longer-term outlook for the U.S. economy and the stock market remains decidedly, drumroll, bullish. John, the most bullish man on the street. Good to see you, sir. Good morning.
Good to see you, too. Thanks.
Let's get to some of these questions regarding inflation. How relevant is this morning's CPI data to today's market?
I think as long as it comes in line or close to in line, I think we'll be fine. If it's a drastic surprise, then, of course, to higher inflation, not so. And if it's also a much lower inflation, then people say we're in trouble. Is the Fed going to do 50 instead of 25? So it's any kind of action that can create bips for the traders you have to watch for. But we think it'll be it'll come in line with expectations, and we think that we'll get a cut tomorrow.
It's important to the extent that it shapes perceptions of Federal Reserve policy for next week and beyond. Does it shape perceptions of monetary policy for next week and beyond?
You know, I think we've said for a long time, we think the Fed is making down payments to Main Street and to Wall Street to give them an idea. Indeed, this monetary tightening policy period is ending. It's just not ending as quick or as deep in terms of the cuts as both Main Street and Wall Street would like. But sometimes, you know, you can't always get what you want, but you may find you get what you need, you know.
Well, at this point, we're looking at earnings that are coming in better than expected. We're looking at a Fed that's going to look past any kind of CPI print and cut rates. And yet, yes, you're bullish. At the same time, you're talking about going up in quality. Mm-hmm. How do you pair those two ideas?
Well, you know, I think you have to be realistic in that the market has genuinely shown that it's still a little bit nervous about small and mid caps. You have these days when we go risk off, where they don't go completely risk off in a traditional sense. They're not running out of the market, but all of a sudden you'll see the smalls and the mids will get a good day, you know, versus the large caps. But when it comes down to it, people are concerned that perhaps the economy is weaker than perceived. We're in this blackout period without any data flow. So the thought really is it's you hug the large caps, but also the large cap stocks appear to be the most resilient when it comes to earnings. If you look at the earnings reports for the last earnings season, fourth quarter, first quarter, second quarter, and thus far third quarter, this looks good.
I love a good cliche on a Friday morning. What inning are we in here? Just because that is sort of a question, given that some people were talking about almost recession-like conditions earlier this year that have really revived, and a sort of reacceleration now into the beginning of next year.
Yeah, I'd say, you know, we've thought for a long time, because of the change in the Federal Reserve's policy and the way it acts, how quick it acts, and how communicative it is, that essentially we've for a long period it's an extended mid-cycle. I like to say the economic cycle is as wide as the Amazon, and we mean the river, okay? Because it's been going on for a long time. How often have you heard from the bears we're late cycle, and then all of a sudden some of the most bearish in the past are saying we're actually coming to early cycle, and we're going back and forth. No, I think it's a big fat mid-cycle, and it's because between the Federal Reserve policy, this Ben Bernanke legacy, as well as increased use of technology, creating greater efficiencies for both the consumer and business, and experience that's been garnered from all these things, whether it was the financial crisis, COVID, coming out of COVID, supply chain, trade wars, all this stuff. It's better than expected, and it's resilience. It's not, you know, what was the old word they used to call us? Robust. Heck with robust. I will take resilience is what I like.
Well, you have a very long-term view.
Yep.
Short-term, though, there's a lot of policy uncertainty. What gives you the most angst?
Anne-Marie, it's well, what gives me the most angst is it has very little to do a lot of times with the market. It's just that the popularism of socialism and communism, which are failed ideologies, is rising in different places around the world. But I think related to what keeps me up at night is just I look at valuations, and as long as it's recognized that valuations are probably higher than historical standards would have us at this point, what we're believing is that people are investing more seriously than ever before, at least in the U.S., because they recognize Social Security will simply not be the same percentage of income in retirement. And people are worried that they might live too long. They don't want to lose their living standards. And so people go to equities, which historically have proven to be past performance, no guarantee of future results. But it's that equities have shown resilience in dealing with inflation, changes in the economy, changes in trend. It's good to own a good business.
This must be a generational thing. Who do you know that worries about living too long?
Well, you know, but everybody.
I was going to say the same thing.
Do you know anyone?
Not at all.
If you look at it, though, if you look at
another year,
what they report in terms of investor behavior, it's cross-generational. So you still have, among the youth, you still have the desire to gamble in a bull market. It's the crypto, it's gold or silver.
I admire their bias to take risks, don't you?
Oh, absolutely. And you need that. It's good for liquidity. But they also are investing seriously on the other side of it because they recognize that this Social Security, it's not that the politicians are going to eliminate it. That would be like an insurance company default. Sure. And those people would never get elected ever again to anything. But they recognize it just will not be the same support that it was, the same safety net.
I think America gets it. I think it's the Europeans that don't. The state is just not going to be there for them. Particularly our generation. In the coming decades, the state is not going to be there for them in the same way. Do you see the Europeans doing the same thing, a bias to invest, to participate in capitalism in this equity market?
I think from a cultural perspective, it's more difficult to move towards that. You've begun to see it just in terms of, if you look at elections in Europe, if you look at the way the market is beginning to respond to needs for development of technology to some extent, all of that shows that things are changing, but slower, because it has been, Europe and the UK have been steeped in socialistic practices that are big government, and that's expensive bureaucracy for the services provided. And there's a move that's beginning to happen. It's a pendulum that's slow, and politically it's, gosh, you have to avoid missing the signal for all the noise on a day-to-day basis. But the market is telling us this is actually manageable. And if anything, the alternative to cooler heads prevailing is much too awful to move towards.
Well, and this is really the key question. Are things better than expectations? What we saw this morning out of Europe were PMIs that actually came in better than expected, led by Germany. France is its own story. I'm just wondering, how much you can get excited there, or how much you really are staying focused on the United States based on the underperformance of the dollar so far this year, and based on the fact that you do have the base of people who very much are going to invest in preparation for reduced benefits down the line.
I would have to say we're still overweight U.S., but we say meaningful exposure to both developed international markets as well as emerging markets, because there you've got combination of valuation, demographics, where they are on the timeline of their financial history, at an attractive area. But we would have to say in the U.S. that it's accountability, transparency, and governance for all the arguments that we have. We do have all kinds. You just see it in all the court action that happens in Washington. It's you've got people can still work things. There's a potential to work things out. The other thing is the dollar. When I look at it versus the Bloomberg dollar index, which is my favorite because it includes the emerging markets as well as the IFAs. What you've got is it was up last year. It was up about 7.98%, not to get too specific. And this year, it's down something like somewhere between 8 and 10, depending what day you look at it. It's down. Essentially, it's just giving back after a period of the dollar being so incredibly strong, because in an uncertain world, when things get really bad, all the world moves towards Papa, which looks like Uncle Sam.
And so much of that dollar weakness so far this year, first quarter story. First quarter story. So much of it in the first few months of this year. John, it's good to see you.
Great seeing you.
Thanks for dropping by. Thank you, sir. John Stolfus there of Oppenheimer. Equity futures on the S&P just about positive here by 1/3%. We are poised for another week of gains with an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada, citing a TV advertisement from Ontario. The commercial features excerpts of then President Ronald Reagan defending free trade. The president's accusing Canada of timing the ad to interfere with the Supreme Court case against his country-by-country tariffs. Arguments in that case are set for November 5th. Meanwhile, talks between U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier Hu Lifeng are scheduled to take place in Malaysia this weekend. The meeting comes ahead of President Donald Trump's sit-down with China's Xi Jinping next week. President Trump wants China to resume American soybean purchases, crack down on fentanyl, and back off restrictions on rare earth exports. And a federal sports gambling probe is rocking the NBA. Miami Heat guard Terry Rozier and Portland Trailblazers coach Chauncey Billups were arrested and charged yesterday, along with at least 30 others. The arrests are linked to 2 separate illegal gambling schemes, one of which is connected to the mafia families in New York. The NBA has placed both Rozier and Billups on immediate leave. That's your Bloomberg Brief. John?
Yahara, thank you. The most bizarre story of the week so far, isn't it? Just crazy.
Can't wait for the
Wild.
movie. Unbelievable. And they use like James Bond technology at poker games. It's insane.
Yeah. Okay.
Why do they need more money?
I got nothing good to say about the NBA right now. Up next on the program,
I was about to say.
Talks with China.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. So a meeting with President Xi.
Up next, we'll catch up with George Pollock of Signum. He joins us in just a moment, live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Live from New York City, welcome to the program. Equity futures on the S&P 500 firmer here by 0.3%, on the Nasdaq up by 0.5%, on the Russell up by 0.4%. Under surveillance this morning, talks with China.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. They can't sustain that. We don't want them to have to go through that. So I'm meeting with President Xi, and I would say we have some big issues, like with the farmers and various other things. But the first question I'm going to be asking him about is fentanyl.
So here's the latest this morning. President Donald Trump and Chinese President Xi Jinping are set to meet on Thursday in South Korea as the world's two largest economies look to ease trade sanctions. Jack Fitzpatrick of Bloomberg Government joins us now from Washington, D.C. Just how high is the bar for next week, Jack?
The president has set the bar very high. He said previously that he wants a deal on everything. If you're talking about every big part of this deal, you heard him talk about China cracking down on fentanyl. We know there's a major focus on Chinese purchases of U.S. soybeans. There's a major focus on those Chinese rules around rare earth materials. I know a lot of people watching this very closely are skeptical that there's actually going to be a massive deal on every major component of this, and a winding down of tensions itself would be a big deal. But when you have these two principals meeting, President Trump has established he has very high expectations on some of the highest profile parts of this. So at the very least, the person going into this from the U.S. is going into it with a lot of ambition.
Jack Fitzpatrick down in Washington. Jack, thank you. To extend the conversation, George Pollack of Signum joins us now for more. George, let's go through the issues. Rare earths, soybeans, and then we've got the issues around fentanyl. Of those three, what's the hierarchy? What's the more difficult one to achieve?
I think for the president, the most difficult one to achieve is rare earths, because China understands that with rare earths, they have the U.S. in a disadvantageous position. And they remember when these tariffs were first implemented earlier this year, the car manufacturers came to the president and said, if you don't get the rare earths started, we're going to have to shut down production. And China knows that, and that's where the president's probably going to have to be most aggressive, but at the same time understand China has the advantage.
Is China sending any signals that they're prepared to walk back what they have been doing when it comes to rare earths?
I think China's understanding of the rare earths issue is we haven't really done anything. And what we have done was more a response to your restrictions. And all we're doing is setting up a new licensing regimen. Rare earths are going to continue to come out, and you don't have to worry. So for China, we're happy with the status quo, but you decided to change things up, and you've decided to overreact and become more pugnacious.
Well, it's not just a new regime when it comes to rare earths. Any material that China exports that has an ounce of a trace of a rare earth needs to get a specific export license, which is why the Europeans are even considering using their anti-coercion tool. George, the fact that the Europeans are willing to go to the third rail, a tool they've never used in any negotiation, is that at the moment helping the United States into Thursday's meeting?
I think for the president, from Scott Bessent's viewpoint, it is helping the president give him a more global power and a more global idea that this can't go on. But at the same time, China is responding to this as that's great that you're united, but we still have the advantage, and we don't understand why you're being so aggressive with us back and why you're deciding to play it so fast and loose.
So what's your base case then for Thursday? Is it just a continuing rolling truce?
Our base case is a continuing rolling truce where the U.S. and China understand the current situation where the president's threatening increased tariffs and the continuing threat of this new licensing regime kind of rolls back to an extent where we get back to the Geneva or London understanding. But that doesn't mean it's a positive situation, because we're still going to be having these situations pop up every couple of weeks where either the president is frustrated or China is frustrated.
In the past few weeks, it seems like the U.S. has been trying to mend relations with a number of traditional allies and create closer ties, which is a reason why, in the wake of the announced meeting between Xi Jinping and President Trump, the new tensions with Canada are interesting. How do you sort of understand that in the bigger sphere of negotiations with China?
In terms of the tensions with Canada, the way we view this is Canada's right now between a rock and a hard place with the canola tariffs and EV tariffs they've placed on China, and they need to get that restarted. But at the same time, they need to deal with USMCA renegotiation. And we've always thought that USMCA is going to be an aggressive renegotiation from the president, and things like transshipment and rules of origin are going to come into play. And I think for the president, he's making clear to Canada, you're either with us, the United States, or you're with China. You can't get both.
This feels like a long game of leverage, and that's sort of been the big question between the U.S. and China, who has the leverage, and people argue on both sides. China having the leverage in rare earth minerals, maybe the U.S. having a bit of an edge when it comes to technology and just the dynamism in the U.S. economy. I just wonder how much you expect there to be some discussion of Russia and oil purchases, how much that's on the table versus just getting there and figuring out how to jawbone and kind of poke your elbows out to sort of have the same thing that we have right now.
Look, I have no doubt that there's people in the White House who would like to discuss Russia, who would like to discuss oil, but I think the president's made clear his priorities are, among other things, fentanyl and soybeans, and I think that's where his focus is going to be. He is thinking short-term right now, and most likely his biggest short-term weakness is the farmers and is their inability to get assistance during the shutdown, and inability to get assistance because China, for the first time in 7 years in September, did not purchase a single soybean.
Can you tell me, George, your date on the calendar, what's circled, when you think the shutdown finishes?
I think we're still taking the place that this ends November 1st. For us, Senate Democrats understand that at November 1st, the healthcare enrollment opens up. Republican voters are going to see that their premiums increase. And for Democrats, that will be, while it'll be negative for voters, Democrats will be able to say, we wanted to fix this. Republicans were the one who said no.
So you're basically saying it ends November 1st because Democrats will line up for the continuing resolution, not because they struck a deal with Republicans on health care.
I think what will have to happen is Senator Schumer will have to walk a hard line to not go down, but to navigate his caucus and to allow either the retiring members or the more moderate members to vote for it. And then message saying, Democrats wanted to fix your health care. Democrats wanted you to avoid these premiums, but Republicans were the one who were saying no. And that will be the Democratic win will be, one, making health care an issue in the election. Two, Democrats being able to take the 80-20 side of an issue, the 80 side of an 80-20 issue, and Democrats being able to say Republicans are the ones to blame for what is happening with your premiums, and if you want to punish them, the best way to do that is to vote for us.
George Pollack of Signum. George, thank you. Got to fix that clock. 20 minutes behind, right? Make it happen. I noticed that. It's a distraction, George. Otherwise, fantastic conversation. A week tomorrow, November, by the way, it's just around the corner.
So November 1st, I think, is actually really soon to end this shutdown. I don't see any side blinking. Maybe this healthcare issue on November 1st, the enrollment opens up, could become a pressure point. But the fact that this administration is looking at ways to pay air traffic controllers, especially as we go into Thanksgiving, they're looking at ways to continue to pay the military. As long as those individuals, potentially, there's an off-ramp for them to get paid, I don't see why anyone is in a rush to open up the government.
So just to be clear here, it's not that it's different this time. They've just been able to push off those traditional pressure points.
Right, definitely when it comes to the military, and they're finding potential ways to get FAA workers paid. Can you imagine all your flights are delayed around Thanksgiving? That is not good optics for anyone in Washington.
You're going to have to wait even longer. for the data.
Well, yeah, that's another issue. And even if the government reopens in the next couple of weeks, you're going to have to wait a while given the collection and just how messy it could get. But to the idea of travel, I just think it's really interesting that House Speaker Mike Johnson has come out and said we're close to running out of funds to be able to really cover the air traffic controllers. So it's going to get messier sooner rather than later. Again, who has the leverage? It's going to come down to the polls. And right now, the Democrats are doing better than the Republicans in the polls when it comes to the shutdown.
The complaints will begin to pile up over the next few weeks, I'm sure. Equities right now in the S&P 500, very close to record highs, up by 0.3% so far this morning. Up next, we'll catch up with Garrett Nelson of CFRA, with Ford posting some very strong sales but cutting its outlook. Plus, Danny's back with your morning movers. Intel up on an earnings beat. In a pre-market, that stock higher by more than 8%. What a few months that company has had. From New York City this morning, good morning to you all. You're watching Bloomberg TV.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Heading towards a second week of gains on the S&P 500. Equity futures up by 0.3 on the week so far, up by more than 1 percentage point on the Nasdaq, higher by 0.5. Let's get you some stock movers this morning. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. What a year it has been for Intel in this earnings season, really just underscoring that, saying that they're going to be profitable for the first time in some time, boosting their outlook. Intel shares up 8.3%. They have a lot going for them. They have the backing of the White House, from NVIDIA, from SoftBank. Also noting a PC rebound, that really supporting their earnings. I should just note Intel is up already 90% this year. At this pace, it will have doubled its share price from the start of the year. We also saw some earnings from Ford after the bell yesterday, to a $2 billion hit from a fire of a key supplier at an aluminum plant. But Ford outlined their vision for the future in which they can overcome that. Investors seem satisfied by that. They also pointed to sales of their heavy trucks and SUVs, echoing what we saw from GM, people willing to buy that. So shares up 3%. But apparently, what people are not willing to buy are Hoka's and Uggs. Decker, the maker of both of those brands, giving a really weak forecast. In fact, cutting their outlook for the second half. The CFO saying it is a consumer that is a little bit cautious. They cited tariffs specifically, saying that the higher price means that people have been pulling back. They are working on mitigating their tariff costs, about $150 million, saying that half of that they think they can mitigate. Either way, shares are getting crushed, down more than 11%, John.
Before that move, the third biggest decliner on the S&P 500 so far this year. Include that move, and it's the worst performing stock on the S&P. Deckers have been absolutely hammered. I was going to say something worse. On our radar this morning, President Donald Trump terminating all trade negotiations with Canada following a Canadian advertisement against his tariffs plan, featuring the voice of the former U.S. President, Ronald Reagan.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
The Ronald Reagan Presidential Foundation and Institute saying Ontario did not seek permission to use the remarks. Elsewhere, Argentine President Javier Milei is meeting with JP Morgan CEO Jamie Dimon in Buenos Aires before midterm elections this weekend. Sources telling us here at Bloomberg that Milei is also delivering a speech to Latin American CEOs at an event organized by JP Morgan. And finally, JP Morgan among banks preparing to launch a record $38 billion debt offering to help fund Oracle data centers in both Texas and Wisconsin. The possible deal is part of Oracle's effort to invest $500 billion in AI alongside Open AI.
This is a fascinating story that keeps percolating out in terms of how Oracle is going to finance some of their promises, especially given that it's coming increasingly in the debt market. Now we're looking at tech-related debt in the overall corporate bond market that is exceeding the financial debt outstanding, which had been the previously biggest component. It just raises a question: how levered is this entire financial cycle to artificial intelligence and a model of it that is current but might not be future? And that, I think, is a fear that keeps coming back to a lot of investors.
And when it comes to these data centers, they're front and center for the Energy Secretary Wright this morning. He is pushing out regulators and urging them to accelerate the process of allowing the data center sectors to actually hook up and connect to power grids. So the U.S. administration is really trying to push these companies to quickly get shovels in the ground when it comes to data centers and have them up and working with the power grids. Of course, this is going to become incredibly political next year, like we're seeing electricity prices become a hot button issue in both the Virginia and the Jersey governor races.
Issues like that have the potential to kick around the debt market. You're familiar with credit issuance. That's a big deal for the credit market.
It's unprecedented. We've never seen a deal that's that big, and it's tied to a company that has increasingly speculative deals. I understand it's not increasingly speculative as its own credit rating. Nonetheless, it has increasingly invested in companies that are below investment grade, that have also issued debt. And we are talking about suddenly new leverage coming into this story. That, I think, is a real question. How much bigger will some of those issues be in the debt markets, in the leverage loan markets, in the private credit markets, given how much exposure there really is to this story?
That issue size is typically something you'd see coming from the Treasury. It's a big number. Let's turn to autos. Ford shares rising after topping estimates on third quarter profit and sales, but lowering its outlook after a factory fire and pausing production on the electric F-150. Bloomberg's Craig Trudell joins us now for more. Craig, welcome back to the program. We can put some pieces together now. What we heard from GM on EVs and what we just heard from Ford. What's the biggest story here?
Yeah, I think the sort of here and now story absolutely is that fire at Novelis, an aluminum supplier. It's been a while now actually that Ford's been sort of kind of the exception in the U.S. market with aluminum bodied pickups. So the fact that this fire took place, it meant that it was really going to hit them hardest, because these are really their moneymakers. F-Series, full-size SUVs as well. So there is going to be this short-term bit of pain for the company, and we saw the shares really sort of take quite a hit a couple weeks back when reporting on the extent of the disruption involved here sort of emerged. But it does seem that investors are sort of getting comfortable with the path out of this situation. And the ability of that supplier, Novelis, to get back on its feet before year end.
Craig, as we put the pieces together, what's underlying demand like right now from the consumer for these vehicles produced by these companies?
What's incredible is just the amount of demand for big SUVs. The likes of the Lincoln Navigators or Ford Expeditions. At GM, the Tahoes and Escalades. Also full-size pickups, and I think the Trump administration has really sort of taken any handcuffs that were on the Detroit manufacturers with respect to emissions or fuel economy. We're now sort of letting loose in those regards, and these companies honestly didn't wait for those policy changes. I think the writing was sort of on the wall based on the way that Trump was campaigning on those issues. And we've seen them, boost production and the consumer eager to buy those. I think, you look at Stellantis as a prime example there, where under the previous CEO, Carlos Tavares, he was trying to wean them off, very, very old V8 engines in their pickups. Once they brought that engine back, you've seen actually the consumer really, sort of eager to go back to Ram and get themselves a V8 Hemi, which I think we've spent the last few years with all of our attention on this transition to EVs. It's been very clear that the American consumer was not quite as ready to make that transition as I think a lot of people thought, a year, even 3 years ago.
Craig, I think that's such an important final point. Craig Trudeau there of Bloomberg. This is not just about EV tax credits and all that stuff. This just wasn't where the consumer was in this country.
They weren't where the consumer was, and a lot of that has to do with the infrastructure of how there's not a lot of charging stations that were set up. And the Biden administration tried to put more charging stations out there, but it just didn't come in time as they were pushing for electric vehicles. The EV subsidy is basically the same price as just buying an entry-level BYD car, which I find fascinating.
Isn't that amazing?
It's $7,500 basically. Either get the subsidy or just buy a car from China.
Ford in the pre-market higher, by the way, up by a few percentage points. Garrett Nelson of CFRA writing, the beat combined with an expectation that the company can recover $1 billion of the fire impact takes the worst-case scenario off the table. Garrett joins us now for more. Garrett, welcome to the program. What a year it's been for these manufacturers, stuck between really volatile tariff policy and changing policies around emissions as well. Out of all the companies that you cover at the moment, Garrett, who's in the right place at the right time?
Yeah, thanks for having me. Actually, the only stock in the auto manufacturing industry that we have a buy on right now is GM. And I think when they reported earlier this week, it really demonstrates why we are bullish on the company. Very solid quarter, significant increase in their full year guidance as fears around tariffs have really gone away. GM was hit arguably the hardest of any auto manufacturer back in the spring when the tariffs first were announced. And so we like GM the best. They're returning a lot of cash to shareholders in the form of buybacks. And we're largely neutral to negative on the rest of the industry. We have a hold on Ford, and we have sells on strong sell on all the EV manufacturers, Tesla, Rivian, and then we have a strong sell on both Lucid and Polestar.
How much, Garrett, does this have to do with where consumer demand is right now? The fact that people are going into more expensive trucks, which has really supported what General Motors has been doing, and not into, as you say, electric vehicles and some of the products that Ford more heavily manufactures?
What we're seeing across the industry is that the auto manufacturers who made bigger bets on hybrid vehicles several years ago, which is largely the Asian manufacturers, such as Toyota. Toyota sells more hybrid vehicles in the U.S. than all other auto manufacturers combined, as well as Honda, a big hybrid seller. They are really now benefiting from consumers who are have shown that they're comfortable with hybrid vehicles, but just not as comfortable with electric vehicles. In fact, hybrid vehicle growth last year was in the U.S. Sales growth was about 5 times the growth rate of electric vehicles. And so, Ford is another company that's had success with their F-150 hybrid and their Maverick hybrid. And you're going to see a lot more hybrid models coming to market here over the next few years. And we think there's really tremendous pent-up demand for hybrid versions of the large SUVs because Americans love their SUVs.
We've been talking about cars for the past 10 minutes, and we haven't talked about tariffs, which is notable to me given the fact that they were supposed to be at the epicenter of the pain. And in many ways, the idea of auto-related jobs has been at the epicenter of a lot of trade disputes. I just wonder, do you think that that story is over? Do you think that GM and Ford and Tesla, although Tesla was in a bit of a different position, have brought jobs back to the United States, rejiggered their supply chains, and are now more immunized?
Well, these moves, we've seen a number of announcements. Stellantis most recently made a big announcement a week or two ago that they're investing. I think $13 billion was the number in the U.S. So you're starting to see some of these announcements. The problem is it's a multi-year thing. It's going to be years before these factories are actually built and up and running. But I think the tariff issue is largely in the rearview mirror, and it has been really for at least 3 or 4 months now. But of course, there could always be new tariffs announced. This is the environment we're in with this administration. And I think there's a fair amount of nervousness regarding what could be announced going forward. But I think the attitude of the street and investors right now is, not so much on tariffs and more looking out to what demand looks like in 2026 and 2027. There's 2 very powerful tailwinds here for the industry, and that is interest rates are now declining again, and oil prices, crude oil prices, back hovering right around $60 a barrel, well below where they were at the start of the year. So those are 2 very powerful things for the industry that they have going for them.
Garrett, at the same time, we know the supply chain when it comes to the autos is deeply connected between Canada, Mexico, and the United States. And I woke up to a Truth Social from the president saying all trade negotiations with Canada are terminated. If you're an auto sector CEO, what are you doing about this?
You're diversifying your supply chains, and I think it's what they've been doing for the last 6 months or so. Even before that, really going back to the election when Trump won, for almost a year now, given what that he really campaigned on the tariffs and making the tariffs a cornerstone of his economic policy. So I think the auto manufacturers have taken steps to mitigate the effect of the tariffs, and they're diversifying their supply chains going forward.
Garrett, can we just finish on a different story? Subprime auto lending. There's clearly been some problems building for a long, long time, and these companies apparently so far untouched by it all. But how does that inform the new car market, what's been happening and developing in this country for a number of years?
Yeah, I think you're seeing especially dealerships and manufacturers really, becoming more cautious with consumers. You mentioned that there was the Tricolor bankruptcy just a few weeks back. And I think that really raised escalated concerns regarding the consumer. We're seeing a lot more distress at the lower end of the income spectrum among consumers. And really that bifurcation between the high-income consumer and low-income consumer has been widening for some time now. But you're at a point where there's actually a lot of distress among lower income consumers. So I think you're going to see the industry being a lot more cautious in terms of their loans going forward. And I think certain auto retailers have been hit if you look at the equities, just given concerns about what might be in their loan portfolio.
One to watch over the next few months, maybe. Garrett, thank you, sir. Garrett Nelson there, a CFRA on Ford, GM, and Tesla, covering a range of companies here in the United States. The favorite GM. Right now, the equity market very close to all-time highs. Positive story, up by 0.3%, with an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. The U.S. government shutdown is now in its 24th day. Yesterday, Senate Democrats blocked a Republican bill that would have paid members of the military and federal workers who've had to stay on the job. Democrats say the bill would give President Trump too much leeway to decide which government employees have to keep working while the standoff continues. Meanwhile, Binance co-founder Changpeng Zhao, known as CZ, has received a pardon from President Trump. Trump told reporters that it was done at the request of, quote, a lot of good people, though he has never personally met him. The move marks the latest act of clemency the White House has granted to a crypto entrepreneur, underscoring how the Trump administration has positioned itself as a friend of the industry. And Target has made the decision to eliminate about 8% of corporate roles in its first major restructuring in years. According to a memo seen by Bloomberg, the retailer is cutting 1,800 roles across various teams, including 1,000 layoffs and closing out 800 open roles. No roles in stores or the supply chain have been impacted. That's your Bloomberg Brief. John.
Yahira, thank you. Thank you very much. Up next on the program, sticky inflation.
We're not getting much progress on inflation. That this report actually is going to be a continuation of numbers that are at 3% or higher rather than moving down towards 2%.
Is that a problem for this Federal Reserve? Up next, the former Kansas City Fed President Thomas Hoenig from New York City. You're watching Bloomberg TV.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about the human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs?
How
and
are
you're
the
lowering the cost of meatballs, too.
I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We actually are running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We've had a bit of disruption over the last 2 weeks. Think about 3 things. Volatility around the US-China story, Flashy headlines about credit, tighter restrictions on Russian crude, and yet equities, the grind higher continues. On course for 2 consecutive weeks of gains and up another third of 1% on the S&P 500, on the Nasdaq up by 0.5. Under surveillance this morning, sticky inflation.
We're not getting much progress on inflation. That this report actually is going to be a continuation of numbers that are at 3% or higher rather than moving down towards 2%. So that is a challenge for the Fed as it tries to weigh how much emphasis to put on inflation and how much emphasis to put on what's happening in the labor market.
So here's the latest this morning. Traders are awaiting the September CPI print due out at 8:30 Eastern Time. The estimate in our survey is expecting core CPI to stay above 3%. The former Kansas City Fed President Thomas Honig writing, if the CPI stays at or moves above 3%, the Fed will be hard-pressed to justify additional cuts unless the unemployment rate spikes surprisingly to the upside. Thomas joins us now for more. Thomas, welcome to the program, sir. Let's build on some of that commentary. We should get a headline read of 3%, maybe 3% plus, based on the estimates we've got on Wall Street so far this morning. Thomas, why doesn't that compromise the decision to cut interest rates next week?
Well, remember, number one, 3% is not even close to price stability. And it's well above, 50% above the Fed's 2% target. So they have a credibility issue there. Now, one of the things the Fed has done is made it very clear they've kind of rotated towards focusing on the employment numbers. That seems to be carrying the day, and that's why everyone expects another quarter point cut. But I would say that if it stays at 3%, they will do the 0.25% cut. That means real interest rates will be 1% or less. That's very stimulative, I think. And that will push the economy forward. So they have to be pretty careful about how much they signal more cuts going forward. And whether they should be cutting, I might question, but that seems to be pretty much on their agenda given their rotation towards employment concerns.
Thomas, based on commentary we've had so far, particularly from the Fed chair, tariffs and trade is not a source of inflation they're particularly worried about. Is there a source of inflation, from your standpoint, in your mind, that threatens the Fed's easing bias?
Well, I think inflation, the sources of inflation, I think tariffs will still carry some more upward pressure, perhaps not as much as people had originally thought, but I think it's still going to be a factor. I think you also have playing with this in this environment, you have this wealth effect. I think Meredith Whitney, who writes on consumers, said there's so much real wealth tied up in the housing market. Home equity lending is going forward. We're seeing some re-leveraging there. Those are factors that will increase demand and put more pressure on inflation. The Fed has to be aware of that, and I think that has to be in their calculation. But I think they're under pressure to cut, and I think they will tend to do that unless we have an upward surprise in that inflation number well above the 3% number, 3.2, 3.3, something like that. Then they're really going to have to rethink things, I believe.
Thomas, can you argue that this is a Fed that has been inclined to run this economy hot and keep rates artificially low for a pretty long time?
I think it's their yes, I do. I think they've been very sensitive to keeping the economy strong, demand strong at least, and that has carried the day. And that's particularly they're getting pressure from the administration to do that right now. So their inclination will be to lower the rate so long as inflation is 3%. That's kind of the new normal for them, it appears, which I think is unfortunate.
Isn't there a sort of additional mandate that's coming into play that nobody wants to talk about, which is fiscal sustainability? And I understand that this is coming in part from the administration, but this has really predated the administration. And increasingly, a lot of people have seen this as a potential input for the Federal Reserve. Deutsche Bank put out a report saying that from 1942 until 1951, one of the main ways the U.S. reduced the debt was keeping rates artificially low. I mean, how much do you see that as something that's sort of a de facto part of Fed calculus going forward?
Well, I don't know that it is, but it should be. I think the fiscal challenge, the Fed will become increasingly under pressure, given that the reserves have come down, the so-called excess liquidity in the market seems to be coming down, and the fact that we have $2 trillion of debt to fund, new debt to fund. The Fed is now going to become a fiscal enabler as we go forward from here, and that will be the pressure they put on it. And that's only going to make their challenge about maintaining price stability all that much more difficult. So they better be thinking ahead towards that, and they ought to be having some conversations, I hope, with the Treasury about this. And that's really part of the standoff. The fiscal challenges, our main issues going forward as far as inflation goes is the pressure on the Fed and the ability of Congress to find some kind of compromise around the fiscal challenges that are building. I mean, they're there, and yet they're getting worse.
Best of luck with that, Thomas. Thank you, sir.
Yeah.
Thomas Einig there, the former Kansas City Fed president, an issue I think we'd all love to see dealt with. It's curious that we've seen these complaints leveled at this Federal Reserve, because if this Federal Reserve has been reckless, it's been recklessly dovish, not recklessly hawkish, and they're the complaints we often hear on this program.
And frankly, they've been recklessly dovish for a long time, and part of it is because of fiscal sustainability. And when you look at the debt expansion over the past 5 years, it has been facilitated by a Fed policy that has really bolstered that and bolstered the ability to take on debt. Going forward, how able are they to truly be independent in the traditional sense when there are these fiscal sustainability concerns that are real? And that is something that increasingly people are asking and factoring into their calculation for the Fed.
I acknowledge the importance of the politics of the debt story, but I think it's the politics of the labor market story, particularly under this Fed, where this Federal Reserve has really been spooked by any kind of weakness that developed in the labor market. You know, we used to say that cycles don't die of old age, the Federal Reserve kills them. Not this Federal Reserve. This is a very different Fed.
They were scarred by 2008 and the scarring in the labor market, and they're trying to get ahead of it, and that clearly is the priority.
Up next on this program, we'll catch up with Kristen Bidley of Citi, Scott Lincecum of the Cato Institute, Ozan Tarman of Deutsche Bank, and Ashok Bhatia of Neuberger Berman, the second hour of Bloomberg Surveillance. Up next.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We are deprived of macroeconomic data at the moment, so we have to rely on earnings results.
The engine of earnings growth is going to be in those tech names.
There is a genuine risk that actually the earnings beat rate will be even better than in the second quarter.
We have to rely on these earnings, and they're continuing to say that the U.S. consumer is very resilient.
The day-to-day noise around uncertainty is high, but I think all of that starts to come down, and America does really well in the next couple of years.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 positive this morning, up by 0.3%. On the Nasdaq, up by 0.5%, heading towards a second week of gains. Some data, yes, really. 8:30 Eastern time, we finally get some economic data. CPI, a delayed report for the month of September, just around the corner.
Yeah, how much does it matter is really going to be key. I'm curious how much the market could potentially react to CPI. Is it potentially a bigger surprise to the downside or to the upside in terms of the market response? If, let's say, CPI comes in below 3%, which it's not expected to, do you suddenly start to see 50 basis point rate cuts getting priced in through the remainder of this year? And alternatively, how high is the bar for inflation to come in for the Fed to truly consider not cutting interest rates?
Mike Gapen of Morgan Stanley wrote a nice note on this. I don't think anyone thinks this is really going to change the story for next Wednesday, interest rate reduction. What it could do is constrain their ability to guide beyond October, because we know there's some division on that committee. We've got to settle a range of issues, including US-China trade talks. We've got a date? I think we've got a date for next week.
Thursday, Xi Jinping is set to sit down with President Trump, according to Caroline Leavitt, the press secretary. More importantly, though, the Treasury Secretary is sitting down with his counterpart this weekend. So by Monday morning, the market actually might have some clarity on the parameters of what we can expect from this meeting. Libby Cantrell of PIMCO was talking about this earlier. She just is expecting basically a détente of the most fiery rhetoric we've heard over the past 2 weeks. And basically we go back to a rolling basis of what these two countries have agreed upon. This story is going to heat up once again next year.
And maybe that's good enough for now. Companies have re-engaged. We saw that with the bank earnings. Are consumers going to re-engage in a major way into year-end, into the holiday shopping season?
That's ultimately the key question. And really, that is really something that even CEOs cannot respond to. Yes, you see travel coming back, but retail clients, you can see, have really hesitated to order their toys from Mattel or really come out and make suggestions about how much they can increase prices into year-end. I thought that this was the line of the day from Ian Lincoln of BMO Capital Markets yesterday. In the land of the data blind, the one-off headline is king. This is the reason why a subprime mortgage default or a retailer that can't sell toys is going to really drive market activity heading into year-end.
The president focused on the automakers this morning, just putting this out on social media. Ford and General Motors up big on tariffs placed on big and mid-sized trucks coming from other countries. Thank you, President Trump. Do you want to explain what's happening with the automakers?
Well, actually what is happening is that Ford and GM are reporting less of a tariff hit than they originally were guiding for. Now, partially is that because the administration has made it a little bit easier, pushing out the timeline for a reduction of a tariff level for imported auto parts. So you heard from the CEO of Ford yesterday on Bloomberg TV saying to Matt Miller, thank you, President Trump, for that light reprieve. But at the same time, they're still taking hits when it comes to tariffs.
Lisa said it. In the conversation with the analyst in the previous hour on automakers, we've been talking more about emission standards than we have about tariffs. That's got to be key for some of these players. If you want to sell a standard Ford F-150 and you're making big fat margins on those cars, then you get to sell far more of them for a lot longer.
And the truth is, a lot of these companies have also been moving jobs back to the United States, and they've been able to do so. And that's behind what's going on with Ontario, because that is the main car manufacturing center of Canada, and they're upset that they're losing those jobs. So you start talking about President Trump talking to the automakers. He's also doing another kind of, little pitch to Ontario in the wake of what happened overnight.
Ford in the pre-market higher by more than 4%. Coming up this hour, Kristen Bidley of Citi, with tech earnings driving equities higher. Scott Lincecum of the Cato Institute ahead of a high-stakes Trump-Xi meeting. And Ashok Bhatia of Neuberger Berman as the Fed eyes a long-delayed inflation print. We begin this hour with stocks rising on upbeat tech earnings. Kristen Bidley of Citi Wealth writing, earnings are continuing to drive bullish equity sentiment in the absence of any macro catalyst. Kristen joins us now for more. Kristen, good morning.
Good morning.
You said earlier this year, fully invested, US bias. Is that still the same story?
Still the same story. We have a modest allocation to cash in portfolios, but I think the major question is really right now is, are we in a bubble? Like, is there something that's going to break kind of this AI euphoria? And I think you have to draw a comparison to prior bubbles and say, right now, this is not fueled by leverage. It is not fueled by debt. It is fueled by a select few companies that have significant free cash flow generation and continuously put up record earnings. So as long as the earnings story is there from a fundamental perspective and it's not driven by debt financing, I think this is something that could continue.
Is the fate of this earnings season then on 2 days next week? Wednesday and Thursday?
I think they're very important days. I think when you look at the broader expectations, you have those top companies representing about 15% earnings growth. And if you were to take them out, it'd be closer to 6 to 7% overall. So you're seeing that contribution. But I think for the most part, even just the first couple of weeks, we've seen a lot of not only like beats, but beat and raise. The numbers of actually declining expectations, it's been sub 5%. So I know we're going into the biggest week of the earnings season, but I think generally people are pretty optimistic.
Earnings have been better than expected, and they've been increasing their expectations going forward. You've seen economic data. Oh, yeah, wait, we don't get economic data. But the commentary coming out of a lot of these earning calls have been really positive. I just wonder why you've seen this shift out of momentum trades, why you've seen a shift out of some of the riskier stocks and riskier investments in bulk over the past couple of weeks, if the evidence that we have points to a pretty positive outcome.
Well, I think this whole concept of a K-shaped economy also expands to the market. And so this concentration, like we have to address the fact that there is a concentration, not just in the market capitalization, but also in GDP, also in the consumer. So when you back into what's actually driving this, you have those free cash flow generating companies that are very well positioned, but being positioned in ones that are exposed to debt. You know, recently a lot of people have been talking about small caps, and I think the truth of it is when you're asked to actually name a couple of the top companies within small cap indices, very few people can do it. And so understanding where you have exposure in this market is really important, which is why the momentum has been kind of pulled out of some of those trades.
Are they worth going back into, or is that a healthy kind of blowout and you want to just avoid at all costs?
Our view is to stay with quality here. I really do think that, you know, given some of the risks that we still have, whether that's inflation, whether that's tariffs, there's still a lot of uncertainty in the market and how that will flow through. So staying with the free cash flow generators and quality bias makes a lot of sense.
A lot of uncertainty, but why is the market just almost completely ignoring it?
It is completely ignoring it because, well, right now, we don't have a lot of data, right? So I think we get our CPI print, which is very important, but its earnings season has become front and center, and earnings have been strong. So you've seen a resiliency in that data. You've also seen a resiliency in the economic data. Aside from some fractures within the employment backdrop, GDP is very strong. Now, if we break that apart, you could again point to the fact that, you know, this is the first time that we've seen another area of the economy overtake consumer spending. So now all of that AI CapEx is now overtaking what traditionally would be driven by consumer spending.
What happens if earnings season wraps up and the government's still shut down and all we're getting is CPI reports?
Then I think you have to go off the data that you have. And I know that's very tricky and it puts the Fed in a very tricky position. But I think, you know, next week is one thing where you can say, all right, there's not enough of a distance here. And we do think that they're going to cut 25 basis points. But I think going forward, it becomes What can we rely on? Private market data, earnings, and really the earnings calls become so critically important in terms of getting clues from what is the actual consumer sentiment, how are they spending, are we still seeing this massive concentration of, the top 10% of income earners driving 50% of consumer spending. So we're going to have to look to signals from management.
We're at about an hour and 20 minutes away from the CPI print. You mentioned inflation as a risk, and yet markets don't seem to be really waking up to that fear longer term. We did see, though, yesterday a rise in bond yields in tandem with oil prices going up, and I just wonder how much of a risk factor this is. The idea that oil prices do spike, whether it is geopolitical tensions and more sanctions or whether it's something else, and that does lead to a reassessment, a fundamental reassessment of inflation longer term.
So I think right now, what's happened this week was obviously driven by sanctions, driven by specific events. Still on a relative basis, oil prices are relatively low compared to where we've seen them over time. I think the major thing is you have to kind of strike this balance between what are the inflationary forces and what are the disinflationary forces. Inflationary forces, we can point to tariffs, we can point to immigration policy, but the disinflationary forces of AI and productivity gains, there's a balance there that I think people are trying to see through.
Credo technology. I always check when people say that about the small caps. $26 billion, which would make it a top 50 stock on the FTSE 100.
I love Credo.
It's like small cap in America's big cap in the UK. Kristen, it's good to see you.
Good to see you too.
Thank you. Kristen Bidley of City Wealth. People were like, never heard of it.
What do they do?
Biggest stock on the Russell. All right, let's give you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Ukrainian President Volodymyr Zelensky says he won't recognize any territorial swaps during potential peace negotiations with Russia. That's as he doubles down on Kyiv's fight for its sovereignty. Zelensky's comments come after his recent meeting with President Trump, who's been pushing both sides to agree to some kind of territory swap. Meanwhile, Argentine President Javier Milei's approval rating has fallen to a new low ahead of Sunday's midterm vote. According to the LatAm Pulse, Milei's approval rating dropped to 39.9%, while his disapproval rating jumped to 55.7%. Today, Milei will meet with JP Morgan CEO Jamie Dimon and deliver a speech to Latin American CEOs. And Ford shares are rising 4.3% in the pre-market after the automaker reported third-quarter earnings that beat analyst estimates and signaled it will largely bounce back from a fire that disrupted a key supplier. The company also said it is pausing production on its electric F-150 Lightning to focus on more profitable models of hybrid and gas-powered vehicles. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, a high-stakes meeting.
On November 1st, the tariff on China goes to 157%, which is record-setting territory, and we don't want that because it's not sustainable for them. So a meeting with President Xi.
That meeting scheduled for next Thursday. Up next, Scott Lidsicum at the Cato Institute, live from New York City this morning. Good morning.
Day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world.
Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Stocks are up by 0.3% so far this Friday morning, heading into the weekend in the green on the week and on the session on the Nasdaq 100 higher by 0.5. Under surveillance this morning, a high-stakes meeting.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. They can't sustain that. We don't want them to have to go through that. So I'm meeting with President Xi, and I would say we have some big issues, like with the farmers and various other things. But the first question I'm going to be asking him about is fentanyl.
So here's the latest this morning. The White House announcing President Trump and the Chinese leader will meet in South Korea on Thursday. The visit would mark their first face-to-face talk since President Trump's return to office. Joining us now is Jack Fitzpatrick of Bloomberg Government. Jack, fentanyl, why is that the major focus for this president?
Well, that's certainly the easiest to sell to the American voting public. He does acknowledge some issues with American farmers. Purchases of U.S. soybeans are another big one. But the focus on fentanyl in the political debate has been so severe and so long-running, and something that Trump has focused on as an aspect of a lot of foreign policy. It's not surprising to see him emphasize that in talks with China, as he has in his dealings with Mexico and South America and a variety of other countries. So publicly, you know what the president is going to pitch people on. It's what he can do to keep Americans safe, what he can do for farmers. He faces other questions. Obviously, the rare earth materials issue is something they've brought up quite a bit. The question of how he handles what China wants from the U.S. on the question of Taiwanese independence. They want an opposition to that. There's a lot on the president's plate, but you see a president who remembers what he can sell to the American people, and those two pieces, fentanyl and soybeans, and broadly what he can do for American farmers, are obviously going to get a big focus from President Trump.
Jack, fentanyl was a big part of the campaign. It's unbelievable to say that we're almost a year at the year mark from the election of last year, and the enforcement we're seeing of fentanyl in places like China, and the strikes we're seeing off the coast of Central America as well. Jack, what's the reaction in Washington, D.C. been like to all of this?
There has not been any hesitation from Republicans to support President Trump's foreign policy at this point. You're going to hear some grumbling from Democrats, but that's not really the focal point of where they're choosing to pick fights. So when you watch the shutdown, they're trying to focus on health care, a kitchen table issue for voters. Largely, you're seeing, as I said, a focus from both parties on what they can pitch Americans as kitchen table economic issues, and the foreign policy objectives of the Trump administration, even when some people get frustrated, are not the major fighting point. So he's being given quite a bit of latitude when it comes to issues like fentanyl, really effectively from both parties.
Jack, thank you, sir. Jack Fitzpatrick there, down in Washington, D.C. Scott Lincecum of the Cato Institute writing this on Trade. The Trump-Xi meeting is back on, with lots to cover. Markets expect a taco walk back on both sides, so we'd see big moves if things fall through. Scott joins us now for more. Scott, good morning, sir, and welcome. I think we have to take stock of things. I said it's been a year since the election. It's been more than 6 months since April 2nd. And I was just speaking to an economist in a commercial break, and we were going through things we've got wrong on tariffs. Consensus has been wrong about tariffs in two ways: pass-through one, and retaliation the other. Retaliation has been quite limited, Scott. How are you taking stock of things?
Well, the frame was looking at the last time around on retaliation and the traditional approach to retaliation. You know, during the first Trump term, you did see Europe retaliate, India retaliate, Canada and Mexico retaliate, and of course China retaliate. This time around, it's narrower. China, of course, is retaliating, hence the big meeting next week to try to diffuse some of that. Canada's retaliated a little bit, but everybody else has really held off, at least by governments, and that has been a surprise. And I think it's one reason why markets rebounded so much in the spring and summer. Just simply that worst case scenario of Europe firing their big trade bazooka, then Trump coming back with more tariffs, that's been taken off the table. Economists would say that's actually a very good thing, that governments don't retaliate for economic reasons. They do it for political and strategic reasons. But it is different from last time around and from what traditional trade policy says will happen.
Scott, when you say markets expect a taco walk back, is that basically just status quo of where we are right now on tariff rates and not the more than 100% that the president is threatening?
Yeah, I think that's right. It seems that everybody believes that there will be some sort of deal next week that will diffuse these tensions and foreclose that return to 150% tariff rates. Because along with that retaliation point I just said, another big reason that markets improved in the spring and summer is that the China craziness on tariffs was taken off the table. 50% is extremely painful for a lot of companies and consumers, but it's manageable. When you get to 150%, well, then you're just throwing up a blockade along with all the retaliation, and things get really hairy really quick. So I think that's one of the reasons why everybody's been so calm this time around, is they're expecting some sort of deal in that 100% plus getting off the table.
Have the Europeans come to the American rescue in the sense that they're now talking about using the anti-coercive tool to combat China when it comes to rare earths? And maybe China, as Jonathan's been saying, since this happened, overplayed their hand?
Well, it certainly does seem the case that the Chinese are getting pushback from more than just Europe even. Really, a lot of governments are extremely concerned about this. And should the Europeans actually get their act together and move on this, it would be, I think, a pretty significant result and something that the United States would be pleased to see. But, let's face it, it'd be a lot easier for the Europeans and for others in the world to get on the United States side if they weren't also getting hit by Trump's tariffs. It makes tons of sense for the United States to build a kind of grand defense industrial base that involves our allies,
Scott,
including
hold on.
Europe.
It's not just tariffs in the United States, though. China is hollowing out their industrial base, and Europeans are losing their jobs because of companies like BYD.
So you're saying that in terms of why the Europeans are upset?
Yeah, shouldn't they get alongside with the United States because China is eating their lunch, literally?
Well, they have to consider their options for both sides. There are benefits to trade with China in Europe, and the Europeans also have to deal with the United States that just isn't as friendly as they should be, quite frankly. It would be a lot easier, I think, for the Europeans to be more hostile towards China, to be more aggressive on trade with China, if they had a friend in the United States, if they had a more open and stable trading environment with the United States.
Meanwhile, Scott, it seems like President Trump is emboldened and thinks that a lot of the tariffs have given them a better position, has given the U.S. a better position when it comes to negotiation. And it appears, at least this morning, based on a slew of different messages, he's really focused on the auto industry. Haven't earnings that we've gotten so far from U.S. industries shown an incredible resilience? Just people shrugging off tariffs, not necessarily any kind of blowback that a lot of people were expecting just a few months ago?
Well, yes and no. It does show, I think, in a lot of these earnings reports, the kind of tremendous resiliency and dynamism, flexibility in a lot of our big multinational manufacturers. But you got to remember, first, a lot of these companies have received tariff exemptions. The auto industry is a great example of this. One reason why GM's tariff hit went down so much is that Trump gave them a big fat carve out when it comes to their tariff costs. The other big thing is, of course, they are passing on a lot of these tariff costs to consumers. And so they are able to avoid some of the tariff pain, but consumers are the ones bearing that. And then finally, there's still a ton of tariff costs for these companies that are, maybe they're not harming earnings overall, but they are adding pressure. I mean, GM, again, was still reporting $3 to $4 billion in tariff hits. The only reason markets liked that is because it used to be $4 to $5 billion in tariff hits. So there's still real costs here. It's just American companies are being quite good at moving the pieces around the table and avoiding those. But, small companies, they don't have all of those options. And you're still seeing a lot of pain among smaller businesses that don't have the carve-outs, that don't have the supply chain flexibility, that don't have the long capital runways to deal with the tariffs like the big guys do.
So, Scott, look, I'm right there with you when it comes to things like free trade, open markets, and capitalism. But I happen to believe that the biggest problem with the global order right now is not the president's tariffs, it's Chinese overcapacity. And the fact of the matter is that even with these tariffs, China is still running close to a record surplus, potentially a record surplus for the year so far. And the rest of the world is going to eat that overcapacity. And that's what I think Anne-Marie's getting at here. The Europeans are going to have to respond on their own. I think they took for granted the fact that America would share the burden and keep sharing the burden with them. And Scott, they're not anymore. How do you think the rest of the world's going to respond?
Well, I think it's going to be a mix of actions because on the one hand, Chinese overcapacity is a blessing for consumers in these other countries. Getting cheap cars and electronics and clothes and other things is good for those folks. But other countries, of course, with that industrial capacity will respond like they often do. One of the big reasons, and that's with tariffs, I should say, because one of the big reasons why industrial policy can backfire is when you try to export your overcapacity, governments respond with things like anti-dumping measures and other tools. But the fact that the Chinese export machine has continued to hum in the face of massive U.S. tariffs really should tell you that unilateral tariffs still just don't work very well when it comes to dealing with these types of issues. You need a global coalition, and that's what things like the Trans-Pacific Partnership and other trade deals used to try to create, and that the United States really just doesn't seem very interested in creating except via a giant tariff wall.
Give it time, Scott. Maybe the Europeans get in line. We'll see. Scott, thank you, sir. Scott Lincecum there at the Cato Institute. From New York City this morning, good morning.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The open about 2 hours away. Equities are positive on the session and on the week, up by 0.3%, 60 minutes out from a CPI report in America. As we count you down to the cash open, let's get you some morning movers and cross over to Danny for more. Hey, Danny.
Hey, John, some gains from Intel this morning. Big gains, and should it sustain this pace throughout the day, Intel shares will have more than doubled so far this year. They had earnings after the bell yesterday, a really sunny outlook. They've returned to profitability. They have investments and stakes, be it from the White House, NVIDIA, and SoftBank, but also helping for their key business at the moment is the fact that there does seem to be around a rebound in PCs, so shares up 7.6%. Ford also reported after the bell yesterday, a decent rally from them as well, up 4.2%. Yes, they took a $2 billion hit because of a fire at a key supplier of an aluminum factory, but they signaled they'll be able to push through that. And what's more, much like GM, their heavy trucks and their SUVs are selling very well. So shares up again more than 4% this morning. Also at the top of the hour, we got earnings from P&G. Those were also solid for the company, exceeding expectations. The things that did the best were their beauty and grooming products. It signaled that Procter & Gamble, their strategy of having a premium and have consumers pay up for that, it's actually working. So here's a consumer company where people are willing to pay more. They also said that they're able to have a less big tariff hit than they originally expected. So shares up 2.33%, John.
Danny, thank you. More from Danny in the next hour. On our radar this morning, the president and the Chinese leader meeting Thursday on the sidelines of the APEC summit in South Korea. The president saying direct talks are the best way to resolve lingering trade issues between the two nations. Elsewhere, Intel shares rising on upbeat earnings, the company beating third-quarter profit estimates and forecasting fourth-quarter sales will be around $13 billion, a sign Intel could be back on track after a very turbulent year so far. Target eliminating about 8% of corporate roles in the first major restructuring in years, the company cutting 1,800 roles across various teams, including 1,000 layoffs and closing out 800 open roles.
And this comes after really falling behind for a number of years, after a number of issues with respect to inventories and seeing Walmart really take market share. They have a new leader. They're cutting jobs. People are going to wonder, what does this mean in terms of some of the bigger themes, in terms of the job market? Does this mean that there's more to come? And the second question is, how much is hitting the white-collar jobs, not necessarily those in the store, and how much is being replaced by artificial intelligence as part of sort of the efficiency drive? None of those questions are really being answered. Nonetheless, definitely notable that this is the response to years of underperformance.
The consumer, the retailer, right now the trade story, you've got to wait until November 19th before the market, November 19th that morning, to get earnings from Target. This is the strange arc of earnings season. Get distracted by tech in the middle. That's what's really important. Towards the end, you start finding out a little bit more about retail America and where the consumer is.
And then in December, NVIDIA reports, and then we'll get a sense of what's going on there.
Sometime next year.
I think they're also the 19th, so more exciting, I think, NVIDIA than Target.
It is true, though, and you have to keep thinking to yourself, how much are each of these companies' specific stories, and how much are these representative of a larger tale. And there's a lot of jostling for market share going on here and specific stories as well. So it's very difficult to sort of extrapolate a big theme from one company. Nonetheless, job cuts does raise some alarms.
Let's turn to trade. Some big moves in the commodity market. Big move yesterday, again this morning, up by 0.7% on both Brent and WTI. Chinese state companies cancelling some purchases of Russian crude. The move's coming after fresh US sanctions on Russia's two largest energy producers. Joining us now to discuss is Bloomberg's Javier Blas. Javier, welcome to the program, sir. The president made a big move. We wanted to understand how China, how India would respond to it. Javier, what are you and the team learning in London?
What we are learning first is that everyone is taking a pause. Companies are reassessing their contracts, are looking at the finer wording of the sanctions, and they're also looking at what the White House is going to do, because one thing is announcing sanctions and another one is to wall the toll. Will President Trump allow prices to go much higher, and will be enforcing those sanctions strongly? History tells us that he will not. Neither President Biden nor President Trump have shown any appetite for high oil prices, and I think that that's going to continue. So there is a pause at the moment of taking more Russian oil, but that pause is a pause. We don't know what the companies are going to do next, and my expectation is that some of that oil is going to continue to flow.
Javier, if we do get secondary sanctions or less of these oils are flowing to India or China, who's going to step in and fill the gap?
The good news for President Trump is that there is plenty of oil in the market. OPEC has been increasing production. Saudi Arabia, the United Arab Emirates, Iraq, a number of countries in the Middle East have increased production in recent months, and they have announced their intention to continue increasing production. So there will be enough oil in the market, and that's why I think that the White House is acting now. They were not acting when prices were much higher earlier this year, but they are acting in a moment that we are heading into a surplus, so the market can easily absorb the heat if that heat really materializes and becomes a permanent heat, which I have significant doubts.
Well, what about U.S. companies like Exxon? Can they also start filling the gap if they get higher oil prices? Will we see American companies start drilling again?
Well, American oil companies are drilling right now. It's not that they're going to be doing it again. They're doing now. And American oil production on a total basis, total petroleum production in the United States is running about 1 million barrels a day higher than last year. So U.S. production is increasing. So is also American demand for that oil.
Javier, always good to see you. It's been too long. Javier Blas there of Bloomberg in London on the latest energy moves. Ozan Tarman, the Vice Chair of Global Macro at Deutsche Bank, joins us now for more. Ozan, good to see you, sir.
Always great to be here.
Good morning. This could be an energy shock. What do you think this means for the bond market?
Well, even yesterday, that news kind of triggered around equities when you guys broke those news, because people got even more excited about Malaysia, what it may imply for the summit. Then some clients said that it affects only 30% of China purchases, but a signal is a signal. As for the bond markets, vigilantes have been quiet for a long time. No data didn't help them. And wonderful to be here on the CPI. They finally get something, so that may move things. And also 5% move in oil move things. Already because of that, we moved from 392 US 10-year to 4% flirt now. It almost wants to go. If majority of my clients, at least fast money clients, and Marcus Haidar, our inflation strategist, is right, if it's a beat, then we may finally get some movement on rates higher.
There's a lot to unpack here. Let's start on the oil, and then we'll go to CPI and the ramifications for market expectations for inflation. Do you think it's valid for people to take cues from the oil market and use that as sort of a signal of whether yields should go higher?
Not necessarily, but Lisa, they were dying for signals. So basically, volatility both for FX and rates are hit so hard that every single sign is hope for them. And for things like Europe, it is very important. Oil is more important. So if you, and it was one of the really working trades. Nobody really believed the Trump administration when they first said it's going to go below 80, then 70, now 60. So people are almost giving up. So that's one hope right there. And the others are shut down. Hasset, somebody very close to Trump, was saying it could be over this week. Well, I'm not even sure about November 1, but if shutdown ends, that's going to trigger rates a bit. CPI. There are some, when everybody gave up hope on this rates higher trade, and more importantly, when most people stopped out, Now there are some signs that we may get some life.
This is interesting because a lot of people have come on the show and we've been talking about how it seems like the Fed's going to cut no matter what. And it's hard to see how high the bar has to be for CPI to come in that would actually prompt any second guessing by the Fed. What's the bar here in terms of what would trigger some of the bond vigilantes to come back to the table?
Pretty high. I mean, if anything, today on a 0.4, we would get a bit excited, but there's the other side of this as well. Even if we get in line, we may get a huge squeeze. So the bar is very high. Unless you get a very, very high number, this October cut is coming. And then because of this two-speed economy, K economy, Wallers of the world, Best Ends of the world, they won the argument. Our friend Neil Dutta. So I think those 225s, in my mind, are almost automatic.
So this is the reason why a number of people have come out and said that actually the sell-off that you saw yesterday was a good indicator to get long because it didn't break above 4% for the 10-year yields, and you didn't see any kind of mass selling, even with a signal after so long of not getting anything. So what makes you not kind of pile into that trade, the idea that any backup is a buy, given the fact that there clearly is a lot of buying pressure and not a lot of concern for a longer run kind of inflation?
Don't get me wrong, I'm a dove. I'm loving this risk parity run, but I'm also my job is trading, right? So I do smell that when there is this lack of positioning, even a 0.4 can move things. But medium term, I think risk parity has the upper hand here. It's going to continue to give the pain trade. Dollar, that's interesting. Even when I was here last month, we started talking about it. Jonathan is right about the Europe trade. You know that the horse feels tired. UK, the stories aren't really working. The big hope for the soft dollar trade was Japan. Then Prime Minister Takaichi happened. Almost didn't happen. Now she definitely happened. So if anything, now yen is turning into a funder. So if the CPI is a beat, if anything, King Kong dollar may do even better against the G3. Emerging markets carry, that's different because volatility is low. IMF DC, I was there in DC last week. Usually it's an orange time when people are so bulled up. This time around, it makes sense for various emerging market stories. So EMFX can do well, but against the G3, King Kong dollar may have new life here.
Ozan, yesterday, the market move on oil was swift, up more than 5% immediately. Why was the market so surprised by what Trump did?
Because they are quite used to taco or whatever you want to call it. So they weren't really expecting this much of a shifting gears. They're all in a little.
But hasn't yesterday proved that you can't just taco this market?
Yeah, that shows you that market too can be surprised by the developments. And if anything, then the European summit, then this potential news, Bloomberg news on what China will do with Russian oil. Maybe they're shifting gears on Putin. Maybe they're raising the stakes on Putin, and that made the oil move.
You spend a lot of time with people on the buy side. What's the credible bear case right now? What have you heard? What are they saying?
We're both smiling, my Jonathan. So anti-risk parity is not on a good run. We need some surprises. Another thing that I brought up last time, and I'm still on it, tariffs and Supreme Court. Tariffs used to be the bad child, now they're the good child, they're the revenues. So these things, back to Lisa as well, these things almost pile up. I'm not even sure if we get a beat, but if my HIDAR is right, if we get a beat, then shutdown ends, then Supreme Court, poly market gives 60% chance that Supreme Court blocks these tariffs. I don't think that's in the price. All of a sudden, I'm back into how Jonathan will open things. Maybe in November, middle of November, you open the show a little bit differently. I'm almost
bonds down, yields up.
Yeah, I'm almost talking for the Mets. I'm not talking for the home camp. I'm risk parity, but I also need to smell what can make anti-risk parity work again. And one thing is, all joking aside, now this trade is too empty. People gave up. Bears are giving up. That's always when you're most vulnerable.
You're sensing capitulation.
I sense and I see. I do see capitulation. Even in places like your ex-island, UK. I mean, what happened to the trust rate? 4 hours, and then Reeves is turning this game around.
Patience, my friend. Wait for the budget.
Wait for the budget.
Yes,
a lot of people are saying, and now at least you have cleaner positioning. On that, by the way, yesterday, some newspapers claimed that she may bring back income taxes.
I saw.
Guilds may love that. I'm not sure about the population. So that's, yes, for sure, November 26 stakes are very, very high.
It's the only tax hike she hasn't floated. Based on the reports in the British media over the past month, I think they've listed just about everything. It's good to see you, sir.
Very good to see you always.
Yeah, save yourself. Ozan Tarman there of Deutsche Bank. Thank you very much. Equity futures on the S&P this morning, positive by 1/3%, very close to all-time highs, despite all these volatile headlines over the last 2 weeks. Let's give you an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada, citing a TV ad from Ontario. The commercial features excerpts of then-President Ronald Reagan defending free trade. The president is accusing Canada of timing the ad to interfere with the Supreme Court case you were all just discussing against his country-by-country tariffs. Arguments in that case are set for November 5th. Meanwhile, a federal sports gambling probe is rocking the NBA. Miami Heat guard Terry Rozier and Portland Trailblazers coach Chauncey Billups were arrested and charged yesterday, along with at least 30 others, including current and former players and coaches across 11 states. The arrests are linked to 2 separate illegal betting schemes. The NBA has placed both Rozier and Billups on immediate leave. And Binance co-founder Changpeng Zhao, known as CZ, has received a pardon from President Trump. Trump told reporters he did it at the request of, quote, a lot of good people, though he has never met him himself. The move marks the latest act of clemency the White House has granted to a crypto entrepreneur, underscoring how the Trump administration has positioned itself as a friend of the industry. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, a bias to ease.
The Fed is going to cut almost regardless of what inflation print that we get. The only thing that could be a challenge is if you start to see the non-tariff related inflation, that super core services ex shelter start to kick up.
A conversation up next with Ashok Bhatia of Neuberger Berman from New York City. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Stocks are positive, higher by 0.3%. The data about 42 minutes away. The delayed September CPI report also gets some PMIs later on this morning. That's worth a look. The preliminary read for the month of October, a more timely measure, possibly, potentially, of what's developing in this economy. Equities on the Nasdaq 100 higher by 0.5. Similar story on the small caps. Under surveillance this morning, an easing bias.
The Fed is going to cut almost regardless of what inflation print that we get. The only thing that could be a challenge is if you start to see the non-tariff related inflation, that super core services ex shelter start to kick up. At the end of the day, the new Fed, the Fed that comes in next year, is going to cut to 3% no matter what. And they're going to ignore the inflation line of things. They'll focus on employment.
Here's the latest this morning. Delayed September inflation data due out at 8:30 Eastern Time. Investors widely expecting the Fed to remain dovish, even if we get a hot print. Ashok Bhatia of Neuberger Berman joins us now for more. Ashok, that begs the question, really. What would constrain the Fed's easing bias?
I don't think there's a lot constraining the Fed, at least till we get to 3.5. And, we're at, the current funds rate range is 4 to 4.25. So I think 2 to 3 eases from here. Our view is those are pretty much on autopilot. And then, the debate will start once we're closer to that 3.5 level. We do think one of the challenges for the bond market is there is a lot more priced in. You look at the bond market today, it's priced for the Fed to drop the funds rate to around 280 to 290. So a substantially further easing is already priced in, and that's going to create some tension, we think, in the bond market probably early next year.
Is that a bet on this Fed or a bet on the new Fed, the next Fed?
I think it's a little bit of both. I think, obviously the markets are wrestling with AI and, all of the, one of our key views is next year, we're going to be taking a step back from policymakers driving a lot of the markets and market narrative. And AI and the outcomes from AI are going to be dominant. And that could be what happens with the capital spending cycle. Does it slow down? Is there a strong return on investment? And also the labor impacts and impacts in the credit market. So we look at what's priced in, and there is some probability of how AI plays out, either with slower growth or disinflation. But your point, I think also that, over time, may not be in the spring, but over time, the Trump administration will have the opportunity to change more and more of the Fed and maybe drive to more of that 2% types of funds rate. That's probably not immediate, but definitely some of that's in the market too.
Ashok, in the near term, I just wonder how much you agree with what we were just talking about with Ozan, that the bears have capitulated, that increasingly they're throwing in the towel. The bond bears in particular, looking at a lack of hyperinflationary types of catalysts into next year. Does that make you a little more negative on just yields where they are?
I think our view is the front end is fully priced here. Now, I think one of the changes and has been in sort of these 10-year and longer maturities. And as the funds rate comes down, a lot of these maturity points flip to be, in bond lingo, positive carry. It starts to be you earn income by extending a little bit of maturities out of cash. So, we do think the front end is fully priced here. We do think the long end and some of these longer rates, a lot of the negatives about government stimulus or government spending kind of getting to be in the price, at least near term. But, on the bear case, I would note in credit, we are starting to see, it is certainly not, and we're not predicting a big default wave or anything like that, but there are more and more cracks coming. A couple of the themes seem to be some of the slowdown in Europe, having some impact on credits there. Tariffs, we haven't been, I know you all were talking about tariffs and the Canada situation. That's starting to show up in some of the credit metrics too. So, cracks might be a little strong word, but the bear case in credit selectively, we do think there's some issues and pressure rising there.
Can you pinpoint any particular pockets? We've already seen it in the subprime auto loans. We've seen it in areas credit tied to immigration in particular. I'm just wondering, Ishak, from your perspective, whether you're sussing out a greater degree of weakness in a certain type of fund or in a certain type of product than you think the market has really reacted to.
Yeah, I think there's been two themes. One has been maybe some smaller suppliers in goods chains that are, big companies are asking these smaller suppliers to bear the brunt of some tariffs, and there's pressure there. So that's one pocket that hits a number of goods industries. The other is the AI idea, and the market is gravitating towards this idea, particularly for the bond market, right? AI productivity gains, as a bond investor, will still just get back par, but it is creating risks for business models and such. And so, there's starting to be at the margin businesses, and this is across sectors, but maybe a little bit more in the software technology that, the bond market can maybe envision this business being negatively impacted by AI, and some of those credits are trading a little softer. That, though, is more of, we'll have to see how it plays out. But we do think that's going to be a rising theme next year, too.
Ashok, you often hear people talk about a positive technical backdrop, the supply side story, issuance. This story that we dropped overnight, the banks are preparing to launch a $38 billion debt offering as soon as Monday to help fund data centers tied to Oracle. How much additional supply are we seeing? And does that have the potential to shake things up a little bit?
I don't think right now. So far the issuers that have been doing these mega types of deals, and Oracle's a good example of it. They have plenty of capacity to add debt to their balance sheets. So we would not say that this is worrisome changes in leverage ratios right now. We do think one thing we are paying attention to is there does seem to be a bit of shift of some of these investments that were internally funded by internally generated cash flow starting to come to the bond market. But, our expectation is these types of issues have been, well absorbed, and we just don't see that changing.
Is that the biggest counterpoint to the late cycle narrative, that we haven't seen the leverage story yet?
I think that is very fair. Like leverage ratios in the high quality areas of the non-investment grade markets, or that double B, the triple B, the investment grade. Companies have not leveraged up, and the leverage cycle has been on the government side. So we do think you could go through a period where the big tech issuers decide to put more debt on their balance sheet, and they are in a position to do so if they wanted to.
Ashok, appreciate it. Thank you, sir. Ashok Bhatia there of Neuberger Berman. Thank you very much. Equity futures, by the way, just spiking a little bit higher. Session highs up by 1/3 of 1%. That last point on leverage, I think, is a really important point. It's a strong counterpoint to this idea we're late cycle.
This is something that people have pointed to. You're not seeing the corporate leverage, you're not seeing the household leverage, because really it has come down significantly, albeit some pockets of stress. Where there could be leverage might be in other areas, which is the reason why people are looking at the darker regions of the market.
Up next on the program, we'll catch up with Eric Friedman of US Bank, the former Fed Governor Betsy Du, Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management, 34 minutes away from the CPI data.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
We're in that moment where we see downside risks to the economy.
It's problematic that inflation has been stuck at 3%.
We should be very careful about cutting into higher inflation.
The CPI report probably is going to be using more estimated results than normal. This data may not be as reliable.
The Fed is going to cut almost regardless of what inflation print that we get.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For the audience worldwide, your third hour of Bloomberg Surveillance starts right now, and your CPI number is 30 minutes away. Equity futures on the S&P 500 firm up by 1/3 of 1%. On the Nasdaq 100 up by 0.5. Before the big one, it's delayed by several weeks, and we finally get at 8:30 Eastern Time a read on inflation in America.
A ray of sunshine in a dark room at a time when we aren't getting any other official federal government data. This is what a lot of people are keying into. Big question for markets is how much will it matter if the Fed is already going to cut rates? And likely there will be a more dovish Fed next year. That said, especially I'm going off of what Ozan said earlier this morning from Deutsche Bank, this idea that you've seen a capitulation from the bears and this real feeling that maybe one headline could, at least in the short term, create a lot of volatility.
And I think it's going to create some headaches for this White House. Yesterday had coffee at a record high. The president has been tweeting about cattle ranchers to bring beef prices down. Beef inflation has been rising over the past few months. And slowly but surely, especially ahead of the holiday season, where a lot of surveys, Dana was on yesterday talking about how they do see consumers pulling back. And they're unsure about exactly how much because of the tariff story. Now imagine from now until the end of the year, the government is still shut, and all we get is maybe hot CPI prints without any labor data. Day 24 of the government shutdown, and no one is blinking.
And the earnings are fine. Companies are dealing with it. Ford's up this morning by 3.6%. Earlier this week, General Motors rallied almost 15% off the back of earnings. Again, just to reflect on April 2nd, the weeks after that, we were sitting around the table, where do you think GM's going to be in 6 months? Where's Ford going to be in 6 months? Ford and GM are doing okay.
There are two takeaways. Number one, adapting and adjusting, and how well companies in the United States have been able to do that. And number two, tariffs came down a lot. Expectations were for Armageddon, and this is someone who really tends to benchmark to a pretty extreme bar and then comes back from it. So all of a sudden, you have people who are coming out from the companies talking about tariff results that aren't nearly as high as what some people expected. It's all about the expectations.
There's been some reprieve on the tariff front to a lot of these auto sectors. Thank you to the auto lobbyists. I'm sure these CEOs are calling them all and paying those fees because they did get a lot of relief when it comes to the auto input costs of the auto parts. But John, Lisa, you guys have both been making this point. That's been a loss for the auto sector, the tariffs and some of the hits. But a win has been the emissions. And the fact that they're not going to have the same standard fuel emissions that they had under the Biden administration. So there's wins and losses that the auto space has been dealing with. The Trump administration, most important things, they've been resilient and they've been able to mitigate the concerns.
Earnings season doesn't really begin until next week. Wednesday, Thursday, a major chunk of the S&P 500 reporting across 2 days, a handful of major tech companies. Equity futures on the S&P this morning firmer by about 1/3 of 1%. Coming up this hour, the lineup looks like this. Eric Friedman of US Bank Asset Management. As stocks are trading near record highs, we'll speak to the former Fed Governor Betsy Duke with a key rate decision just around the corner, and Tiffany Wilding of PIMCO as we break down the latest inflation data. We begin this hour with stocks edging higher as traders await the September CPI report. Eric Friedman of US Bank Asset Management writing the following: we retain a bullish glass half full perspective into year end, thanks to a still optimistic view on both consumer activity and corporate spending trends. Eric joins us now for more. Eric, thank you, sir. From glass half full to glass half empty, what would it take?
I think it would be two things, Jonathan, and great to see you. I'd say number one would be an unexpected rise in interest rates. We are now in year 18 of the 10-year Treasury yielding less than 5%. That's a significant, let's call it, catharsis from consumers and from businesses that have not had to deal with higher rates. It's not in our forecast. We almost got to that 5% level back in April and early May. But again, the first shock we think would have to be higher interest rates. The second thing would be a rollover in consumer data. And as you mentioned, we've been more glass half full on consumers, not just the higher income spender, but also middle income spenders as well. One variable that's really important that I think is getting less attention is what is actually going to happen post-holiday season. One thing we're seeing consistently is this idea of keeping up with the Joneses. Because equity markets are really high, because property prices are up, there may be this push through to holiday season, but we have to pay attention to what happens on the other side of holiday season. We as a bank love it when people pay us back for credit. So again, making sure that consumers are spending responsibly will be important. Likely a push through to the end of the year. What happens in Q1 of next year we think will be really, really important.
Eric, are you getting paid? That's the key question. Not you personally, of course, but are you seeing the banks getting paid? Are we meeting those repayments monthly?
Yeah, we are. I think if you look at even the bookends of consumer credit, U.S. Bank has a very strong credit base. If you think about other banks that perhaps moved down a little bit further into the lower quality credit spectrum, they're actually seeing some modest improvement. You heard that from a number of banks last week as well. So certainly there are issues of delinquencies. Student loans is a new expense item that consumers are still adjusting to. Auto loans is not new. That's been something that's happened for some time in terms of there's being some issues in that credit schema. But in general, we think that delinquencies are somewhat healthy. Actually, there's a decent, look at that across FICO scores. So in general, we think that there are responsible payments being made. But again, to your point, Jonathan, we can't extrapolate that will happen on into perpetuity. If we get a softer labor market that permeates, that would certainly leave us with some concerns about consumer strength.
There are a lot of ifs about how things could go wrong. There haven't been that many fears recently about how things could go so right that we suddenly see a reacceleration in inflation. Are you in that camp as well, that really today the CPI report will be interesting, something to study for the history books, but not necessarily something that will really get you thinking more materially about price and stability?
Yeah, Lisa, I think you framed that perfectly. I think if you look at this upcoming CPI data point, this will be a pick your narrative number. We think if it comes in really hot, I think people will say, hey, that's kind of a kitchen sink number and the data is a little bit messy. If it comes in low, we do think that the Fed, as well as a lot of investors, are using that function in Excel called a round down, meaning if they see something with a 2 in front of it, they say, hey, that's actually a really bullish number and that rates do have, pathway lower from here. So we think the key point, if you look through the cycle, even out to May and June of 26, Lisa, you're still seeing CPI headline estimates at like 3.1% for the US. That's very different than rest of the world. So what I think that says is that markets can't really forecast tariff policy very well. And I don't say that in a begrudging fashion. Look, and Anne-Marie nailed it yesterday. You think about what's supposed to happen between the US and Russia this week. President Putin and President Trump were supposed to have a cup of coffee by the Danube in Budapest, and it didn't happen. In fact, we saw 2 sanctions on major oil companies in Russia. And you look at, obviously, the overnight news with Canada. So this is let's call it a price taker's market with respect to tariff policy. We do think there will be a more conciliatory outcome with respect to U.S.-China relations, but no one has a definitive edge. And so, again, estimates are still keeping a margin of error with the thought that inflation remains high because of tariffs remain a bit stickier than perhaps we thought a couple months ago.
Eric, is there an inconsistency of investing in real assets tied to the AI build-out, to the new economy, and also bet on disinflation, especially given the fact that commodity prices will likely rise in response to some of these investments, and you will see a certain degree of price pressure coming from just how much investment is going into some of these areas?
Yeah, I think, not to make a shameless plug to David Gura, who had a very, very thoughtful podcast on this point with respect to this to call it loggerheads between AI data center build out and utilities in cities like Memphis, Tennessee, and other parts across the country. But that's a really important concept, is that we are seeing a land grab. And again, as an industry, we always do this. We always overbuild, if you will. And at some point, you have this, this real concern between consumers and everyday residents that are maybe happy to see some more industry coming to their town until they realize that there's not a lot of net new jobs occurring, but costs of utilities are going up significantly. So the way that we're thinking about infrastructure, we're more interested in like the transmission of hydrocarbons and moving petrochemicals from point A to point B. That we think has some embedded inflation contracts within. We don't think that there's a great edge in what's going to happen with the spot price of oil. In fact, we think that oil probably has more downside than upside in the very near term. So I think, Lisa, to your point, this is really more about understanding how the ecosystem will work as opposed to making bets on what may happen with individual commodity prices. That's the way that we're thinking about real inflation and real assets in the here and now.
Eric, what happened this week with Russia, does that show that the market might be just too complacent going into the talks with Beijing?
Yeah, I do think so, Anne-Marie. You think about 2 Fridays ago where we had a back and forth in the headlines between what was happening with the potential talks between Xi Jinping as well as President Trump, and President Trump saying, we may not actually get together. There was that kerfluffle, if you will, on rare earths. And you had a 2.1% down day with a massive VIX spike. And that, I think, goes back to the notion of, we on the street feel like, and obviously we on the buy side feel like we can forecast certain things. No one can adequately forecast policy with respect to the back and forth with these major trading powers. And again, CFOs, I think to the point that Lisa made very elegantly earlier in the show, CFOs are still very cautious about making definitive decisions. We see it in our survey data. We see it when we talk to companies. CFOs are like, look, we're not sure how sticky and how durable tariff policy may be. Look at what's happened with automakers. Again, I think you've covered this very well. You've seen a consistent thought about EVs. That landscape has changed, as well as tariff policy that's made a significant bottom line difference for companies like GM and Ford. So those are the sorts of things where I think the market tends to react, if you will. The underlying thesis on consumers and business spend is positive, but we all recognize we're price takers on policy with respect to trading, and that's why there's much more of a reaction heading into what may come out in the next couple of weeks.
I'd love to know how you're thinking about the potential reaction, Eric. If we get a messy meeting next week, is that still bond bullish? Because that's a big shift from where we were back in April.
Yeah, we think it probably is bond bullish, Jonathan, but probably the more immediate reaction function would be very stock negative. And, I think that we've done a good job as an industry of thinking about this broadening out theme. Will we see not just the hyperscalers participate in equity upside. If we do have a messy meeting, then that narrative gets a lot of cold water thrown at it pretty quickly. I do think the big question we have to ask ourselves as bond market investors is, again, how will this play out in actually the auction market? And I know that Lisa pays attention to them, we pay attention to them as well. And so that notion of supply and demand, I think that Bessent really understands that the bond market will not accept a lot of supply on the long end of the curve. So to your point, I do think it would be potentially, a bond bullish outcome, if you will. But I also think that the Treasury in particular has to be very smart about where issuance comes, because the market may not be very interested in long duration fixed income. It may be more belly of the curve and short duration maturities that the market has more appetite for.
Eric's getting paid. That's my takeaway from this. Eric Friedman of US Bank Asset Management. Eric, appreciate it. Thank you, sir. Bond yields have had quite a rally. We're down about 80 basis points from where we were in the middle of January. That's quite a move. This is a big move too as well this week. Crude higher by more than 8% on Brent so far this week. 4 consecutive days of gains, potentially the biggest weekly incline we've seen going back to June of 2025. It's quite a move.
No one was expecting Trump to come out and go after the two major producers, Rosneft and Lukoil, and he did. The start of the week, we were talking about maybe taking flights to Budapest to go to this Putin-Trump meeting. No, he doubled down. Huge sanctions. Rhinestan is talking about 500, 600,000 barrels coming off the market because of this. This is why everyone is very complacent going to next week, but Trump doesn't always chicken out, and he has an incredibly high pain threshold. And if he doesn't get what he wants out of that meeting with China, potentially it can get messy.
Brent crude, 66.42. With an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Shares of Procter & Gamble are rising 3.3% in the pre-market after the company reported better than expected sales in its latest quarter as consumers brushed off higher prices. P&G reported 2% organic revenue growth for the period, with earnings per share also topping expectations, led by growth in the beauty and grooming categories. Meanwhile, Anthropic has confirmed a cloud partnership with Alphabet's Google. Google will supply up to 1 million of its specialized AI chips to Anthropic in a transaction valued at tens of billions of dollars. The arrangement boosts the AI startup's computing capacity while reinforcing Google's role as a major investor and key infrastructure provider. And in a political U-turn, New York City Mayor Eric Adams has endorsed Andrew Cuomo for mayor, calling frontrunner Zohran Mamdani a snake oil salesman. This comes just weeks after Adams himself called Cuomo a snake and a liar. That's politics for you. The move is seen as an effort to boost Cuomo's campaign less than 2 weeks before the November 4th election. That's Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Watched the basketball game early this week, didn't they?
Yes.
Court side of the Knicks.
So Cuomo left the debate after it's quite fiery and went to the Knicks game to sit down with Eric Adams. And the next morning, Eric Adams is endorsing Cuomo.
There you go. Just like that. Basketball. Things happen. Apparently other things happen too, but we'll get to that story another time. Equity futures on the S&P 500, firmer by a third of 1%. Up next, the morning calls, plus the former Fed Governor, Betsy Duke, with a key rate decision just around the corner. That conversation up next, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The sources of inflation, I think tariffs will still carry some more upward pressure, perhaps not as much as people originally thought, but I think it's still going to be a factor. The Fed has to be aware of that, and I think that has to be in their calculation. But I think they're under pressure to cut, and I think they will tend to do that unless we have an upward surprise in that inflation number.
It would have to be a monster surprise in about 13 minutes' time to change that story. That was the former Kansas City Fed President Thomas Hoenig there on the inflation report. That inflation report is just around the corner. Your scores into it shaping up as follows. Equity futures up by 0.3% on the NASDAQ, up by 0.5. That's the price action. Let's get you some morning calls. First up, JP Morgan raising its price target on Intel to 30, citing favorable customer demand. Second up, Wells Fargo raising its target on Ford to 11, highlighting better than expected tariff guidance. And finally, Goldman lowering its target on Deckers to 81, citing weak revenue growth in the US market. That is one of the worst performing stocks on the year so far for the S&P 500. Deckers in the pre-market is down by about 12%. Let's turn to the data as we count you down to CPI. The former Fed Governor Betsy Duke writing this: even if the tariff effect proves transitory, inflation is likely to be at 3% or higher for more than 5 years. Betsy joins us now for more. Betsy, welcome to the program. Before we even talk about today's number, what does that say about the credibility of the Federal Reserve that we're going to be so above target for so long?
I think it says a lot about the credibility, which is why I think it's a mistake to ignore where inflation is right now. If you look at where it's been and the Fed, it has been stationary or stuck for over a year now at 3% or higher. And so it's hard to argue that monetary policy is too tight.
At this point, though, Betsy, couldn't you argue that it's okay, that actually it's fostering that a 3% inflation rate has been in some ways beneficial for certain aspects of the market?
It may be for the market, but the thing is, the credibility of the Fed is based on anchoring inflation expectations. And most people can't really accurately tell you a percentage of what they expect inflation to be, but they begin to build in sort of, what recently is what they expect. And if you have 5 years of over 3%, the expectations just instinctively are going to be for higher inflation.
Right now, there seems to be this feeling that artificial intelligence is going to solve everything, and that come next year, you're going to start to see productivity increases that really triumph over any inflationary forces. How much do you think that that's factoring right now into the Fed's calculus?
I don't think you've seen that yet, and I don't think the Fed is counting on that at this point to bring inflation down.
Well, when it comes to AI, though, at some point, how do they address this when maybe it's not even an inflation issue, it becomes a labor market issue?
I think the labor market is going to get really difficult to judge because of mismatch in workers and jobs. So it seems that AI is impacting job market for particularly new college graduates. But those new college graduates are not likely to take the jobs that are currently unfilled because of deportations and reductions in immigration.
Betsy, how difficult is this moment for the Fed, and maybe not next week, but in the months coming, if we remain in a government shutdown, we're day 24, no one's blinking, and we might continue to get CPI reports because we have to in terms of what it means for Social Security checks, but we might not have labor data.
I think this is actually the reading that matters for Social Security checks. So you may not even get inflation data going forward. the Fed will just have to deal with the data that it can get. And there is a fair amount of private sector data that's available. It won't be as good, but I think it will give them enough to be able to judge sort of generally where we are. Frankly, I don't think monetary policy is what's driving the economy right now. It is much more driven by fiscal policy, the great big beautiful bill, currently the government shutdown, tariffs, immigration, deportations, all of these things, as well as just the uncertainty and unpredictability of policy right now.
So, Betsy, I think that final point is a really, really powerful one, and it's something Lisa's asked quite a few times. The Federal Reserve is cutting interest rates, responding to this massive downshift in payrolls. I think the question worth asking is, what difference are those rate cuts actually going to make?
I agree, and I think the Fed would be well served to be very cautious in this environment.
Betsy, do you think they will be cautious in this environment? They've basically managed to cover up differences on the committee at the moment by calling these risk management cuts. Now, they're risk management cuts that come with their own risks. And Betsy, do you think that's going to come to the surface, not at this meeting, but maybe at the December one?
I think it might come to the surface at this meeting. I think you might see dissents on both sides at this meeting. The reason I say that is because this meeting sets a pattern. So if your pattern is quarter point every meeting, that's hardly a cautious pattern in my mind.
Going forward, do you think that right now there is any reason to think that this Federal Reserve could actually become more hawkish in the near term? Or do you think that ultimately it's going to come down to the long end of the yield curve and how much it's going to respond to exogenous factors and be the discipliner, if you will, on the market?
I don't know how much the market is going to pressure the Fed, because if you start setting up an expectation for more and more cuts, at some point, the majority of the Fed voters are going to feel uncomfortable with that pace, and then it's going to appear to be a hawkish turn, although it may not actually be if you'd been in the room for the entire discussion.
Betsy, this was thoughtful. We appreciate it. Thanks for being with us. The former Fed Governor, Betsy Duke, just ahead of that CPI data, 6 minutes away. That point on inflation is an important one. You have to remember why we're going to see the CPI data in about 6 minutes' time. Raises questions about when we'll next see CPI.
Because these workers were brought back, deemed essential, to make sure they could find out what's going on with inflation for Social Security checks and the cost of living. Are they going to remain on staff the remaining of the CPI reports, or are we going to go back into full blackout? No CPI, we're definitely not going to get labor market report either.
Mike McKee's going to break down the number for you in just a moment. He's got a quick preview. Mike, what are you looking for in 5 minutes' time?
We're looking for inflation, John. Right now, analysts are expecting a still strong inflation report for the month of September. Really no change from August. A 0.4 rise in the headline number, a 0.3 rise in the core, puts both of those on a year-over-year basis up over 3%. Betsy Duke, not kidding. It is a long way from 2% and going the wrong direction, which is why you have to worry or wonder about what the Fed is thinking. We do have one other set of economic data I want to point out to you guys. The Labor Department puts out the collected unemployment statistics from the various states, and we have taken those and we have seasonally adjusted them, and basically what we're showing is that 227 last week after 220 the week before, continuing claims up just a little bit. Now some states are missing their data, so we had to impute them, but basically we are getting unemployment initial claims, and the Fed is being able to do the same thing and showing that we're not seeing a labor market problem yet.
Mike, thank you, sir. Mike McKee's going to have the numbers for you in just a moment. I thought maybe October's too soon for there to be some real division at this Federal Reserve. Betsy Duke thinks you might see it next week. Coming up on the program, September CPI, moments away. From New York City this morning, good morning.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
So we had to wait a while. This is it. Seconds away. CPI data in America. Your scores heading into that data look like this. Equity futures on the S&P 500 up by 1/3%. On the S&P, on the Nasdaq 100 up by 0.5. Heading towards a second consecutive week of gains in the bond market. 2-year, 10-year, 30-year bond yields higher in the last 24 hours. Up again this morning. 10s at 4, 30s at 4.59. For your economic data for inflation in America, here's Mike McKee. Good morning, Mike.
Good morning, John. We have a little bit of good news here as headline inflation comes in up 0.3 on the month. The forecast was for 0.4, and core comes in up just 0.2%. Forecast was for 0.3. We're still at 3%, though. Instead of 3.1%, as was forecast for both numbers, we get a 3% handle for both headline and core in terms of where we are for the total month here. We're going to have to check out the overall numbers here, but let me give you a few before we check the markets. Food prices, and this has been something that people have been worried about, only up 0.2 after being up 0.5 in the month of August. Energy prices in terms of gasoline up 4.1%. That added to inflation definitely. It was only up 1.9% the month before. And here's something good. Car prices. New vehicle prices up just 0.2%. We thought we might see a jump because of the new models coming in. Used car prices are down 0.4 on the month. Apparel, though, a big rise, 0.7 during the month after 0.5 the months before. Services were up 0.2% during the month, and goods up 0.2%. So inflation restrained, Fed is a go.
Mike, that is what we call the right kind of downside surprise on headline and on core. Headline inflation comes in at 0.3, the estimate in our survey 0.4. Core CPI month over month comes in at 0.2, the estimate in our survey 0.3. I'll go the back of that, push you through the bond market, 2-year, 10-year, 30-year bond yields declining as you might expect, particularly at the front end of the curve. We're down by 4 basis points to 345. Take the bond move, push you through foreign exchange. What have you got? Some dollar weakness, euro dollar up to 116.40. And ultimately, with that kind of yield move, equities up by 0.7% on the S&P 500 and some outperformance, some big outperformance on small caps. Bramo up by 1.6%.
That was exactly where I went to, this idea of how much this is going to help some of the smaller and mid-sized companies that really have been more significantly affected by higher rates. This is a clear signal to the Fed that they can go for 25 basis points. My question is, how long before we start to see some analysts saying, this means they can go 50 or something of that nature? Not clear that that's exactly what's being priced in, but definitely a sigh of relief.
And Mike, I'm sure you've got another take on the data, but I've got another question on the Federal Reserve, and if we can deal with that up front. I think for many people, this data this morning wasn't going to change whether the Fed will or won't go next Wednesday. Does it give them a little bit more space to guide beyond October when the chairman sits in that news conference and addresses you directly?
I don't think it really does, in the sense that we are flying blind right now in the month of October, and when they get to December, they may not have any October data, and who knows whether they'll have November data. So at that point, they're really not going to be sure of where we are with inflation, and they're certainly maybe not going to know within a reasonable guess of what happens with labor market. So I think you have to assume that December is going to be up in the air until at least we know when this shutdown ends and data starts coming back in again. Things we want to note here for you in terms of prices, rent of shelter. We're talking about here the overall housing numbers that play into services. Up by just 1.4%. No, I'm sorry, I'm reading the wrong one. By just 0.2, which is good news because shelter has been coming down. Owner's equivalent rent up just 0.1. I don't have the comparison, but that is the lowest in many, many, many months. And remember how last year we were always worried about when would housing come down. So as I mentioned, we're also seeing gasoline prices were up a lot. Food prices up 0.2. Food at home up 0.3. So still a little bit of inflation at the grocery store. Motor vehicle insurance down 0.4. That was one that was rising big. So it looks like we've seen a kind of a rollover in inflation. Airline fares up just 2.7%. They were up 5.9% in the month of August. So inflation has rolled over, at least in the month of September, and this is good news for those who want a Fed rate cut.
Mike, I feel like we're out of practice. It's been so long. Mike McKee, thank you, sir. Some economic data to go through. Yields take another leg lower at the front end of the curve. We're down by 5, another leg higher in the equity market. You can see that across the board down the S&P, on the NASDAQ, on the Russell. We turn briefly to foreign exchange as well. Just a little hint of dollar weakness and some euro strength. Data out of Europe was pretty good as well this morning. Eurozone PMIs, one of the best reads we've seen going back to 2024. Look out for the US PMIs a little bit later on this morning. If you are just joining us, a downside surprise on headline and core CPI, unlocking some lower bond yields this morning, going into that Federal Reserve decision next Wednesday. Joining us now to discuss is Tiffany Wilding of PIMCO. Tiffany, welcome to the program. Is this a source of comfort for this Federal Reserve next week?
Well, I mean, I don't know. I mean, I think certainly it's good news on the inflationary pressures, but the argument that we've been making, which I think is symptomatic of this report, is that the economic adjustment that we're seeing to tariffs is coming through less on a price adjustment. And instead, companies are finding ways to defend margins by offsetting other costs. And I think the fact that you saw another headline this morning around a large retailer, that is doing, some layoffs at the, kind of higher executive levels, that's just in our minds symptomatic of that they are finding these other ways to cut costs. So, what that means for the Federal Reserve is that there is some downside risk to the labor market here. So I don't know that they should be, completely, taking a sigh of relief here. We need to see the labor market data, obviously, when the government reopens. But as you and Mike mentioned, we do think they cut in October. And of course, the median expectation from the Fed is that they'll cut again in December.
How much of a forward look can they give us at the October meeting, Tiffany? When Chairman Powell goes into the news conference, he doesn't have much visibility on anything right now. How much guidance can he offer us for December and beyond?
Yeah, I mean, I think it's incredibly tricky, and I'm not sure that they will offer a lot of guidance. I think they're going to say that we don't have a lot of data to go on here. There's private sources of data, but even there, it appears that some of the Fed's, the previous sources of private data that they got in the labor market, maybe they're not getting anymore. So it is a much more tricky situation for the Fed. They're going to be looking at markets and and I think the news flow in order to kind of figure out what's going on here. And I think it's going to be really tough for him in terms of guiding any further.
Tiffany, a lot of people have been looking at the housing market in particular as a sign of disinflation going forward. And one thing that Mike pointed to was owner's equivalent rent. Looking at this, it just looks like inflation in owner's equivalent rent has fallen to the lowest pace going back to 2021 with a pretty big decline, which is one thing that's giving fuel to some of the enthusiasm in bond markets this morning. I'm just wondering how big of a tell that is for you.
Yeah, no, I mean, I think that the normalization in housing and rents is something that the economics community has expected for some time, and I would argue that it's delayed, and it was delayed because we saw a really big immigration boom over the last couple of years. Now, obviously, that the immigration policy has taken a big U-turn, you're not seeing those tailwinds of additional population coming into the United States needing housing, and as a result of that, you're seeing rents cool off quite a bit. So I don't think it's that surprising, but I do think it's one of the things that should give the Federal Reserve comfort, that inflationary pressures outside of some tariff-related pass-through are pretty benign at this point.
Given the fact that we're seeing no inflationary pressures to note that really are even beyond what people expected, and you are getting these announcements, you were talking about the Target announcements without naming them, laying off about 1,000 people and removing 800 jobs from their listings. We also saw GM announcing a round of job cuts this morning. I'm just wondering how much these are just anecdotes and typical versus something that really is a softening that is behind the disinflation as well as the concerns that the Fed has about the labor market.
Yeah, I mean, again, we think it's very symptomatic of how we see the economy that's ultimately adjusting to tariffs. I think the really big surprise this year coming into the year and thinking about tariffs is that you'd get some price level adjustment. And there's multiple ways that companies can adjust to this. And I think what we're learning is that, they're not fully adjusting prices and that they're trying to offset costs in other ways. And I think the fact that you're seeing this AI investment boom and some broadening out just in the diffusion of AI technology, companies are hoping to get some labor-saving cost benefits here. And investing in capital because of the tax, the new tax law, the One Big Beautiful Bill Act, gives you pretty big, tax incentives with upfront capital expensing. So I think companies are really just making this adjustment, more so through the labor market. And in terms of the Federal Reserve and their mandate, that just suggests that they have more room to start to adjust policy back towards neutral. If they do cut 2 more times this year, they would be, 3.5, which is kind of the upper end of the range of neutral estimates that they have. And so getting back there and making that adjustment, seems very reasonable to us, just given the information that's coming in.
Tiffany, when you say labor-saving cost benefits, should we all be expecting more layoffs then to be announced in 2026?
Well, I mean, I think the economy will need to go through an adjustment as a result of these transitions that we're seeing, whether it be the policy-related transitions this year or this tech. Sort of tech transition that we're seeing. It does seem like AI is moving pretty quickly. I think it's still uncertain how much productivity gains we'll actually get and how that will save costs for companies. But I think we are starting to see the effects of that. I think you could start to see it at announcements, layoff announcements as well at some of the tech companies. It is displacing some workers. Now, I think what's harder to understand is eventually it will also create new jobs, and how quickly will that happen, and what those new jobs will be is more difficult to forecast. But I think at least in the near term, you will see some labor-saving displacement here, and the companies need that and are forced to try to get it because they have more tariff-related costs.
Tiffany, thank you. Tiffany Welding there of PIMCO. It's why so many on the committee right now are prioritising the one side of the mandate. To take stock of things, though, unemployment in the low 4s, headline inflation still at 3%. There's a lot of people out there still asking the same question. There's some hawks on the committee. They'll say the same thing. What's the rush? Why go again?
And the Fed's still going to cut rates, so they can ask questions all that they want. And ultimately, how they justify it is going to be that we are at restrictive areas, so we have some room to have these insurance cuts. You are asking the right question about long-term. Can they signal beyond that level, those easy insurance cuts, about how far they can cut into just what a lot of people can't determine is the neutral rate?
It gets harder, that's for sure. Equities roll over just a bit after spiking, still positive by 0.5%. In the bond market, off the back of the right kind of downside surprise on the CPI report, yields are a little bit lower, but off session lows. We're down 3 or 4 basis points now on 345. Let's give an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada. The president posted on Truth Social this morning. Canada took a big buy ad saying that Ronald Reagan did not like tariffs when actually he loved tariffs for our country. Ontario Premier Doug Ford responding on X, writing, Canada and the U.S. are friends, neighbors, and allies. President Reagan knew that we are stronger together. Meanwhile, this just in, General Motors is laying off more than 200 workers, mostly affecting tech center employees in Warren, Michigan. The cuts come just after GM raised its profit guidance for the year earlier this week. The news also follows a post in the last hour from President Trump, who touted the positive impact of tariffs on the company. Shares are up nearly 1%. And the Trump administration is preparing a proposal to open almost all U.S. coastal waters to new offshore oil drilling, despite opposition from state governors. Sources telling us here at Bloomberg that the draft plan for selling oil leases includes waters near the southeast U.S. that President Trump tried to close off while campaigning for re-election 5 years ago. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next, we'll catch up with David Kelly of JP Morgan Asset Management as we break down the latest CPI data. Plus, Danny's got some morning movers. Beyond Meat, up on a revenue beat. That stock is higher by 11%.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The open about 43 minutes away, and we're looking to add some weight to this rally this morning. We're up by 0.6% on the S&P, on the Nasdaq up by 0.9, on the Russell. Small caps up by 1.6 following a downside surprise on inflation data Up on the week, up on the session with your morning movers. Here's Danny. Hey, Danny.
Hey, John. It's the poster child for the meme stock rally renewed. Beyond Meat, the company that's up more than 300% so far this week. Finally, some fundamentals to trade on. Beyond Meat reporting earnings, EPS coming in better than expected. It's a company that, again, fundamentally has been struggling, giving a pullback in some of the meat alternative products that they've been offering. But the earnings come in better, so you get this renewed bout of buying, up 11.6% in the pre-market. Shorts still exist in this company, so there still is more room for a short squeeze. Elsewhere in earnings, the big one after the bell yesterday was Intel, and what a result it was. A sunny outlook from Intel, a return to profitability given all of their partnerships, but it was the old school business, not building out AI. It was PCs that seemed to really be benefiting them. We also got earnings after the bell yesterday from Deckers, not so sunny. Shares falling 13%, the maker of UGG and Hoka, cutting their second half outlook. The CFO getting on the call and saying it's a consumer that's a little bit hesitant. They feel the price raises from tariffs and they are pulling back because of it. They did say they had about $150 million impairment charge from tariffs, but they are working through that, trying to mitigate some of the costs. John.
Danny, thank you. Looking forward to the coverage. We got a consumer problem or a Deckers problem?
I think it's a Deckers problem.
Based on the year so far, without a doubt.
People are kind of, I think, over Uggs, and they're not buying Hokas. I think Hoka, the top was when Biden wore a pair of Hokas with his suit.
I said the same thing at the time.
It just wasn't that cool.
Not great for the brand. Once you start becoming that, like for older people with problems with their feet.
Like when boomers were starting to wear Skechers, it was over.
It was over. The kids aren't going to be interested. Equity futures on the S&P up by 0.6% as we count you down to the opening bell. Let's get you the trading diary. Some more data later. Look out for some PMIs, UMich consumer sentiment. Next week, though. Wow, next week. Next Wednesday. Federal Reserve interest rate decision, Chairman Powell news conference, earnings from Microsoft, Alphabet, and Meta. On Thursday, the president meets the Chinese leader in South Korea, and more tech earnings from Apple and Amazon. Next Wednesday and Thursday, absolutely humongous. This morning, the focus is on inflation. CPI coming in below expectations. Traders adding to bets for 2 more rate cuts this year, including 1 next Wednesday. David Kelly of JP Morgan Asset Management joins us now for more. David, let's start with the inflation data. Is 3 the new 2? And is it going to stop this Federal Reserve from cutting interest rates?
Well, I think the Fed's going to keep on cutting rates. It's generally a better than expected report, but I think what it really shows is we have a K-shaped economy, and it's sort of a K-shaped CPI report. The thing that really jumped out at me is, first of all, rental costs coming down. There's, we've got a big change in demographics here, and rental inflation is just going away. You also saw used vehicle prices fall. I thought that was pretty interesting. And then the big thing here is core goods prices outside of food and energy. That's the stuff that should be hit by tariffs, but that's only up 0.2%, up 1.5% year over year. It is clear that mainstream retailers don't believe they can pass on the tariff increases right now, and that's what's making this inflation rate a little bit tamer than people feared.
David, doesn't this just justify what the market's already sussed out, which is that inflation fears were overblown earlier this year? The Fed can keep cutting, potentially below 3% by the end of next year, and that it's not going to cause a huge inflation problem?
Well, I never thought we had a long-term inflation problem, but I think it is still early days on the tariff effects. What's going to happen is, right now, retailers feel like they can't pass on the price increases. But early next year, you're going to have this refund bonanza. The average income tax refund per household, we believe, is going to be over $4,000. Last year was $3,200. And that is the exact time when retailers are going to feel like they can pass on these tariff increases. So I do think we've got a little bit of a spurt in tariff inflation still to come. But then, if nothing else happens, there isn't a lot of momentum in this economy, and it'll slow down again, and it'll cool down again. So I don't think we've got a long-term inflation problem. My real question is, given how bubbly financial markets are, do you really need the Federal Reserve adding more liquidity to the party right now, or should they just hang on in there and say this is enough liquidity?
What are you saying, or what are you seeing that really is bubbly, given the fact that earnings have exceeded expectations, the forecasts have exceeded expectations, and we're likely to see more of the same next week with the tech earnings?
Well, valuations are extremely high. Extraordinarily high. So overall, the total value of all U.S. market cap is about 365% of GDP right now. It was about 212% before the tech bubble burst back in 2000. It was 87% before the 87 stock market crash. So there's it's leverage upon leverage, high PE ratios on a very high level of earnings relative to GDP. Now, I still think this is a very good economy for equities, but I wouldn't say that you could call the market depressed at this stage. I think that one of the dangers here is that everybody gets out over their skis, and then you have a significant market correction or a bear market.
So are you talking about potentially if the Fed is cutting into strength, they'll be making an error this month?
Yeah, because it's a different economy, and we keep on talking about, the Fed's going to tighten to lower inflation. Forget about it. The Federal Reserve's short-term interest rates are not impacting growth. They're not impacting inflation, but they are impacting financial markets. And the big problem that we've had in this century of the 2000s hasn't been CPI inflation getting out of hand. It's asset bubbles, whether it's housing bubbles or tech bubbles. And the Federal Reserve should not be in the business of blowing up bubbles. So I think they should just take it easy. I don't mind if they cut rates a little bit here, but I certainly would have a problem if they cut rates below what they think neutral is, if the economy is not threatened by recession, because we are seeing money go into financial markets, go into financial assets, and just not come out. And it's kind of like a stuck valve. And the more money goes in, the more this market just seems to accelerate upon itself.
David, we asked Governor Waller this question when he was on the programme last week. We asked whether he was getting lulled into cutting interest rates and potentially juicing financial markets. David, do you think there's a problem with their interpretation of the dual mandate, or just the dual mandate?
I think the dual mandate itself. I think that Congress needs to recognize, they need to recognize that monetary policy has significant impacts on financial conditions, and therefore maintaining stable financial conditions should be part of the goal. It's kind of like with the ECB, who for years decided they weren't supposed to intervene if one particular country got into significant economic distress and destabilize the euro system. And then finally Mario Draghi said, look, if Greece is a problem, we got to do something about Greece. Well, this is a similar situation where the mandate needs to be expanded a little to recognize the impact of Fed policy on financial and other asset price bubbles, to try to prevent bubbles or busts, because of course that's what a bubble creates a bust, and you want to have financial market stability, not just economic stability. And I think the Federal Reserve can have an impact on that.
David, this was thoughtful. We appreciate your time. David Kelly there of JP Morgan Asset Management. An important question about the Fed's dual mandate, and I've heard that question now a few times.
Yeah, especially because they seem to respond to financial conditions, but only when markets go down, not when markets go up. And that has been a consistent theme over the past number of years.
It's going to be a really challenging meeting next week, especially because they only have the inflation print. That's it. They're data-dependent Fed. They only have inflation. But more so, what do they do in December if the shutdown is prolonged past today, 24 days?
What a week coming up next week. This week has all been about anticipation of next week. Massive tech earnings, Federal Reserve decision, and a meeting between the two leaders of the two largest economies on the planet. The President of the United States with the Chinese leader Xi Jinping. Coming up on Monday, full coverage of all of that with Elizabeth Economy of the Hoover Institution, Greg Peters of PGIM Fixed Income, Angelo Zeno of CFRA, Abby Yoda of JP Morgan Global Wealth. Before we go, a very special happy birthday to our executive producer, Amy. Have a wonderful birthday, Amy, and to all of you at home, have a wonderful weekend. Live from New York City this morning, good morning.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
In case you missed it on Bloomberg Surveillance.
We heard from Restoration Hardware, and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
People have less money. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on.
Anne-Marie had one final question.
How are the meatballs?
How
And
are
you're
the
lowering the
meatballs?
cost of the meatballs,
So I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We actually are running today about 40% of our sales is actually vegetables and plant balls. And personally, I don't love the vegetables, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty.
Don't miss Bloomberg Surveillance live every weekday.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Inflation cooling off, giving equity markets a boost. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, the first major data release since the shutdown. U.S. inflation rose less than expected in September, keeping the Fed on track to cut rates.
And the latest tariff twist, President Trump terminates trade talks with Canada and gears up for a meeting with China's Xi.
Plus, the busiest week for earnings is upon us. Nearly $27 trillion in market cap reports, with the Mag 7 leading the charge. That's next week, right?
That's next week. We're already getting some of the tech players, though, maybe not the bulk of the Mag 7, but we got Intel and Matt. Those earnings were very strong. The CFO over at Intel saying that demand is outpacing supply. They returned to profitability. They give an upbeat forecast. PCs are doing well, so shares up 5.7%. I believe if this sticks, it means Intel will have doubled so far this year in price.
All right, very good news for Intel. For Ford, they plan to build 50,000 more F-150s and Super Duty trucks at factories in Michigan and Kentucky in 2026. This will recoup about half the production it expects to lose this year as a result of that fire at a New York State aluminum factory, at the Novelis aluminum factory, Danny.
Well, not just Ford, but markets overall are higher this morning after the release of a long-awaited CPI data. Underlying inflation coming in less than expected in September, keeping the Fed on course to cut rates next week. Let's break down the data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, the right kind of surprise?
Well, the right kind of surprise, not a huge surprise in the sense that it was only slightly lower than anticipated. We'll take what we can get. But take a look at the overall numbers, the 0.3 gain in headline and 0.2 gain in core on the month. Better news, and that's something to hold on to, but look where we are annually. There's a 3 handle on core and headline inflation, and that is not a 2 handle, which is what the Fed's target is. So owner's equivalent rent. Furniture also tariffed up 0.9%. Here's an interesting one, though. Smartphones down 2.2%, and that may be because Apple held the line on pricing when it brought out its new iPhones this year. So it's something to keep keep in mind as we go forward. And finally, we should note that the Social Security cost of living increase for 2026 is going to be 2.8%. That's why they put out this data during the government shutdown. They had to have the latest numbers to calculate what the COLA would be for next year.
The iPhones remind me of, I'll never forget when a reporter told Ben Bernanke that you can't eat an iPad. By the way, the White House says just now, coming over the wire, there will likely be no release of the inflation data next month, which is interesting. Don't they legally have to put out some release for the COLA increase for Social Security recipients?
It's based on third quarter averages, and so September was the last month of the third quarter. The farther we get into October, the longer it goes, the less time they will have to collect data. We saw this in 2013. A lot of the data comes in electronically now, so that would still be available, maybe half or so. But if you're not collecting the rest of the prices, you're not going to get a scientifically valid number. So people have asked me, well, does this mean the Fed's going to cut rates at both October and December? December, who knows? Because they're not going to have any data maybe. And it's better when you walk into the dark room, as they say, you want to avoid the furniture.
Well, I think we all hope that this government shutdown is resolved by then. Michael McKee, thanks for joining us, Bloomberg's international policy and economics correspondent. Now, Ford's CEO, Jim Farley, says the production of the company's top-selling F-150 pickup will bounce back after a fire at one of its key aluminum suppliers. I spoke with him yesterday on The Close.
We're still working through it. It'll be, I'd say, around 100,000 units, but we still have the opportunity to improve that. This is really a retiming of wholesale. What we lose this year, we'll gain most of it back next year. Maybe $1.5 billion to $2.5 billion of EBIT this year, a little bit heavier on the cash because of how auto works. But we'll be gaining at least $1 billion, if not more, of that back next year.
For more on Ford, we're joined by Bloomberg's auto reporter Keith Naughton. He covers the company out of Detroit. And Keith, this was interesting yesterday. The market has known about the Novelis fire for a while now, and I guess the shares rallied on a little bit of relief that Ford is going to boost production to try and bring some of that back, but it's still going to cost the company quite a bit.
Oh, for sure. But there was relief, Matt, because they feared it would be far worse. The loss will be about 100,000 units. The financial loss will be 1.5 to 2 billion of EBIT. But as you just had Jim Farley saying, they think they can make a lot of that back. And the other thing that sort of counterbalanced and helped drive the stock up is that they had a very strong third quarter. It was a big beat, and they're selling a lot of very profit-rich SUVs and pickup trucks.
What about this message from the president on Truth Social, Keith? He said Ford and General Motors up big on tariffs placed on big and mid-sized trucks coming from other countries. Is that why Ford and GM are up big, Keith?
Well, I mean, Jim Farley did thank the president in his comments to the analysts on the phone, and his CFO, Sherry House, said that the tariff impact will be reduced by $1 billion based on these newest tariffs and the proclamation from October 17th that extended tariff breaks for automakers to 2030. So they did get relief on tariffs, and both GM and Ford reduced their tariff impact numbers this week.
All right, Keith, thank you very much. That's Bloomberg's Keith Naughton in Detroit, and we're going to have more from Matt's conversation with the Ford CEO in the next hour. First, other earnings that hit the market post-market close yesterday. Intel, those shares climbing 5.8%. Their sales forecast was below Wall Street estimates, but that's because some analysts were still including revenue from a unit that Intel just spun off. Bloomberg Tech co-host Ed Ludlow joins us from San Francisco. Ed, digging through Intel's results, how much of it is starting to factor in the various partnerships and investments they have from the government, from OpenAI, from SoftBank, versus just like a classic PC kind of market for them?
Yeah, the plan in the short term was to strengthen the balance sheet, and they probably added $15 billion in that sense in the quarter. They also paid off $4 billion of debt. The one partnership that isn't accounted for yet is the NVIDIA investment. That $5 billion stake or investment will close at the end of the current period. But basically, the stock is up, Danny, because in aggregate, The turnaround, they are producing evidence that it's working to an extent, at least based on financial metrics, but the environment for them was a lot better than perhaps they had thought. You know, PC processors is still their bread and butter, and you know, Windows had a refresh, AI PC is strong, they benefited from that. But they're also finding a little bit of a foothold in data centers and servers, noting that they don't do the sexy bit. They don't do the GPU that NVIDIA does. But their argument is that the hyperscalers and other data center operators realize that the CPU is ready for a refresh, and so they're investing, and Intel's a beneficiary of that.
Hey, at my weekly dad lunch, the topic of conversation has been whether or not ChatGPT will be a monopoly. And I see you wrote a story yesterday with a couple of your colleagues, Davey Alba and Rachel Metz, about Alphabet working with Anthropic. What's the deal?
Yeah, I mean, Anthropic is a frontier model lab, an AI lab that has just intense demand for compute. This confirmed our reporting from earlier in the week, right? But 1 trillion TPUs, 1 million TPUs, 1 million of Google's custom processors is a massive win and validation of their custom technology for both running models, inference, and training them with Anthropic, who historically have been very closely aligned with Amazon. And so, you know, that was a very interesting dynamic to play out this week. It's not been a very good week for Amazon and AWS, frankly. So the fact that Google's willing to back Anthropic at that level with the compute they need would suggest, to answer your question on ChatGPT, that Claude, the models that Anthropic makes, are seen as market leading and a contender. But I would say that the difference between ChatGPT and OpenAI and Anthropic went very aggressively and early for enterprise business, not for the consumer. And now OpenAI is kind of acknowledging that they need to catch up in that enterprise domain.
If it were OpenAI, Ed, then it could be 1 trillion TPUs.
I know, and I misspoke, sorry.
No, yeah. I mean, in this day and age, I wouldn't initially or immediately disbelieve that number. Ed Ludlow is the co-anchor of Bloomberg Tech. That show kicks off at 11 o'clock, a show you don't want to miss, even on a Friday. Let's get a check on futures, because on this Friday, we're looking at a rally to what could be another record close. Right now, S&P futures up 0.6%. NASDAQ futures up almost 1 full percent, about 0.9%. So we could see new records on both of those benchmark indexes.
Thank you, CPI. Now look at some of the other movers that are on our radar this morning. Deckers, which makes Uggs and Hoka's, is plunging. 2026 sales look weaker than anticipated. Analysts say it might be a conservative outlook. I don't know if the issue is the consumer. The CFO got on the earnings call and said that people are worried about tariffs and higher prices, so they're not buying, or is it just that nobody wants Uggs anymore?
Well, I certainly don't, but
I'd be surprised if you did.
Tastes change, so maybe, you know, I will by this Christmas. P&G sales, Procter & Gamble sales, topped estimates led by beauty and razor products. P&G maintained its outlook for the fiscal year, and as a result, those shares are up 2.5% in an up market.
Yeah, and it just shows that people are willing to pay up for brand names like P&G, so not everything is weak for the consumer. We also heard from precious metals miner Newmont. Their 2026 guidance for gold production is the same as 2025, which disappointed analysts and shareholders, especially given the run that gold has been in. Shares down 5.5%.
All right, coming up, President Trump halts trade talks with Canada over a tariff, an anti-tariff ad. Plus, he heads to Asia for a high-stakes meeting with China's president. We'll round it all up for you next. This is Bloomberg Open Interest.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Getting out of high interest, look what's making headlines around the world. Jane Street, Citadel, and other non-bank firms now command a fifth of global trading revenue and could hit 30% by the decade's end, according to Boston Consulting Group. Fueled by tech and lighter regulation, they're overtaking banks like JP Morgan and Goldman Sachs as top market makers, and Jane Street alone raking in $10 billion last quarter. JP Morgan Chase plans to let institutional clients use Bitcoin and Ether as loan collateral by year-end, deepening Wall Street's crypto embrace. The program will rely on a third-party custodian and expands the bank's acceptance of crypto ETFs as collateral. The move is a symbolic shift for CEO Jamie Dimon, once a fierce Bitcoin critic, as major banks warm to digital assets under the Trump administration's lighter regulatory stance. President Trump is shutting down trade talks with Canada over an ad campaign funded by the government of Ontario. The ad uses quotes from former President Ronald Reagan's address in 1987. Here's part of it.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
President Trump, reacting on Truth Social, wrote, quote, Canada is trying to illegally influence the United States Supreme Court in one of the most important rulings in the history of our country. And he even said that President Reagan loved tariffs, which makes me think I wasn't there in the 80s. Let's bring in Brendan Murray, who leads our global trade coverage. Brendan, I was there in the 80s. And President Trump, although he did put tariffs on some countries and industries, was most definitely anti-protectionism and pro-free trade.
Yeah, absolutely. I think what President Trump has done with this tantrum that he's thrown against the Ontario government is turn a lot of people to President Reagan's old speeches about how free trade is really the path to prosperity, not tariffs. And so this could complicate the talks that are going to start in the weeks and months ahead between the U.S. and Canada and Mexico. They need to review the USMCA by the middle of next year. And so this really isn't a great starting point for those negotiations to get going. But by the same token, the president of the U.S. didn't threaten tariffs. He just threatened to suspend talks. So there seems to be some room for Canada to either apologize or retreat in some way to get back in President Trump's good graces. But it definitely leaves the two sides in a sticky situation if they're going to reach some sort of agreement on the USMCA negotiation by the middle of next year.
At the very least, it shows that negotiations and talks and sentiment can turn on a dime. Brendan, we're also awaiting a meeting between President Xi and Trump next week at the end of this month. What's the expectation?
Yeah, well, first we're going to see Treasury Secretary Scott Bessent meet with his Chinese counterpart in Kuala Lumpur through the weekend. They need to extend the truce that expires November 10th. It's going to be a tough ask, though, because both sides have ratcheted up the tensions, the rhetoric, and the threat of export controls on, in China's case, with their rare earths, and in the U.S.'s case, with high-tech exports to China. So those talks are going to play out over the weekend. We've seen a pattern where they escalate the rhetoric, and then they reach some sort of deal, and they push back the next deadline another 90 days. That would be sort of the base case scenario that you could expect out of this. But there's a lot at stake, and China has realized that it really has a lot of leverage with these rare export controls that it can apply to the rest of the world.
You know, I was thinking about these rare export controls. They didn't exist before this trade war was started. Rare earths flowed freely, and soybeans also is a product that the Chinese bought a lot of before this trade war was started. In fact, almost $13 billion worth of soybeans from the U.S. last year. So is a win here just sort of reversing the damage that's already been done by this trade war?
Yeah, exactly. I mean, something like getting China to purchase American soybeans again is not really a win. It's just kind of restoring what has been happening all along. And the same goes with rare earths. You know, China knows it has a lot of leverage here. The U.S. is trying to rally other countries, from Canada to countries in Europe to Australia, to try to push back against China's leverage on this. And it's yet to be seen whether that will have an impact. But China is definitely going into these talks feeling like they have the upper hand, whereas when they started off in May back in Geneva, the U.S. felt like it had the upper hand. So we've really seen the tables turn over the past 5 months.
All right, Brendan, great to get some time with you. Really appreciate it. Bloomberg's trade czar, Brendan Murray, coming to us out of London. Now, quick check on what's going on with futures ahead of the opening bell as CPI came in a little bit lighter than expected. We were looking for 3.1%. We only got 3% even on the headline and the core. So as a result, traders pricing in more rate cuts and futures rallying right now 0.6% on the S&P.
A look at some of the other movers on our radar this morning. GM laid off about 200 salaried employees just days after raising its profit guidance. The firings were due to business conditions, they said, and not their performance.
Target will eliminate 8% of corporate roles, about 1,800 positions through layoffs and closing out open roles. Booz Allen, I guess, is actually down. The shares are down after the defense contractor cut its adjusted earnings per share guidance for the full year, and as a result, those shares are off more than 10%.
Now, coming up, Emily Bowersock Hill says overvaluation by itself rarely triggers a stock market correction in 2025. The same goes for government shutdown, trade upheaval, or credit market worries. We're going to discuss what it would take to slow the bull rally. That's coming up on Bloomberg TV.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Fed's going to keep on cutting rates. It's generally a better than expected report, but I think what it really shows is we have a K-shaped economy, and it's got sort of a K-shaped CPI report. The thing that really jumped out at me is, first of all, rental costs coming down. There's, we've got a big change in demographics here, and rental inflation is just going away. You also saw used vehicle prices fall. I thought that was pretty interesting.
JP Morgan's chief global strategist, David Kelly, speaking earlier on Bloomberg Surveillance after an inflation print that came in lower than expected. Let's bring in Emily Bowersock-Hill of Bowersock Capital CEO. Emily, really great to see you this morning. And there you go. One risk event out of the way. We got CPI coming in less than expected. Next up, we have tech earnings. We have a meeting between President Xi and Trump. Do any of those risk events, do they seem like it could derail this rally, this ride that we're currently on?
The momentum behind this rally is very strong, and the market seems basically impervious to bad news. DeepSeek, Liberation Day, cracks in the credit market, a government shutdown. So I think what it would take to derail the market at this point would be something really unexpected and surprising. I don't think it's going to come out of the meeting with Xi. I think the markets have just stopped listening to the tariff vacillations coming out of the administration.
What about earnings? How do you see the third quarter going so far?
I do not see earnings disappointments significant enough to derail the market momentum. I think we're probably not going to see. I think the next chance, frankly, for a very significant market downturn, and this is this is notwithstanding some minor correction, which is certainly possible before the end of the year, is going to come in first quarter earnings of next year, which is going to report how things went during the retail season. We've got three very significant sources of stimulative spending coming into this economy. And the first one is well talked about. That's the spending on AI. The second is consumer spending, which while it's not high by historical standards, it's certainly stabilized after the second quarter. And the passion of the American consumer for spending is unmatched. The worse their mood, the more they spend. The better the mood, the more they spend.
Yeah.
And we're seeing the spending coming from those higher income Americans that seem pretty insulated from price change.
So Emily, we'll get more into some of those individual earnings and the spending coming up. Emily Bowersock-Hill is going to stay with us. Coming up next, it's your Market Open.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, moments away from the start of trading on this Friday, and it looks like we have a rally on our hands, potentially new record highs on equity indexes today. S&P futures up 2/3%, NASDAQ futures gaining almost 0.9%. In terms of the bell ringers, we don't have a lot of substantial historical performance to look at. Grayscale ringing the bell at the New York Stock Exchange. Speaking of crypto, just working its way into traditional financial structures. They're putting out an ETF that now has multiple different crypto kind of coins in it. Who knows? And then down at the NASDAQ, AXG, I think it's SolarWind or something, but if you look at the performance, it's like done nothing forever. So there are stocks that are important for us to watch and take note of and are doing things, and you've got one on your board there.
Yes, and if we keep at this pace, Matt, I have Intel. It's going to have doubled, or just about doubled, for the entirety of the year. What a wild ride this company has been on. Shares are up 7% here at the open. Their turnaround plan, it's showing signs of progress. They've returned to profitability. Intel also gave an upbeat revenue forecast because it sees a rebound in PC demand, Matt.
All right, and speaking of rebound, Ford plans to build 50,000 more trucks at factories in Michigan and Kentucky in 2026, recouping about half the production it expects to lose this year as a result of a fire at the Novelis aluminum factory here in New York State. As a result, Ford is up more than 3% because it looks like the market expected worse and is happy to get some guidance. Ford shares actually doing really well this year. They are up 29% year to date, really neck and neck with GM, which has just really broken out this week, also up, but only 27%.
President Trump taking credit for it, saying that GM and Ford are up big because of tariffs on foreign trucks.
Yeah, they don't mind that they're going to have to pay billions or multiple billions of dollars in tariff bills, and maybe the Supreme Court reverses that, and then they'll be up even bigger. Let's bring back Bowersock Capital CEO and founding partner Emily Bowersock-Hill. I guess that's kind of the story of this market, right? Things could have been so much worse, but is that really reason to rally this far, this fast?
We're deep into the greed phase of the fear-greed cycle. And so there's a lot of FOMO going on, and I think that the momentum is very significant. So frankly, I think that as long as earnings overall don't really unexpectedly surprise investors, I don't see earnings themselves being a reason for a major market setback. And frankly, Intel's earnings and the earnings by Lam Research earlier this week, both of which are AI-related tech names, surprised on the upside. And I think we may see more of that.
I was reading some research from Citrini Research that's done a really excellent job on capturing the AI trade. Emily, they wrote over there something that has been a relative comfort in being able to stay long despite calls for an AI bubble so far has been the fact that most of the CapEx has come from cash and cash flow. You don't have a bubble until the majority of the expansion is done on debt. I bring that up because we have coming into the market $38 billion worth of Oracle coming in to secure financing for a data center that they're building for OpenAI. Does the use of debt concern you from these tech giants?
You are right that until very recently, the AI spending was funded by free cash flow. And now the Fabulous Five are starting to take on debt to do this. I think the most analogous recent period in history that I'm looking to is the telecom boom. And the real build out was 1997 to 2000. A lot of that was debt financed. And so, yes, it does concern me that debt is now part of the equation. But I still think that if you look at where we are versus that telecom boom, we're still a couple of years, 1 to 3 years away from that coming to an end. I think debt is one indicator that we're getting closer.
What do you like right now outside of growth? Or let me put that a different way. Do you see value that's worth buying in this market, Emily?
Yeah, it's tough. It's tough right now to put cash to work, and it's definitely tough to chase these tech names if you don't already own them. We like financials because I think they will benefit from deregulation. The capital loss requirements have significantly loosened, and most of the banks have not taken advantage of that yet fully. And earnings last week, I think, were a good indication that, that things are looking good for financial institutions generally. I think they will benefit from the adoption of digital payments over the next 5 to 10 years. So you have a little bit of an AI boost and, some productivity boosts that are going to come from AI and AI spending. So I think generally financial services are probably still at a good value.
Has we've seen some stocks get clobbered as a result of the one big beautiful bill, but you note that there were some real tax advantages there for certain businesses. Is there an investment case to be made because of some of those changes?
Yes, I think I mentioned previously that I mentioned two sources already of stimulative spending that are going into this economy. The first being AI spending, and the second, higher-end American consumers. The third is that the tax legislation put new depreciation rules in place, which provide a very strong incentive to finish construction, capital spending projects by December 31st of 2029. So there is a rush to start these projects and finish them within 3 years. And that is also going to inject more stimulus into this economy.
Emily, it's an interesting environment because you have that at the same time that you have Trump sparring with Canada over trade talks, with trade talks on deck for China. From Bespoke, they said companies so far on their earnings calls are avoiding mentions of negative macroeconomic headwinds on their earnings calls. Are you surprised that more of corporate America isn't citing this macro environment, or has it just become all the more friendly for them?
I think there's a certain amount of fear out there. I think people are trying to avoid any kind of statement that could be construed as political. Why do that? Why put your head up above the parapet? And so I think it's probably prudent on their part. I think it's unfortunate because I think what we need is transparency and communication, and we want to hear during company earnings what people think about the macro environment and what they're concerned about. But I think we're getting less of that disclosure, frankly.
You mentioned that we're in the greed stage and that we could have, if you look at the parallels of AI to the telecom boom that we saw in the late 90s, very early 2000s, maybe a year or two left. In October of 99, as we've heard a few times from Paul Tudor Jones, we still had a doubling of the NASDAQ before March of 2000. Do you think that's the phase that we're in right now?
I don't think we're quite there yet. When you look at infrastructure booms in history, so take the railroad boom in the 1840s in Britain, which was real, right? It went from taking you 4 days to get from Manchester to London to taking 4 hours. And it peaked at 7% of GDP in terms of spending on railroads. We're now at about 1% to 2% of GDP, which is very substantial. And in the first half of the year, it actually was a bigger part of GDP than consumer spending. But I think there's probably still some room to run on it. I think there's some massive misspending going on. No doubt about that. We are in a bubble. The question is, where is the misspending? And when are we going to find out what it is?
I talked to an executive who said we're putting data centers on the moon, so I definitely feel some of that kind of froth coming in. Emily, it's been such a joy to have you. Please come back and join us again soon. Bowersock Capital CEO and founding partner, Emily Bowersock-Hill. A check on your equity market. We are nearing 6,800, and if we close at these levels, we will be at another record high. All we had to do to get there was go up 1/4%. We are up more than 0.8%. So yeah, we got there. The CPI report comes in 0.2% for core. The expectation was for 0.3% month over month for core. And what does that do? That gives you a boost to your tech stocks. NVIDIA, the biggest mover by market cap, followed by Broadcom, Alphabet, Amazon. If you're a Mag 7 holder, it's a good day for you for everything except your Tesla in your Mag 7. Tesla, a crazy day yesterday. They had earnings that disappointed, despite the fact they had record EV sales. Tesla opens up sharply lower yesterday and ends the day higher. It is lower yet again, some real volatility. Newmont, one of the worst performers too this morning. They said that they're not going to be spending as much as the market had hoped on new gold mining operations, a disappointment there. Netflix down incredibly sharply, it would appear this. Oh, sorry, I'm looking at Deckers. Deckers is down 14. They're close to each other. Deckers is down 14% because no one wants to buy Uggs and Hokas. Netflix, though, Matt, did have bad earnings, so I'm not totally without reason flagging Netflix. Just a quick look at some of the sectors. Most of them are in the green today. Again, it's the macro story of CPI allowing the Fed to cut. Infotech, that is number one, followed by financials and communications. Materials, the only sector lower, Matt.
I'm going to push back on the Hokas because my former co-anchor, Katie Greifeld, and now co-anchors The Close of the Romaine Bostic. She buys a new pair of Hokas like every 6 weeks.
I guess that's not enough to support them because they didn't have good earnings, Matt.
I'm going to tell Katie to step it up.
More Hokas. Maybe she needs to start buying Uggs too. Maybe that's the problem.
Yeah, I wouldn't put it past her, frankly. I can see that being the case on the weekends. Coming up, Ugg and Hoka maker Deckers. We're going to talk more about this. Absolutely pummeled. You can see this chart year to date, losing more than 50% of its market cap. This company, it's been a tough year for shareholders. We'll explain when we come back. This is Bloomberg Open Interest.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
After After a cooler than expected CPI, we are just under 6,800, easily a new record for the S&P. If it hangs tight, the NASDAQ, that outperforms not only because of the CPI coming in cooler, but also Intel earnings. Some of your top calls this morning, the analyst action that we are focusing in on, Coinbase. That gets an upgrade at JP Morgan. They cite reduced risk, fresh monetization prospects, and the company will report earnings next Thursday. Next up, Stifel, they downgrade Snap to a sell ahead of a third quarter earnings. They cite tougher year-over-year comparisons and still macro uncertainty. Stifel says that sentiment from advertisers is also worsening with more risk to the downside. The market doesn't care though because everything is rallying today, except for Deckers. UGG maker Decker Outdoors gave a weak forecast for 2026. Analysts though do say that the outlook may be conservative given ongoing strength at Hoka and UGG. Its price target though was cut at Bernstein and a handful of other firms. Those shares getting crushed, Matt, down 13.25%.
Yeah, let's discuss Deckers further with Bloomberg retail reporter Lily Meyer. And I had a buddy in town, an old hippie friend from Boulder, and he was wearing Tevas. And I thought, this has to be the last guy on earth who's bought Tevas. That's the other big brand that they make. Hoka, Uggs, and Tevas. It's not going well, is it?
Yeah, I mean, I hate to share this, but I do own a pair of Tevas.
Nice.
But, I think with earnings, the stock really dropped on their guidance, and I think they are really expecting consumers to begin to feel that tariff impact.
How much of that, though, is just a one-off, Lily? Because there's Deckers, and then there's P&G, showing up really strong earnings that people are willing to pay up for a brand name.
Yeah, so P&G actually cut the tariff impact, and a lot of that was on Canada getting rid of their retaliatory tariffs. And they also said they're seeing consumers trade up. So, we're going to have to wait a little bit and see what other companies report, but they kind of had different outcomes.
Right. I mean, one is really a consumer staple. You have to, if you're a slave to the Gillette razor machine, continue to buy those replacements.
You could buy like a white label razor, though. You don't need to buy the Gillette branded
I'm going to say, if you've gotten into the Mach 16 or whatever it is now, you just can't get out of it. It's a tough cycle to break. And then, obviously, a toothpaste or washing detergent, you're not going to stop buying that, and you're probably not going to switch down. You're more likely to save money by not buying a new pair of Uggs, right?
Yeah, I mean, I guess it depends what your calculation on that is. But, yeah, I mean, grooming was one of the areas that they saw a lot of success in, as was beauty and personal care.
All right, so they're still doing well. We still want to look good, And
at least
here's the fun thing, right? Part of looking good is a Gillette razor and Tide detergent.
Are you getting
Part
paid by Gillette? What's happening, Matt?
Is not UGG. No, I'm just saying, as you know, I like the Japanese double-edged safety razors.
Yes.
Feather. It's a very good choice. Buy now, buy once, cry once, But I'm just saying, if you're in the cycle of Gillette,
right,
you can't
get
out.
out. You're stuck forever.
No one's buying the Wilkinson swords, right?
I have no idea what that is. Sounds great.
All right, Lily, thank you very much. Bloomberg's retail reporter, Lily Meyer there. In other news, Intel's CFO says demand is outpacing supply as the company returns to profitability and gives an upbeat forecast. The stock has been hot this year. Bloomberg Tech's co-host, Caroline Hyde, joins us now. So this company getting an absolute mega boost from President Donald Trump.
And from NVIDIA. And from SoftBank.
Well, because of President Donald Trump.
And it's about $16 billion of money that either is a stay of execution or actually can reignite real growth once again. Because let's face it, yes, they returned to profitability, but it's been about 6 straight quarters where they didn't have profits, and we're actually still leaking out only 3% revenue growth. At a time where we're meant to be seeing CPUs a delight within the AI data center space, as well as GPUs. They did see more demand than supply. They are seeing a demand really for the next generation of chips that go into PCs in particular. Maybe the AI PC is starting to take off, when we're really starting to see people wanting to be upgrading with the new Microsoft Windows as well. So they did see some stronger overall fundamentals for this business. But the stock is up 90%. Most companies that analyze this stock, so most of the overall analysts that are on it, are saying, look, you should either hold or sell from here because the upside is still so much hinging on whether they can compete with TSMC. Are people going to eventually want their chips fabricated by Intel in the United States? What types of chips? What margin are they going to make on it? What sort of actual good chips are we going to be getting out of these ones that are manufactured when you're looking at the 18A, not to mention 14A, which is the next iteration of chip that at the moment, Lip Bhutan, the new CEO since March, has been saying, I'm not going to build it unless they definitely come, unless I know I've got the demand. So we're in this kind of catch-22 situation.
Caroline, I can only imagine how insane your week is going to be next week on Bloomberg Tech. It's all the rest of the big cap tech. Microsoft on Wednesday, then Meta, then Alphabet. You also have Amazon and Apple coming in on Thursday.
It's a party.
Yeah, I mean, is it, or is it like a hold on to your seats and pray that they keep the rally going?
And I think this is what, for most investors, is the question. Are the fundamentals there to keep on pushing up these valuations? And I think from what we've got so far, the hints are that, yeah, people are actually committing real money into real revenue-generating businesses. Whether or not we'll see the advertising momentum still carry on for Meta, whether we see Microsoft still managing to cash in on Azure and seeing with an uptick. Look, we've had a big deal for Alphabet's new chips coming from Anthropic. What does that mean for Google's ability to outperform when it comes to Gemini demand? More broadly, for the advertising to remain sticky. A lot of these businesses need the economy to keep on growing too. But I think thus far, we have managed to see fundamentals bear out in a lot of the growth stories to these companies. The valuations on these companies, unlike NVIDIA, which trades at 60 times future earnings, NVIDIA is much healthier because earnings have risen at the same pace as the shares have more broadly as well.
Wow, no, NVIDIA trades at 41 times future earnings.
It's not as bad.
60 would have been a huge jump, I think.
That's Intel.
You're thinking, well, and Costco, right? I mean, some of these companies are trading at huge. Okay, Costco's 47 now, but
Microsoft, Meta, some of the other numbers seemingly in line with where the Nasdaq generally performs. People feel that they're not too expensive.
Yeah, no.
To currently stay.
It looks cheap. 33 times. Microsoft is 33 times earnings. I love to go through these estimated PEs. All right, Caroline Hyde, looking forward to your program. She co-anchors Bloomberg Tech with Ed Ludlow. Coming up, Goldman Sachs is launching a new ETF.
Yeah, and it's an ETF that's designed to mimic private equity returns. How are they going to do that? More on that coming up next. You're watching Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on in stocks. Just about 20 3 minutes into trading right now at 67.92. We are at an intraday record, and if we close anywhere near here, we'll be at a closing record as well. So the market continues to march to new highs today on optimism, really, that President Trump and President Xi at a meeting will finally deal somehow with this trade spat. NASDAQ gaining 0.9% as all of the Mag 7 stocks, really, other than Tesla, are rallying. Danny showed you that just moments ago. Take a look at some of them here. NVIDIA up almost 2%. Intel up 3.4%. We just talked about with Caroline Hyde. Next week is massive for tech earnings. I think 27 trillion, is that right? $27 trillion in market cap reporting next week.
Yeah,
and then,
sounds about right.
Look, what are we going to need in order to make the AI bubble work? It's going to be power. So Oklo up another 8% today. Grindr, I have no idea what's going on with Grindr, but it's being taken private here, and I wish those gentlemen luck. Up 26% and change. Newmont Mining down as gold continues to retrace its spike higher, and then Cipher Mining up 10% today. Danny?
I do want to confirm you are right. 27 trillion next week. It was 9 trillion this week. Elsewhere, Matt, Goldman Sachs joining the growing list of managers looking to replicate private equity exposure with an ETF. The only other one is Apollo doing credit. I spoke to Michael Brunn, global co-head of private equity at Goldman Sachs Alternatives, on the activity he's seeing in private equity.
We certainly think that deal-making volumes are back for very fundamental reasons. First of all, private market valuations have stabilized. At the same time, you've seen volatility come down, and importantly, you've seen base rates reduce and credit spreads reduce. We certainly see it as a more constructive environment, and we certainly think that that backlog will allow for a lot of interesting deal formation on the buy side.
GSAM's Michael Brunn there. He says private equity is doing well, and apparently Goldman agrees and thinks everyone wants exposure via their ETF, but they're not buying private companies, they're buying public companies, which begs the question, if you can make an ETF with private capital returns via public companies, why would you ever invest in private equity to begin with?
It really is pretty confusing when you think about it that way. And Goldman Sachs said that they're doing this because so many investors want private equity exposure, but this isn't that.
Right.
So they should say they're doing this when so many investors want private equity returns.
Right, but again, their thing is they can create private equity returns in public markets, which I think is against the whole point of it. Anyway, another hour of Bloomberg Open Interest coming up next.
Estava sitiada.
Isso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. We begin in the Caribbean, where the U.S. has taken aim at a 10th boat, making an alleged drug run to the U.S.
Defense Secretary Pete Hegseth posted on X the latest strike was on a boat operated by the Venezuelan gang Tren de Aragua in international waters in the Caribbean Sea. Hegseth says all 6 male narco-terrorists aboard were killed in what was the first nighttime strike. President Trump has warned the strikes on drug cartels may expand beyond boats.
So now they're coming in by land, and even the land is concerned because I told them that's going to be next. You know, the land is going to be next.
At least 46 people have been killed in the U.S. strikes. Michael Wallace, CBS News.
The government's overdue CPI report shows the inflation rate hit 3% in September. That's a little lower than expected. Business analyst Jill Schlesinger.
The report will be fodder for the Federal Reserve, which is set to meet next week. Most believe the Fed will continue cutting interest rates, this time most likely by another 0.25%.
The other big takeaway, the cost of living increase will go up by 2.8%, or about $56 a month, for Social Security recipients, like this woman in Bethesda, Maryland.
I'm just so worried about what's going to happen with Medicare. I worked hard all my life. I finally was able to retire. And I really depend on my Social Security check.
A big automakers just announced layoffs. WWJ's Jeff Gilbert from Detroit.
Most of the 200 job cuts are at GM's technical center outside Detroit. The workers were reportedly told by a Slack message early this morning. The company telling them this was for business reasons, not performance. All car makers have been trying to deal with rising costs.
The FBI is investigating a shooting at a Coast Guard base in Northern California's Bay Area. KCBS's Matt Bigler says law enforcement opened fire on a U-Haul truck that tried to drive onto the base after a day of anti-ICE protests.
The U-Haul driver seemed to be taunting security guards as he drove onto government property, backing up the bridge to Coast Guard Island.
Protesters and the Coastal Guards are both saying, like, you need to stop, please go back to the blue line.
Protester Jenny was recording when the guards opened fire. The driver sped off and was reportedly taken to the hospital.
Former President Biden wasn't a fan.
If I took you blindfolded and took you to LaGuardia Airport in New York, you must think I must be in some third world country.
A lot's changed in 7 years. After an almost $8 billion makeover, Forbes travel guides named LaGuardia the best U.S. airport in the country for the second year in a row. Dow's up 387. This is CBS News. findings on UTIs.
A new study published in the MBio journal finds that E. coli from contaminated meat was the cause of nearly 1 in 5 urinary tract infections in a group of patients in Southern California. The E. coli strains were found in meat samples from grocery stores in the same area. Senior study author Lance Price with George Washington University says urinary tract infections have long been considered a personal health issue, but their findings suggest that they are also a food safety problem. Jennifer Kuiper, CBS News.
A Halloween horror for young K-pop fans.
You think we're just going to let you steal our fans? You're going to have to fight us for them.
So many kids are clamoring to dress up like their favorite demon-hunting girl group from Korea. Stores are running out of costumes. Wall Street Journal says some parents have been scouring Amazon for Chinese knockoffs. They're not setting them back as much as officially licensed merch from Netflix. Yellow jacket worn by the character Rumi sells for $90. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com and search Bloomberg Local Podcast. That's where you'll find us. Scarlett Fu, Paul Sweeney. We are here with you, the Bloomberg Intelligence radio program for the next 2 hours. Coming up, we're going to check in with Joanne Shu. She's the University of Michigan Director of Surveys over there. We're going to get the UMich data. Came in a little bit weaker than expected. John Tucker will have some reporting there. Brendan Murray, Bloomberg Global Trade Editor. Talk to us about the U.S.-Canada tensions. The president's upset about an ad. I don't know what's going on, but it's impacting trade discussions between the U.S. and our number one trade partner, Canada. So we'll break that down. Noor Youssef, Senior Vice President, RBC Wealth Management, will give us her thoughts on these markets. And then Bess Friedman, Chief Executive Officer, Brown Harris Stevens, on the residential housing market out there. We're talking about housing affordability or lack thereof. So we got a lot of stuff coming up over the next 2 hours. Right now, let's kick it all off with John Tucker in the Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more at your timetable. Learn more at ibkr.com/round-the-clock. You want data? We'll give you more data. Yeah, UMich, go Wolverines. The sentiment index, a little lighter than expectations, 53.6. Let's do the one-year inflation expectations, right on target at 4.6%, on target with the expectations. In the 5 to 10 year, the longer-term inflation expectations index, 3.9%. So that's a little more than what economists surveyed by Bloomberg were looking for. And the data earlier shows inflation not as bad as some thought. That's pushing stocks, yes, to record highs. 10 of the 11 major industry groups in the S&P 500 up. Information technology, financials in the lead. Ford Motor, the best performing stock in the S&P 500. And then you have Deckers Outdoor. That's the worst performer right now. Lisa's going to break that down. Constance Hunter at The Economist says, you know, that tame inflation report today seals the deal for the Federal Reserve's next move.
The Fed is going to cut next week, and this certainly gives them cover for next week and possibly even to cut again in December.
And right now, the S&P 500 up 62 points. That's a record, 6,800, up 0.9%. The Dow up 406 points. That's a record. NASDAQ 100 up 288 points. That's a record. I'll do this real quick. I don't know if you saw this one. The daylight robbery at the Louvre has turned into a marketing opportunity for Bocker. This is the German maker of cranes and elevators.
Which
their products were used. So
and
anyway,
Left Behind, too.
Yeah, and Left Behind. So the CEO sees this and like, hey, those are my machines. So he's got a new advertising campaign on social media. When you're in a hurry, the Boker Agila carriers your heavy treasures.
Yes.
And it's creating quite a media, I don't know what I think about this, creating quite a media buzz out there. Anyway.
Got to jump on the moment, John Tucker.
Yes.
I guess so. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett. Happy Friday, Scarlett Paul.
We see you're sporting the Red Bank Catholic pullover today. So is that
Go Casey's?
You paid years of tuition, and that's what you get?
I paid like $30,000, and I got this shirt.
You got this shirt. That's how.
That should be what's on the jacket.
I'm a CBA guy myself for the Jersey
just for
folks.
clarification, but Red Bank Catholic, the Casey's, good stuff there. All right, Market Drivers is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to Commonwealth.com to learn about their consultative support and technology. As John was just reporting, we got green on the screen across the board. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Lisa Mateo. Again, can't we get rid of you?
Sorry, you can't. Okay, so we'll start with Intel, ticker INTC. All right, its shares have been up as much as 5% of the open. They've kind of come back just a bit. The thing is, they're making progress on a comeback. It was a pretty rough year for the company. There have been concerns about whether it can manufacture products that really pull in those customers again. The good news, well, it returned to profitability, gave an upbeat revenue forecast. Fourth quarter sales will be roughly $13.3 billion. It was just below Wall Street's estimates, but some analysts were still including revenue from a unit that Intel just spun off, and that was money that wasn't part of the company's forecast. But it comes after a few things, right? You think back, Intel secured that investment from the U.S. government and won backing from companies like NVIDIA and SoftBank, and investors really loved those deals, and they sent actually Intel shares up 90% this year.
My boy Frank Yeary's the chairman of the board there, so that stock is ripping.
Oh, nice.
Yeah.
It's had quite the turnaround. All right, let's take a look at P&G, consumer goods company, like the staple, safest of the safe plays.
Yes. Okay, so their shares have been up as much as 2%. So yes, better than expected sales. Revenue earnings per share also beat expectation, but its beauty and grooming really came in big for the company. They have Secret deodorant, Gillette razors, right? So that's leading their sales growth. The interesting thing is that they raised prices in all their business division except for baby, feminine, and family care, and consumers paid the higher prices for them. So that was the news that stood out for them. Wow. And the company's been going through changes. You know, they cut about 15% of their workforce over the next 2 years to kind of improve in, efficiency. They're bringing in a new CEO. So yeah, they're going through a lot of changes, but people still paying more for some products like Bounty paper towels, Tide detergent. Wow. Think about it.
So that's tariff inflation that consumers are paying?
They actually, the company itself sees a lower impact from tariffs. Okay. Originally, they thought it was $800 million. Now they've brought it back to $400 million. So that's coming back a bit.
Decker's Outdoor.
Yes. Okay.
That's not Decker's clothes, right?
No, it's the running shoes, the Hoka running shoes, Uggs boots. Yes. Okay, they're all over our house. Okay. the company though, their shares have been down as much as 14%. So it missed on its sales guidance. People spent on consumer goods like from Procter & Gamble, like we were just talking about, but they held back on these things like footwear. So they went for the things that they needed, like, deodorant and razors, and it looks like they're holding back on like this expensive footwear. So Bloomberg Intelligence is saying their 2026 forecast could be a little bit conservative if momentum at both brands continues. They said Hoka it actually has a little bit room to grow, and for long-term success at UGG, they said that they need more product diversity. They need to come up with new products, new UGG products. Like they had the sneakers that, I don't know if you remember, that came out and they were all popular, and I had to buy those too. So it goes to show you, like, a new product comes out, your kids want it, you go buy it, you spend more money. So they're saying they need to do that a little bit more.
Have you seen the Mary Jane Uggs?
No.
They're really cute.
Really?
Yeah. I mean, they're kind of open and at the top, so, you question the value of having shearling Uggs that are open, but very cute.
What are they called?
I got to look
Mary
it up.
Jane
Mary
Uggs.
Jane's.
I'm Googling it now, folks.
All right, Lisa Mateo, thank you so much with our market drivers this morning. And for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We got data this morning, Paul.
No, I'm looking at the Mary Jane Uggs.
Oh, and?
Okay.
He's not convinced.
Yeah, I'm not sure about
Lisa, would your daughters be into that?
Actually, I think those are in her closet. Sorry.
They look familiar.
All right. Very good. All right, let's get back to the economic data.
Yeah, so we had University of Michigan numbers come out, and the read was somewhat concerning if you were thinking or hoping for consumers to feel better about the economy.
Yep. Didn't really see it, right?
No. The sentiment number 53.6 versus the expected 54.5, and that is a decline from the previous period. So let's bring in Joanne Shu. She is Surveys of Consumers Director at the University of Michigan. Joanne, walk us through what these numbers tell you.
Essentially, we're seeing a very small decline from last month. I would say that's essentially unchanged. Consumers don't really see meaningful changes in the trajectory of the economy. They're relatively sour views, both in terms of their personal finances as well as business conditions. Consumers just continue to be quite worried about the prospect of inflation coming back.
So on that inflation front, Joanne, I guess for the one-year inflation outlook, it holds steady at about 4.6%. That's certainly higher than what the Fed would like to see. It ticked up a little bit on the longer term, the 5 to 10-year inflation outlook here. So inflation still higher than I'm sure a lot of folks would like to see it, including the Federal Reserve.
That's right. Consumers have been telling us for quite some time that the number one factor that's weighing on them is the specter of high prices and inflation. Right now, consumers see a lot of uncertainty on the path of inflation. I think they continue to be really quite worried about that the impact of tariffs has not quite fully finished passing through to consumers quite yet. So they see a lot of uncertainty going forward. That median long run ticking up is not good news. But yeah, consumers are quite unsure about the future trajectory of inflation.
And Joanne, ever since President Trump unveiled his tariffs earlier this year, give us a sense of how that outlook for 5 to 10-year inflation has moved. Because initially it created a lot of worry, but then he backtracked quite a bit. And now we're starting to see it kind of stay at those levels.
That's right. So consumers, when they first heard about those major announcements back in April, they really braced for a worst case scenario. We saw sentiment plunge and we saw inflation expectations spike. Moving past May and June, consumers started to feel slightly more confident that the worst case scenario wasn't coming to pass, and those inflation expectations started to come down. For the short run, currently, we're about midway between where we were a year ago and that peak in April and May. With long run, we're also still in between those 2 points. So consumers don't think we're out of the woods, but they don't fear the really big fears that they had just earlier in the summer.
So, Joanne, again, the headline number is sentiment number 53.6. Where would you like to see that number? What's a healthier number that you think we should be seeing?
We've been bouncing around in the 50s and low 60s for most of this year. And what we really want to see is a sustained increase. It was really good news earlier, just a few months ago, when we started to lift up from the lows that we had in April and May, but that didn't stick. What we need is several consecutive months of improvements that actually stick. So that upward trend is really more important than hitting a magic number.
And very quickly, Joanne, can you give us a broad overview of who you're surveying for the sentiment?
We interview a nationally representative sample of U.S. adults spanning ages, education, income levels in the lower 48 coterminous states as well as D.C. We're unable to really reach Hawaii and Alaska in a timely manner, but we are really reaching a representative sample.
All right, good stuff, Joanne. Thank you so much. Appreciate that. Joanne Shu, Surveys of Consumers Director for the University of Michigan. Not just great football players, but they got great economists out there at the University of Michigan. So we get that data. And again, a little bit weaker than the consensus forecast. And again, Joanne was suggesting we'd like to see a number north of 60 here. And I was just looking at it over the last 4, 5, 6 years, and the average seems to be somewhere in that 60 to 70 range. So if you get a reading at 53, a little bit lower, then you'd like to see.
That's the uncertainty. That's the uncertainty showing up.
Absolutely. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News, with this Bloomberg Business Flash. We're being brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Major stock averages at records, and that much delayed CPI showing tame inflation, so that clears the deck for an interest rate cut for the Federal Reserve next week and probably December too. At the same time, consumer sentiment falling in October. That actually hit a 5-month low. You heard from Joanne Shu just a few minutes ago. Worries persist about the stubbornly high prices and the impact on everybody's finances. Ford Motor, that is the best performing stock right now in the S&P 500. Ford shares, they are up 9.7%. They posted third quarter operating profit of $2.6 billion on record sales that beat all the forecasts. And then Procter & Gamble gaining about 0.5%. The owner of Tide and Pampers, posting core earnings of $1.99 a share in the fiscal first quarter, better than expectations. And right now, the S&P 500, 53 points higher, up 0.8%, 6792 on the index. That's a record. The Dow up 386 to a record. NASDAQ 100, 258 points higher. That's a record there. Oh, Pop-Up Bagel. I haven't seen them. They started in Connecticut. Pop-Up Bagels.
They're around the corner from our office, John.
I don't leave the office, even to go home. That started in Connecticut in somebody's backyard. Now
During
it has
the pandemic.
16 stores, 7 of them in New York City, which I would say is the bagel mecca of the world. Most recently, it's valued at $60 million. This is backed by private equity. They're betting they can catapult from a viral TikTok-fueled phenomenon into a national bagel juggernaut. Sure. They have plans to open up 300 locations in the U.S.
You're going to know the answer to this. Why can't you get good bagels out of the city?
I guess it's the water is so
That's what
pure.
people tell me, but I don't understand that concept.
I'm going to test that because I brought some Pop-Up Bagels to friends in California, and I was all excited saying, these are great. And then in La Jolla, there's a sign that says, coming soon, Pop-Up Bagels. Oh, my gosh.
I'll stick with my Essa Bagels here in the city.
Okay.
I think they're awesome.
I love Pop-Up Bagels.
So
they're great.
Okay.
We'll do a field trip down there, around the corner, literally.
That's what makes a market.
Yes.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
JT, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Head over to youtube.com. That's the internet. Search Bloomberg Live Podcast, and that's where you'll find us. I guess we're back on arguing with our friends up to the north in Canada, a TV ad.
It's about time.
I mean, I thought we were moving towards détente or something. I don't know. Brendan Murray joins us, global trade editor for Bloomberg News. Brendan, what's going on between the U.S. and Canada here?
Yeah, well, this is really more of a tantrum than it is a trade war. President Trump didn't like this advertisement that the government of Ontario put out, quoting Ronald Reagan as being opposed to tariffs. And so he lashed out at Canada and said, all right, that's it. Trade negotiations are off. The reality is they weren't really going anywhere anyway. They're supposed to get underway in the next several weeks or months. They have to review the USMCA agreement that is due to be reviewed by the middle of next year. So President Trump is just trying to push the government of Prime Minister Carney back a little bit, back on its heels. And in the process, what he's done is forced all of us to go listen to old Ronald Reagan speeches and find out that he was actually quite the free trader as opposed to President Trump, who's quite pro-tariff.
I suppose that's one, I mean, sure, that's what's happening, but the Reagan Foundation objected to the use of the sound bites in the Canadian ad, and they say they're now exploring legal options because the full context of the late president's comments was that he was actually in talks with Japan and trying to explain why he was imposing tariffs on some Japanese goods.
Yeah, I mean, listen to the radio address from President Reagan yourself, and there's no reasonable reading of that other than it's a takedown of the use of tariffs. President Reagan was trying to use tariffs against Japan in a very sort of measured way, and he was trying to explain that. But the flip side of that, and this is the one that Ontario seized on for its ad, was that I don't want to do this. I think he actually says I'm loath to use tariffs. President Trump loves to use tariffs, and so that's what the Reagan Foundation didn't say that they fabricated anything that President Reagan said. What they did was they made a political ad the way political ads are made. You take you take the message that you want people to hear and you splice it together, and that's what it is. But the full reading of the Reagan address is clear, and it stands in direct opposition to what President Trump stands for when it comes to trade and tariffs.
So, Brendan, looking ahead, President Trump and Mark Carney will both be in Asia next week attending ASEAN and APEC summits. Do we get a sense of whether these two gentlemen have any personal chemistry that they might be able to restart unofficial negotiations right there between them?
Yeah, we'll have to wait. I believe Carney is speaking now or soon, and so we'll have to see what he says. I mean, the big discussion next week is going to be between the U.S. and China, and whether they can get some sort of extension on their trade truce that they've got going. That's really what markets are focused on at the moment. Are we going to escalate that U.S.-China trade war or de-escalate the way they have for the past 4 rounds of trade talks? So we'll have to see how that turns out. Secretary Bessent, the Treasury Secretary, is meeting with his counterpart in Kuala Lumpur this weekend to set up any sort of agreement that they might reach later in the week, the two leaders, Trump and Xi. So we'll have to see how that shakes out.
All right, very good. We appreciate that. Brendan Murray, appreciate getting a few minutes of your time. He's a global trade editor for Bloomberg News. He's based over there in London. Let's get back to these markets here. You got the S&P up 50 points, the Dow up 370, the NASDAQ up 250, more than 1% here. I don't know. I mean, is this market stretched? Are the earnings out there to support it? Is the Fed cutting rates enough to keep this market moving higher? I don't know. But we got some people here who know they do this stuff for a living. Nora Youssef, she's a senior portfolio manager, RBC Wealth Management. She's based up there in Boston, but we have her in our Bloomberg Interactive Broker studio here in New York today. Nora, thanks so much for joining us here. How are you thinking about these markets here? Again, seemingly hitting new highs. Well, not seemingly, we are hitting new highs every day, but we've got some good earnings. We've got a Fed that's cutting. Can this market continue to move? How are you guys thinking about it?
You know, it's really interesting. I love what you said at the top about sentiment being down. I love when I hear sentiment is down because, as Sir John Templeton famously said, bull markets are born in pessimism, rise in skepticism, die in euphoria. So I don't mind a little skepticism. And what I will say, you know, when assessing the economy, myself and our RBC analysts, what we pay attention to a lot is the consumer. After all, consumer spend makes up 70% of GDP. So we look at the 3 C's. First is cash. Well, household debt to income ratio is looking all right. Nothing alarming there. Second is confidence. Well, net worths are at all-time highs. Collectively in the U.S., we're at $176 trillion. And when people feel wealthier, they tend to spend more. Guilty. And lastly, capacity. Unemployment, yeah, it's rising, not at an alarming rate. The job market is still relatively good despite headline layoffs, and wages are rising. So all that provides a really nice backdrop to help, in part, substantiate some of these earnings in the context of things like cumulative inflation.
At the same time, though, you are pretty clear about wanting to make sure investors don't get too carried away with this optimism, that there is reason to, be skeptical of some of what we're seeing.
Yes. Now, stocks are flirting with all-time highs. We might hit another today. And we're defying the seasonal declines we typically see around this time of year. And so what I remind people is that, hey, listen, that doesn't mean bad news and volatility isn't around the corner. So I do urge clients and investors to really, don't be too complacent. Don't be too comfortable. Really don't lose sight of the fundamentals here. If you have overrun positions in your portfolio or your allocation is out of whack, you want to be rebalancing, likely be taking money off the table and doing something with that cash.
Is there kind of a model portfolio you kind of start your discussion with your clients here in terms of stocks, bonds, maybe even alternatives?
Yeah, it really depends on the clients, of course, their goals, the time horizon, all of that. What we're really paying attention to a lot right now at their portfolios, especially closing out the year as we're taking a lot of cash off the top is doing something with that cash while interest rates are still at these, elevated rates before the, Fed makes their big decision next week and continues to likely on this, declining trend here down. And so this window of opportunity to lock in fixed income for as long as people don't think they're going to need the money is here, still available before that window continues to shut on clients.
How worried are you about what we've seen in the credit markets? The bankruptcies of a couple of companies. I know the favorite term, and John, you're going to...
Don't say it, Scarlett.
One-offs.
Yes.
There we go.
One-offs.
Much better.
And then, of course, some regional banks saying that they were victims of fraudulent loans. It's getting people worried that, if this is happening in what's supposedly a really strong economy, if the economy does turn south, there's going to be a lot more that's uncovered. How much are you thinking about that?
There's all kinds of considerations out there, and things can change at any minute, that's for sure. What we do, though, is always continue to pay attention to the fundamentals. We're looking at, the rates where they are, the economy, innovation, and, of course, earnings. And the earnings on a lot of these banks, are looking, so far on the favorable side, and we'll continue to see what earnings show.
So are there sectors that you like in the equity markets versus others? How do you think about that?
Yeah, the big position that we're really focused on portfolios right now is that fixed income story. We feel like it's not getting enough love, and people are sleeping on the fixed income.
Now, is that credit risk as well? Looking at corporate credit and high yield credit?
Yeah, and again, that depends on the client and their risk tolerance and what's appropriate for them or their tax strategy. And so really that fixed income story there, because we find a lot of people, ultimately, if they don't take action, likely going to have some FOMO with their cash and their high yield savings accounts and money markets that will follow the Fed's trajectory.
We are going to get a lot more earnings in the coming weeks, particularly from the Mag 7 names. We got Intel, which is kind of not really a Mag 7 name, although it's kind of been catapulted to that. Would you say catapulted to the rafters given the share price performance?
I think so.
Okay.
Yeah.
So what are you looking to hear from these companies that will set the tone for how investors think about AI and the return on AI?
The big takeaway with AI is that its efficiency use cases are going to be broadening into all aspects of our lives. Right now, it's synonymous with tech. You mentioned IBM. But, what makes AI tick is data. And when you consider healthcare, for example, our bodies have 37 trillion cells in them. That's a lot of data. And so, the pace of AI is moving so rapidly, we encourage people to really take that long-term approach. And what's interesting, and our analysts will always point this out with emerging technologies and trends, what tends to happen is the impact on the short term tends to be overstated, but the impact on the long term tends to be understated. So there's inevitably going to be winners and losers. And so a prudent approach to take is to consider diversifying, investing in broad funds as opposed to trying to stock pick.
Nora, thanks so much for joining us. Really appreciate it. Nora Yusuf, she's a senior portfolio manager, RBC Wealth Management, based up there in the Boston area. And again, markets on a risk-on kind of view here today with the S&P 500 up about 0.8%, the NASDAQ up 1%. The Russell doing even better, the small cappers. How about that? We like to see that. Small cap stocks doing even better, up 1.4% in the Russell 2000. The Tom Keene Memorial VIX, that's below 17 here today, 16.5. And Tom from the Upper East Side writes in and say, I need a Bitcoin quote. It's up about 0.6%. We're at about $110,000 on the cryptocurrency. WTI crude oil, $62 a barrel. This is Bloomberg Good Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. It's a Wall Street relief rally. It's pushing the major stock averages to records today. September core consumer price index increasing 0.2% from the previous month. Finally got this data. On an annual basis, CPI advancing 3%. So that is actually seen as tame enough for pretty much penciling in, well, guaranteeing almost a Fed rate cut next week. And maybe in December as well. And, of course, rate cuts, that's usually rocket fuel for the major averages. S&P 500, 55 points higher. That's up 0.8%, 6794 on the index. The Dow up 386 points. That's a rise of 0.8%. NASDAQ 100, 268 points higher, a 1% pop there. John Stolfus at Oppenheimer, he remains bullish of stocks.
The thought really is it's you hug the large caps, but also the large cap stocks appear to be the most resilient when it comes to earnings. If you look at the earnings reports for the last earnings season, fourth quarter, first quarter, second quarter, and thus far third quarter, this looks good.
And Intel, they seem to be on track for a long-awaited comeback. Chipmaker returning to profitability, also delivering an upbeat revenue forecast. Shares of Intel 2% higher. And then Procter & Gamble sales beating as consumers brushing off price increases at P&G. Those shares up 0.4% right now. This one's from The Verge. It was earlier this week, but I want to take a deeper dive into cat litter. The litter robot 5 Pro, the newest poo scooping machine from Whisker, and it brings facial recognition to cats and their self-cleaning litter box line. The litter box robot 5 Pro, $899. That's $899.
Not $8.99.
No, it's
self-cleaning litter box.
Self-cleaning, cool. And it's also, this one is outfitted with 2 night vision equipped AI-powered cameras, so you can keep track of your kitty. Nice. And make sure their habits are consistent, so you can spot, like, I guess
so
problems.
The unit itself is self-cleaning, but then the area around the litter box is not. So you're still going to be cleaning.
Why are you poo-pooing on this idea?
He was waiting for that.
Sounds like a great idea to me. Anyway, we check the markets for you. It's not a publicly traded company, so anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett, do you have a cat?
No, I have a dog. But so AI is supposed to create productivity gains, and this is a productivity gain device?
When you're a cat, I guess.
The self-cleaning. Interesting.
Yeah, the night vision, that takes it to a new level. All right,
Yep.
John Tucker, thank you so much. Speaking of what you have in your house, let's talk about housing here, because I was just reading how U.S. mortgage rates have dropped to the lowest level in more than a year. Sounds great, right? But still well above 6%, Paul. 6.2%, in fact, 6.19% to be very specific. Where does that leave housing, especially because it does not really change the affordability question? Bess Friedman is CEO at Brown Harris Stevens, and she joins us right now from New York. Bess, what does that mean for residential housing? Because everyone's been waiting for mortgage rates to drop or housing prices to pull back, and we don't seem to be getting much of either in a meaningful way.
Yeah, I mean, good morning. Thanks for having me. I think it's showing some incremental progress. The housing market has improved, more inventory, more sales, volume is up, so that's a good thing. And the rates coming down helps because buyers will get into the market, but it's been really slow. And sellers are still hesitant, as we know, because of the lock-in effect. So it's taking time, but we've had a much better housing market in 2025 than we did in 2024. And as you had talked about, the Fed is most likely going to cut next week and probably again in December, which maybe could hopefully inspire rates at some point to come down further. So we'll have to see, but we're in a better place at least.
Bess, how about on the commercial side and the office side here? How about just like in New York City? How's the office market these days?
I mean, who knew? I mean, the office market, it has performed its best since 2006, I read. They've leased more than 20 million square feet. And I think obviously, law, tech, all that stuff in the city, people wanting to be a part of the city, coming here, back to work in the office. But it's Class A office space, the B and C stuff is sitting there, or they're looking at that for conversions. So that's been great. I mean, I think people are really inspired by the office, and retail has picked up a little bit as well. And I think we're on record for tourism to be at its height at 68 million visitors this year. And I think that's helped retail. Consumer confidence and spending has helped. So it's better. I mean, the pandemic, everybody thought it would be over. It's dead. Everybody's going to work from home. We don't need offices. And it's absolutely not the case.
Certainly not here in New York. You mentioned demand and how it's looking better. What about supply? Supply of the grade A office markets space versus the B grade and C grade?
I mean, anything that's Class A, it gets picked up pretty quickly. There's just a high demand for that. And the B and C stuff lingers, and that has to be considered. I think since the pandemic, there's been something like, or in process, 44 conversions, which is great. This year is on record, a lot in the financial district. And I think converting that will give us something like 17,000 new units. And that's a really good thing because we know we need more supply in that area, but it's slow and steady. And those conversions are not easy by any stretch because office space is so different than residential. The core, how it's laid out, the work that needs to go into it. I mean, it's just not an easy task. It's not like you just convert it. And so, but slow and steady, we're making improvements there.
So where do we go from here just in terms of, it seems like in residential here, just like in New York City, the rents continue to just surge here. There never seems to be enough supply for the demand. It's even getting political. It's a big part of this political race for the mayor this year. How do you think the city goes over the next 5 to 10 years from a residential supply perspective?
I mean, so much depends on what we legislate for and what we support. And I don't think that things like freezing rents in any way, shape, or form is going to help our supply drought. And I think we have to have smart policies that encourage developers, to build. We have to have good tax exemptions and things that make sense so they continue to do that. But we've been at odds, as we know, with the legislature who enacts things that kind of are contra that would create more supply. So it depends. I mean, I don't know what's going to happen with the mayor's race. It looks like the polls are saying that Mamdani has a real advantage. We'll have to see. And if some of his policies, get enacted, if he enacts those, we'll have to see. It really depends. But I do like the fact that, the governor is more moderate and, it's sort of that check and balance and they'll have to work together. So, I just hope that we have smart policies that help everyone.
What's the level of engagement the real estate industry has with Mamdani? I mean, there are a lot of corporate leaders who are being very pragmatic about things and meeting with him and talking to him and trying to just get a sense of how not flexible, but how pragmatic he will be ultimately in office as opposed to on the campaign trail. What is the industry saying about him as a practitioner once he potentially gets into office?
I think people who have met with him, a lot of people in the real estate community, business leaders, people have met with him, say he's a really nice guy, very charismatic, a great communicator. And so people are leaning into that because if he does become, the next mayor, you have to work with him. You have to fight with the army you get, not the one you want. And so, they're trying to have an influence and be supportive. And I think there was something that came out yesterday that said he was planning to keep Tish in place as the police commissioner, which makes a lot of people feel safe and happy because she's been really great. And so maybe he will come around and be more to the middle and listen to everyone. I mean, he's the mayor for everybody. And so I think business leaders are hoping that he will come more to the center and work with everyone. And that's what people, you have to give the guy a chance. We have to give the guy a chance.
Bess, thanks so much for joining us. Really appreciate it. Bess Friedman, she's a chief executive officer at Brown Harris Stevens. She's getting a lay of the land of some of the real estate here in the New York City, greater New York City area. Again, we're seeing a lot of new absorption, a lot of space being leased here in the city. So people are coming back to work, and the space is being taken.
The trains are crowded. The sidewalks are crowded. Everyone's in the office.
Yep. I just zipped past the Princeton Junction, New Jersey Transit train line a couple days ago. Man, was it packed like the old days. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Boy, the news in the sports world, there's lots of them, but the NBA and this betting scandal front and center, calling into question, the integrity of the game, as they say. Let's check in with Adam Minter, get the latest reporting there. He's an opinion columnist for Bloomberg News. Adam, what's the latest on the NBA? How widespread is this? How big of a problem is this for the NBA?
Well, there's nothing yet this morning, but there's an expectation that we may be hearing about more players being connected to this just based on what was in the indictments. But in terms of the scale of the problem for the NBA, it's huge. I mean, for the last couple of years, it's handled gambling controversies. We've had a couple players accused. Malik Beasley was accused. Jonte Porter was accused and pled guilty. And the league was able to treat those instances as sort of one-offs. Deviant individuals, if you will. And what this scandal is calling into question is whether the NBA has a systematic problem, because it wasn't just it wasn't just players pulling themselves out of games to help with the under on a bet. It was players as coaches leaking information allegedly to bettors so that they could make bets on injuries. So it's really calling into question whether there's a systematic integrity problem within the NBA, and that's huge.
Do you think there's something about the NBA or the fact that there are not that many players on the court at any given time that lends it to being more easily manipulated?
There is something to that. One advantage to betting on the NBA, and this goes for legit bettors as well, is there's a lot of games, and there's a lot of individual things within games that can be bet upon. Prop bets, propositional bets. So you can bet on, how many three-pointers Steph Curry is going to shoot in a game, how many he's going to make, and those, because there's so few players on the court, those are attractive bets. And so, yes, it does make it very attractive. And likewise, betting on, having inside information on injuries. I mean, if you take a star out of a game, if LeBron James isn't playing in a game, that has a huge impact on how well the Lakers are going to do. And that's one of the allegations in this, is that Chauncey Billups, wasn't Chauncey, but there were leaks about whether LeBron was going to be in a game. And so, again, fewer players, bigger impact.
So prop bets, therefore, are kind of problematic in this instance. Is the NBA or any professional sports league, for that matter, in a position to ask sportsbooks or prediction markets to pull back on some of these side bets that are easy to kind of get in there and difficult to prove?
Absolutely. In fact, following the Jonte Porter scandal last year, the NBA actually asked its sportsbook partners to stop offering prop bets on two-way players. So two-way players are players who are paid less, relatively speaking, to other NBA players. They're on short-term contracts, and so they're considered more vulnerable to manipulation by gamblers. And the sportsbooks complied with that. The question now is whether, the sportsbooks, which, profit heavily from these prop bets, they're a huge part of their business, if they're willing to pull back on others. For example, pulling back on taking under bets on individual players. So that would be something like, if I would bet that Steph Curry would make fewer than X number of three-pointers. That's an easy manipulable bet, but it's also a big source of profit. So we'll see if the NBA wants to take that step and if the sportsbooks are willing to partner with it on it.
Have we heard from the NBA office at all about this news? Kind of how are they playing it at this point?
Yeah, I mean, it's mostly just they released a fairly boilerplate statement saying exactly what you would think they would say. I think the more interesting thing is that the day before this came out, hours before this came out, really, NBA Commissioner Adam Silver was on the Pat McAfee show on ESPN, where he was talking about his desire for more federal regulation, that they need to take a look at prop bets. And, I don't know if he knew specifically that this was, these indictments were going to come yesterday, but certainly it was something on his mind when he went on the McAfee show. And I don't want to say he was telegraphing anything, but clearly, it's on his mind that they need to be taking more proactive steps.
Yeah, the timing definitely raises some eyebrows, as does the timing of the announcement of this investigation, because it's at the start of the NBA season. Adam, if you are the athletic director of a college sports program right now, and we haven't even gotten into potential problems with college sports, what are you likely doing today to guard against similar things happening?
Well, I'm quite worried because there's a lot of money flowing into betting on college sports, and you want to talk about vulnerable individuals. I mean, most college athletes are not making the six-figure NIL deals that we see. They're making smaller NIL deals, and so all you can really do at this point is panic and probably, improve education. Ironically, it's just in the last few days that the NCAA agreed to allow college athletes to bet on pro sports. They're allowing them to do that. So, and some of that is a recognition of reality. If they don't allow it, they're going to have more scandals. Athletes are going to be doing it. But it's a very dangerous situation because a lot of these college athletes, especially at the top level, already have connections to pro teams. Arguably, they would already have, access to inside information. So if I'm an athletic director, I'm thinking about maybe we want to reconsider this decision.
Right. All right, Adam, thanks so much for joining us. Appreciate it. Adam Minter, opinion columnist for Bloomberg News, joining us on this NBA story, which is just extraordinary. And it just kind of feels like it might be a tip of the iceberg type of thing.
I can't wait for the HBO treatment.
Yes, exactly right. Exactly right. It writes itself, it seems like. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with the S&P 500 up 50 points, 0.8%.
Good Friday morning. It's TGIF, everyone. We're live from Bloomberg's Interactive Broker Studio in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We are streaming live on YouTube. We've got a lot coming up in the second hour of Bloomberg Intelligence. We're going to check in with Michael McKee, Bloomberg International Economics and Policy Correspondent, on the latest CPI report, long awaited, long delayed, and it comes in, it shows inflation not too much of a problem. Kunjan Sobhani, Bloomberg Intelligence's senior semiconductor analyst, will join us to recap Intel earnings. That stock is higher right now. And we're going to put munis in focus because it is Friday. Ashna Shah, Bloomberg Municipal Finance reporter, will join us on the latest there. Barclays sees muni space bonds becoming a big market. I didn't know that space bonds existed, Paul.
I did not.
Yeah, well, we'll find more. We'll find out more there. And Craig Trudell, Bloomberg's Global Autos editor, will join us to give us the latest on some of the news coming out at GM and Stellantis. GM laying off hundreds of salaried workers as part of a profit push. But first, let's bring in John Tucker for our Bloomberg Business Flash. John.
All right, we're higher. Records, in fact, the core consumer price index, when you strip out food and energy because they're so volatile, it increased 0.2% for the month of August. Finally got these, after weeks of delays because of the shutdown, I've got this data. This is all fuel for the rally today. The major stock averages again at records. And this comes on expectations after the latest data of a Fed cut, pretty much penciled in at this point for next week and maybe even December. NVIDIA, Alphabet, Broadcom, they're the leaders in terms of the index points for the S&P 500 right now. And after their earnings results, Ford right now up 10%, best performer in the S&P 500. The worst belongs to Deckers Outdoor, the UGG maker, forecasting net sales next year below average analyst estimates. Laura Cooper at Nuveen says investors are now looking for tech spending to start paying off.
We are still positioned in U.S. tech. We think it is quite this profitable dynamic will support equities. But I think the risk right now is less about, this AI bubble bursting, but more around valuation fatigue. When are we going to start to see substantive returns on all of this investment come through?
Right now, the S&P 500, 50 points higher. That's up 0.75%, 67.88. The Dow Jones Industrial Average, 381 points higher. That's also a record. The NASDAQ 100 up 221 points, a rise of 0.8%. Also a record there. And of course, we get a lot of, 5 of the Magnificent Seven reporting next week. We had Tesla this week, and then for some reason, NVIDIA is at the very end. At the very end of the month. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Scarlett, Paul.
John Tucker, thank you so much. We appreciate that. As always, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube as well. As John just reported, we got a strong tape here this morning. Let's take a look at some of the stocks on the move today. Let's check in with Bloomberg's Nora Melinda. Nora, what do you got?
Well, let's dig into shares of Intel. We did see Intel hitting its highest level since August of last year, now pairing up about 0.5%. But this, of course, after the company reported an upbeat revenue forecast. They're really citing demand for personal computers here. And we are seeing the company returning to profitability for the third quarter. So this is really sparking optimism for a turnaround story here. Of course, we know the U.S. earlier taking a stake in this company here. Shares of the company up about 92% so far this year. But if you do look at how Wall Street is viewing it, you've got about 5 holds on the stock, 5 buys on the stock, 36 holds, and about 10 sells. So about 70% of Wall Street thinks that you should hold this stock, about 19% saying sell.
All right, let's move on to Ford, and that stock is on fire today.
On fire indeed. We are seeing shares of Ford jumping as much as 10%. The best day since 2022. This is after the company reported a profit beat and a boost to pickup truck production here. But we did see the company talking about an up to $2 billion profit hit. This, of course, we know coming after a fire at a key supplier of aluminum for its F-150 pickup truck. So that's something that investors are still continuing to parse. But nonetheless, we are seeing shares up more than 10% as we speak. And year to date, gaining about 37% here.
It's a 52-week high for that stock.
Right.
So nice move. And GM had a nice move earlier in the week as well. And I tell you, the internal combustion engines cars, those things are profitable. I mean, they've figured out which things sell, which ones are profitable. For Ford, it's the F-150
Right.
truck. That just kind of is a problem.
They figured that one out.
Scaling back a little bit on the EV rollout, and I think investors like that story. Palantir.
Palantir, so this is a stock that's really been on a tear, up about 143% so far this year. And today we're seeing a gain of as much as 3.2%. This is after the company launched the fact that it's going to be having a new partnership with Lumen Technologies. This should support more AI services. Lumen has agreed to spend more than $200 million on Palantir software over the period of several years. This in hopes to better manage and operate its networks and services. We are seeing shares of Lumen, which is ticker LUMN, up about 4% right now as we speak, but Palantir clearly gaining as well.
All right, good stuff. Nora, thank you so much. Nora Melinda, Bloomberg Markets correspondent. And for more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners, the biggest losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We finally got some official data today.
Yeah, Mike McKee, he's not shut down. Even though the government shut down and there's no economic data coming out, Mike McKee keeps coming in.
I know.
Now you love me.
So CPI, Mike, it came in exactly the way that people who are looking for the Fed to cut rates wanted to see it.
Yeah, a little bit less inflation in the month of September. And so it gives the Fed sort of a green light for the October rate cut. But it still showed that inflation was up 3% headline and core on a year-over-year basis, which is a 3-handle and not the 2-handle that the Fed is looking for. So it's not all good news. And I think the news that happened after the CPI report, the tweet from the White House that there's not going to be an October CPI report, is probably going to, have a much bigger effect on December than this one. People say it cleared the way for the Fed to cut rates in December too, but I would strongly
is that the
argue with
takeaway?
that.
Okay, interesting. Yeah, I guess that makes sense because there's nobody to. Is that because there's nobody to physically collect that data?
Correct. Yeah, I mean the about half of the data comes in electronically, so you would have that, but you need more than 50% of people to give you a response. And the difference with the jobs report is the jobs report is all people who send in their data electronically. So while they get low response rates for the first release, the data keeps coming in. But because the CPI, you have to go out and actually collect it yourself, there won't be anybody to do that in October. So even if they're back to work in November, it doesn't tell you what October prices were. And now we're on the 24th of October, so there isn't really enough time to get all those prices.
I was down in D.C. in June for another remote broadcast we did down there, and it was sightseeing, going to see all the sites. And I guess it was right around 5 o'clock, and I was across the street from the Department of Commerce building, and literally it's like a school when school's ending. The doors open, and people came streaming out. I mean, thousands of them. I said, oh, that's our federal workforce. There's like real people doing this stuff.
And those are essential workers because they're going in every day.
And they're not going in now, I guess. I don't know.
Somebody said to me in Washington last week, you can find a parking space now.
Yes, that is exactly true. Yep.
So let me ask a really dumb question here. We know that there's been some politicization over at the BLS. President Trump fired the guy who managed the BLS because he didn't like a jobs report. He thought it was too weak. How difficult or easy would it be to politically influence a CPI report if one wanted to do that?
Almost impossible. The way the CPI is put together and the other data releases is that they're segmented. Different workers work on different parts of it in different groups, and then it's all put together at the end. And the director of the Bureau of Labor Statistics doesn't see the report until after it is all finished and has no ability to make changes. So you would need essentially all of the BLS people working on the CPI, hundreds and hundreds of them, to all cheat at the same time. So that's not going to happen.
Very unlikely.
Yeah, it's very unlikely.
Mike, I think probably a lot of people are surprised that we haven't seen more inflation. That was the call of some economists when tariffs started to be implemented earlier this year, that, oh boy, we're going to see slower economic growth, increased inflation, higher inflation. One could argue we haven't really seen that. What do you make of it?
Well, I think there's a couple of things that contribute to that. One is that the president's been so often on about the tariffs. In April, he announced all these huge tariffs, and then he took it back, and then he put it back on, and then he took it back. And they didn't really start taking effect until August anyway. Okay. Some companies have raised prices, but a lot of them have absorbed them in their margins so far. And we are still awaiting other tariffs. And this changes on a sort of day-to-day basis. Right now, look at Canada is in the crosshairs today. So if you're a company and you know that you might get tariffed and you might need to raise your prices, you don't want to be constantly raising prices. You want a kind of final number. Yeah. And that's what everybody's been waiting for, that they don't get. So it's certainly possible. And I think the Fed officials have basically said this, that what they're doing now is pushing out the date for which they think the tariff impacts will hit. They're going to be hitting in the fourth quarter and then maybe into the first quarter of next year as tariffs start to come on. Then the Fed view is you get those one-time moves up and we stop seeing big inflation. But so far, we are seeing some inflation in some tariff areas. Apparel was up 0.7, furniture was up 0.9, but we haven't seen the complete impact yet.
But that goes to the point where companies can kind of slowly drip out the price increases over time. And we are seeing inflation. We spend so much time talking about how inflation is not surpassing what economists had anticipated, but at 3% an annual rate every year, there's inflation.
Yeah, as the Wall Street Journal put it today, very aptly, I think, it's not an inflation target anymore, it's an inflation suggestion. Because they haven't gotten 2% in decades. So.
Yeah. All right, very good. Michael McKee, we appreciate that. As always, Michael McKee does all the economics stuff for us, so we don't have to, because we have Mike McKee here to do it, and he's here all day, every day. It doesn't matter whether his government's shut down. Red headline crossing the Bloomberg terminal. New York Attorney General Letitia James pleads not guilty to U.S. charges. So we'll have further reporting on that going forward. Getting back to earnings, Intel, our good friends out there in Southern California and out in the Valley, they reported some pretty darn good numbers, and the stock's rallying. And I was just looking at Intel as a stock, and I guess when the government invests in you and NVIDIA invests in you, that's a pretty good sign of support. And the stock is up about 0.7% today, but it's up 92% year to date. Kunjan Sobhani, he follows Intel. He's a senior analyst. He covers the semis for Bloomberg Intelligence. He's based out there in our San Francisco office. Have you been to our San Francisco office?
I have. Beautiful.
It is awesome. Yeah. Pier 6, I think, or Pier 3. I can't remember which one it is, but it's awesome out there, right out into the bay. It's very cool. Kunjan, talk to us about Intel here. What's happening with their business?
Yeah, I mean, look, the results yesterday sort of seemed a start of a turnaround for us. Fundamentally, the stock rally you mentioned over the last few months has not been driven by any fundamental improvements. It was all purely driven by the deals that, the three deals, the U.S. government, NVIDIA, and the SoftBank deal, which all together brought in somewhere between $16 to $18 billion to them. That brings in long-term secular tailwinds, or not secular, but strategic tailwinds, but doesn't do anything to improve the near-term fundamental businesses and address the challenges. However, the results yesterday showed a step in the right direction where improving the demand for their AI PC and the server CPU products improved, which we have been wanting to see for a while. There were some structural changes that they're doing, which will help with gross profit improvement, gross profit dollar improvement going forward, even though the gross margin will still have headwinds next year. But we like the structural changes they are doing, bringing more wafers into Intel, ramping up the Arizona foundry with their newest Intel 18A node, which just has better cost structure than any other sites that they have. So they're doing many steps in the right direction, improving OpEx discipline as well. So all of that seems to be a start of a good turnaround, and there's still a long way to go. Yeah. Execution still needs to be done for many quarters, but this is the good news.
I'm so glad you brought up the investments from the U.S. government, NVIDIA, and SoftBank as something that helps certainly shore up the balance sheet, but how does it translate into operational gains? I mean, do customers decide to buy Intel's chips in meaningful volumes as a result?
I mean, not directly, not implicitly. The deals don't come with that, but there is some indirect influence, right? Or you might want to call it a validity that now, the risk of liquidity risk within Intel, which was there until a few quarters ago, the risk of sort of failing, the foundry business failing or not investing goes away. So customers, big customers, would gain some trust, right? That when you have backing of such key players in the industry, they must believe in you.
So Kunjan, talk about the competitive environment here. So Intel's made some nice inroads here, but there's a lot of competition out there in their chip fab business. Talk to us about the competitive landscape.
Yeah, I mean, the competition for them both on the foundry side and the product side is intense. Frankly speaking, they've really missed out on the AI accelerator and the really AI in the data center ramp, which all of their peers like NVIDIA, AMD are enjoying. So they're playing catch up when it comes to most areas. The second issue in competition has been that they've been losing share significantly in the data center side. Again, this is the most profitable, highest spend side. This is where you really don't want to lose share. But slowly we have seen the share loss pace reduce. Almost coming sort of staying share loss steady quarter over quarter. So now they need to work on improving, which the changes that they're doing going forward, which is moving the capacity to serve the data center customers at the expense of low-end PC customers, we think is the right step to, you don't want to lose share in that market anymore.
Right. So how different is Lip-Bu Tan, the CEO's strategy, versus Pat Gelsinger, his predecessor, who was let go? Is there a meaningful difference?
That's a huge difference. I think from a personality, communication strategy perspective, it's the two opposite ends. Lip-Bu seems to be more practical, sort of under-promising and over-delivering, which usually the street likes. Pat, on the other hand, was visionary, but was trying to get to the stars before focusing on the moon. So very different styles. Lip-Bu has done a lot of cultural changes, significant restructure in middle management. Getting everyone back to the office, which he really believes will bring significant culture and working changes. So a lot of different opinions, different styles. It's too soon to say which style is going to win, but at least we are seeing some good proof points of the new culture shift.
All right, good stuff. Kunjan Shabani is Bloomberg Intelligence's senior semiconductor analyst, recapping for us Intel's results. And the stock did gain earlier today, but it's really pared back some of its advances, now up only 1%. And Paul, I'm looking at the DES page of Intel. You want to know what its forward multiple is?
No.
122 times.
Wow.
And there is no PE because it just returned to profitability.
It just returned profitability. So, yeah, I think a lot of these AI names people are saying, oh, they're going to earn their way into the multiple. And NVIDIA, for its point, did do that.
Yeah, but Intel's not an AI name. That's right. Not yet. It wants to be.
But they'd like to be, yes.
That's, that's a lot to pin your hopes on. For now, anyway, so Intel shares up 1.1% and the NASDAQ up by 1.2%.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News, and with this Bloomberg Business Flash, and we are being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Cooler than estimated inflation. So that's reinforcing the traders' conviction that the Fed's going to cut interest rates. Remember, they meet next week. So it seems to be written in stone that we're going to get a 1/4 point cut next week. And stocks extending the October advance, S&P 500, the NASDAQ, and also the Dow Jones Industrial Average hitting all-time highs. Intel, just talking about that, returning to profitability, also delivering an upbeat revenue forecast. Those shares right now up 1.3%. And then the maker of Tide and just about everything else in your kitchen cabinets and, bathroom, reporting better than expected sales for the latest quarter. Procter & Gamble, consumers brushing off price increases and snapping up things like Gillette razors and Secret deodorant. Newmont Corporation, the miner, delivering stronger than expected quarterly earnings. The world's largest gold miner, starting to reap some of the benefits of cost cutting at a time of surging gold prices. And then there's Alaska Air. Those shares right now down close to 5%. They're grappling with the aftermath of an IT outage. More than 100 flights canceled as of this morning. This is a data center failure, the second in about 3 months, causing chaos across their network last night, just as they were set to report third quarter results. How's that for timing? And right now, the S&P 500, 65 points. The industrial average is up 495 points, and the NASDAQ 100 up 286 points. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. All right, let's talk about the municipal bonds. Why not? It's a Friday. We're joined today by Ashna Shah, municipal finance reporter for Bloomberg News. She is a proud graduate of the University of North Carolina at Chapel Hill, and usually that would exclude her from our radio program, but somehow she got through here, so we'll have to make do. Ashna, thanks so much for joining us here. Talk to us about the new issuance market. I know last year for municipal bonds was a record year for new issuance. How's this year shaping up?
Yeah, I mean, it's been a good year so far. We've seen heavy supply weeks. It's been a heavy calendar. And, I know that's been a little point of concern that how the market's going to be able to absorb it, but it's been absorbing it well. And, the market's been pretty stable.
The markets have been pretty stable. So let's talk a little bit about some of the stories that you've been writing on municipal bonds. Specifically space muni bonds, which Paul and I were talking about. Nice. We've never heard of this before.
Bring it.
What are they, and is there any linkage to the legislation that was passed earlier this year, the president's One Big Beautiful Bill?
Yeah, this is definitely a hot topic right now in the muni market. I mean, it's so new. And it basically kind of works similarly to how airport bonds work. So it's municipal debt that can be used to fund spaceport facilities. And it is a new provision that was added to the One Big Beautiful Bill, and that lets spaceports sell tax-exempt bonds.
What is a spaceport?
Yeah, so a spaceport is any facility located near a launch site or a reentry site. So basically they can use these bonds to help support those facilities, and those facilities, either operate flights, load cargo, they fix and maintain the spacecrafts. It's really interesting.
Certainly for space buffs it is. How much of this kind of space muni debt could we start to see, Ashna?
Yeah, so Barclays did an interesting report at the end of last week, and they said that they could start seeing about $25 billion in outstanding debt in about a decade. And we hadn't seen many numbers up until this point, so it was helpful for Barclays to put an estimate on that.
Scarlett, have you ever been to Colonial Williamsburg?
Yes, a long time ago.
Yes, I think it's a great place just to kind of hang around. It's great. It's the home of William & Mary University. It's a great town. I went to the University of Richmond, so we went to Williamsburg a lot here. Colonial Williamsburg, you write, Ashna, which describes itself as the world's largest living history museum, is coming to the municipal bond market for its first public bond sale. Tell us about that.
Yeah, so that sale priced earlier this week. It was super interesting. I mean, you mentioned it. For me, it's such a historic site. I remember going for field trips there when I was in middle school. And so it was a blast from the past when I saw it pop up on, seeing these muni docs. But it's interesting because they issued about $335 million of municipal debt, which is more than what they had originally posted in their bond documents. So, that's a good sign that there was demand for the deal. And, we saw the prices have increased on those bonds since they've sold. So that's a good sign. But yeah, they issued the debt for mostly refinancing purposes, but also to help with, revamping their gardens, adding a new arrival center, restoring colonial era structures. So just kind of revamping the place.
What a spaceport there. Okay, located in southeastern Virginia, the Colonial Williamsburg campus welcomed about 3.5 million visitors in 2024. The campus features museums, hotels, restaurants, 3 golf courses, a spa, and a shopping district.
3 golf courses?
Yeah, they have the one right on the James River is awesome.
But that's not consistent with Colonial Williamsburg.
I don't know, but it's a great
I feel
course.
like if you could do that, you could do a spaceport.
One of the hottest rounds of golf I've ever played was in Williamsburg, Virginia, one August day. I was supposed to be in school, but we skipped out and went down to
I like hearing about Paul Sweeney's stories of his youth.
It usually involves skipping school for golf. So, Ashna Shah, thank you so much. We appreciate that. Ashna Shah, she covers all the municipal bond market stuff for us at Bloomberg News. Let's talk about the auto business here. Ford. Holy cow, they had some good numbers. Stock just ripping here today. And I think the automakers are kind of saying we're focusing on the units, the models that make us a lot of money.
And they're not EVs.
No, they're not. They're kind of dialing back that rhetoric a little bit in response to, I guess, what they're seeing in the market. Craig Trudell, he's a Bloomberg Global Autos editor. Craig, talk to us about Ford. They had some good numbers, but I'm also seeing some layoff discussion out there. Talk to us about Detroit. What's happening?
Yeah, it's been quite a week. It's hard to parse because you're seeing GM and Ford have these, strong earnings reports, huge moves in the stock. President Trump is taking victory laps over this on Truth Social, and yet this morning our colleague David Welch in Detroit had the scoop that GM is laying off hundreds of workers. So you have this situation where, as you say, the amount of sales these companies are pulling off with full-size SUVs, the Ford Expeditions, the Chevy Tahoes, those sorts of vehicles are really hot, and in some cases, as good as these companies have seen in something on the order of 2 decades, and yet also with that, real cost issues in terms of tariffs. I think maybe not the worst case scenario that they were concerned about months ago, but absolutely those were still headwinds. I think there is a concerted effort on the part of these 2 companies, however, to sort of really thank Trump for these sort of incremental bits of relief that he's taken off of the measures that were put in place earlier this year.
Is that part of it done? Is that part of the story over, or are they still working to kind of continue to whittle away at some of the costs imposed by the president's policies?
I think it's still very much a live issue, and interestingly, some of the attempts to sort of curry favor with the White House seems to be around actually sort of applauding his move to put new tariffs in place on medium and heavy trucks. And the reason that they are appreciating that is because their rival, Stellantis, makes big Ram pickups down in Mexico. So it's a case of actually 2 players in Detroit kind of ganging up on the third and sort of praising Trump. And I think that was one of the interesting storylines out of last night's earnings, that Ford sees sort of some incremental opportunity to take advantage of the fact that one of their big competitors now faces much more of a tariff bill on those larger pickups that are made down in Mexico.
Craig, reading between the lines from the GM release and then the Ford results, it feels like these companies are stepping back on the margin from EVs and EV investments, and that seems to be one of the things that the street is applauding here. How do you read it?
Yeah, I think it's a little different across these two companies where you have GM is much further along, I would say, in standing up battery capacity, standing up EV capacity as well. So they, I would say, on the other hand, have kind of on one hand have more EV potential and more battery potential to work with, and haven't quite sort of cut to the bone in terms of what they have to offer. And yet, I would say, it's also been the case that it's fair to look at sort of what they've managed in terms of how many EVs they're selling, and fair to say that it's been a real disappointment. We've not seen the ramp up in demand that was hoped for. Even in the times when we were able to take advantage of $7,500 federal tax credits. As we know, that those days are now gone, and so you're seeing GM cut back. I think Ford's cutting back sort of predated some of these policy changes, and it's more to do with the fact that they've just been losing so much money on that side of the business, and have a little bit less to work with in terms of progress in scaling up the business and bringing down costs thanks to that scale.
Craig, did we learn anything from GM or Ford's financing divisions about consumers and how much debt they're able to take on? And I ask because, of course, we had the subprime lender PrimaLend enter bankruptcy this week. That followed Tricolor entering bankruptcy a few weeks ago. So there are a lot of questions about credit quality, particularly for low-end consumers or low-income consumers. Excuse me.
This absolutely came up, with Ford in particular, because Ford Motor Credit is a pretty, big part of that company's business. They did emphasize just sort of how small a sort of amount of exposure they have from a subprime perspective. I think that's not necessarily a shock, where you do have a situation where there's a lot of subprime lenders willing to sort of, go after that business. And the captive lenders at Ford and GM tend not to play in that necessarily. I think there was a lot of concern years ago when GM, around the time that they were coming back from bankruptcy, acquired a subprime lender, and everybody said, "Hey, wait a minute here! Isn't this kind of what put GM in the ditch back in 2008, 2009?" But really, they've also turned GM Financial into a captive lender that does a lot of higher credit scores, and not necessarily targeting that subprime segment that everybody rightfully is concerned about, given the events of the last couple of months.
Yeah, well, thank you for that context. That was really interesting. Craig, really appreciate your joining us. Craig Trudell is Bloomberg Global Autos editor, joining us from London on the latest when it comes to Ford earnings, GM, of course, laying off hundreds of salaried workers as part of this profit push. We are looking at gains across equities right now, with the S&P 500 at a record high, gaining almost 1%. The NASDAQ and the Russell 2000 are the real stars of the show, with the Russell 2000 gaining 1.6%. That cooler than expected inflation print pretty much cementing a rate cut for next week, although big questions about what happens in December, since there won't be an October CPI report.
That's true. That's true.
All right, so we'll keep an eye on all of this for you here on Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we're being brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centered support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to Commonwealth.com to learn how. Major stock averages at records. This comes as traders embrace an interest rate cut for next week from the Federal Reserve. And, of course, that most of the time is rocket fuel for stocks. Of the data this morning, clearing the decks for that as the Consumer Price Index showed the rate of inflation a little tamer than what we were expecting. And Kristen Bitterly at Citigroup says stocks are pretty solid footing.
This is not fueled by leverage. It is not fueled by debt. It is fueled by a select few companies that have significant free cash flow generation and continuously put up record earnings. So as long as the earnings story is there from a fundamental perspective and it's not driven by debt financing, I think this is something that could continue.
The S&P 500, 63 points higher. That's up just about 1%, 6802 record. Dow Jones Industrial Average up 536 points. That's up 1.2% record. The NASDAQ 100 up 279 points. That's up 1.1%, and that's a record right now. We've done all the green stuff. How about Deckers Outdoor, the owner of Hoka running shoes and Uggs? They forecast revenue next year falling short of expectations. Pressured consumer spending is what they blame. Worst performing stock in the S&P 500. Then real quick, you have TerraWolf. They have completed a $3.2 billion debt deal to expand a data center.
Sure, why not?
So this is the biggest junk bond sale led by one Wall Street institution since 1989.
Yeah, now we're talking. That's my time.
That was, well, yeah, the barbarians at the gate. So in this case, it was Morgan Stanley. And the transaction seen as opening the door for further crypto miners to fund data center expansions with, yes, high-yield debt. Do we call it junk?
I still call it junk.
Okay.
I mean, the industry doesn't call it junk. We call it junk.
Well, whatever. We check the market's view all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. We go by the rate at which they're offering, or what? When we call it, when do we get?
It's by the ratings agencies. You know.
And we know their
below
track
investment
record.
Grade. Yes, below investment grade. Yes.
Let's just bundle them all and then get. Never mind.
Wait. That's innovation. Yeah.
Wow.
Exactly. That wasn't a problem. All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. And we're also streaming live on that internet thing. So head over to youtube.com and search Bloomberg Live Podcast. You know, what is it, day 23 of the shutdown?
I've lost track, but basically all this month.
I don't hear people complaining as much as I thought I would.
We're not in Washington, though,
It
Paul.
doesn't come up in top conversation, does it? I mean,
I don't know. We're not in the right place.
I guess we're not in the right place. I mean, if we were in Washington, D.C.
Yeah, different story.
Then we'd be talking about it, as
Absolutely.
is our next guest, Nathan Dean. He is not shut down. He's a senior policy analyst for Bloomberg Intelligence. He's based in D.C., Nathan, I mean, I don't know what's going on down there, but I don't see any incentive for either side to come together. I don't have a White House pushing for a resolution. I don't seem to see any leadership, you know, on either side doing anything other than pointing the finger. What's going on down there with you guys?
No, so you're absolutely correct. I mean, if you look at the polling data, it really hasn't changed since the beginning of the shutdown. It shows that independents are slightly more blaming Republicans than Democrats. And because those numbers haven't changed, if you're looking at this from the Democratic view, you're looking at your party and say, yep, we're good. If you're looking at the polling data from the Republican view, you're looking at the data and you're saying, yep, we're good. And so really neither side has an incentive here to come together and negotiate. Now, we're telling our clients is that there is a potential for some negotiations next week because we have three catalysts that are coming up that could potentially push people to say we need to come to get a deal. The first is you have the second military paycheck, assuming that President Trump doesn't take moves to pay that using other funds. You also have the expiration of SNAP benefits for 42 million Americans. You could have some slight headline risk associated with Walmart, Albertsons, and Kroger as a result. And then finally, you have the open enrollment for the ACA beginning and the idea that premiums will go up. Maybe the Democrats say, okay, you know what? This is a good time to try and pin this on the Republicans, reopen the government, and then see if we can figure something out.
Okay, so a lot of time cues to watch for if you are negotiating, except that no one's negotiating, right? I mean, there's no formal meeting scheduled between the two parties. Are there even informal discussions taking place at this point?
You know, so there's some informal discussions amongst bipartisan senators or moderate senators, but these are just more of like water cooler conversations. Hey, what do you think of this idea? Yeah, potentially we could do something. Nothing really specific here because neither party really sees the need, and the White House is somewhat absent on this. President Trump just left for Asia, or he's going to leave for Asia later tonight. You know, the White House is taking the approach of Congress, you figure this out and you come to me. And that's why I think a lot of folks in Washington think that this could go until Thanksgiving, because you need to see a reaction from the American populace to say to folks up on Capitol Hill, you need to resolve this. And what ultimately can do that? If air traffic controllers and TSA agents right before Thanksgiving start calling in sick and you have this massive travel chaos, that could potentially push people back to a deal. But there's a lot of folks that think this will go to November or Thanksgiving, or if not even longer.
And I just remembered, I mean, the president's remodeling his house, so you know how time intensive that can be.
Right. That's very time consuming. It takes your attention away from other things.
Or something like that. It becomes all encompassing. Nathan, early this morning on Bloomberg Surveillance, you kind of floored me when you said this thing could go to Thanksgiving. I mean, this thing can drag on for a long time, right?
Yeah, I mean, if you think about it now, apologies to the federal government workers and contractors that are listening to us right now, but, you know, we're only talking about, you know, a small subset of the actual populace of the United States. I was talking to a broker earlier this week, and I just said, look, you know, here's my update on the shutdown. And he said, look, I really appreciate you telling me this, but I just do not care because the markets don't care. Yeah. And we continue to don't see much of a market reaction here other than small sectors like the grocery stores that I mentioned earlier, and that's more of a headline risk message. Now, obviously, we're not going to have more data. You know, the inflation data potentially next month may not be there. That could play a little bit, but until the markets care and until we see economic issues or we see the populace saying, look, I want to be able to fly for Thanksgiving, policymakers just look at the polling data and they say, nope, we're good.
What might make markets care? I mean, what will make travelers care is that they, you know, their flights are not taking off on time because there's no one at TSA, but what would prompt the markets to take a second look? You've been covering these shutdowns for a long time now, Nathan. You've seen what gets the market's attention, what doesn't?
Yeah, so I think if we see this go past Thanksgiving early into December, then obviously I think markets will start to care. You know, our chief economist, Anna Wong, has put out several pieces, and she says, I'm paraphrasing here, that for every week the government is shut down, you lose about 0.2% of GDP. But if the government reopens by mid-November, you can essentially gain a lot of that back. But if we go into December, or if we go into January, then you get this idea of, do we even have a functioning government here? You know, what happens if we were to get into a situation where we need a quick legislative response? Markets could begin to feel a little unease about that. So I don't want to say that markets will react to it, but certainly markets will then start to pick up and say, look, I'm not exactly sure I like this idea of operating long-term without a functioning government. Then we may have to start looking about risk-averse assets and so forth. But again, just right now, we're just not seeing it.
30 seconds left, Nathan. Is there anything legislatively that we need to focus on in the coming days and weeks?
Not really, and this is one of the reasons why Congress isn't all that interested in coming back together, because the only thing I would say is there's crypto legislation, but we've always been saying to our clients, look for the first half of next year, don't focus on 2025. The bulk of that work will be done in 2026.
Why are we paying those guys? Why did they get paid? They're not doing anything.
Exactly.
I'm sorry, I'm opining now.
Yeah. All right, Nathan, thanks so much. Appreciate it. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. He's down there in Washington, D.C. He's plugged in as you can be in a shutdown government, but it's also kind of like they haven't been working for 3 weeks, and like, does anybody care? I mean, I don't know. I mean, it kind of begs the question, do we need you guys? You know, it's like,
and maybe that's a point that some of them are making. By the way, the longest government shutdown, 35 days from late 2018 to 2019. And where we're at right now, if we wanted to match that, would get us to November 5th.
Okay. All right. Well, I'm not
so
sure that's
Nathan's
something
talking
to
about
shoot for.
Thanksgiving.
Yes, I know. That's kind of what floored me this morning when we were interviewing him. So anyway, and again, to the point that the markets don't care, the S&P's up 65 points here, about 1%. The NASDAQ's up 270 points, that's 1.2%. And the Russell 2000, the small cap stocks, the ones that are really susceptible to moves in the economy, up 1.5% here. So again, the market's moving here. And we had some weaker than expected inflation data suggesting that, all right, this Fed can lower rates. We'll stay on top of that. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Local Podcast, and that's where you'll find us. We've got, as President Trump prepares to leave for a week's trip in Asia, here's red headline crossing the Bloomberg terminal. U.S. opens probe of China implementation of Phase 1 trade deal. So it looks like tensions might be continuing to ramp up here in the days before these Asian summits, and we'll have more reporting on that going forward. Back in the U.S., in the stock market, company news, Target cutting some people here, cutting some headcount in the corporate levels, in the salaried levels in corporate HQ. Let's see what's happening with Target and with the broader retail space in general. We can go to Jen Bartasha, Senior Retail Staples and Packaged Food Analyst for Bloomberg Intelligence. So, Jen, so it looks like Target is announcing some corporate job cuts. What do you make of it here?
Yeah, hi, Paul. So when we look at Target, these are corporate jobs, as you said. It's about 1,800 in total from 1,000 existing and 800 postings that haven't been filled. And really, this is, to us, signals that they're finally really looking at how to streamline the organization, tighten things up, and hopefully initiate change a little bit faster than they have to kind of get things back on track.
So is this an issue for the company, i.e., maybe they are a little bloated, maybe their profit margins aren't up to snuff? Is that something that's been identified?
Yeah. I think that the bloat is something that has been identified by the company, and they're not alone. If you think about, as we came out of the pandemic, a lot of companies introduced a lot more redundancy in their processes, in their things like that, just in order to make sure that they would have enough supply of goods for everybody. And as the overall supply chain is stabilized, now it's time to go back and trim that fat that they put on just after the pandemic. And again, Target's not alone. Walmart, earlier this year has also announced corporate head cuts. And so I think this is a normal course of business, but it's a good time for Target to do so.
So all right, assuming it's a due course of business here, let's step back and take a look at their core fundamentals of the business, whether it's Target or Walmart here. As we go into this, holiday shopping season, what are the key drivers or the key levers that you're looking at to gauge success or, maybe some challenges?
Yeah, I think one of the things that needs to be kind of reiterated about Target's decision is that it doesn't impact the client-facing part of the business. And so that won't affect their seasonal hires. It won't affect their number of employees in stores. And when you're looking at broader retail coming into that holiday season, success is really going to hinge on making sure they have enough of the inventory in stock, that they've made good calls on what the items are that they're carrying, but also that customer support and experience. And so, those are the things that we're going to be looking for as we get closer to the holiday season. And we had Mattel and we had Hasbro report earlier this week, and they didn't have great results. And part of that is reading into toy demand for the holidays. And the orders that didn't actually materialize. So we'll be watching that very carefully when it comes to these retailers that really specialize in those kind of products for consumers around the holidays.
So what is Walmart, what is Target, what are they saying about the upcoming holiday season, which is such an important chain?
Yeah, it is the most important part of the year for these companies. And both of these companies, as well as others like Costco, they all say that they're well positioned for the holidays. If you think about the procurement process, most of the orders for holiday goods were placed back in January or February. A lot of the goods started to arrive in July and August. So they should have their goods, here in the U.S. kind of ready to go. And so I think, but with the state of the consumer spending patterns in the U.S., although people are still spending money, they're still looking for value. So when we're looking forward to the holiday season, we think we're going to see much more spread out deals and people spending, on a spread out basis so that they don't get hit hard by big credit card bills in January. So watch for lots of small deals that kind of lead up into the holidays.
And will prices that we pay at the retail, at the Target level, at the Walmart level, are they going to be influenced by tariffs, do we think?
I think there will be certain categories that will be influenced by tariffs. And so all the retailers are saying they're using price increases as the last possible resort. And I think actually one of the interesting things is that when they talk about pushing back on suppliers or sharing the cost of suppliers, some of the commentary that we heard this week from Mattel and Hasbro sort of illustrate that, there were lower orders, there's, less expectation for quick refills. So it'll be interesting to see, where that, how effective those companies are at negotiating other ways to manage tariffs before they put price increases in. But in some areas, it's going to be impossible not to pass something through.
All right, Jen, thanks so much for joining us. Always appreciate getting a few minutes of your time talking about the U.S. retail business. Jennifer Bartashis, Senior Retail, Staples, and Packaged Foods Analyst. She covers it all, Bloomberg Intelligence. She's the one that told me for the first time that the #1 supermarket in the United States is Walmart. And I was like,
I believe it.
I didn't, but I guess if you're in whatever business you're in, if you're Walmart, you're going to be #1. That's how big our good friends at Walmart are. And Walmart stock, I'm just comparing it to Target. Over the last 5 years on a compounded basis, Walmart's up 19% per year. Target's down 7.5% a year. So Walmart's really outperformed.
Are you still on target to become a Walmart greeter at some point?
I am all in on that when this gig is up. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. The S&P 500 up 63 points, 0.9%. The NASDAQ up 277 points. That's 1.2%. Bloomberg Radio continues right now.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. New York's Attorney General in court today pleading not guilty to bank fraud charges brought by the Trump Justice Department.
There's no fear today. No fear. No fear.
CBS's Scott McFarland.
Letitia James seeks to have either this case dismissed or simply have the prosecutor kicked off the case. James's team has argued that Lindsay Halligan, the newly appointed acting U.S. attorney in the Eastern District of Virginia, who is in the courtroom today in Norfolk, was unlawfully appointed due to some technicalities with how long acting U.S. attorneys can stay on that job. There also may be forthcoming motions to dismiss this case, arguing selective, vindictive prosecution.
No photos, please, of the destruction of the East Wing of the White House, as we hear from CBS's Linda Kenyon.
The Treasury Department is next door to the White House, and the people who work there have a good view of the demolition site, which is part of President Trump's White House ballroom project. A fresh email to the Treasury staff has once again urged them to refrain from taking pictures. It says photos might inadvertently reveal sensitive security information. The email also urged staff to ask guests not to take pictures either.
Defense Secretary Hegseth says a U.S. strike in the Caribbean targeted an alleged drug-running boat. 6 people were killed. Still no word on the cause of the massive blast 2 weeks ago at an explosives plant in Humphreys County, Tennessee. The Sheriff, Chris Davis, says they've identified 14 of the dead.
It really saddens me that we still have 2 souls that we have not been able to locate.
CBS's Michael Wallace says Canadian Prime Minister Mark Carney wants trade talks with the U.S. to resume.
Carney says Canada and the U.S. have made a lot of progress on trade regarding steel, aluminum, and energy, and his country is ready to build on that progress when the U.S. is ready to talk again. President Trump cut off the talks after the government of Ontario released an ad featuring former President Ronald Reagan, saying tariffs only work for a little while and hurt every American.
As the government shutdown heads into another weekend, CBS's Stacey Lynn tells us.
Massachusetts Governor Maura Healey says if SNAP benefits disappear, it's because of the president.
President Trump has chosen to take away food from people all around this country.
She says during past shutdowns,
food benefits continue because they're essential.
She said in Washington right now, there's a contingency fund of billions of dollars that the president can use to make these funds available next week.
And checking Wall Street, right now, the Dow Jones Industrial Average up 556 points. This is CBS News. An upcoming auction features a piece from a legendary figure.
Norman Rockwell's four-panel drawing depicting two U.S. senators, a Scottish military officer, and Miss America gathered around Press Secretary Stephen T. Early, waiting to see President Franklin Roosevelt, will be sold at auction in Dallas November 14th. The work was on display at the White House for 44 years on loan from the Early family. It appeared in the Saturday Evening Post in 1943. After a court dispute among Early's descendants, So You Want to See the President is expected to bring in between $4 and $6 million. Deborah Rodriguez, CBS News.
Back to the summer of 1982.
Sometimes I feel I've got to run away.
Tainted Love by Soft Cell was a top 10 hit. One half of that synthesizer duo, Dave Ball, has died. He was 66. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
It's the news the market was hoping for. Welcome to the Friday edition. As a delayed reading on inflation comes in soft today, building hopes, yes, for more interest rate cuts. We're going to dig into this rare spot of data in the midst of a government shutdown coming up with Bloomberg's Michael McKee in New York. Vladimir Putin's calling up reserves now to protect Russia from Ukrainian drones. We'll have the latest on the war and Ukraine's call for cruise missiles when we spend some time with Dr. Rebecca Grant at the Lexington Institute. President Trump says he's terminating all trade talks with Canada because of a TV commercial. We'll get into it with our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us for the hour. And speaking of the markets, they are looking pretty good. John Tucker has the read on Wall Street for us right now from world headquarters in New York. John, what do you have?
Joe, we finally did get data, and it shows inflation not as bad as some thought, pushing stocks to record highs. And right now, 9 of the 11 major industry groups in the S&P 500 are higher. Information technology, financials in the lead. Ford Motor, best performing stock in the S&P 500 after their earnings report. Decker's Outdoor, well, that's right at the bottom of the list, worst performer. Constance Hunter at The Economist says the tame inflation report today seals the deal for Fed Reserve interest rate cuts.
The Fed is going to cut next week, and this certainly gives them cover for next week and possibly even to cut again in December.
Alaska Air Group continues to grapple with the aftermath of an IT outage. More than 100 flights canceled just this morning. Data center failure, second in roughly 3 months, causing chaos. And how's this for timing? Comes just as they were going to report earnings. That stock down 5%. S&P 500 up 63 points, up just about 1%, 6801. That's a record. Dow Jones Industrial Average up 551 points. That's a record. The NASDAQ 100 up 280 points. That's a record. So inflation, move along. Not much to see here, folks. And Joe Matthew, that is rocket fuel for stocks. Happy Friday.
Yeah, it is pretty happy on Wall Street. Rocket fuel we like. John Tucker, thanks. He's going to spend the hour with us here. And for the mighty Charlie Pellet, we'll get back to John in about 15 minutes for the Friday trade, which does seem to be getting better all the time here. And it's interesting because it's coming against the backdrop of this trade story with the president throwing a tantrum over a television commercial and ending trade talks with Canada. But we're seeing around this all over again. It's a market that doesn't seem very concerned about trade at all, is it? Whether it's tariffs or otherwise. And of course, that's because we're in the glare of the lights of this CPI report today. So thank you for being with us on the Friday edition here on Bloomberg Radio. We're always available on your satellite radio at channel 121. You can watch us on YouTube right now. Search Bloomberg Business News Live. Welcome to day 24. That's where we are, right? Yes, I'm just checking if you're playing along on your home game still. The Senate is gone until Monday, so that'll be 25, 26, 27, 28. And, of course, the president's leaving town tomorrow. The House has not been in Washington for 35 days. So there is a great chance that this will be, in fact, a record setter, and everybody's looking at the 1st of November, what this is going to mean when SNAP benefits start to expire. You might have heard Maura Healey talking about that in our news at the top of the hour. SNAP benefits, open enrollment for Obamacare subsidies that are set to expire at the end of the year. If you're getting bored, I'm sorry, nothing's changing here, and nobody's talking about it. We're just ticking up the days. But as far as Wall Street is concerned, none of this stuff matters, at least not yet. We've been whistling past the graveyard on tariffs for months now, 9 months? And the latest reading on inflation gives the administration a whole new excuse to say, hey, guess what? You guys were wrong again. No tariffs showing up in the numbers. Let's see if Michael McKee feels that way. He's with us now from New York as well, Bloomberg's international economics and policy correspondent. Mike, it's great to see you. Happy Friday. Markets can't be bothered with a lot of the news that I'm talking about here. What do you make of this CPI reading? And does the White House suddenly have a point?
The White House has a good political point right now, a good political talking point. Tariffs are showing up. Some of the tariffed areas definitely saw big moves. Clothing costs were up 0.7%, furniture up 0.9%. So there is a tariff impact out there. What really drove the number down was a big collapse in home prices in the way they measure it, with the owner's equivalent rent up just 0.1%. Now the question is, would that be continued, or was this statistical noise? And unfortunately, the follow-on to the report today from the White House is we're not going to have an October CPI report. So we aren't going to know.
I'm confused. By the way, I'm confused all the time. If you listen to the show, you know that.
You're not alone here.
Very good. And, you know, you all, our listeners might be confused as to why Joe and Mike are talking about CPI on a Friday. And, well, because the government's closed and BLS hasn't been putting out data. So we got this, I'm assuming, Mike, because of the Fed meeting next week. How come we can't get the jobs data? We're still missing last month's jobs report. That's the same agency.
Well, there's two answers. We got the CPI report because the law says that the Social Security Administration has to calculate the cost of living increase for 2026 by the end of October. So they called in some furloughed workers, to work for free, of course, for the time being, to collate all the data. The CPI data had been collected already. And so because of the Social Security issue, they did put that out. Now, the timing coincided with the Fed meeting, so it's good news for the Fed because they have some data to work with. The other side of it is jobs, because the administration doesn't want to. They could designate somebody as important, you know, the cafeteria worker or something, and say, go in and push the button. But they don't want to put it out right now.
Well, it's interesting because, you know, it was weeks ago, 4 weeks ago now, Mike, almost, that Senator Elizabeth Warren was demanding that BLS release the jobs data. To your point, that had already been gathered. I think it was just a matter of running the numbers and whatever curve they have to the algorithm they put it through to make a report here. Couldn't that person have maybe worked a second day to do that? Or what would be involved in releasing the jobs number?
Joe, was completely finished. It was all tied up in a neat little bow, and it would have been delivered on October 1st to the head of the Bureau of Labor Statistics, who would have then sent it over to the White House and released it on the Friday following, October 3rd. But because the government shut down, they mothballed it. So it could be released. It'd probably be a little bit useful. We've, moved way beyond it. The problem we're going into now is like the White House said, there's nobody collecting the data for CPI.
Yeah.
And so we've gotten so far into the month now that you probably can't collect enough to make it scientifically valid. The jobs report could be done because most of the employment numbers come in electronically, and they come in over 3 months. So you could put out a preliminary report as we normally get that might be not totally accurate, but would point you in the right direction, and then you get the revisions. But the unemployment numbers we won't get because that's a phone survey along sort of like the CPI. So we're starting to get it deep into territory. So what happens when we
reopen? Do we have a big gap that will never be filled, or do they do all this somehow retroactively?
We have never had this before, but it does appear we'll have a big gap. Now, whether it'll never be filled, there are some ways to go put some of this data together. The jobs numbers could be probably, as I mentioned, put together and not have a gap. It may not be as statistically valid as normally. But the CPI numbers and all the rest, the PPI, things like that, are going to be very hard to recreate because now we move into November and you send somebody out to check the price of coffee, but it's going to be the price of coffee in November. So it isn't going to tell you what July was. So we may actually have a hole there. I've complained, as somebody who makes economic charts for a living. I've complained for a long time about what the pandemic did, because it's just, when you look at the labor market numbers, they were so out of line with everything that you can't make a good graph these days. It just kind of screws everything up. And now we might have that with maybe CPI or something.
Yeah, wow. All right, this is just absolute uncharted territory, obviously, as we spend time with Michael McKee. And in our remaining couple of minutes, Mike, I want to tap your expertise when it comes to politics, history, and the economy, all colliding into one here, because we woke up this morning, and well, maybe you were up late last night to see this. Canada cheated and got caught, says President Trump. 3 exclamation points. They fraudulently took a big buy ad saying that Ronald Reagan did not like tariffs, when actually he loved tariffs, in all caps, for our country and its national security. This is the Ontario ad that's got the president very upset. A lot of people already saw it in the ball game. Apparently it's going to be in the World Series game tonight, if I understand correctly. Let's give our listeners and viewers a chance to hear what this is.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
Well, there's nothing like going for the jugular. We want to get people upset. Put Ronald Reagan on screen, and here it is, Canada. The president's offended on multiple levels here. But the fact of the matter is, Mike, that speech that came from a radio address was Ronald Reagan at the time explaining why he decided to put duties on goods, semiconductors, ironically, from Japan as a last resort, because he actually hated tariffs, and that was the case he was making and explaining. President Trump says that Ronald Reagan loved tariffs for our country. Is that how you remember it?
No. I was in the White House covering Ronald Reagan. So, no, that didn't happen. Reagan was opposed to tariffs. He was an ardent free trader. The argument that he made was that in certain cases, if a country is cheating, then you need to respond. And Japan, in this case, was not playing fair. You go back to the 80s, and, of course, Japan was the big trade enemy instead of China today. And so Reagan put on short-term semiconductor tariffs, but he made a very lengthy case. And if you listen to this whole radio address, which you can find on the internet, he makes a very lengthy case for why tariffs are not good for economies, and that he hoped this would be a very short-time thing.
He was interesting that he was at the time very proud of a trade deal with Canada. So is Milton Friedman turning in his grave today?
I suspect Milton Friedman has probably thrown his hands up and said, I don't believe these people anymore. I'm just gonna walk away from all of it. It is really hard to see any justification, any policy justification for what has happened, because even if you think there's some cheating, there are remedies, specific remedies for cheating. But all of the tariffs right now are based on Donald Trump's dislike of the trade deficit. And economists know that the trade deficits don't make a difference. It's not necessarily a negative thing. So one man's anger at something that he maybe doesn't understand is driving all of this crazy economic policy. And that's certainly different from what Ronald Reagan was doing.
Michael McKee with a little dose of history for us. I thought you might be able to address that, Mike, and we're looking forward to having you back in town next week for the Fed meeting. With us live from New York, the great Michael McKee. I'm Joe Matthew in Washington. Glad you're with us here. We're going to turn to geopolitics and matters of the Pentagon next as we look to Venezuela. Dr. Rebecca Grant will join on Bloomberg.
And I'm John Tucker. He had the Bloomberg News with his Bloomberg Business Flash. Cooler than expected inflation, making the case for an interest rate cut from the Federal Reserve starting next week. So that's music to the ears of traders. Major stock averages at records. As a result, you have 9 of the 11 major industry groups in the S&P 500 up. Information technology in the lead, and that's home to NVIDIA. Those shares up 1.7% right now. Best performing stock in the index, Ford, gaining over 10%, posting third quarter operating profit, $2.6 billion. Record sales that all beat Wall Street forecasts. So then we have to do the worst performing stock in the S&P 500. That's Decker's Outdoor, down 12%. They make Uggs, issuing a fiscal year forecast. Kind of disappointed. Procter & Gamble, they make just about everything in your house, gaining about 1.2%. The owner of Tide and Pampers, posting core earnings of $1.99 a share in the first quarter, better than expectations. The company now expects to incur higher costs, though, from tariffs. They did reiterate their fiscal 2026 guidance. So right now, the S&P 500 up 67 points. The Dow up 566 points. The NASDAQ 100 up 303 points. Records for me, records for you, Joe Matthew, and Balance of Power.
Thanks for the records. We'll see if we can't keep doing this with John Tucker. Maybe we'll do this every Friday with John Tucker. He's in for Charlie today and be back in about 20 minutes with a pretty darn nice rally here on Wall Street, thanks to that CPI report we were just talking about with Michael McKee. Maybe we keep doing CPIs on Friday as well. Got a breaking news story that I'd like to share with you, and it will not be a surprise as Politico reports that Hakeem Jeffries is at last on board. We talked about this up and down yesterday following David Gura's conversation with the Democratic leader in the House. He will endorse Zohran Mamdani for mayor of New York, according to 2 people with knowledge of the situation, talking to Politico, the nod coming after months of pressure, and just before early voting begins Saturday. Did you hear that? That's what he told David. He couldn't answer it yesterday because he was waiting until early voting started in 2 days. But now we know that the Democratic leader is going to support the Democratic nominee in his own town. Also breaking overnight, unless you were up late, we blew up another boat. At the direction of President Trump, the Defense Secretary Pete Hegseth says Department of War carried out a lethal kinetic strike on a vessel operated by Tren de Aragua, a designated terrorist organization trafficking narcotics in the Caribbean Sea. This is, you know how we do this now. You've got the video of the boat bouncing around until the thing blows up. This one looks a little grainier than usual, presumably a satellite photograph or maybe it's drone video. I don't know. I've got a lot of questions for Dr. Rebecca Grant about the way all of these things are working out. The B-1 bomber is nicknamed the Bone. That's what it looks like, kind of this long flying bone that when you look up and see this thing, it's menacing, knowing as well that it can carry some of the heaviest firepower of any aircraft of its kind. The sweep wings, the B-1 that we reportedly flew over Venezuela or near Venezuela in international waters. That was the Wall Street Journal story we told you about yesterday, as the United States continues to bear down on this country with a flotilla off the coast. President Trump was asked about that report yesterday. He said, no bone. Listen.
There's reporting the U.S. just sent B-1 bombers near Venezuela to ramp up some military pressure there. Is that accurate? And can you tell us more about that mission?
No, it's not accurate. No, it's false. But we're not happy with Venezuela for a lot of reasons, drugs being one of them, but also they've been sending their prisoners into our country for years under the Biden administration. Not anymore. We have a closed border. We had actually nobody for the last 4 months.
So we have a lot of questions, as I mentioned, about what's going on down there, as well as what's going on in Russia, where they're just now calling up reserves to help protect the motherland from Ukrainian drones. We look no further than Dr. Rebecca Grant, Vice President at the Lexington Institute, joins us once again here on Bloomberg. And Doctor, it's really great to have you. Welcome back and happy Friday. Can I just start by asking, what are we shooting these boats with? Are these drones or some other kind of military hardware?
They're not going to tell us because it's still an active operation, and that's why you don't hear any real details. The intel sources are still active. It looks to me a lot like what you're seeing is kind of an infrared white hot designation. So there's obviously a missile. It could be, for example, Hellfire, but it could be any one of a number of other types of missiles as well. What we do know is they're extremely precise. And, you know, Joe, we track the movement of these boats, our military. Our military watches a lot of ships. We watch Russia in the Baltics. We watch China in the Pacific. And we can watch the Venezuelan. They see when the cargo gets to the dock. They see when the crew pulls up to the pier. And these boats use long established routes. That's why we have such precise intelligence and are carrying out these strikes in international waters.
Well, that's fascinating. So we can see them loading, presumably loading the drugs on the boat, which gives the administration or the Pentagon the confidence that it has that these are, in fact, drug smugglers?
Oh, absolutely. You know, this is technology that was developed to track, you know, the Soviets and the Russians and the Chinese.
Yeah.
But our maritime surveillance is excellent. It's exquisite. So you shifted over to the drug boats, number of different resources, drones, satellites, patrol aircraft, everything is all set. Maritime sensors are kind of a different group, and they're all tuned to do this. And yes, you could just see everything. So that's why the administration and Secretary Rubio especially is so confident that they know they are striking drug boats for sure. And of course, Venezuela is directly tied to it.
All right, Cece's showing us now the unclassified footage here on YouTube of this thing blowing up. Cece's got all kinds of video, Doctor. It's kind of amazing. What we're looking at right now, is that from a satellite or is that from a drone or an aircraft at high altitude?
Any of the above. You know, it's hard. It's deliberately difficult to tell, but aircraft, drones, all have this, you know, there's a lot of systems, all the ones you named have the ability to give some pretty good resolution stuff. Or it could be indeed a targeting pod also showing that.
Sure, got
so
it.
anytime a target's attacked, they've really carefully considered the weapons parameters and made sure there's not another boat nearby or any chance for unintended collateral damage.
Okay, got it. This idea of us flying B-1s around, we had reported as well that we had B-52s flying nearby Venezuela. Is this just, if true, the president says we weren't flying B-1s. I don't know if you have a take on that, Doctor, but what would be the point of this? It's not reconnaissance. Is it just a projection of power?
Oh, well, and the B-52s do have, again, an excellent overwater reconnaissance capability to go out and find and target ships. That's for the B-1, you know, that BONE acronym, it stands for B-O-N-E, BONE, B-1. The museums call it the Lancer, but the crews call it the BONE. And remember, it did a lot of this work in Afghanistan, sometimes doing just a low pass. If the B-1 flies over you at 2,000 feet, as they often did in Afghanistan, that'll scare the living daylights out of you. But we're really trying to show power projection to Venezuela and to Venezuela's friends, the Russians, of course.
I'm guessing it seems like it's within the realm of possibility that we were flying B-1s over there. Dr. Grant, I want to ask you about what's happening in Russia as well. As the president heads to Asia, there are a number of hotspots that he needs to worry about that may play into some of the talks he's having with President Xi, assuming that that meeting takes place. Vladimir Putin today says it's time to call up the reserves. They need thousands more troops, not to go into Ukraine to do shooting, but to stay in Russia to deal with attacks from Ukrainian drones. This happening at the same time that Volodymyr Zelensky is asking for Tomahawk cruise missiles. What do you make of Russia's posture in this war right now?
Well, inside Putin's head, he is really worried about those Tomahawks. President Trump hasn't given permission yet, but if they decided to send Tomahawks to Ukraine, they can be put on an Air Force C-17 cargo plane, and they can be there in about 24 hours. The Tomahawks and Ukraine's drone attacks present an almost insoluble problem for Putin of trying to defend air bases. There are 60 Russian air bases within Tomahawk range from Ukraine, and also to defend that oil and gas pipeline and energy infrastructure targets, a lot of it out in remote areas. They literally cannot put air defenses around every potential drone or Tomahawk target. And so we're seeing this partial Russian mobilization to try to beef up air defenses. Remember, Ukraine has very successfully hit some Russian bombers and warplanes on the ground with drone attacks, as well as really schwacking the energy infrastructure in the last couple of months.
I know that they're getting some cruise missiles from European partners, but if in fact Volodymyr Zelensky got the tomahawks he was looking for, what would that mean for the trajectory of the war? And is Donald Trump right that we only have enough, maybe for ourselves?
Tactically, tomahawks would let Ukraine attack Russian energy infrastructure, the goal there being to push Putin to the table. We have a lot of tomahawks. We've just sold some to the Japanese and to the Netherlands. And don't forget, the Army has some new hypersonic missiles like Dark Eagle coming along. We have the SM-6. We have plenty of missiles. There are enough there. So Trump doesn't have to decide right away. The goal of all of this, of course, is with the economic and the oil sanctions and military pressure from Ukraine on legit Russian targets to try to push Putin to at least agree to a ceasefire.
I do find it interesting that we're hearing from Maduro now that they have 5,000 surface-to-air missiles that are ready for us. And I mentioned this, Dr. Grant, with a breaking story that just dropped here from Sean Parnell at the Pentagon. You may have known this was coming because I know you have great sources in the DOD. In support of the president's directive, it says to dismantle transnational criminal organizations and counter narco terror. The Secretary of War has directed that the Jerry Ford Carrier Strike Group and Embarked Carrier Air Wing to the U.S. Southern Command area of responsibility. We're sending a carrier strike group down to the Caribbean. What does that tell us about what happens next?
Yeah, and the Gerald R. Ford is our newest aircraft carrier. They've just been in Europe. It's another fantastic use of aircraft carriers by President Trump. That means that they can have the most sophisticated aircraft there. And hey, you saw what aircraft carriers participated in, hitting the Houthis in the Red Sea area. And I think Maduro needs to be very worried. Hey, don't forget, Secretary Rubio has a $50 million bounty on Maduro's head following an indictment by the Southern District of New York. I'm delighted to see the aircraft carrier Ford down there and really showing American presence in the Western Hemisphere.
Well, is that it, though? Why are you delighted? Is it a projection, once again, of force, or are we going to use this thing?
Oh, all of the above, right? It greatly extends the options, but I think what the administration wants to see is they want these drug boats to stop making these drug runs. And the Ford is going to give them a much greater ability to do overwater surveillance. They can intensify the attacks if they want to. That's plenty of shooters in the area. Or maybe Maduro will come to his senses. The Ford can strike. It can carry out presence. Excellent platform for this.
Doctor, it's great to have you back. I always appreciate your insights. Rebecca Grant knows this stuff inside and out. Clearly, the vice president at the Lexington Institute with her view on Ukraine and the Caribbean as the president heads to South Korea. He'll be wheels up tonight after 10 p.m. It's a late departure as he heads over for the APEC summit and a meeting with President Xi that'll be 1 week from yesterday. Pretty scary stuff we're talking about here. My God. We'll assemble our panel next. I guess the carrier strike group is headed down to the Caribbean as well, so stand by for more on that. I'm Joe Matthew in Washington. There's much more to follow here on Balance of Power as we zero in on this Ronald Reagan commercial in Canada. That's next on Bloomberg.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. It is a Wall Street relief rally, and it's pushing the major stock indexes to records today. The September Core Consumer Price Index increasing 0.2% from August. On an annual basis, that advances 3%, and it's seen as tame enough to get a rate cut from the Fed next week. A rate cuts, that amounts to rocket fuel for equities, usually. In the meantime, Laura Cooper at Nuveen says investors also looking for tech spending to start paying off.
We are still positioned in U.S. tech. We think it is quite this profitable dynamics will support equities. But I think the risk right now is less about, this AI bubble bursting, but more around valuation fatigue. When are we going to start to see substantive returns on all of this investment come through?
Intel seems to be on track for a long-awaited comeback. Chipmaker returning to profitability, delivering an upbeat revenue forecast. That's up 0.6%. And P&G sales beating consumers brushing off some of the price increases, at least for now. Procter & Gamble up 1.3%. Overall, S&P 500, that's a record of 58 points, 67.96 on the index. The Dow Jones Industrial Average up 466 points. NASDAQ 100 up 278 points. Balance of Power, that's the show. Joe Matthews, the host. Happy weekend.
Boy, you too. Happy Friday, John Tucker. That is the show. Yes, indeed. I am Joe Matthew, and we're live in Washington. John will have more on the markets coming up a little bit later on here as we welcome you to the threshold of the weekend. On Bloomberg Radio, satellite radio channel 121, streaming live on YouTube as well, with a slight update on the White House demolition, the now former East Wing, with walls built up around the area so you can't see it in person. And as you've been hearing in the newscasts, staffers of the Treasury Department have been told to stop taking pictures, and people on tours the same. Enter Charles and Judith Voorhees taking the matter to court, filing a motion in Washington federal court just yesterday asking a judge to halt any further damage to the White House while the legality of the project is assessed, knowing, of course, the administration says that they're well within their rights to do this. The motion seeking a temporary restraining order against the demolition, arguing that it's taking place, quote, without legally required approvals or reviews, unquote. I don't know if the Voorhees have seen the White House lately, but you might be a little late, unless, of course, they're planning to take down the West Wing. Now, the president, of course, is heading abroad, as I mentioned, casting his gaze beyond our borders here. Number one, on his way to Asia, where he's going to meet next week with President Xi, and two, canceling talks with Canada because of a television commercial. And it's not new. You might have seen it in the ball game a week ago. It's going to be back on TV tonight. This is an ad from Ontario, and it invokes the voice of Ronald Reagan, which already we've got everybody upset about this, certainly with the trade spat that's being had right now. It takes lines from a Ronald Reagan speech that was delivered on the radio, and if you haven't seen it yet, here's a taste.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
Donald Trump on Truth Social. Canada cheated and got caught, he writes. They fraudulently took a big buy ad saying Ronald Reagan did not like tariffs, when actually he loved tariffs for our country and its national security. He says Canada's trying to illegally influence the U.S. Supreme Court with this ad in one of the most important rulings, he says, in the history of our country, saying that Canada has long cheated on tariffs, charging our farmers as much as 400%. Thank you to the Ronald Reagan Foundation, he says, for exposing this fraud, when in fact those are Ronald Reagan's words here. The ad, however, misrepresents, according to the statement, presidential radio address, and the government of Ontario did not seek or receive permission to use and edit the remarks. Indeed, they grabbed a couple of lines from the speech and stitched them together. But if you read that whole speech, you realize what he was actually doing was explaining his decision to add duties to semiconductors from Japan as a last resort, and explained why he did not like tariffs as opposed to loving them. Let's assemble our political panel and get their thoughts. I have a feeling that they'll have a few. Bloomberg Politics contributors Rick Davis with me here in Washington, Jeannie Shanzano in New York. Rick is Republican strategist and partner at Stone Court Capital. Jeannie is democracy visiting fellow at Harvard Kennedy School's Ash Center. Happy Friday. Great to see you both. People should know, if they don't already, Rick Davis actually worked in the Ronald Reagan White House. And as a Republican, I think we can start with Rick here, because I'm pretty sure that the word tariff was considered a swear word in Republican politics until Donald Trump came along. Rick, did Ronald Reagan love tariffs?
Ronald Reagan did not love tariffs. Ronald Reagan was a free trader. He was someone who really espoused the sort of power of open markets and free trade. And I think that it's really important for people to know that this, in the case of this radio address, which he used to announce certain kinds of policies or describe the ones that his administration was giving, kind of the internet of the time. He was announcing a very sensitive issue that the administration spent a year working on, and that was a 301 case, an anti-dumping case against Japan. And he used existing laws to do that. He didn't go out and announce an economic state of emergency in order to sort of, bootstrap the congressional efforts. And by the way, and he had to work very hard with the Republicans on Capitol Hill to do this because they were free traders and they didn't want us going into a trade war with Japan. But long story short, I mean, I think, Ontario got what they really wanted to, which was an enormous amount of publicity around this, sort of very inexpensive 30-second ad.
That's the truth. I heard a couple of people mention it just in the wild after it appeared in the ball game about a week ago. Jeannie, if that hadn't taken place today, to Rick's point, if the president hadn't been truthing about it, I don't suspect it would have been on front pages. We should also note that Ontario's Premier Doug Ford posted Reagan's full remarks, saying that Reagan knew that we are stronger together. Mark Carney said negotiators actually were making progress until this happened. So I'm wondering your thoughts on this, Jeannie, and if the editing in this ad did anything to change the meaning of Reagan's speech.
No, it didn't. And I'll tell you who I'm most concerned about is the Ronald Reagan Foundation, because to me, their statement read like sort of like a hostage video, like, oh, we're going to look into whether we can press charges and pursue this legally. But wink, wink, look at YouTube and see the actual speech and you'll know that it doesn't destroy, it doesn't mess up anything that he said. Because Ronald Reagan's point was like most Republicans at the time, and quite frankly, many today, which is that after the 1930s and the Smoot-Hawley tariffs and the destruction that did not just to the economy, but to the Republican Party politically, they have not been in favor of widespread tariffs. Ronald Reagan, like many Democrats and Republicans, support targeted tariffs for a specific reason at a specific point in time. But these broad, widespread tariffs that Donald Trump and William McKinley before him have pursued and were pursued with those protectionist acts in the early 1930s have been disastrous for the U.S. economy. So I think somebody needs to make sure that they go to the Ronald Reagan Foundation and make sure they're all okay, because it feels like there was some arm twisting there. You get out and make a statement, and then they nodded to what's on YouTube, which is the reality that Donald Trump, like most Republicans, doesn't favor broad tariffs like Donald Trump does.
Jason Kenney, former premier of Alberta, on X calls it, quote, a direct replay of his radio address formatted for a 1-minute ad. Rick, what do you think about the editing here? President Trump has a history with this type of thing, calling out CBS, for instance, for editing remarks and trying to suggest that Canada was cheating here. Does it betray the spirit of what Reagan was trying to say?
I think a vast amount of advertising that's in the public policy or political domain does exactly what Doug Ford, the premier of Ontario, did, which is he took the meaning of the speech. He knows that Donald Trump or Ronald Reagan was a free trader, and he pulled the pieces out that that enunciated that. And so I think, again, a lot of smoke, no fire, right? I'm not sure Premier Carney appreciates the intervention of Doug Ford in the negotiations.
That's a whole other side of the story
with the White House. But Doug Ford's a very, I think, boisterous leader and has gotten into a tiff with Donald Trump on more than one occasion. And I think this is a good example of how you can live inside of Donald Trump's head in a cheap 30-second. I shouldn't say cheap. It is baseball. But I think this is a lesson to other leaders.
Well, let's just stick on that for a minute, because you've made a lot of political ads. Is this an effective 30-second ad?
Well, yes, because of the fact that they probably spent $100,000 to make and put it on, and it's now had $50 million worth of publicity. So I would say that is a very effective ad.
Free media. Let's do that. We've got sound of Carney here talking this morning about our trade relationship. Let's listen.
We can't control the trade policy of the United States. We recognize that policy has fundamentally changed from the policy in the 1980s, 1990s, 2000s. And it's a situation where the United States has tariffs against every one of their trading partners to different degrees. A lot of progress has been made. And we stand ready to pick up on that progress and build on that progress when the Americans are ready to have those discussions.
I don't know when the Americans are going to be ready, Jeannie. He's going to be in Asia. He'll be at the APEC and ASEAN summits next week. Does Donald Trump have a little pull aside here? Does Carney have to demand the ad come off the air?
I don't know if they will speak. I wouldn't be surprised if they do. But what Carney is saying is absolutely right. They can't do anything to change Donald Trump's mind on this. They can't do anything to change U.S. policy. But what they can do is what so many allies are doing, which is working in the long term to protect themselves economically from the United States. And that is good for them and bad for the United States security, economy, long term. We have allies for a reason. We need their support, and we need it both economically and we need it from a security perspective. And all this broad spread tariff policy has done since it was announced is alienate the United States from its closest allies. And if there was a good sound reason the president could offer for the policy, it would make sense, but he for Canada goes for everything from fentanyl to immigration to raising money to returning manufacturing home. And so it is a confused policy. It is a president who apparently is up in the middle of the night triggered by ads that are a week old. And this is no way to set sound policy. And doing it at a time he's headed over to Asia. And also the Supreme Court is hearing a case on whether he has this power to set this policy to begin with. So at the front time for the tariff policy, and the president is making decisions that are not in the long-term best interest of the United States. That's clear. Ronald Reagan knew it, and Donald Trump should swallow that and learn the lesson.
Boy, a lot there as the president prepares to board the jet here. Rick, he's going to be flying out late tonight after 10 p.m. on his way to this summit. The point has been made that he won't get the carpet rolled out quite the way that he did on recent trips to Europe, for instance, that this is going to be maybe a more difficult trip as he works up to the meeting with President Xi. How will his reception be impacted by everything we're talking about here?
It's hard to tell. It certainly puts his back up before he boards the train. Yep. And, he is an emotional animal, right? So if he's in a bad mood when he lands, either, a lousy breakfast on landing or, somebody has announced a trade sanction against him. Right. Those things affect his demeanor and his relationships with other heads of state. And different from Europe, where he's really gotten to know these guys particularly well, I think it's still a growth plan in Asia to sort of develop these relationships, develop the bilateral relationships between the U.S. and some of these countries. And so it's much harder work than hanging around the guys from Europe who you've gotten to know quite a bit. And frankly, outside of trade, the issues are much more intractable. In other words, yes, you have a shooting war in Europe, but you have the, potential for an existential war in Asia with China. And so all of that sort of clouds the proceedings here. And so I think that this is going to be a much harder work for the president. and it will appear more like a working trip. It's not just a big party
right.
where everyone's going to take a picture and walk the red carpet.
Exactly. We're not always used to those, and we're going to be covering that, of course, over the course of the weekend. Tyler Kendall will be wheels up to Asia as well, bringing us reporting throughout next week here on Bloomberg. Great to have our panel with us on the Friday edition. Rick Davis and Jeannie Shanzena will be back in hour 2 as we welcome our global television audience, and the aforementioned Tyler Kendall will join us here for our second hour as well. We're going to spend some time on the shutdown. It's day 24. Congressman Mark Alford with the Republican View from Missouri will be with us right at the top, so stay here on Balance of Power on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Day 24. Welcome to the Friday edition as the government shutdown continues with no progress in solving it. The president, meantime, setting his sights abroad, canceling talks with Canada today and flying to Asia for a meeting next week with President Xi. Thanks for joining us on the Friday edition. I'm Joe Matthew alongside Tyler Kendall, who's in for Kaylee today in Washington, D.C. Tyler, it's great to have you. We're going to talk with another stakeholder here. The House is not in session, but lawmakers are still talking, and Mark Alford of Missouri will give us the Republican point of view here with day 24. And you know you're going on the president's trip to Asia. This likely will not be resolved before he comes back.
No, because President Trump is considered to be a key stakeholder here, of course, Joe. And our upcoming Congressman Mike Alford, interesting guest as well, represents Missouri, a top soybean-producing state. And we know soybeans are going to be top of the agenda when President Trump sits down with Chinese President Xi Jinping next week.
That's true. Our other big story that we're following here at home, at least, is inflation data. We've got a rare Friday dose of CPI news here, and it's showing some soft inflation numbers, at least enough to make the markets happy here and kind of solidifying the idea that there could be rate cuts beyond next week. There is a Fed meeting next week, so the timing here is pretty important. We're going to talk to Michael McKee about that coming up as well.
Right, pretty remarkable release today because the backdrop here is that the BLS had to recall staff because this was considered to be essential for this Social Security Administration's annual cost of living adjustment. It has to do with these inflation numbers. So essentially, the long way around, we ended up getting this data even though we weren't expecting to, and now the White House is saying that we might not get it again next month. So for a check on how the markets is watching all of this, we go now to Alexis Christoforous in World Headquarters in New York for the Friday trade. Hey, Alexis.
Hi, Tyler and Joe. We're calling it a relief rally on Wall Street this Friday as investors bet that cooler than expected inflation report will keep the Federal Reserve on track to cut interest rates by a quarter point at next week's meeting. So we've got stocks extending their October advance. The Dow Jones Industrial Average powering ahead more than 500 points, a gain there of better than 1%. The S&P 500 up 63 points now in record territory and crossing 6,800 for the first time. NASDAQ Composite now up nearly 300 points, a gain there of 1.2%. Actually, all three major stock indexes in record territory right now. The reaction in treasuries more subdued. We've got the yield on the 10-year at 3.99%, the 2-year yield at 3.47%. Checking commodities, gold up fractionally right now at 41.33 the ounce, and oil continuing its recent rally. WTI crude up about 0.1%, and the global benchmark Brent crude up 0.6%. In stock news, Procter & Gamble reporting better than expected sales for its first quarter as consumers bought its Gillette razors and Secret deodorant despite price increases. The company cut its projected impact from tariffs in half and reported organic revenue growth above estimates. We've got shares of P&G now up 1.33%. Intel, the chip maker, reporting sales growth in its core product line of PC processors and shrinking costs. Wall Street likes it. Intel up 1.25%. And Ford reporting strong sales, helping to push the automaker's revenue and operating income well past estimates. Shares of Ford racing ahead 11%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Balance of Power now, and Tyler and Joe.
All right, Alexis, thanks so much. As Alexis mentioned, I'm Tyler Kendall here in Washington alongside Joe Matthew, and we are tracking closely after this consumer price index report. Highly anticipated because, Joe, we weren't expecting to get it because, as we've been reminding you on this program, the government is shut down, and it has been for the last 24 days, and some of the data releases are not deemed essential. It takes time to collect the data, put together the reports, and ultimately release it.
Yeah, how'd you like to be called into work as an essential employee and not paid for that? The question is why we didn't get the last jobs report, because that actually had been compiled, and we still haven't seen that, noting that there's, of course, a dual mandate at the Fed, and they need to see both the inflation numbers and the jobs data. But you already mentioned it. It's a cost of living adjustment that forced this CPI to be released. That's why we're talking about inflation data on a Friday.
Right, and even more interesting, hearing the White House weigh in earlier when it comes to this inflation data, but also when we could get the next inflation data, saying that they are not expecting the October CPI report to be released.
So if you're Michael McKee, it must feel like a Wednesday or something. Bloomberg International Economics and Policy Correspondent joins us now from World Headquarters in New York. Mike, this softer than expected reading says what to you? Is this vindication for the White House that tells us tariffs simply are not inflationary?
No, it is not. And I would say that the White House has a good political case to make for people who don't follow the data. And it will look good for the president, and I'm sure we will hear many times about it, how he's brought down inflation, yada, yada, yada. But if you take out used cars, goods prices rose significantly again, because we're starting to see tariffs leak into goods prices, and we saw some increases that were out of line with what would be normal, like apparel prices up 0.7 and furniture prices up 0.9. Services prices still rising at about the same rate. They were held down by a significant drop in home prices, the way the government calculated it with owner's equivalent rent. And there's a general feeling among the economists I've seen, the reactions I've seen, that was probably statistical noise and would not be repeated next month. But as Tyler adroitly points out, there may not be a next month.
Well, to build off of that, while we likely know what today's report means for next week's Fed meeting, Mike, how are you watching this? How are policymakers watching this as we close out the year? And of course, we have another FOMC meeting down the line.
Yeah, we have a meeting on December 10th, and I don't think they're going to do anything this week that would give a hint as to what the December plan would be, because we don't have data. It looks like we're going to have a hole in the data, but then we might get some data before that December meeting. And anything you say now could be, as Larry Speaks, and Joe will remember this, as Larry Speaks once said, that's, no, as Ron Nesson, I'm sorry. Ron Nesson said that's inoperative. And I knew you'd remember that, Joe. But
we're dating ourselves now. I'll tell you what, I don't know. Services prices, excluding energy, up 0.2, or in part reflecting a slower advance in airfares. Shelter prices making the difference here. Mike, if there was another CPI a month from now, what would it tell us?
Well, the question would be, in terms of services especially, whether house prices continued to rise at that very, very subdued pace, because up until this month, they were rising at almost 0.3 a month, and sometimes more than that. They'd been coming down gradually, but this is a very quick fall. So was there a reason for that, or is this just kind of a random number? And that's why you want a series of reports, and the Fed is looking at a series of reports and always says, you know, one number doesn't make a difference, but they may not get it. So that could add some confusion into what they are doing. Now, what they'll do is they will call all the realtors in their districts, and they will ask them how it's going and what prices are. And there are a lot of private price providers in real estate. So I think they'll have a pretty good idea, even if the number is not there.
All right, Michael McKee, Bloomberg International Economics and Policy Correspondent, thank you so much, as always. And we want to extend the conversation because we're joined now by Congressman Mike Alford, Republican representing Missouri's 4th District. Congressman, thanks so much for joining us here on Bloomberg. And I want to pick up on where we were just talking about with Michael McKee, because this government data was released today, but it was delayed because of this shutdown. As policymakers, lawmakers try to make the best decisions about the economy, do you think economic data like this should be deemed essential so that we get it in real time?
Well, I think it should be. This is just another effect, a negative effect on our great nation because of the Schumer shutdown. America held hostage. We're now in the 24th day of this, and we're held hostage on these numbers, which are so important to get a real good gauge, I think, of where our economy is and where we're to go with our economy and what decisions that Secretary Bessent and President Trump need to make to right the ship that President Biden and the past administration has really run us into a reef of despair.
Well, okay. That said, we've got a Federal Reserve that's set to make a decision next week, Congressman, and it's good to have you back, Congressman Alford. I would just wonder what the Fed is supposed to do with this dearth of data. There's obviously enough to work with for next week, but there are questions about what happens after that. If we're in for some kind of record shutdown here, as somebody who serves on the Financial Services Committee, what's the Fed to do?
Well, look, I think the Fed's in a tough spot. I think Powell needs this information to make a wise decision, as do the Board of Governors, including one here in Kansas City. They need this information. That's why President Trump has made changes in the past to the person who actually puts this information together. But, yeah, you've got to have the right information, and Chuck Schumer standing in the way by not voting with other Democrats in the Senate to vote for this simple extension of current government funding. This is just one of the repercussions. We're seeing it all over our district. The other repercussions, people not going to have food stamps next month, money running out for women, infants, and children, money running out for our military. We found the money President Trump did to pay our military, but come next pay period, the Democrats in the Senate just voted yesterday not to pay them, not to pay other essential employees in the U.S. government. I think that's despicable.
And Democrats, of course, also floated their own bill when it came to some other essential employee funding.
But they just wanted 1 week. They didn't want, we wanted for the entirety of the shutdown, and they're trying to use that as leverage. Catherine Clark was very clear with her interview with Chad Pergram on Fox that they needed this leverage of pain in America so that people would get on their side. We're not negotiating. There's nothing to negotiate.
Well, Congressman, I do want to ask you about one point that you just made about this idea of a simple extension. Right now, the stopgap measure that lawmakers are voting on would fund the government until November 21st. We did hear from the Senate Majority Leader John Thune earlier this week, actually, saying maybe it is time for the House to start thinking about coming back into session because you're going to need a little bit more runway, potentially. Do you think that your chamber should come back into session for this? Is a November 21st stopgap, is that date really still viable?
I think it's very reasonable, and I think our chairman, Tom Cole, came out with a statement earlier this week saying that we can get this work done. Look, against a lot of odds, we got all 12 appropriation bills out of committee this year. Some of the Democrats were offering 40 and some odd amendments to these individual bills. We had 12 14-hour days of hearings and debate. We debated all these spending bills. We came up with about 7.3% in cuts overall. We cut 9 of the 12 subcommittees. We gave plus-ups to Homeland Security, our defense, as well as military construction VA. We got 3 off the House floor. And all we were asking is 7 more weeks to get our job done. The Democrats don't want us to return to regular order. They want a big omnibus bill at the end of the year, and we're not doing that.
Congressman, your colleague from Missouri, who chairs the Ways and Means Committee, was with us yesterday. Jason Smith made some news suggesting that he was behind the idea of a full-year CR that had been floated by John Thune and even the White House a couple of months ago. I just want you to listen to what he told us, and we'll have you respond. Here's the chairman.
December 21st, 2026 is what I've been hearing up here as a suggestion, as an opportunity of a continuing resolution. As we know, we're operating under a year-long resolution from last year. We're looking at what was appropriated when Biden was president.
I know we're basically living under perpetual CRs. I know it sounds like it. Congressman Alford,
2024 numbers.
You're talking about regular order, which would be a pretty amazing thing to see take place. But if that is the solution, would you back it, a full year CR?
Well, look, if leadership was behind this, I don't think they will. But I have the utmost respect for Jason. He is one of my dearest friends and mentors. And he loves Missouri and loves the United States of America and done a great job as Ways and Means. He was really instrumental in getting the One Big Beautiful Bill reconciliation through the House and also helped in the Senate with his influence there. But I also trust in Chairman Tom Cole. If he says that we can get this done, I have complete confidence that we can get this done. We just need a little time to get these 9 bills. They may not all be separate bills. We may have to do mini buses where we group 2 or 3 together, but we can get this done. The time has come for us not to operate Congress on continuing resolutions. We are still on 2024 budget numbers that Biden came up with, and our military can't move forward with new programs that they need to deter thugs around the world like Xi Jinping and Vladimir Putin. These programs that are vital to our national defense. We cannot continue to operate America under continuing resolutions. And so while I understand where Chairman Smith is coming from, that's got to be a last-ditch effort, in my opinion. We have made tremendous strides in getting these appropriation bills done, getting 3 off the House floor. Let's move forward. We had momentum until the Democrats stuck a stick in our spokes and are trying to wreck the American people. they've got to get out of the way. They've got to quit digging the hole that they have dug and let us move forward and fund the government.
Congressman, you did bring up Xi Jinping there, and I want to quickly ask you about China, because that's another story that we're following very closely here at Bloomberg as President Trump heads overseas for this highly anticipated meeting with Chinese President Xi Jinping. I've learned that Missouri is one of the top 3 soybean producing states in this country. What is going to happen if China doesn't agree to these agricultural commitments, purchases, since we know that they have not imported any U.S. supplies so far this harvest season?
Yeah, I'm in a very ag-rich district just south of Kansas City over to Lake of the Ozarks and almost down to the Arkansas border. Our district borders Jason Smith's district, and he has a lot of ag there as well. We have 87,000 farms in the great state of Missouri. We are down from 95,000 farms just 2.5 years ago. Many of those farmers are soybean farmers, and they are about halfway through their harvest right now. We're getting a little rain right now, and that's delayed that. But they're having to put these beans in storage right now until the prices come back up. It is not helping not having a deal with Xi Jinping. I know that they love buying our protein. They love buying our pork, which we also have a lot of that here in Missouri, but they also love our soybeans. And so I think it's incumbent on the president to reach a deal with Xi Jinping to get this trade back going with our soybeans going over to China. I know the president has made some inroads in helping offset, mitigate some of the losses that our farmers and ranchers are seeing here in Missouri and across the United States of America. Thank God that we have this tariff money that's coming in, almost $400 billion right now. He is going to use 30 to 50 billion of that to replenish the Commodity Credit Corporation, which is overseen by Secretary Rollins in the U.S. Department of Agriculture. And that is going to help offset some of the losses in the short-term, I think, downturn for our farmers. This is short-term. I think in the long term, our farmers and ranchers are going to be much better off with the trade deals that President Trump is making. I would much rather have him as our negotiator than Joe Biden.
Well, with that said, in our remaining moment, Congressman, there's been a lot of talk about Argentine beef around here lately, and you've probably heard this. The president looking to do some more extra importing to try to lower prices, and that's got a lot of cattlemen and ranchers upset. Did you just give us the answer? Is the answer to eat more pork from Missouri?
Hey, it's the other white meat. You know, pork. I love pork.
I heard that.
I love all, I'm a carnitarian. I love chicken, beef, and pork. But look, I was just at a cattle auction barn in our district yesterday. Prices are extremely high. The ranchers are enjoying the higher prices because they have had such losses over the last couple of years. We have been under a level 4 drought in parts of my district for the last 2 or 3 years. And that has caused the price of beef to go up. A lot of ranchers have had to sell off their herd because they didn't have the grazing grounds, they didn't have the hay, and so a lot of the beef was sold off. We've got to get the 5 packing house companies under control. We've got to get back to local control, local ranchers, and local processors. That's going to bring the price down.
Mark Alford of Missouri with us, the Republican on Bloomberg.
121 on Wall Street. I'm Alexis Christoforous. That weaker than expected inflation report for September combined with another batch of strong corporate earnings powering yet another record rally on Wall Street. All three major indexes are on track to end the week at fresh all-time highs, and that's despite the ongoing government shutdown. The Dow Jones Industrial Average up by about 500 points now, led higher by IBM, Goldman Sachs, and JP Morgan. The S&P 500 up about 62 points and now above 6,800. The NASDAQ composite up now 286 points, a gain there of about 1.5%. Not participating in the rally today, we've got shares of Deckers Outdoor tumbling to a two-year low, down now more than 12%. It's one of the biggest losers in the S&P 500. The footwear and apparel company behind the Uggs and Hoka brands forecasting full-year sales that missed estimates. Deckers Outdoor also expects consumers to be more cautious as the full effect of tariffs come into focus. We've also got the consulting firm Booz Allen Hamilton on the downside, off now more than 10%. It relies heavily on government-related work. It cut its outlook for the year after posting lower profit and revenue. But shares of Applied Materials up about 0.5%. The largest U.S. producer of chip-making equipment planning to cut 4% of its global workforce as it copes with a sales slowdown and trade turmoil. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back over to Balance of Power.
All right, Alexis, thanks so much. I'm Tyler Kendall here in Washington alongside Joe Matthew, and we just took you through the latest on the domestic policy front as the government shutdown is now in its 24th day with no sign of easing. And part of that is because President Trump is heading overseas. He's set to visit 3 countries next week, including Malaysia, Japan, and South Korea. And he, of course, is key to any such talks, Joe, when it comes to reopening the government. But there are a lot of important things on his agenda as he makes his way over to Asia.
That's for sure. It's going to obviously culminate with a meeting on Thursday with President Xi, as we learned yesterday, right around this time, actually, from the press secretary. Tyler's going to be on that trip, and we'll be reporting from South Korea next week, knowing that the president's got some hot spots around the world to deal with beyond what he's going to be discussing in Asia. Look no further than the Caribbean, where we just knocked out another boat.
Right, getting confirmation on this. We're still awaiting some perhaps further details, but this really does continue what we've seen from the administration when it comes to targeting these alleged shipments of narcotics from Venezuela. I was pretty struck that we actually heard from the Brazilian President Lula, who says that he wants to meet with President Trump. They're both set to be in Asia this week, and that he's willing to talk about Venezuela.
Yeah. Well, this one was just announced, or I guess confirmed by Secretary Pete Hegseth a short time ago, the first night strike that we've seen against a vessel. He says that the direction of the President, Department of War carried out a lethal kinetic strike on a vessel operated by Tren de Aragua, a designated terrorist organization. Now, as we have heard from the President, they're promising more where this came from. And to that end, with our questions about what exactly is happening off the coast of Venezuela, where a naval flotilla has been assembled for some time now, we just heard from Sean Parnell at the Pentagon that the Jerry Ford Carrier Strike Group is now on its way. This is straight from the statement. The Secretary of War has directed the Jerry R. Ford Carrier Strike Group and Embarked Carrier Air Wing to the U.S. Supreme Command Area of Responsibility, referring to the enhanced U.S. force presence in the U.S. Southcom, bolstering our capacity to detect, monitor, disrupt illicit actors, knowing as well that there was a covert CIA operation on the ground in Venezuela that the president himself confirmed.
Right, there's a lot that we could dig into, and just for the statistic that I was trying to find before, this latest action marks the 10th strike since September 1st against a vessel allegedly ferrying drugs and brings the death toll to 43.
Let's bring in our panel for more on this. Rick Davis and Jeannie Shanzano are with us here on the Friday edition of Balance of Power, both Bloomberg Politics contributor. Rick is our Republican strategist and partner at Stone Court Capital, and Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Jeannie, considering what the president said yesterday, that at some point, once all of these options on the water are exhausted, he calls them water drugs and sea drugs, he said the land is going to be next. Quote, I think we are going to kill people that are bringing drugs into our country, okay? We're going to kill them, he said. They are going to be like dead, unquote. What's the point of the Carrier Strike Group, and how far is this going to go?
Yeah, I mean, it was a pretty stark reminder when the president was asked yesterday, to your point, about whether he needed to go to Congress to get approval for a declaration of war in Latin America. He said, probably not, but don't be surprised if we move this from the water to the land. And that, to your point, in doing so, they would kill many people. But, you know, you look at, and already, to Tyler's point, 10 strikes and over 40 people killed. The problem is something that Senator Rand Paul and many others have talked about. We don't know who is on those boats, nor is Congress apparently getting information. And we don't in the United States, because we are a democracy, abide by strike first and think about it later. We have the Coast Guard go in, we have them get on those boats, we have them deal with who is ever on there, because we too make mistakes. And so all of this is a violation of US law, international law, and the president, from his comments yesterday, seems not at all concerned about what is happening there on the water and promising more on the land.
Well, Rick, what's your take here, and what's been your assessment of how the administration has been telegraphing these strikes and the questions that, as Jeannie is phrasing, still remain?
Yeah, look, it's been a very provocative series of actions by this administration toward the Venezuela regime and the drug cartels resident in it. But I would remind everybody, too, repeated opposition groups inside Venezuela have referred to the Maduro regime as a narco-trafficking regime, that they are not administering justice and running a government. They're running a criminal organization bent on lining their pockets with drug profits. And so this is not the first time we've dealt with Maduro as an individual who is basically created a drug cartel out of a government. Now, that being said, also moving the carrier strike group into the region is, again, an even more provocative measure, because these are seen as some of our most lethal capacity that we have, and an incredible show of force that we would do typically in a shooting war in the Middle East, not necessarily something in our own hemisphere. And so clearly the message the administration is sending to the Maduro regime is, we are not going to put up with any other misbehavior on your part. And it goes well beyond these seaborne drug runners who have been doing this. And look, I have confidence in our intelligence community and in our military and in our ability to gain information from various sources, that the administration is likely confident of the people who are being attacked as violating various laws governing our resistance to drug cartels and their pernicious effects, not only on our country, but all those around them. So I think it's a little bit too hot to say we don't have a clue who they are. I suspect we know exactly who they are. And I think that then it's a matter of policy of this administration to decide what they're going to do about it.
Yeah, just in our last hour, we heard from Dr. Rebecca Grant, Jeannie, who said that military is looking at these ships as they're being loaded on the docks, and they have a very good sense of the material, where it's coming from, and who is on the boat. I don't know why that means we need to shoot them just off the coast of Venezuela. It takes a long time to get here. We presumably could wait to intercept them as they approached U.S. waters. I think might be part of your point involving the Coast Guard. But I'm curious about the congressional response. The Senate next week is expected to vote on a bill that would bar the U.S. from engaging in hostilities inside Venezuela without the explicit authorization of Congress. Could that even pass?
You know, it's unclear. I think there is a possibility, but it is important that they are taking it up. They are debating this, because for too long they have allowed this administration to sort of run roughshod in so many areas. But to the point that Rick was making, number one, it's not an issue of whether we trust the intelligence. What the statistics show us is a quarter of the time that the Coast Guard boards these boats, they are wrong. They have made mistakes, number one. Number two, again, we're a democracy. We don't kill people because they are suspected drug runners. We stop the boat, we board the boat, we take them into custody. Number three, they're 2,000 miles away, so they're not a direct threat to the United States. They have to stop several times in these small boats to get more oil to continue. So much of that doesn't ring true. What does ring true is that the administration, like the Biden administration before, is intent on regime change in Latin America. And we've been there before. It does not bode well or work out well for the United States. But if that is the case and we are intent on regime change, then the administration should be as explicit about that as they were about the fact, or the president was, that the CIA is on the ground engaging in covert operations. So there's a lot here, and history doesn't suggest that these policies are workable for the United States in the long term. If regime change is it, we should know, and the Congress should support any act of war.
We do want to bring you some breaking news over the Bloomberg terminal. Hakeem Jeffries, the Democratic leader in the House, has given Zohran Mamdani, the Democratic nominee to be the next mayor of New York, his endorsement. Joe, this is seen as a last-minute endorsement. He, of course, was asked by Bloomberg's David Gura just yesterday, and we got sort of a non-committal answer.
Yeah, he said he would make the announcement before early voting started, which is in a day. So I guess we did wait until the end here. And we did mention last hour a report by Politico saying the same thing. Now we add the New York Times. So we've got a couple of sources here as Jeffries, of course, the Democratic leader in the House, finally endorses the Democratic nominee in his own town. We've only got a couple of minutes here. Rick, this was inevitable?
Yeah, I think so. I mean, there was a lot of pressure on Hakeem Jeffries to do this endorsement, but I don't think it is really worth the time of the announcement. I don't think it's going to have any impact on the outcome of the race. I think this race has been baked for a while, and unless he can get Curtis Sliwa out of the race with this endorsement, it's not going to really benefit anybody else.
Your thought on that, Jeannie? He obviously didn't need Hakeem Jeffries to win the nomination, and based on the polls we're seeing, he didn't probably need him to win the race.
He does not need him, but of course for Democrats, this is a big deal because they are scratching their heads as to why he stayed out. Well, we know why he stayed out. And by the way, where is Chuck Schumer on this? Also in New Yorker, it's because they are deeply concerned that the president's communist socialist message is going to resonate across the country and it's going to impact them negatively in the midterms. So they are trying to maintain as much of a distance as they can from Mamdani, who is set to win this election in a couple weeks.
All right, our political panel today, Jeannie Shanzano and Rick Davis, both Bloomberg Politics contributors. Thank you so much, as always. And Joe, according to this New York Times reporting, people familiar with Hakeem Jeffries' thinking, saying that he had planned to announce an endorsement earlier, but that he delayed it because of the government shutdown.
Well, there's always a reason, I suspect, but he's come off the fence now, and not a big shocker here, obviously. We're going to be, by the way, in New York to provide special coverage with the help of Rick and Jeannie on Election Day. We'll be watching New York and, of course, gubernatorial races in both New Jersey and in Virginia. Big thanks to our panel, and thank you for spending part of your Friday with us here on Balance of Power on Bloomberg TV and radio. We've got a lot more ahead as the president prepares to fly to Asia. We'll be joined coming up on this rare CPI Friday by Heather Boucher, former Biden economic advisor. She's straight up next on Balance of Power on Bloomberg.
6:40 on Wall Street. I'm Alexis Christoforous. A cooler than expected inflation report igniting a rally on Wall Street, with investors betting that now paves the way for the Federal Reserve to cut interest rates at next week's meeting, and possibly more rate cuts to come in the months ahead. The Dow Jones Industrial Average at its best level of the day, now up 570 points, a gain of 1.25%. The S&P 500 up 67, crossing over 6,800. The NASDAQ Composite up better than 300 points. All three major indexes near or at record highs. Gold's recent record rally helped Newmont Mining's third quarter sales and profits beat street estimates, but shares are still down 4.5% after its guidance for 2026 disappointed. More layoff announcements one day after Target said it's slashing 1,800 corporate jobs. General Motors says it cut 200 jobs today, mostly at its tech center in Warren, Michigan. GM recently reported better than expected third quarter earnings and boosted its profit forecast for the year, helped by policy changes supporting sales of high margin vehicles. Shares of GM up 3.4%. And General Dynamics stock is up better than 1%, hitting an intraday record after the defense contractor reported better than expected Q3 earnings on strong revenue growth in its aerospace and marine systems segments. Once again, stocks rallying across the board, with the Dow up 560 points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back over to Joe, Tyler, and Balance of Power.
All right, Alexis, thanks so much. This is the Friday edition of Balance of Power. I'm Tyler Kendall alongside Joe Matthew here in Washington. And as Alexis mentioned, we received the first major data release since the government shut down, which, as we've been reminding you on this program, happened 24 days ago. On an annual basis, consumer prices rose 3% from a year earlier, according to the Labor Department. But Joe, inflation is a sticky issue, and price increases are above where policymakers really do want them.
Well, that's for sure, although it's not going to keep the Fed from cutting next week or maybe even beyond, which is why the market's having a party right now. You listen to these numbers, we're at new highs, it seems, as we continue our conversation here on Balance of Power. We heard from Michael McKee a little earlier this hour. He's got some concerns about what's under the hood with home prices offsetting some of the noise that might have shown up otherwise, or would be in next month's report if there was one, but we don't know when the next batch of data will emerge.
Right, exactly. As the White House suggested today that we're not going to get the October CPI numbers. Right. Now, next week would be considered a relatively exciting week by our standards, I think, because there's a Fed meeting. There's supposed to be third quarter GDP. There's supposed to be PCE inflation. But those latter two, those data reports, we're not expecting, because at the moment, again, there are no signs that the government's reopening.
Well, remembering, too, there was a jobs report that could have been released. In fact, Senator Elizabeth Warren was calling for its release when she joined us a couple of weeks back. That was compiled right before the government closed, and there was a decision made, I guess, to not bring somebody in to press the button on that release. But we're deeply curious to know what was in there, because we could have a couple of dark months by the time we're looking back on this closure that could set a record. That's why we wanted to talk to Heather Boucher, the former White House Council of Economic Advisors, Deputy Director in the Biden administration, joins us now with her take on things. Heather, it's great to see you. Welcome back to Bloomberg TV and radio. The question here about this CPI data, knowing it's softer than expected, is really whether it's showing finally the emergence of tariffs in inflationary data. The administration has told us that's never going to happen. What do you see when you look under the hood?
Well, I mean, it is inflation data that is lower than expected, but it's still higher than where the Fed wants it to be. And it's still high for families all across the country. When you look at some basics like, meat and eggs and other things that, people buy at the grocery store all the time, we have not seen the kind of relief that families need to see. And that is, of course, on top of the kinds of increases that families are facing in costs around healthcare that's likely to come or is already coming for families because of the cutbacks to the Affordable Care Act premiums. So the consequences for families remain pretty distressing, and you can see that in the consumer sentiment data and the like, where people are anxious about the economy right now. But it is certainly better than I guess economists expected, given the fact that we don't have a lot of data to look at right now because of the shutdown.
So to that point about this lack of data, and I made sort of the joke earlier with Joe that next week it would have been a jam-packed week when it comes to economic projections and what we do know about the current state of the economy. I'm wondering what you are watching, what you are looking for amid this lack of economic data, particularly as we're talking about economic growth, because as of now, it doesn't look like we're going to get third quarter GDP data. How is all of that factoring into what you perceive as the state of the U.S. economy?
Well, I think, we are flying blind right now. It's, there's no ifs, ands, or buts about it. We don't have access to the kind of data that we need to understand the economy. We think that this is especially important right now because if the economy is at what economists would call an inflection point, if we're moving from, growth to maybe growth slowing or paring back, and these are, of course, the reasons that the Fed would lower interest rates next week to make sure that we don't see us move towards recession or don't see more job troubles in the labor market. Without access to that data, we don't know. We, of course, have all the other kinds of private sector data and other things that we can look at. But I don't think we should kid ourselves that we know as much as we would if we had this really important government data. And I want to stress, because I think that can kind of get lost in the details, that it is about helping us all understand what kinds of outcomes we're seeing across the country. Without that national data, we're left with anecdotes, we're left with the individual stories. But of course, we live in a country with, 340 million people? We can't know all of that unless we have access to this data. So it's important for families that we all understand what inflation is, what jobs are, so that policymakers can make sound decisions and so that we as citizens can hold them accountable.
Heather, you helped to run the White House Council of Economic Advisors, so you have been able to see behind the scenes the way this works, how the sausage is made in a way that most Americans never will. When we hear that the BLS has compiled jobs data, in this case, I guess this would go back to August or September now, but chose not to release that data because of the government shutdown, what would be involved in making that public? And do you think that should be a priority?
Well, I find it very concerning that they chose not to release it. One of the things that you always try to do if you're trying to run the government based on facts and evidence, because whether or not people are employed is a fact, right? And you want to gather those facts so you can make good policy decisions. It really has been striking the extent to which this administration has made it harder for the Federal Reserve to do its job and made it harder for the American people to hold it accountable. So in prior administrations, they were focused on making sure that the unemployment insurance data was still released on a timely basis. I think they could have made a different decision on the labor data that would have come out in early October. And I think that speaks to a lack of transparency, or does it speak to the fact that the data wasn't good and they didn't want us to know what it said? I mean, it leads to this sort of conspiracy thinking, which is not helpful when you're talking about an economy as important as the United States and with a data indicator so important to American families who get up and want to know, hey, should I be worried about keeping my job? Is the labor market good or bad? Giving people that information is really helpful for their kitchen table conversations, especially because all of the data we're seeing on, again, consumer confidence, consumer sentiment, says that people are anxious about the job situation right now. So it seems odd that they would have made that choice from my perspective, and it's very distressing that they did that. It was good, of course. I think that we saw the data come out today on prices, and I think that will help inform a better decision coming out of the Federal Reserve meeting next week.
And Heather, just more broadly speaking, what sort of economic impacts are you expecting when it comes to a longer-term government shutdown? We know, of course, that furloughed employees are going to be counted as temporarily unemployed. But when we get to that labor market data and the government reopens, then that could have an impact on the unemployment rate. What are you just watching for here, as we really haven't gotten any signs that this is abating anytime soon?
I think we're looking for signs of economic distress. We're already seeing that the number of folks that are having trouble making their car payments is shot up. It's been going up, and that's as high as it was, back in 2009. So that's very disconcerting. If someone doesn't get a paycheck, even if they're likely to get that money back because of laws passed by Congress that say that furloughed workers will get their paychecks eventually, that can mean that they miss their mortgage or they miss paying other things. It's going to slow down the economy, and it's going to slow down the economy in particular places. And it's going to affect the decisions that people make. So I think we are looking for this this stress and how that is playing its way out across the economy. But let's look at the other side of the equation. Of course, one of the reasons that we have this shutdown is because the Trump administration and the Republicans want to cut back on the amount of subsidies for people's health care premiums. This is a really big ticket budget item for millions of American families who are struggling to be able to afford the cost of health care. And the cutbacks that were already made as a part of the Republican budget bill, that one big beautiful bill that passed back in the spring, these are going to make the cost for health care more expensive around the country, and that's going to crowd out other kinds of spending. So I think for millions of families right now, they're looking at what can they cut back on, and that's never a good starting place for economic growth.
All right, Heather Boucher, former White House Council of Economic Advisors, Deputy Director under President Joe Biden. Thanks so much for joining us here on Bloomberg. And Joe, the markets are also watching Argentina ahead of a key midterm election vote in the country this weekend. The Argentinian President Javier Milei trying to restore investor confidence, but also notch some political wins for his party, because it's my understanding that nearly half of the seats in Argentina's Congress are up for election this weekend. For more, we're joined now by Patrick Gillespie, Bloomberg Buenos Aires Bureau Chief. He joins us live from Argentina now. Patrick, can you just give us the top lines here? What is at stake for Javier Milei?
Hi, Tyler. A lot is at stake for Javier Milei and for Argentina right now. Beyond Milei's relatively low-profile candidates in this midterm election, you really could say that voters will be casting ballots for Milei's harsh economic policies that have delivered a fiscal surplus, his pro-market agenda and the reforms that he wants to pass after this, and of course a $40 billion rescue package from the United States that President Trump himself has conditioned on Milei's party winning this election. So what was a relatively normal midterm race a few weeks ago has now turned into a make or break moment for Javier Milei and his radical economic experiment. Excuse me.
Well, the bailout that the administration is working on, and some would check me with the use of that term, has been very controversial here in Washington. Even Republicans like Marjorie Taylor Greene are crying foul. She calls it one of the grossest things she's ever seen. And of course, beef ranchers here, cattle ranchers in the United States are concerned about Argentinian beef imports. Patrick, this money is supposed to ride on the outcome of this election, right? What if he loses?
That's a great question, Joe, and you're right to point out that this has caused ripple effects both in Democrat and Republican circles in Washington and beyond, because some of the measures regarding beef and soy have been sort of tied or related to this rescue package. But there's three pillars, basically. There's a $20 billion currency swap line that's directly between U.S. Treasury and Argentina's central bank. The Treasury is also trying to line up private financing from Wall Street banks of the same amount, another $20 billion for Milei. And then most recently, the U.S. Treasury has been buying Argentine pesos, which is a bit ironic because Milei campaigned as a president who would dollarize Argentina. Now he has the U.S. buying pesos. But all of this really relies on what has been so far unprecedented U.S. support for Argentina and its pro-business agenda. But of course, Milei's root problem is a lack of political strength. The reason why the U.S. stepped in was that 6 weeks ago, his party lost a key local election that was seen as a bellwether for the national race. So he really needs to come back on Sunday, and both for his agenda and for this rescue package.
In the final minute we have with you, Patrick, can you just give us some local context here? We have this headline on the Bloomberg terminal this morning that Milei's approval rating hit new low before the midterms, according to a new poll. What do we know that led up to this from those in Argentina?
Sure. Well, Milei 2 years ago inherited a full-blown economic crisis, and he has brought Argentina back from the brink. Inflation was nearly 300% annually during the early months of his presidency. It's now down to about 30%. Poverty, similar story. It's come down significantly. But the reason why voters are increasingly disapproving of Milei's government is that he's significantly increased the cost of living when it comes to utilities. Those have quadrupled during his time. Economic momentum has also slowed. The job market is well below levels it was before Milei took office. So there's a lot of hardship as a result of Milei's austerity policies, which he symbolizes via the chainsaw. So voters are running out of patience, and they want to see some changes in policy and direction from Milei.
With apologies to the Golden Chainsaw, Patrick Gillespie. Many thanks, Patrick. It's great to have you. He's our bureau chief, Buenos Aires. We got to do the show down there soon. Alongside Tyler Kendall, I'm Joe Matthew. We'll meet you on the late edition of Balance of Power, only here on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Definitely Friday here at Bloomberg headquarters.
Why do you say that, Carol? Why do you say that?
Getting sass from our producer, Ari. You're giving him sass.
I'm never giving sass. I don't give sass. I just get sass.
Okay.
All right. It is Friday, October 24th, 2025. I feel like October was like whew, just flying past us. We got the S&P 500 hitting a high today.
Yep, 1% on the S&P right now. The NASDAQ composite up 1.3%. We're going to have much more on the trade with Alexis Christoforous in just a minute. But a cooler than estimated inflation print that supports a Fed cutting rates. We're all in on that. Michael McKee is here. We're going to speak to him in just a minute.
Yep, pressure's on, Mike. We're going to talk about the data and the Fed policy. We're also going to check in with Katie Kaminsky at Alpha Simplex. We're going to talk Fed 2 with her, Treasury trade, a lot coming your way.
Drew Mattis, Chief Market Strategist at MetLife Investment Management, joining us on the K-shaped economy and how the consumer is not okay.
I love this. We're going to dig into that. Also, in the shadow of regional banking concerns over real estate, we get into opportunistic real estate investments in the distressed sector. We're going to do that with the CEO of Clear Investment Group. So much coming your way. Do not go anywhere. Stay with us on this Friday. First up, let's get a check on the trade and the rally underway with Alexis Christoforous.
Thanks, Carol and Tim. That cooler than expected inflation report has ignited a powerful rally on Wall Street. Investors betting the report paves the way for the Federal Reserve to cut interest rates at its meeting next week. The Dow Jones Industrial Average up better than 1% now at up 530 points at 47,264. The S&P 500 up 64 points above 6,800. That's a record high. The NASDAQ Composite gaining nearly 300 points, a gain there of 1 1/3%. Procter & Gamble reporting fiscal first quarter earnings and revenue that beat analyst estimates despite higher costs from tariffs. Results getting a boost from strong demand for its beauty and grooming products. P&G stock up now 0.6%. And shares of Advanced Micro Devices jumping here on a report that IBM can use the company's chips to run certain quantum computing algorithms. IBM plans to launch a quantum computer by 2029, and it announced that partnership with AMD back in August. Shares of AMD up now nearly 7%. And Ford's strong sales pushed the automaker's revenue and operating income well past estimates. Investors here looking past Ford's warning that a fire at an aluminum factory will dent fourth quarter profits. Shares of Ford driving ahead nearly 13%. The New York Knicks sent Zohran Mamdani, the frontrunner in next month's mayoral election, a cease and desist order for the use of the team's iconic logo in his campaign ad. Mamdani ran an ad during the home opener on Wednesday that ended by flashing the team's blue and orange basketball logo with Zohran in place of Knicks. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's the Bloomberg Business Flash. Don't mess with the Knicks, Tim and Carol.
No, oops, indeed. That's important IP, that's for sure. All right, Alexis, thank you so much. Yes, we are in a U.S. government shutdown. It's now in its fourth week. Is it 24
days, I believe. Mike, is that right? 24 days?
24?
24 days. But
Okay.
who's counting?
We are.
Well, I'm trying to, but sometimes I forget what
Well,
comes
it's
after
the weirdest
the
thing. It
latest
just
number.
feels like nobody cares. But anyway, we should point out, though, in the absence of a lot of official data from the U.S. government, we did get a highly anticipated read on inflation today. It's a bit of a welcome surprise, Tim.
Yeah, that's particularly for several policymakers who are leery of cutting rates further. Here with the data and the market and the Fed implications, we got Bloomberg TV and radio international economics and policy correspondent Michael McKee.
Isn't it kind of wild, though? We're in this shutdown.
Yes,
and I feel like in the
nobody-
past when we've covered it, our covered shutdowns, we're all over it nonstop. And it's just the weirdest thing.
Well, yesterday, the president tore down half the White House. So
I know.
It's kind of hard to know what to focus on these days. The economy is chugging along, which is probably one reason that we're not seeing as much focus on it, because people are still, we're not seeing big layoffs yet, although the number of layoff announcements came this week. And people are still, their incomes are coming in, they're still spending. If things continue to weaken, then it'll become much more of an issue.
And then we want to talk about an inflation report, too, as well. We've also got another guest with us.
Yeah, Katie Kaminsky is joining us. She's Chief Research Strategist and Portfolio Manager with Alpha Simplex Group. She joins us from Boston. Mike here in the studio. Mike, let's go back to the inflationary print, though, and really the focus of it. Look, we don't know if even we're going to get one for this month. We don't, or do we know if we
don't know. The White House suggested that we wouldn't, but
it's not definitive.
It's not definitive.
Why did we get one for last month?
Social Security. It's
because of the cost of living increase.
The cost of living increase is
2.8%, I believe.
Yeah, 2.8%, calculated based on the average of the third quarter CPIs. So they needed this last one from September to be able to put that out, and it legally has to go out by the 1st of November. So
interesting.
That's why we got that.
So not too worried about inflation right now?
No, we're worried about inflation right now.
Oh, okay. I thought this was a softer print.
It was a slightly softer print, but you know, what people were watching for was two things. One is were services prices still rising, and services prices were still rising with a big exception for home prices, the way they calculate it with owner's equivalent rent, and they almost collapsed it down up just a tenth after being up 4/10, 5/10, 3/10 for some couple of years. So that could be noise, and it is an anomaly, and we don't know. But if you take that out, then you have still regularly about the same as we've been with the service prices, and then tariffs. Used car prices dropped a lot during the month, and if you take out autos, you still have core goods prices rising, and we saw things like furniture up 0.9%, almost a full percentage point, and other tariffed goods rising in price. So it does show that that's starting to bleed through.
Hey, listen, Katie, we want to bring you into this because, if I look at the Treasury trade over this month, we've seen benchmark 10 years below 4%. It's kind of where we are, although we've had some volatility in today's trade. Bring in your read on the inflation print and what it means for the Treasury trade.
Well, this is a good question because what we've seen is a little bit of jitters around this potential CPI print, but to be honest, bond trends haven't moved that much. They've been up, then they've been back down. So there doesn't seem to be a lot of movement in that asset class in reaction to the Fed. The movement's actually much more in other asset classes like a strong dollar.
Which makes no sense, right? If we're getting lower rates.
Exactly. Lower rates, strong dollar. And then the movements today that are consistent with this CPI move are the equity market just, showing relief about some concerns about not getting rate cuts because of the shutdown, I think.
So Mike, come on in on this. Push it to next week. I mean, does that mean that we might not get rate cuts as a result of the shutdown?
No, we'll get the rate cut. The Fed
there was
has
some folks on surveillance talking about 50 basis points this morning.
No.
Not going to happen.
Who are those
Well, you want to get on
kids?
surveillance, you have to be outrageous. If you want to talk the truth, you come on this show.
His name rhymes with Tom Keene.
Yeah. No, we're not going to get 50 basis points. We'll get 25. The question is, will we even have any dissents other than Stephen Myron, who's already sort of advertised he's going to dissent every time?
Unless he gets
50 or 75 basis points or whatever. I mean, that's why they sent him there. But the Fed came into this meeting letting the markets believe in a 25 basis point cut, and there's nothing in the inflation data that's going to say screamingly you can't do that. So the Fed will just go ahead and cut rates, but I wouldn't put any bets yet on what's going to happen in December.
Katie, you were on surveillance this morning. Tim and I were listening. Were you one of those crazy kids who said 50 basis points? I don't think so.
No, definitely not. I'd say I was surprised, though, because I think the numbers did come in a little bit. I thought they'd come in as expected, so coming in a little better than expected definitely accelerated some of the trends that we're seeing. I do think it kind of relieved the market from concerns. I think the bigger shocks would be if you had any sort of shift in policy. So the less likelihood of a shift in policy is what has kind of soothed the markets right now.
There's an interesting story in the Bloomberg that caught my attention. I'm curious what you guys think about this. The bond market's movements have been suggesting a U.S. downturn for 3 years since 3-month Treasury yields first pushed above 10-year ones. Our right through on this notes the yield curve's predictive power may be sounding a false alarm this time. This is from Campbell Harvey due to factors such as massive fiscal spending and healthy finances of consumers and corporations. Do you agree, Katie?
I would have to say it is very contextual because when you look at the inverted yield curve over different periods of time, I think some of the potential inflation and other issues with policy is just kind of not necessarily means that there's a recession right away. So I think it's been sort of a false signal during this market environment.
Yeah, we should mention that Campbell Harvey is the Duke professor who came up with the idea of the inverted yield curve signaling recession. And I think there's been general consensus at the Fed and among economists since we went through the great financial crisis, but certainly coming out of COVID, that it's not reliable now for a whole host of reasons.
So ignore it.
Ignore it, yeah.
Hey, Mike, we're going to be speaking with Drew Mattis over at MetLife Investment Management in just a minute about the consumer. Prep us for that conversation. Like, lay the groundwork here. How is the consumer doing?
Well, I think you advertise it as the K-shaped economy, and
or not.
That explains kind of where we are with the consumer.
But
because
as we'll hear from Drew, he kind of argues that the K-shape, the top end isn't doing as well as people think.
Well, I think the top end is doing just fine because when you get to the higher top end, you're making all your money off of interest and dividends, and the stock market just keeps going up and up and up. It's the people who are on fixed income and low wages who are struggling now because inflation is still going up, and they're trying to make ends meet and finding it harder and harder. If you've gone to the grocery store lately to buy a hamburger or something like that. So you have this bifurcation, and the question is, how long can people hang out before they start pulling back on spending? And there's anecdotal evidence that they're starting to pull back in some areas already. Then if we get any layoffs, as some of these companies,
we're seeing.
P&G today had good earnings, but oh yeah, by the way, we're going to get rid of 1,800 people.
Hey, Katie, I want to go back to just one, about the idea of what we're seeing in equity markets versus bond markets versus the dollar strength. I mean, I'm trying to, gold, silver rally, then more recently dropping back. Do the market metrics fit together, make sense? They tell one story or no? And if not, then what does that mean?
So this is a good question. I think for me, the question has been, it's been a growth story in equities, having good GDP numbers. So you're seeing that very strong equity trend. But coupled with that, seeing also very strong gold and a weaker dollar has made me feel a little nervous about that, there's a chance that we might have an overstimulation. So low rates, high growth, and you kind of have inflation potential. I think today's print is helpful in the short term, but those are the themes that I'm seeing where there's sort of a hedge out there against, things look good, but, we need to proceed with caution. We could have inflation. We may have issues, especially with a weaker dollar. So this firm dollar is also kind of interesting to me. I think probably the most interesting recently.
All right, great stuff. Great when we can do a double dip with Katie Kaminsky on this morning, on this afternoon. She is Chief Research Strategist, Portfolio Manager with Alpha Simplex Group. Hey, we're going to stay on this. Mike's going to stay with us. We want to bring your attention to something that JP Morgan's Asset Management's Chief Global Strategist, David Kelly, said this morning, too, on BTV on surveillance. Talked about the Fed, inflation, and the K-shaped economy.
I think the Fed's going to keep on cutting rates. It's generally a better than expected report, but I think what it really shows is we have a K-shaped economy, and it's sort of a K-shaped CPI report. It is clear that mainstream retailers don't believe they can pass on the tariff increases right now, and that's what's making this inflation rate a little bit tamer than people feared.
Want to bring in, of course, that was JP Morgan's David Kelly earlier today. But right now I want to add to the mix the senior economist, actually was a former senior economist at Lehman Brothers. We've been talking to him for a long time. We're talking about Drew Mattis. He's the chief market strategist at MetLife Investment Management, joining us from New Jersey. Drew, your recent note caught the attention of our Talia Torella about how the consumer is not okay. Walk us through that.
Well, there is a K-shaped recovery or consumer. The upper end is doing reasonably well, but the question is always kind of what's the change look like? And the change for the upper end consumer is beginning to show signs of stress. Now, whether that's because a lot of the federal workers would fall in that 100,000 plus category, or whether it's something else, what we are seeing is that upper income consumers are increasingly saying that their real incomes are expected to decline over the next year. And their job separation anxiety is actually quite high, particularly relative to kind of lower income cohorts, probably because a lot of the jobs that had been being created were actually kind of, healthcare and kind of other jobs that in many cases tend to be, kind of lower income side of things. And so I think, yes, they're doing fine for now, but there are signs of stress, and ignoring them is something that can lead to trouble.
Yeah, I got to tell you, Drew, I see that anecdotally right now with people who've been looking for jobs, who have been making good money and got laid off, and been looking for jobs for months at this point. When do we, if we haven't already, how does that then manifest in data? We're not necessarily getting it from the government, but how does that manifest in data that investors can react to, Drew?
Well, I think that one way it will manifest itself is a decline in service sector spending, which we have been seeing, at least through the August numbers, which were the latest ones we had before the shutdown. What tends to happen when you have to worry about things, or when people begin to adjust their lifestyles in ways that shouldn't really be adjusted. And by that, I mean, buying a cup of coffee in the morning is not a decision that should really tax most people's brains. Or that they should really think about if they're feeling good about their job prospects or that they have a job. And what we're seeing is people are pulling back on those kinds of purchases. And when that happens, if you're not buying a cup of coffee, you're not going to buy a car. And so we're beginning to see that roll off on the service sector spending side of things. And yes, maybe people are in the upper income tier are still splurging on certain things, or maybe there's a cohort within that upper income cohort that's still splurging on certain things. But the reality of it is, it seems like it's beginning to shift into a kind of a lower growth dynamic. And of course, we can't find any of the data, or we don't have the data to know whether or not that in fact is happening.
Drew, how much of tariffs are a problem, given what we saw today, that there is some leakage in and there may be more coming? It's obviously not what was feared back in April, but how bad is it, Johnny, as Ed McMahon used to say?
And Google that if you don't know what he's talking about, because you should
Drew's
know.
old enough, he'll know.
I know he will.
I do know, unfortunately, because I am old enough. And
I meant that for the rest of the audience out there in our control room.
I do think we're going to see pass-through. I think it's going to happen. It's not going to be a full pass-through, nor is it going to lead to kind of this wage price spiral type inflation story. It's going to be a one-time adjustment, and the Fed should look through it. I was just complaining to you, Mike, though, what about all the credit card surcharges that I'm now paying for? It seems like everything went up by 3% on top of the 3% inflation rate, because every time I pull out my credit card, I have to pay a lot more to kind of just use it. So I think, once again, it's going to be something that people notice and are affected by it. But one of the things that's actually helping people right now is that gas prices are actually extraordinarily low, particularly relative to where they had been. And so we look at gas prices relative to kind of how much you have to work to get there. So how many minutes of your work life does it cost you to buy a gallon of gasoline? And when you look at it that way, it's actually, quite contained and well below where it had been the last couple of years, which is probably helping people continue to spend.
All right, we're going to leave it on that note. I know we will be continuing this conversation in the future. Drew Mattis, thank you so much. Chief Market Strategist at MetLife Investment Management. Of course, our thanks always to our own Mike McKee, TV and radio, international economics and policy correspondent. Hey, coming up next, Wall Street wary of being burned by the Malay trade again. A lot at stake, too, for Argentinians. The Bloomberg Big Take. It's coming your way on this Friday. Carol Massar, Tim Stanovic, and we are Bloomberg Business Week Daily.
Street. I'm Alexis Christoforous. Stocks rallying to records after that weaker than expected inflation report got investors betting the Fed will not only cut interest rates at next week's meeting, but could cut rates at the next couple of meetings. Strong corporate earnings from the likes of Ford, Intel, and Procter & Gamble also lending support. We've got the Dow Industrials up 535 points, a gain of more than 1%. The S&P 500 also up about 1% or 65 points at 6803. It's first time crossing over that 6,800 mark. The NASDAQ Composite racing ahead more than 300 points now. All three major indexes on track for record closes. Not invited to the party today. Shares of Deckers Outdoor tumbling more than 12% to a two-year low. The company behind the UGG and Hoka shoe brands served up a disappointing sales forecast. The company also expects consumers to be more cautious as the full effect of tariffs come into focus. The consulting firm Booz Allen Hamilton giving back 10%. The company we know relies heavily on government-related work. It cut its outlook for the year after posting lower profit and revenue. And shares of Applied Materials up about 0.5%. The largest U.S. producer of chip-making equipment planning to cut 4% of its global workforce as it copes with a sales slowdown and trade turmoil. To recap, all three major indexes in record territory. The Dow up 535 points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, Alexis, thank you so much. Well, it's going to be a pivotal moment for the Malay trade, and nobody wants to be caught on the wrong side of it again. The frantic selling that hammered Argentina's markets after President Javier Milei's party suffered a defeat at the polls last month has left global investors bracing for another potential hit in the wake of the legislative elections on Sunday. He is not, Milei that is, on the ballot this Sunday, though, Tim, when Argentinians head to the polls.
With what's at stake and why this election is important for the future of Argentina and what Argentinians think about the interest and level and support from President Trump and the whole Trump administration. This election and story, it is the Bloomberg Big Take today. With us is Patrick Gillespie, Bloomberg News Buenos Aires bureau chief. He joins us from Buenos Aires. Patrick, Milei's coalition needs to score more than 34% in the upcoming midterm elections to push through legislation to bolster the economy. Polls show support for him is flagging. Is it true these elections really could go either way at this point?
Hey guys, well, I think what's really important is that it seems like a done deal that Milei can secure a third of the seats in the lower house of Congress. That is something that investors are widely expecting. That would help protect Milei's vetoes, which have been overturned as the opposition has tried to push through spending bills recently. But what Milei's team has already talked about publicly is that they're not going to get a simple majority, which is what they would need to pass the deep economic reforms on labor and taxes that Milei has promised both voters and investors who are waiting to see how this vote turns out. So it's really going to be something of a make or break moment for Milei's economic agenda and, of course, this $40 billion U.S. rescue package coming from the Trump administration.
If it's not a make, but rather a break moment, what does it mean Monday or come Monday when we think about markets and policy or changes in policy out of Argentina?
Well, we will definitely be looking at how the sovereign bonds perform as well as the currency. There has been market speculation that the Milei administration has pushed back against. Treasury Secretary Scott Bessent has also pushed back against it, that there would be some overhaul of Argentina's currency policy. Investors have been thinking that this is a necessary change because the peso is widely seen in markets as overvalued. If Milei is not able to secure that 1/3 of seats in the lower house of Congress, that gives him something of a legislative shield and negotiating power with other blocs in Argentina, you could see a lot of pressure on the peso and on those sovereign bonds and potentially a policy change. We are expecting Monday or soon after the vote for Milei to overhaul his cabinet. His foreign minister already resigned this week. There's a new minister in place. So we expect a wider change in the cabinet that's supposed to help consolidate power and help Milei build his coalition.
You know, Patrick, we've spent some time this week talking about this $20 billion swap deal this week. And you know, it's not a monolith by any means, but how would you characterize Argentine support right now coming from the U.S. in this? I mean, this is just, how do you characterize it?
Well, I think it's a bit ironic in the sense that if you think about beyond the currency swap line, which is $20 billion, Milei campaigned as a president 2 years ago on dollarizing Argentina, and now he has the U.S. Treasury buying Argentine pesos. So it's a bit of a turn of the tables, but there's three pillars. There's the currency swap line, the buying of the pesos, and the negotiations that are still underway for Wall Street financing of another $20 billion for Milei that are meant to dispel any investor concerns that Argentina can make upcoming debt payments. It's really unprecedented U.S. support for Argentina, but of course, President Trump himself conditioned that support on Milei's party winning these midterm elections.
So then what happens if his party doesn't win the midterm elections?
Right, exactly. So there's been these new conditions introduced that we have to see, and what exactly is defined as a win. Of course, you could look at the national level, but these results are going to be coming in Sunday night, province by province. And of course, in Buenos Aires province, where a third of Argentines live, that has overwhelmingly a huge number of seats. So that'll be a top battleground, and we'll be looking at some of the key interior provinces where Milei now needs to make up the ground that he's lost, because this whole market sell-off and U.S. Rescue package came together after Milei lost the local election in the province of Buenos Aires. So if it's a worst case scenario, of course, the first eyes will be on Scott Bessent and how he reacts, and if the support is still in place.
You know, Patrick, one of the things I think we've been trying to get our head around, I don't want to come off like an obnoxious American, but it's just why is the U.S. singling out Argentina for support? What do we need to understand about the Argentinian economy or its role in South America? What do we need to understand why this is an important relationship and for the U.S. to provide support here?
Well, I think there's two key differences. One is, as Scott Bessent called Argentina a systemic ally or something to that effect. His word was systemic. And I think it's statistically hard to make the case in the sense that if the Argentine economy collapses, I mean, Brazil doesn't even sneeze next door, let alone the rest of the region. But when you think about the geopolitical relationship, there's a lot at stake in the sense that Argentina has big lithium, uranium, other rare earth reserves, copper, gold, I could go on. So that could be a key concession from Argentina to the U.S. in exchange for this financial support. And then, of course, China. China has a space station in Argentina. China has an $18 billion swap line with the Argentine Central Bank. Scott Bessent has made clear that Milei has to be committed to getting China out of Argentina without explicitly saying what that looks like in real terms. So there's a lot of geopolitical issues on the table, a lot of sort of strategic interest in terms of natural resources here, but from a statistic or economic perspective, Argentina is not systemic, neither to the U.S. nor to the Latin American economy.
And I will say the post that the U.S. Treasury Secretary Scott Bessent put out, Argentina is a systemically important U.S. ally in Latin America, and the U.S. Treasury stands ready to do what is needed within its mandate to support Argentina. All options for stabilization are on the table. That was on September 22nd, so this is going back.
It's a whatever-it-takes approach, really a Mario Draghi-style approach by Scott Bessent here.
Patrick, on that, is the support from the U.S., I mean, you mentioned rare earths and you mentioned some strategic elements, but I'm also wondering about just the politics of this and the Milei, and just the way that he and the way that the folks around him might be ideologically aligned with the Trump administration. Like they see in him, they see in that something of a kinship.
Absolutely. There's a lot of the ideological alignment behind this financial support, less so than say the economic fundamentals or ties between the two countries. Milei has been a relentless cheerleader for Donald Trump, and Donald Trump is rewarding him with this financial support now. But I think there's a case to make that politically this could be more unpopular than it is financially beneficial, in the sense that Argentines are very weary of another, say, U.S. rescue, whether it's from Washington, whether it's from the U.S. or from the IMF. That usually comes with a lot of concessions and hidden terms that people only find out about much later on. So politically, people are weary of Washington coming to the rescue for Milei, and And of course, this has had a big ripple effect on Trump. There's been beef farmers, cattle ranchers, soy farmers that are very unhappy about the U.S. providing so much financial support, especially during a U.S. federal shutdown. So I think there's a lot on the line, certainly for President Javier Milei, but also as well for the Trump administration, and in particular, Secretary Scott Bessent.
I mean, the cards are stacked in a tough way. I mean, a deep recession early last year. We've seen a tepid recovery in Argentina, and I'm looking at your team and the reporting that's gone out. It says apart from some inflows into Argentina's most lucrative industries, agriculture, mining, oil, and gas, foreign investment has been almost non-existent. If anything, multinationals have been selling off assets and repatriating money. So HSBC, P&G, Procter & Gamble, Mercedes-Benz, and Telefonica, among others. I mean, it's a really tough situation. So people on the ground kind of mixed in terms of whether or not President Milei's policies are going to make a difference? And if not, then, what is kind of the policies that will go into effect?
Milei has not delivered on his pledges to provide robust economic growth in Argentina. He has brought Argentina back from the brink. Annual inflation was near 300%. It's now 30%. Poverty is also at its lowest level in several years. But that's come at the cost of significant austerity policies. Electricity bills in Argentina have quadrupled in the last 2 years under Milei. The job market is still well below the levels it was when he came into office. Retail sales are down for the last 6 months in a row. So clearly, from a consumer perspective, from an employment perspective, the economy hasn't delivered on the policies that Milei did. And I think there's also a lot of frustration with the corruption scandals that he's faced. He's had 3 corruption scandals, both involving him, his sister, and his top candidate in these midterms, and that candidate had to drop out of the race. They all, of course, deny any wrongdoing, but it's dismantled an image of an outsider who's here to, say, drain the swamp. So from an economic policy perspective, he hasn't delivered on the growth, and the corruption scandals have certainly put a big dent in his image.
How is the opposition using that to their advantage in Sunday's election?
Well, they're using I think a multi-pronged strategy. They have come at Milei with strategically timed corruption scandals. They were the ones who leaked this information to the public, and of course the harsh austerity and the unemployment that people are dealing with has only sort of revived a bit of nostalgia among a certain part of the swing population, swing voters in Argentina, that the previous government or Peronist movement wasn't so bad. So we've seen some of the Peronist leaders who are, again, I should stress, are not on the ballot. Some of their popularity ratings have gone up as Milei's have gone down. We can't speak about election polls at this stage, but you clearly can tell that the corruption scandals that were strategically timed by the opposition have had the intended effect of denting him right now.
All right, Patrick, thank you so much. Patrick Gillespie, he's Bloomberg News Buenos Aires Bureau Chief. Check out our Bloomberg Big Take story. It's on the Bloomberg terminal at bloomberg.com/Big Take. A headline crossing Axios reporting the United States, the USDA says it will not use emergency funds for food stamps. We know with the shutdown, those benefits have run out.
It's 2:40 on Wall Street. I'm Alexis Christoforous, and investors are celebrating that cooler than expected inflation report for September, betting that report is going to pave the way for the Fed to cut interest rates at its meeting next week. The Dow Jones Industrial Average up 534 points now at a record high. The S&P 500 gaining 65. The Nasdaq Composite up nearly 300. All of the indexes are actually at record highs right now. General Dynamics stock in the news. The aerospace and defense company posting higher quarterly revenue and profit driven by increased orders for business jets. Shares of General Dynamics up 1.3%. We've got gold's recent record rally helping Newmont Mining's third quarter sales and profits beat the street, but shares are coming under pressure today after its guidance disappointed. Newmont Mining down 4%. And shares of the Boston Beer Company are higher today after the maker of the Sam Adams and Truly brands raised its profit guidance for the year as it sees fewer headwinds from tariffs. Boston Beer up 2.6%. By the way, Sam Adams has a new beer. It's so strong it's illegal to buy in 15 states. Utopia's 2025 is called an extreme beer with a 30% alcohol volume. It also comes with an extreme price, $240 for a 12.5 ounce bottle. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
Yeah, with a name like Utopian or whatever, like, yeah.
Okay,
It's
you
gonna
ready?
Be a little heady. Yeah, I'm ready. I'm ready for a lot of things this Friday. Interesting couple of weeks. We've talked about Zion's, a couple of regional banks. Zion's tumbling last week. The firm said it was the victim of fraud on loans to funds that invest in distressed commercial mortgages. After the collapse of subprime auto lender Tricolor Holdings and auto parts supplier First Brands Group, some investors said they are becoming concerned about cracks in the credit market. And then, of course, there was JP Morgan Chase CEO Jamie Dimon.
You can't forget what he said last week, that there's really just one cockroach, which some private credit executives saw as a barb aimed at them. Blue Owl Capital co-CEO Mark Lipschultz responded by saying banks should look at their own books.
All right, we've got a view on the distressed market, a specific area. Back with us is Amy Rubenstein. She's CEO of Clear Investment Group. It's Chicago-based, specializing in opportunistic real estate investments, specifically in the distressed mid-sized multifamily sector in mostly secondary and tertiary markets around the United States. She is, lucky for us, in studio. How are you?
I'm great. Good to be back here.
Well, it's great to have you back here. And I'm just curious, big picture, the environment. There's been a lot of stuff over the last week. Tell us about the distress market, certainly the area that you play in. Are there more distress situations / opportunities out there for you?
Yeah, there's a ton of opportunity right now.
Is there always, or is there more than there have been?
I will say when we're in buyer's markets, we see more distress. Right now, we have seen a lot of distress over the last couple of years and continue to see it. Although I think we might have bounced off the bottom and might be starting to come back.
Why do you think that?
Well, I think that the drop in interest rate that we recently had was a little bit helpful. That was only 25 basis points, but what we've really been seeing is that bank spreads are coming in as well. So while we only saw a 25 basis point drop from the Fed, we're really feeling something more like a 100 basis point drop based on the fact that banks are coming in.
That makes it, some situations, not so stressful.
Well, it doesn't
or
help,
does it?
It doesn't help people that have existing loans that might have gone up on interest rates. But as people are refinancing, we are finding a better lending environment than we were about a year ago.
So talk to us about a deal that you've recently done.
So we are doing a deal right now that we're getting a spread. We're actually assuming a loan that is being purchased at debt. So we're seeing a lot of that in the market right now, where you do see distress from people and people are walking away from their equity in order to save their personal guarantees.
And that's more than you saw maybe 3 months ago, 6 months ago?
It happens to be that we've had our last 5 deals that we've looked at have had loans where we're assuming the loan at debt, and the sellers walking away, losing all of their equity.
Why are sellers walking away?
Well,
what are they not able to do that then you can come in and do?
So what this particular lender is doing for us is dropping that interest rate. The lender doesn't want to lose any of their equity in this.
Exposure, yeah.
So they instead are saying, all right, we know that things were a little bit off. We know that interest rates were high, and we know that that seller or that owner was struggling. Here we have a new borrower coming in who's going to be solid, who's going to maintain the integrity of our investment. Let's give them a little break for a little while so they can get through this period.
Are lenders doing that without a transaction going through? Could that seller have gone to the lender and said, look, we can't handle this rate? Can we renegotiate so then you don't have to bring someone new in? You know us.
I do think that happens as well.
Okay.
So yes, I think that's a possibility. And I think that's something that borrowers need to ask for. And I think when they do ask, they're often able to negotiate something with their lender.
Amy, how many of these deals have some kind of private credit in them as well? Or is it separate?
So I think that is the reason that spreads have come in.
Okay.
Because private debt really flooded the markets. And while banks took a step back, I would say over the last couple of years, banks kind of pulled back, wanting to see how the market was going. And then all of this private debt flooded the market, which is what really caused when banks wanted to come back in, beginning of 2025, they started to enter the market and they saw more competition than they had before. And so then what happened is they started to bring in their spreads. And that's what brings us to have that feel of a much lower interest rate than just that 25 basis points.
So give us an idea. You do work in multifamily. Give us an idea of the types of properties or the regional variations where maybe these deals are happening.
Sure. We have a deal under contract right now in St. Louis, a deal under contract right now in Tuscaloosa. So we're talking about, those are secondary and tertiary markets. We're also in DC, so that's a primary market. So it really depends on where we're finding the right deal.
Where are you not seeing deals because the market is so good?
So some of the places we won't buy are places that got a little bit overinflated. So some of those growth markets that are now starting to show some declines.
Austin, Texas?
Sure. Austin, Nashville.
South Carolina?
Yeah, absolutely.
What about California? There's a lot of questions about the future governor, who that is, a lot of questions about regulations and red tape during the next administration.
Absolutely. We tend to stay away from California right now because we just don't get cash flow there. So that ends up being an appreciation market. And so we never really find that cash flow to be able to go into that market.
So would you go as far as to say, what we've seen over the past few months and just the past week, that, Tricolor, First Brand, there have been knock-on effects when it comes to financing as a result of this, or no?
As a result of?
Well, on any of the real estate financing deals, have what we have seen with these and nervousness within the credit market, has it had an impact?
No, I actually think that we are seeing enough money in the market to be lending. So I don't see that there's an issue of borrowing. I see that there are fundamentals that are still strong, although even in September, I'm sure everyone's kind of watching this drop in rental rates, right? September was that first month where we really saw a big drop, I think 30 basis points in just that month alone. And if you kind of pull it apart and look at it, what's causing this? If you dissect it, you're getting about about 50 basis points drop in lifestyle renters. So renters who are choosing between home ownership and renting, and that probably is coming from people wanting to go back into the home market. You're only getting about 10 basis points of drop in renters by necessity. So you got to dissect that number.
How are delinquencies with tenants right now?
That's an interesting question. We have seen that delinquencies and evictions have been a higher trend than usual, but that hasn't been just as of recent. We've seen that over the last couple of years.
So that hasn't changed at all in the last 6 months or so?
I haven't seen it in the last 6 months that's growing. It definitely is a trend that I think started post-COVID.
Who's struggling? Who are those people in those properties? Just got about 30, 40 seconds here.
Yeah, well, the rents are staying stronger in these C-class assets, but I think it's also that lower income zone that is struggling more than the higher brackets.
Are you talking recession at all, or just no?
No, we're still seeing things being very strong as far as employment. We're
Sounds it.
still seeing tenants come in that have qualifications to rent.
Well, listen, you're the perfect person to check in considering this environment and the conversations we've had over the last week. Amy, thank you so much. Thanks for coming in studio.
Thanks for having me.
Yeah, great to have you here. Amy Rubenstein, she's CEO of Clear Investment Group, joining us right here in studio. When we come back, a check on the trading day. We've talked about the S&P at a record, but we're going to get into some of the stocks on the move.
this Friday's session.
A lot of them are moving higher today, 0.9% to the upside right now on the S&P 500. The NASDAQ Composite up 1.3%. The Dow up 530 points. That's 1.1%. You're listening to and watching Bloomberg Business Week Daily.